STT hike, I mean, I think overshadowed everything else. It was a pretty pragmatic budget, focus on the long term, staying the course, did not let the fisc slip, etc., etc. But I think the one thing which markets were expecting, along with everything else, which is the pragmatism, given that it's a tough place that we find ourselves in. The budget is tight, not very much money, not very much leeway to spend in that sense. So all of that was fine. But I think what was expected was some help on the equity taxation front, perhaps at the margin. But what was absolutely not expected was it going in the reverse direction, which is the STT hike. And that's why that's what I'm saying, that pragmatism in the budget perhaps overshadowed, at least yesterday. But let's see, let's pick it up from there, right? Now, the numbers are all on your screen. FY27 budget spending growth and CAPEX has been a focal point. So defense 18%, railway 10%, power CAPEX up about 18%. And these are healthy, good, strong numbers in that sense. The one thing I picked up from conversations with many across the board, post markets, etc., as well, is that the data center investment could be a big thing. It's a 21-year tax holiday. We'll talk more about this. I mean, in terms of what this can do, what this could mean for FDI, large amounts of FDI to come in. And remember, I mean, you know, with something like this, 3 or 4 players globally control 70–80% of the data center market. So you're not talking to hundreds of companies. But these companies have the ability to pump in, $100–200 billion. So this is something which came out as a piece of, positive, something new, unambiguously, and also which, of course, addresses what's happening with the big AI boom globally. Now, STT on F&O, of course, the biggest surprise, by far, as I said, negative surprise. No offset from capital gains tax. However, the mood, I don't need to repeat that. And on the back of it, and remember, yesterday, FPIs were not there in the market. It was just us, right? But because FPIs were not there and there today, we'll see if there is some selling which starts to come through. If you look at the cash market numbers, the local investors also sold. I would imagine, I mean, that's, of course, also on the back of this disappointment, but also perhaps a little bit of anticipation of what FIs may do today, FPIs may do today. So that's where we kind of find ourselves at. Now, the other thing which was not there yesterday, along with the international markets and FPIs, was bond and rupee markets. So bond markets will open, rupee markets will open, and watch it at 9 o'clock. And I feel it's possible, bond deals perhaps inch up at open, 5, 6, 7 basis points, and perhaps the rupee could be under a little bit of pressure as well. So, again, something to watch out for. The worry here, especially on the bond market front, is the gross borrowing number, which is, of course, higher than what markets expected. So, I think 915 equity, but I think before that, both bond yields and equities should be in focus as well. Just a few other things. Auto sales numbers for the month of January are strong, and we'll get more details company-wise in a little bit from now, but this is good to see. Gold and silver prices, Manisha tells us, are, because remember, the last close, of course, was on Friday. International close was on Friday. We were trading here yesterday. And in Asia this morning, gold and silver prices are lower. But I don't think there is a big correction after yesterday's big sell-off in gold and silver prices, because if you look at parity prices in rupee terms, the market here closed lower than where international prices closed on Friday. So this morning, as we opened the ETFs and the trading on physical front, the MCX market, I don't think there is a big down leg, despite the fact that, in spite of the fact that gold and silver internationally is lower once again. Later in the week, I mean, there's the RBI decision which will come through, and I think it's largely expected to be on hold. But I think it'll be interesting to see, especially because the RBI expected to be a net buyer of bonds this year, and we'll have to watch their views on rupee, etc. So commentary, I guess, more important than the action where they expected to stand pat. I'll just tie in the levels here and wrap it up. So Nifty is back in the channel, big intraday swing, right? So we're back in the channel, and the downward sloping channel, we broke above it on the upside. And we are, by the way, we are now closer to the lower end. It's a big whiplash yesterday, and we are now closer to the lower end and then to the upper end. The channel support is 24,650. We left off at 24,825. Let's move on. Let's put the levels up, please. And 24,650 is the first support. If 24,650 breaks, which is the channel support, the August low comes into view, which is, I think, 24,337. Yeah, 24,337 is the next support, if you can put that up as well. And so these are on the downside levels to watch. On the upside, the resistance is 25,170. And I think that's where we find ourselves at. Remember, for financials, for the Nifty Bank, etc., I'm not putting out levels. It'll also depend in a large bit on the bond deals and how they open up, because it'll impact Treasury gains and Treasury. I mean, on the Treasury front, it's going to be a big mover this quarter. So we'll sort of get to it as we go along. GIFT Nifty will come up on your screen as we open up, and we'll give you a quick sense of where we are starting. It's 10 points, so neither here nor there in terms of very, very measured kind of start. I guess still watching for what foreigners will do, because that we'll only find out by about 9:15 or so. And of course, before that, the bond and rupee market start. Positioning and how does it look? Nigel, over to you.
Well, one quick point. The Nifty ended down close on 2% yesterday, which was budget day. And this was as bad as what we saw in 2020 when the Nifty ended down 2.4%. But guess what? 1 week later, we were actually up 3.5% before COVID took over. And that's when we had that big sell-off out there. So that's the data point that I'm clutching onto, that maybe, in fact, yesterday we did position ourselves for a manic Monday, but may not happen. Let's see how that goes. Well, looking at the Nifty intraday chart, clearly, yesterday the domestic players were definitely bracing for a very, very bad Monday. So we'll see how that goes, because there was a lot of selling that we saw from the DIs itself. DI sold close to around 700 crores. That's something that we haven't seen. And FIs were virtually absent in trade. But in the futures market, on index futures, there were short positions that were added close to 9,500 contracts, with their short positioning at around 88%. I was looking at the F&O data, and the clients on stock futures, they unwound some long positions. Close to around 45,000 long contracts is what they unwound. And that's something I haven't seen in a while. So there was some unwinding of longs that we saw from the domestic participants, coupled with selling in the cash market. How does the positioning look on index futures now? Well, clients, they are net long, 1.3 lakh contracts on the long side, while the FIs, they are moving towards extreme levels at around 2 lakh contracts on the short side. So that's one data point. When the FIs are so aggressively net short, and you have the markets that have already corrected, in a jiffy, we have corrected what, 26,200 to around 24,800. That's a sharp correction that we have seen. The other technical factor that I'm looking at is the way we have stretched in terms of the PCR data, because the PCR is at around 0.6 or thereabouts, which is the lower end, and normally this technical indicator indicates a bit of a bounce. So the PCR at the lower end, the FI is aggressively net short. The bulls will be hoping that both these two factors play in their advantage. The call writing, though, continues. 25,000 call aggressive writing is what we saw in yesterday's trading session. So let's give you the levels then. This market has turned into a sell and rise, and the structure itself has been broken. But I'll be looking at important support levels. And I think the 24,400, 24,500 level is very, very important. It coincides with yesterday's low, which was ballpark around 24,570. And even the low that we saw on 30th of September, when we made that low of around 24,588 or thereabouts. So holding on to that 24,500 is an important data point. Otherwise, we're bracing for a sharper correction. The Nifty Bank as well has pulled back considerably from around that 60,000 odd mark, which was just a couple of trading sessions ago. So the 100 DMA is now a reference point at around that 58,000 odd mark, and yesterday's low at around 57,780. You don't want that range to break on the downside. So we're positioned for a weak trading session. Let's see whether or not that happens. But my gut is we do see some kind of recovery from the lows, because yesterday it appears that we actually overextended ourselves on the short side just in the near term.
Okay, so the PCR is at oversold levels of 0.6. The auto sales numbers are good. And plus, crude prices have also come off from levels of $70, $71. It's down to about 67, 68. But let's invite Samir. Okay, before that, the futures and options tax was hiked, and it stumped the Lal Street. The Sensex and Nifty posted its biggest budget day decline seen in the last 6 years. So before we get our experts in, listen in to the Revenue Secretary explaining the rationale behind the STT hike.
If you look at the volume of the F&O, if you compare it to the underlying securities market volume itself, or the size of the GDP for that matter, it is too large for it to be considered desirable. It looks to be fairly speculative, which is not a good way to take it forward. So in some way, this increase is essentially meant to address that kind of, possible risks that may be involved in this highly speculative side of the market. With no impact in the volume, if the volume remains the same, put together, it may fetch us around 15,000 crores or so.
Samir Arora is with us, founder and fund manager at Helios Capital. Samir joined us yesterday morning as soon as the finance minister budget speech ended. Samir and I sort of posted that later last night, and really lots of comments, mostly thanking you to kind of sort of that you expressed what a lot of people are feeling. So Any changes in the mood, thought process?
So
As I
let me
said, budget
explain.
plus one.
Let me explain for everybody's benefit.
Yeah.
So the point is, I think that the market participants and even the government feel that the market is just dependent on other sectors. So, when the, say, Mahindra and Mahindra CEO will come, he will talk about how the budget has helped the auto sector. But if in that budget, the help had gone to quick commerce sector, then the Mahindra and Mahindra CEO will say it's an okay budget, bad budget, whatever. The point is that we should look, and the government should look, and the system should look at the market as an independent sector also. In addition to saying because it helps data centers, it will help the market. Because the market has many other factors, for example, taxes, FII taxes, liquidity, and relative this market versus that market. And so when the market is bad, like say today the textile sector is bad because of US tariffs, then the government says we are going to help the these textile companies with whatever, either cheaper loans, this, that. Currently, in the last 1 year, the Indian market has done very badly. And look at it in dollar terms or more, look at it in euro terms, Swiss terms, because maybe X percent, 20, 30, whatever percent of the people might be coming from Europe and Switzerland, and they would have lost more than 20% on currency alone. So in that context, it should be at least accepted, recognized, maybe 5 lines should be said that, we are keeping a watch on this, and if it goes beyond a point, we will do. In that context, to put a charge, even if it is to squeeze liquidity of by the way, if you see me on Twitter, hundreds of times I have said that STT should be increased on futures and options, but always accompanied by a corresponding lowering of either capital gains tax or lowering of STT for cash or doing something. So that's why this one is that we are not accepting the fact that if you get, say, $5 billion through some FDI with doing hundreds of things, you can get it in 1 hour with the FPI guy if you understand the power of the market. The FPI guys or FII guys can put 5 billion in a month or in a week, and all they need is a little bit of recognition of their role and the fact that this money is easier to get. It funds Indian promoters. All it needs is fairness and a little bit of recognition of the role of stock market per se itself.
Samir, we played out the Revenue Secretary soundbite, right? And Shireen spoke with him.
Yeah.
Now,
yeah.
that you just played it before we came to you. What he said is, this is not to raise revenue. This is to...
I saw it.
Yeah.
I saw it.
This is to...
But the fact is now you got 15,000 crores, so please give it to the other side.
I am asking you whether this is actually even... Because it seems like it's kind of, they're taking a stance. So it's ideological in that sense, that we want to curb speculation.
I don't myself, know. By the way, I myself used to say it, that it is too much. I agree.
Okay.
But you see, you need it in a certain environment.
Yeah.
You can't have it in an environment where India is massively underperforming, and primarily because the stock market is doing badly relatively and all that, and FPIs are leading. You need a certain time for that. And also, this gives the impression that the market itself is not of importance. And I am saying that the market should be seen as a separate this thing, and I am the self-appointed representative of the market or of FPIs. But I'm saying the market can solve so many problems. The market is like an ad. It's an ad of the country. If the world sees that the market is down and the currency is down, without looking, they think that the budget is bad, which is what I keep recommending this book, The Halo Effect. The price also determines many things. And then, therefore, you will postpone things saying, no, that means nothing has changed. Everything changes. And why should we be, and it's, some of it you may say, we are overvalued and all, which I don't believe too much. Some of it is because we have extra taxes, extra STT, etc., which in bad time comes out. In good times, nobody cares because it absorbs, the fact that the performance.
You don't mind paying a little bit more. Yeah, you don't
mind, but you say it doesn't matter because overall. So what I'm saying is, it is for these times, and even now you don't have to do it.
Yeah.
But please say it that, we are watching this closely and we are going to track it and, we are not letting it. Everything helps. But at that time to do an STT is like saying we don't care. And that is the negative part. Not so much that whether what is happening in EMS companies or what is happening in defense, obviously. And by the way, we still own all those. By the way, even yesterday, of course, before the budget started, we bought a lot for our FPI account. Some of these which actually did okay. But anyway, so the point is, nobody's walking away. So this idea, oh, if you don't like it, go to another country. If you don't like it, how come the market went up in 24? That's not the point.
Yeah.
It's like the textile guys want their relief, and all the time the auto guy says don't open to Chinese competition. We are saying please look at our market as one more independent sector, and not only that, if other things are doing well, this market will do well because there are so many other elements over and above.
Yeah, Samir. I'm
liquidity, tax rates, commission rates, hundreds of things. Yeah.
I'm paraphrasing you. Government should at least give verbal support to markets, if not in action.
No. Verbal first, and then if needed action, not only verbal.
No. I want to get
that. But definitely not hurt the market at a time when it is anyway being isolated in the world as being a poor performer. Mostly we might be last in the world this year or something like that.
100%. So what will FPIs do now today? That is a big question. Will they become...
The thing is, FPIs were already selling, which is why I was saying yesterday, this cannot change it now. How will this change it? And also today, of course, the world is bad and all that. So I would think that FPIs would sell. I don't know. Because I'm a long only guy in that, and the long short, I keep doing various things. We actually, as I said, bought yesterday also, but okay, all before the budget. But what I'm saying is that I would think that because they were selling, in that context, at that time, we should not be doing things which are negative, because this means they will not change currently. Now, after 5 days, 10 days, 20 days, if there is a US deal or something which changes the sentiment for India relative to other markets, then it'd be different. But right now, how will that momentum stop?
So, Samir, I get the fact that you would have wanted an offset. But just analyzing the impact of STT standalone, are we over worried about the impact of it drying up liquidity in the market? Because in the past also STT has gone up and the overall market has gone up and we've managed to absorb it.
So I would think that all these big guys who come on your channel should worry. I am the smallest mutual fund and a small FII. So if it is good enough for all these guys who like it, then it's good enough for me. So I don't care about the liquidity part, basically because we are smaller than all the guys who don't care about it. So it's okay.
Okay. And so now that there is an STT hike and there are no incentives for FIIs, since you are the representative for the FPIs, self-appointed representative, does India need a higher equity risk premium, to your mind?
So right now it does, because the currency has come in and created a big problem. Another thing is that even in the days when, in the last 1 or 2 weeks, when the US dollar weakened a lot overnight, even then we used to open 10 basis points down and 20 basis points down while the rest of the world. And by the way, if you look at it in other currencies, it is dramatic. It is very, very, that's what I keep saying, that, it's embarrassing. I have a call this Friday with one European current investor. Now, how to explain? We keep saying we are a dollar fund, this, that, but we know that they are basically euro investors. And how to explain that, hang in there for 2 more years, 3 more years, because last 2 years they would have lost, if we look at in their currency, maybe 20% on currency alone. These are very serious issues where, something had to be done. So that's why it's like, as I said, the point is, if in any other sector there is something bad happening, then temporarily the government helps. Like it temporarily reduces or increases some duties or reduces some import duties. It temporarily says, I will give textile industry lower cost loans. It had to temporarily, if not for permanently, help.
Yeah, no, 100%. Anything on the back of this budget to do this way, that way? Single stocks, anything? Samir?
So right now, we still haven't had a proper meeting with our analysts. This was my impression on that day of the instant this thing. So we'll see, but broadly 1 or 2 days. So definitely we're not going to do anything on the long side for sure, 100%. Because I think the market will dominate rather than any one stock that may have done better. By the way, yesterday, even after budget, we did, I remember now, for that same account, we did buy one stock, which is 197. But again, I'm not buying more today.
You already own it in that sense.
Yeah, but yesterday for that other new FI account, I'm just saying that even after the budget, we were buying. So it's not that everything completely stops.
Yeah.
But what I'm saying broadly is that the market needed a bit of hand-holding support, words, and actually some action, maybe, or promise of an action, at least if things go worse. And also to recognize that people are paying taxes in rupees and then losing on the currency. Somebody has to accept it and not say that because auto sector will do well and because defense sector will do well, therefore the market will automatically do well.
Right.
That it does most of the times in a steady state. But because of these extra frictional costs, which are now only in India primarily related to FPI taxes and now very high STT even in general,
Right.
that at some point you need it back and forth. That is what it is.
Okay, well, you're in a holding pattern. Wait and watch for the next 2 days. Samir, we'll speak to you again, but thank you so much for joining us joining us on the day of the budget, and of course joining us now as well. It's been
I think Samir is sounding a little more upbeat today, actually, and at least some tinge of a green coat, at least a little better, Samir.
So I matched it with my green new specs.
Super.
And also, of course, what I want the market to still be.
And you deployed some money yesterday. That's why I'm saying a little bit more optimistic today, this morning, with those green specs, green coat, and hopefully green market later this week.
And an orange shirt.
And I'm sure, Samir, the advice is being heard and perhaps hopefully acted upon as well in the relevant quarters. Thank you very much. Appreciate it. Well, I think that's Samir Arora, and so that's the view coming in. It is what it is, right? Let's just quickly run you through interactions which are lined up over the next 2.5 hours or so before we go any further. So at 8:35, Harshit Kapadia will take a look at the infrastructure, capital goods areas. Defense, of course, stocks all sold off, but they had done well going into the budget. 9 o'clock, we have Rajesh Baheti, STT, capital market impact coming through. We'll ask him what is that. 9:20, S. Narain of ICICI Pru. AMC is one of the largest money managers in India. 9:30, I mean, I think that's a conversation everybody wants to hear once the budget is over. That is with Neelkant Mishra. On the equity strategy side, we have none other than Rhythm Desai joining us at 9:50. That is going to be a big one that you don't want to miss. We, of course, also will focus on individual company earnings. In that sense, Chola will be joining us as well. 10 o'clock, the management of Dixon. There is, of course, increase in allocation towards the EMS space to 40,000 crores from 26,000 crores earlier. Saurabh Gupta, CFO of Dixon, and towards the end of the program, Latha in conversation with CNBC TV 18 Citizen MPC, head of the monetary policy. That is later this Friday.
Welcome back. You're watching Bazaar Morning Call, and moving on now to the individual stocks that you need to have on your radar this morning. Our research team is standing by with the top stocks to watch for the day. But Ritu, first up, it's over to you on the budget and macros.
Well, Reema, overall, the street reaction to the union budget is largely pragmatic, not very excited, not really disappointed, but clearly calling it a very cautious consolidation-led budget. Now, Morgan Stanley says the budget balances debt reduction with growth support, but consolidation is at the slowest pace that we've seen since the pandemic. They also flagged that the strong semiconductor focus, which you saw at the very start of the speech, is perhaps a strategic pivot for India as well. Deutsche Bank calls the stance conservative and credibility enhancing, and HDFC Bank sums it up simply foundational, not fireworks. They say the fiscal math is pretty cautious and it is broadly credible. Nomura also echoes that sentiment, saying it is no big bang budget. Citi says overall it is negative for brokers, for exchanges, PSU banks, and positive for select industrials, particularly defense, OMCs, cables and wires, etc. For CLSA, it says overall again positive for defense and EMS stocks, negative for PSU banks because of that large borrowing. Bernstein again says no reason to alter its 12-month outlook based on the budget, even with the recent market decline. Now, on growth, the street believes the assumption of 10% nominal GDP growth for the next fiscal, it is a tad too conservative. HDFC Bank says its own estimate is about 10.5%. Axis Bank also says the actual outcome could be much better than what the government is projecting. And Deutsche Bank says the growth map is credible, but Bernstein adds the budget has only delivered what was feasible within the limited flexibility it had. Now, on consolidation, most do see the glide path slowing down. So Morgan Stanley calls the numbers realistic but very gradual. And HDFC warns that the gentler debt reduction we are seeing now may require a much faster tightening later to get to the 50 to 51% debt to GDP target by FY31. Deutsche Bank sees the risk of slightly higher revenue spending and some capex slippage as well, given the past record. And Jeffrey says a marginally higher deficit can put pressure on yields. Axis points out that the pace of fiscal consolidation has slowed down, and without stronger disinvestment, which is a challenge, further consolidation can be difficult. And finally, borrowing, the big bond market concern. HDFC flags that while the net borrowing is as expected, gross borrowing at 17.2 lakh crores is far higher than market estimates. They warn that can push the 10-year into the territory of 6.8% kind of a range in the near term. Deutsche Bank and CLSA also say this heavy bond supply will weigh on the market sentiments, and Citi expects continued RBI OMOs to manage liquidity and the yield. So to sum it up, steady growth support through capex, conservative fiscal math, positive for defense and industrials, but bond markets, they could feel the pressure first.
All right, Ritu, thank you very much for that. So that's the D Street verdict in that sense. Well, let's go straight from macro top down to stock specific stuff, right, in terms of what will move. And it's always, budget day plus one, day two. There are these individual movers and shakers. Vivek is here with what's on his radar. Vivek, morning.
Well, good morning. That's right. So, we've called out the top 10 list of sector stocks that we have to keep on our radar on the back of the fact of the budget speech. The first sector, of course, has to be the IT pack, a relative outperformer yesterday. Reduced tax incidence on buybacks, both for promoter as well as non-promoter entities, as well as rationalization of the tax incidence for corporates as well as non-corporates holding these companies is something that is seen quite positively. One clear beneficiary is the defense, the roadways as well as the railways pack. Core capex has positively surprised. Core capex growth at 14% versus 16% in FY26 budgeted estimate. FY27 budget too for the entire pack has seen higher by almost 8 to 11% versus a flat growth last year around. Defense budget is up 18%, so expect the entire set of stocks to remain in focus. The third set of stocks will be the power financiers, PFC as well as REC. They are planning to restructure both of these entities. Analysts estimate a merger will help PFC go ahead and reduce the holding company discount it currently suffers from. Keep an eye out on the entire pharma pack. The Biopharma Shakti scheme has been given a strong outlay of close to 10,000 crore rupees. Merchant banking in terms of Paytm as well as PhonePe, they have gone ahead and reinstated the UPI incentives at 2,000 crore for FY27. The entire EMS pack will be in focus. They've gone ahead and increased the outlay to 40,000 crore for the electronics component manufacturing scheme versus last year's 22,900 crore. The entire textile pack will be in focus. three key schemes announced over there: integrated textile program outlay with 1,500 crore budgeted for that, mega textile parks, as well as Mahatma Gandhi Gram Swaraj initiative. And the last positive set of stocks will be the data center initiative that's been announced. Anantraj Netweb Lodha will be in focus, close to 20-year tax exemption for the cloud service providers. Now, coming to the set of negatives, you can't look beyond the exchanges, BSE, Angel One, Nuvama Wealth, Grow. Remember, HTT on futures has been increased from 2 basis points to 5 basis points, and from 10 to 12.5 basis points to 15 basis points on option premium. For BSE, almost 60% of the revenues come from this particular segment, so it'll be interesting to watch whether there is further downside today. Dixon Technologies, one stock from the EMS pack. Remember, mobile PLI has not been extended, and PSU banks will remain in focus. Higher than expected gross borrowing could lead to treasury losses that these companies could face, and also lack of clarity as far as foreign ownership limits could also weigh in on the stocks today.
Okay, all right, Vivek, thanks a lot for that. Well, let's hop across to Manisha Gupta, who's joining in to tell us all the action she's picking up from the commodities market. Morning, Manisha.
Morning, Nigel. Thank you for that. Well, the sell-off has continued for a second straight day today. Friday was some kind of a deluge. You saw a complete sell-off happen in many of those metals. And today there's a follow-up selling that we are looking at in the Asian market. I'll start with copper because we've seen nearly 2% of a decline coming in for that one right now. If you look at from its all-time highs, copper has declined by 11% from last week's all-time high. Well, this is the speculative rally that we saw in gold and silver and copper, in various other metals as well. What has happened is, one, the rally has met with resistance. There is profit taking coming in because there was overheated condition in the market. Second, you have seen the dollar index gain quite strongly, whether it is about the new Fed chief or the fact that the Japan Prime Minister has said that weak Japanese yen works in the favor of exports therein. The third thing really has been about the Chinese selling. That is where markets believe the most froth really came in from. The sentiment change that has come in from China also has led to a lot of decline. So whether it's about gold, which is down 5% right now, silver after declining 36% on Friday is trading 5% down right now. And most metals are down anywhere between 8 to 12% from their all-time highs in previous month.
All right. Manisha, the rupee, when MCX opens today, in rupee terms, will it reflect this correction or I think the prices kind of closed lower than the Friday kind of close. So it's kind of adjusting for this fall this morning, gold and silver?
It is. Because yesterday international markets were shut but we were open, and there was a sense that the lower circuits would perhaps still continue. So we've seen a further decline than what the international markets have done.
Okay. All right. So, I mean, it kind of compensated a little bit to in terms of what we are seeing right now. Manisha, thank you very much for that. It's a story we'll continue, of course, to follow. Lots of interest. I mean, equity is one, but commodities, last 48 hours of market trading has been phenomenal. We take a quick commercial break here. Dharmesh Kant of Chola Securities with us on the other side for some fundamental stock conversation.
Welcome back. You're tuned into Bazaar Morning Call, and we've got a market to contend with, barring the negative sentiment that we've seen yesterday. Dharmesh Khan joins us on the show. Hi, Dharmesh. Good morning. Good to see you win. Well, it seems yesterday there was a bit of an overreaction on the downside, at least because of the sentiment hit that we got. What's your view? And did you spot anything that was positive and that in tail would, force you to go ahead and buy a couple of stocks? If you could name 2-3 beneficiaries of Budget 2026.
Yeah, good morning, Nigel. Thanks for having me for the show. So if you recall yesterday's conversations around the same time, I have pointed out that spending is what is more critical in the budget. Of course, allocation does matter, but it's more to do with spending. And spending was good this time around. Even the capex for the government has done 10,95,000 odd crores. It was only down by 2%. Usual rate of, downfalls has been 8 to 9% going by last 2 years number. Defense particularly came out very well. Even they exceeded the allocation. About 14% more spending was done in the defense for likely to do for revised estimates for this time around. Same is the case with railways. The spending was pretty well, and the power sector. So I think the critical areas where the spending should be done, government has exceeded what they have allocated for last year budget, estimates. And this year again, there has been an incremental increase. Defense, yesterday there was sharp reaction on most of the stocks. They came down sharply. But I think this is a good time and opportunity to buy them, because if you look at the entire defense space, they are sitting on 4.5 times book-to-bill ratio. So very healthy order book in excess of 3 lakh odd crores for 8 to 9 defense companies put together. And their HAL, BDL is standing at a book-to-bill ratio more than 6x. VEL itself is standing at a book-to-bill ratio of 3x. So strong order book visibility, or strong execution visibility over the next 2 to 3 years time frame. And this is, just allocating more, but execution will take its own sweet time. So our sense is 18 to 20% kind of a profitability compounding is likely out there. And there still the topic remains Hindustan Aeronautics because of the valuation comfort it enjoys as compared to BEL, and the structural problems of jet engines not getting, aircraft engines not being supplied by GE is now being resolved. So but that supply will enhance. Railway, I think, is one sector which has been languishing for last 2 years, and now it's the time to look at it again. After 3 years of budgetary allocation, this time around there has been a growth in the railway spending around 11%. Execution has also started picking up, and there, to my mind, Ircon International, because of valuation comfort, stands a good chance. Is standing over 24,000 odd crores of order book and doubling of railway lines, and more gauges to be put in place. All this will, put in line, will go smoothly with Ircon International. Valuation-wise, it's comfortable as compared to, say, others in the peer like RBN and all. So these two sectors look pretty strong to me, and I think yesterday it was an overreaction to the market. Today, if market gives you a chance to, open on low side, you should be going all long on the market, because looking at the numbers, ex-Nifty, around 325 companies we have done in aggregates on year-on-year basis. The PAT number has grown by 16%, and quarter-on-quarter they have grown by 6%. This is after adjusting for the labor costs. So the outside larger market is very strong. Large caps may take its own time, but the market itself looks very healthy and very juicier at current valuation multiples to do cherry picking.
So HAL and Ircon. HAL trades at 30 times forward multiple. What about Ircon's forward valuation? What is it?
So Ircon forward valuation will be around 21, 22 times. Okay. But I think the execution is likely to pick up. So this can get, to 19 times or 18.5 times.
Got that. The big positive is also the 21-year tax holiday to foreign companies to set up data centers in India. What is the investable play here in India? And if you could, give us 1-2 stocks and the rationale behind it, if at all.
Rima, good morning. It's a large space, and it will take its own sweet course of time to get us into the entire, revenue and PAT kind of earnings visibility. We have to see how much of it comes to the Indian companies, and there I think a couple of companies are there. We have initiated coverage on Orion Pro Solutions Limited. They are there in the data center structural architecture stack. And what they do is an asset-light model. They design the entire data center model, do the software integration into the hardware, and that is where they make enough profit. So right now it's around 18 to 17% of their entire revenue pile, which is likely to go up in near future. They have already done 2 projects with RBI and one more company, and the name just I'm missing out right now. So they also have a historical track. Other than that, NetWave is already there. E2 is there. So NetWeb and Orion Pro Solutions, I think they should stand to gain significantly from this entire, offering coming in future. But it won't happen overnight. It won't happen in a couple of quarters because a lot of structural issues are there. First, allocation of land and putting in the entire real estate infrastructure in place. So maybe 1 year down the line, we can see the benefits of it trickling down to the profitability.
Dharmesh, this morning when I think at 9 o'clock bond markets, etc., open, I think, the sense is perhaps you will see an uptick in yields because of that gross borrowing number. Financials, NBFCs, any thoughts on that pack? If the market, that's not your view. Your view is actually based on earnings that you've looked at. It's looking healthier. But there's another segment which believes actually everybody's going to go sit in banks because it's perhaps valuation comfort, safety, and things like that. But these rising yields, does that sour that view in any way?
In very short term, yes, because there would be mark-to-market losses in the treasury side, and that can take up part of the profitability, which happened in Q1. I mean, the same phenomena played out there. Q3, somewhat rebalancing was done, but again, the same problem crops up there, and it's 30-35% of their profitability. The treasury income, it has a significant chunk in most of the bank's profitability. So, but definitely, from a trading point of view, I think there should be some decline. Yesterday, we saw sharp selling in most of the PSU banks. 7-8% kind of a correction was already there. Maybe 3-5% more, but again, my long-term call is you should be buying those corrections.
Okay, and what about the capital market plays? BSE got slammed yesterday. I saw on Friday as well, the stock lost its way second half of the trading session, and it's followed that up yesterday with another slam dunk. What would you do? Any of these capital market plays you want to dip in, or you rather stay away?
Yeah, Nigel, I mean, as far as wealth management, asset management companies are concerned, they are a good pick out there. But BSE, MCX, I mean, all the infra plays, definitely, there are two reasons. One is the STT hike, which happened yesterday, which will definitely cut down on volumes of most of the derivative algo trades. So all synthetic trades, high frequency algo trades will see a trim down, but it will happen 2 months later. I mean, from April, it will be effective. So we have a window of 2 months out there. The second most important reason is the NSE is coming out with an IPO, and there was a differential in the valuation multiple going by the unlisted price of NSE shares between BSE and NSE. So that I think will get adjusted right now. So for some time, I mean, maybe 6 months or down the line, till this entire NSE IPO is through, sustainable traction on BSE shares is unlikely. It may take time-wise correction, but I don't think it's going to have a healthy upside traction.
Okay, Dharmesh, appreciate you joining in and giving us some stocks this morning. Defense, railways, some of the data center plays as well is what you're pretty positive on, while you're saying capital market plays maybe go through a phase of consolidation, so you'd rather stay away. Have a good day ahead, and we catch up soon. Thanks a lot for joining in. Well, we'll slip into a short break. On the other side, we'll connect with Harshit Kapadia of Elara Securities as well as Rajesh Baheti of Cross Seas Capital Services. But also do note, in a while, we'll also connect with S. Naren, Nilkant Mishra and Rhythm Desai. They'll join in to decode Budget 2026. Stay tuned.
Welcome back. Defense stocks, right, were in focus actually going into the budget. They were focused yesterday as well. The market sold off and so did defense stocks. Capital goods perhaps is the other area. Ria is joining in with, the granular stuff here. I mean, what really happened in terms of future ordering, etc. Are analysts excited? Is this subpar? Ria, take it away.
Well, yes, first up, Goldman Sachs has come out with a note on the defense space after yesterday's budget. They have highlighted that the FY27 defense budget spend came ahead of their estimates. And they have also said that within capital procurement for this budget, for other equipment, which comprises missiles, ammunition, as well as radar electronics, that is up roughly 62% compared to last year at 82,200 crores. They believe that solar industries, Bharat Electronics, as well as Bharat Dynamics are well placed to benefit from the spending focus on other equipment, and they also see a potential trickle-down benefit for Astra Microwave as well as for data patterns. Apart from this, they have also highlighted that in case of the aerospace segment, the exemption of the basic customs duty on raw materials for the manufacture of parts and components of aircraft is likely to benefit companies like PTC Industries as well as Azad Engineering. Apart from this, CLSA has also come out with a note on the capital goods space. They have said that the $200 billion worth of projects for 7 new bullet trains and a new dedicated freight corridor was an important part of the budget yesterday. And they've also said that the defense capex growth of 17% year on year should reassure the market. But they also believe that there is no constraint for this, and it depends on project delivery. They've reiterated their outperform rating on L&T, HAL, Bharat Electronics, as well as NCC as orders and execution recover in 2026, which could surprise the markets.
Thank you very much for that. But there was a violent reaction and sell-off in the stocks yesterday. Bharat Dynamics ended down 10%. Data Patterns 7.5%. BEL was one of the big Nifty losers, a fall of about 5.5%. Harshit Kapadia of Elara Securities is now joining in. Harshit, your initial read, and if you had to pick one or two defense budget stocks, which ones would it be and why?
Morning. Yes, so defense budget has seen a very good increase of close to around 17% on a YY basis compared to the revised estimate, which is at 2.2 lakh crore. And in that, 75% is allocated for domestic procurement. So all number comes to around 1.4 lakh crores against 1.2 lakh crores. So that's a sharp increase. And within that, what we have seen is there has been a upward trend on the other equipment side, construction side, and high mobility vehicle side. So these are 3 key segments where we would see growth coming in. Within this, if I want to pick on the defense side, I would pick BML and Hindustan Aeronautics as my top picks on the defense side, followed by Bharat Dynamics. This is the 3 companies that I would be watching out for on the PSU side. This will be followed by solar industries on private side.
Okay, got it. So we've got the picks in terms of the defense allocation. Harshit, what about railways? Out there as well, the spend is pretty much in line with what the street was working with. Your take on that? And from the railways pack, what stands out?
So on railways pack, if you see the headline number looks good, but when you get into nitty-gritties, into volume numbers, you will see a sharp variation. So only 2 segments within railway has seen growth in terms of volume. One is coaches and the other is locomotive. Whereas the doubling of lines, track lines have seen a decline in volume. However, the value number has increased for doubling of lines and new lines construction, which means a lot of commodity price related inflation has been booked. So prima facie, it may look good to get into EPC companies for the railway side, but I would be preferring more on coaches and locomotive side. So companies which still again picks would be BML within the space, Siemens Limited would be another pick within the space, and on the component side it would be CG Power and ABB India. These are the companies to watch out for. And the third component which I mentioned, which I forgot to mention, was on the Kavach side. We have also seen a Kavach segment related increase as well, which will see a HBL Power coming in, CG Power coming in terms of Kavach orders as well.
Right. Sorry, before CG, Harshit, what did you say? Which is the company?
HBL Power.
No. The earlier on the loco and coaches side.
So on the BML, that is where the first company is. Then Siemens Limited is the another company on the loco side who will benefit.
What did you mean when you say volumes so we get the rupee crore number, right? In terms of allocation, what do you mean volume? You said only volume increase in these two segments.
Yes. So in terms of number of coaches which the government is planning to procure for FY27 has seen an increase of or is an increase of 10%. For locomotives, it is an increase of 7%. The value growth has been close to around 3 and 8%. Whereas when you look at doubling of lines, we have seen a volume decline in terms of kilometers of 8% for doubling of lines. For new line construction, we have seen a volume decline of 20%. But if you see the value rise in new lines and construction has been in the range of 10 to 20%. So there is a differentiation here as far as doubling of lines is concerned, and the other on the coaches side is concerned in the railways.
Now, all these picks in these segments, right? I'm assuming you had coverage, you liked them, had buys before the budget also.
Yes.
Would these announcements and increase in allocations in these segments make you want to buy them incrementally if you don't own them, or no?
No, these announcements will certainly give me more color that more order inflows are sustainable in this segment, and this is what the government is looking more towards new age trains, which is Vande Bharat, Amrit Bharat trains. So this gives me further confidence on the picks that I have already mentioned.
All right, we'll leave it there. Harsha, thanks very much for joining us. Quick conversation, but very useful. And that's railways in focus, defense in focus as well. So some nuance there, which I think is important to note. We take a break. We're back. The pre-open session is coming up in about 6 minutes' time. And the other one, right, capital markets, where do we stand now there? So STT changes in F&O, 50% hikes respectively. Rajesh Baheti will be with us. We'll also connect with S. Naren, Neelkant Mishra and Rhythm Desai. So the trio, the big market faces coming up. So we'll have the big, AMC view. We've got the equity strategy view, and of course we've got a top, economist/strategy view coming in from the three of them. So those are faces you will see here on CNBC TV 18. Stay tuned. Coming back.
Go.
Welcome back. This is Open Exchange, and we are coming to you live from the CNBC TV 18 Motilal Oswal studio. As promised, let's welcome our technical guests. We have Mitesh Thakkar and Sudarshan Sukani who join us on the show. Good morning, gentlemen. Good to see you all in. Well, we were bracing for a super Sunday. It didn't really play out that way for the Bulls. But now, will we get a manic Monday or not? What's your take, Mitesh, coming across to you first? It seems yesterday, particularly the last 30 minutes, the positioning was taken for a gap down today. But what happens post that? Tell us, Mitesh, the levels that you're looking at. How would you trade the Nifty?
So, good morning, Nigel. A couple of things. I've been saying that the market is on the weaker side, and 25,000, 24,950 was a support area, which yesterday the Nifty kind of broke below. Now, that's a rising trend line which has been taken out, which also means that any pullbacks will face strong supply around this 24,950, 25,000 zones. And if you're not able to capture that, which means that the market weakness will persist and therefore should logically force us to lower levels, which could be close to about 24,400 to begin with, and even 24,000 in the near term could happen. So in that sense, the structure is negative unless we start capturing or trading beyond 25,000 on the upside.
Sudarshan, would you play for more downside? And where do you see the Nifty headed?
Yeah, good morning. Well, yesterday the idea was to take a short position below 25,100, but I don't think that was actually possible in real life because it was so volatile. Trading yesterday would have been difficult practically. But the bigger worry is that, for the Nifty has been in a trading range between, let's say, 25,000 and 26,300 for 6, 7, or maybe 8 months. That range is breaking decisively on the downside. Now that starts looking very sinister, like a distribution. Now, Indian markets don't distribute. We simply buy on the dips. So it's a very unusual pattern for India. For today, I would be a complete bystander, avoid any trading. Let's see what the markets are doing. Are they willing to buy this dip, or is that really a distribution for a much longer downtrend? But for today, it's an avoid.
Okay, all right. I think we need to pull up. I think the rupee, we're getting the initial rates that should come up actually for our viewers. If you've got the initial rates, it's 9 a.m. So I think we'll be getting the rate on the rupee. Director is just going to confirm in a bit. Just wait for a minute or so. For the time being, let's get in Mitesh. Mitesh, tell us individual stocks.
I have more of sell calls today. I have a sell on Bank of Baroda, which after a good rally has given some kind of a breakdown showing first signs of profit booking. So keep a stop just about 286 here. Look for targets of 265 on the downside. Similarly, Tata Consumer is a negative or a sell call as well. I would suggest keeping a stop loss just above 1110 levels and look for a target of around 1040 on the downside. I have a buy on CG Power with a stop at 580 for targets of around 630 on the upside, and Nuvama Capital is a sell as well. Keep a stop at 1270, and a short-term decline could see the price head towards around 1200.
Look at that, 20 paisa stronger on the rupee. So I'm not sure if there is some strong defense coming in right at the word go, right? We'll try and get some intel and some feedback. But this is stronger at this point. We'll also, if we can have the 10-year yield, which perhaps we can put up, because the bond market would also have opened. There was some expectation that perhaps yields open a little higher, but we'll let us see. I mean, look at this. And remember, the rupee market, from the time that we closed, the rupee closed on Friday to now, the dollar is up. The dollar index is up about almost, it's back above 97, right? I mean, the broader dollar index. And here you've got the rupee going the other way. So, there is, as I said, Bloomberg is saying, and we'll put this out, RBI selling dollars offshore to protect the rupee. And this is what I was talking about, that it looks like for this kind of a start, after the worries around gross borrowing, the dollar going the other way, for the rupee to start 20 paisa higher, I think there is strong defense on the front foot right at the word go. Bond yields have surged, as was expected, as I was saying in the morning, 6.77 compared to, that's a 10 basis point higher start on bonds. There you go, 6.77. And it's compared to 6.69, which was the last close. So bond yields are higher. Rupee for now, of course, is managing with help from the Reserve Bank providing dollars to keep its hold its own. But this is just the start, and we'll have to see what happens 9:15 onwards. Because I mean, the big problem for markets, for the rupee, for all of this essentially has been FPIs who've been actually selling stock, right? So what happens starting 9:15, I think, is the critical point, and that we don't have to wait very long, another 10, 12 minutes or so. Sudarshan and Mitesh, good morning. Good to have both of you here. So individually, what would you want to do? Sudarshan, you go first.
Yes, I have more buys because there are opportunities of buying this dip for stocks. HCL Tech is a buy with a stop under 1610. Vedant is a buy with a stop under 610. Oil India Oil is a buy with a stop under 491. One short selling idea is TVS Motors, sell with a stop above 3690. But there may be some bargain hunting, at least in stocks.
Okay, what about? Okay, yeah, no. We'll come back to both of you in just a bit. Thank you very much for joining us, gentlemen. Really appreciate your time. And keep an eye out on what's happening at the bottom of the screen as well with rupee and yields. Rajesh Baheti, Managing Director at Cross Seas Capital Services, is with us. Rajesh, good morning. Good to have you here. Sorry, I'm taking you away from your tennis. So you can play later. The weather is nice. So this STT hike, Rajesh, both the futures and options, first of all, it was not expected. 50%, 150%. What will this do, in your opinion, in terms of market impact?
So first, let's understand that the futures and options industry is now the financial equivalent of pan masala, tobacco, alcohol, casinos. So if we're not expecting it, I think that's probably our fault. The government signaling is very, very clear. They don't want this. They think it's undesirable. The problem is they will tell you this, and mostly it is to raise revenue, because if it wasn't, they should have at the same time cut delivery-based STT to 0. If they had done this along with this hike, I think the market would have rejoiced it and said, yes, this is signaling. It's telling you that you don't want an activity of a particular kind, but you do want an activity of another kind, and we would encourage that. Unfortunately, we get one, we don't get the other.
But it can't both be true, Rajesh. The objective of this is on the speculation side, you have all those comparisons, pan masala, tobacco, etc. On the other side, you don't want to do that to protect revenue because it's a tough year. I mean, I'm just saying.
But you saw that interview. They were clear in saying that this is not about revenue. I mean, it wasn't about revenue, and it was about signaling. Then I think a very strong signal could have been sent to the market by removing the extra STT you pay on delivery-based trades, telling the market, go ahead, take delivery, invest, and we're not going to tax you because...
No, I agree. I am saying they could not do that because they don't want to lose revenue while they want to do this. That's what I'm saying.
You're talking about 10,000 crores. What's the
I don't
on this?
I'm not.
Crores?
I'm just saying. Is it possible that both are true, this and that? Because you said, well, they're signaling it, but obviously it's not showing up in action.
Yeah, but if you're going to want to take 10,000 crores and take the market down by 6.5, 7 lakh crores, I think that's poor economics.
Rajesh, have you spoken to any high-frequency traders, arbitrageurs? What is the feedback that they expect? Because their margins are anyway razor thin. So what impact do you foresee on liquidity, on the behavior of HFT and arbitrageurs?
The strategy of the government is to not break the rubber band, but keep pulling it and see at what point does it break. We don't know when this STT comes into play. We'll really know the structure of the market, how the market adjusts. But you can be sure it's going to hurt. It's going to hurt the high-frequency traders the most. But they are the ones that provide the liquidity. So, if you think liquidity does not become a very important factor for FPIs to decide which markets to put your money in, I think there's a little bit of a disconnect in what the government wants to do and what could happen.
Okay, hi Rajesh, good morning, good to see you, Ben. How much does the cost effectively go out, on a particular contract for futures as well as options? And there was some who were talking that higher volume shift to options rather than futures because of the STT shift now. Any view?
Futures was already like a very small percent of the options volume. If you actually saw the volume, it was anyway skewed in favor of options. It could just get unviable to trade either. at some point. And so I don't know if this point has been reached or not, but at some point it will get unviable for professional traders to trade this anymore, which will have serious repercussions for liquidity.
Yeah, got that. You know, you can, now again, I'm just playing devil's advocate here. There is one viewpoint that whenever, look at past instances, whenever STT was hiked, right? 2030, 2023, 24, etc. as well. It's not as if volumes took a large hit, or activity took a large hit, Rajesh. How would you respond to that?
So that's what I'm saying. You know, you're stretching the rubber band. I don't know whether this is the breaking point or no. So when the move actually happens and the STT does go up, we are there in the market. At some point, some people will pull out of trading. I don't know whether it's us this time or the high frequency traders. It's yet to be seen. But at some point, I think it will become unviable. For sure.
From a customer point of view, you don't see this changing. I mean, this is what is reducing speculation is what this is aimed at, reducing or rather changing customer behavior, Rajesh? I mean, client behavior or trader behavior?
I mean, if the client or the retail client behavior is to buy or sell some option and hang on to it for days and weeks till either you double your money or you completely zero out your position and you know, lose everything, then it's not going to be a game changer. What it will do is it will make bid and ask spreads wider. And that's where the repercussions are for not only the retail trader, but for FPIs when they evaluate a market.
Rajesh, we just step back and see the direction of the capital market taxation over the last couple of years, whether it's to do with STT this time, sometime back it was the hike in LTCG. What does that tell you about what next, irrespective of what the intent behind it may be? But just the direction seems to be taxing more and more on capital markets.
I mean, generally, if you've seen from 2014, whether on personal income tax front, except for corporate taxes, where a fantastic move to bring the taxes down. On the personal taxation front, taxes have moved up. The surcharge on personal income tax is very high. The AIFs get taxed at 42%, which I think is killing that industry. So the messaging is very clear. The government doesn't think that the rich deserve any handholding, or the capital markets can be healthy on their own because of the growth that we are likely to see in this country. So I think the government is betting that 6% growth or 7% growth alone will take the markets up. They don't need any more support financially.
Yeah. Do you have exposure to any of these capital market stocks themselves, apart from, I mean, your own trading, Rajesh, on the equity side?
Luckily, I'm in the capital markets. I think I don't want to add to the problems by having investing in capital market stocks. I do have NSE as a disclosure, but apart from that, I try to keep away, because if the business gets good, I will do better anyways. So I don't want to double down.
Yeah. No, absolutely. A point taken. I mean, you're already in it in that sense. Rajesh, thank you very much. Good speaking with you, and have a good day on the court. Thank you for joining us. That's Rajesh Baheti, and strong words and strong view coming in as always. Doesn't mince words. I think we've got let's just go back to the yields and rupee market, right, and see what's happening, because what's happening is, of course, yields are hardening as was expected. At the open, we got the RBI defending the currency, so that's still there, 91.78. So it's a strong open for the rupee against the USD. And in about 3 minutes' time, I think we'll have the market open as well, and we'll have the FPI sense. Sudarshan is back with us. Sudarshan, anything on your screen and 910 calls?
Well, the 910 call is HCL Tech, buy with a stop market 1610 and avoid the Nifty.
HCL Tech, Mitesh?
I'll go with the sell on Tata Consumer with the stop at about 11.10 or just above it.
Tata Consumer. By the way, look at Asia this morning. Yes, perhaps the Indian markets preempted the fall, the kind of weakness that we're seeing in Asia yesterday. But Kospi is down nearly 4%. Hang Seng is a cut of 2%. The Chinese markets are down 1% despite positive economic data coming through. The Taiwanese index is lower by nearly 2%. So across the board, there is a very sharp sell-off, a rout that you can see across the Asian market. And the mood is clearly risk off. So the question is, will that add to the negative sentiment here in India? Maybe they're also reacting to the bullion bloodbath that we've seen over the last 48 hours, with silver prices down nearly 40% from the peak. So maybe that's also, the volatility in the commodity markets is hurting the global equity markets in Asia. But I guess we've seen part of the fall yesterday.
Well, that's what, Rima, you want to tell us, earlier today we were trying to clutch into some kind of positives, and you're telling us auto sales numbers are looking more or less better. Run us through that.
Yeah, so auto sales numbers are actually pretty good. We've seen a double-digit sales growth across most of the OEMs. So in one line, the numbers are strong, and the momentum has continued in the month of January. For M&M, both auto and tractor have seen strong growth. Auto sales are up 24%. For tractors, it's up 47%. Tata Motors passenger vehicles too have seen a sales growth of 47% on a year-on-year basis. For Hyundai, it's the highest ever monthly sales with an increase of 11.5%. For commercial vehicles, Tata Motors CV, it's another strong month with total sales rising by nearly 30%. Again, Ashok Leyland also seeing very strong momentum, particularly on the truck side. The total sales are up 27%. TVS Motors has had a strong month. Here, the growth rate is inching towards 30%. For Eicher Motors, 14%. And Hero MotoCorp's total sales continue to remain above 5 lakh units, with total sales jump of 26%.
Okay, we are at that moment, and the market's opening. What do we have? First rates coming through, 60 points lower on the Nifty, 24,750. And you've got the Nifty Bank, which is down about 300 points, 350 points at about 58,071. So this is not a bad start at all, but this is just the start. We've got the mid-cap index, which is down about 45, nothing flat. Then we've got the small-cap index, which will come up. And I think you will have some change coming through there as well. Small cap index is, down about a third, 56 odd points lower. Advanced decline, 800 up, about 650 odd names which are starting lower. And lots of stocks at the bottom of the screen with regards to how they are starting up. I mean, the Nifty heat map should give you a quick sense of where we are starting. And then we will pick it up from there. Okay, heat map in just a bit. But this is a much better than expected start. But this is, I mean, the first 30 seconds that we're referring to, and you've got a full trading session in front of you, a full trading week in front of you in that sense. 24,760 for now. Nigel has walked across to the big wall. Nigel, tell us more.
Well, Nifty down close to around 50 points or thereabouts. The Nifty Bank, that's pulled back a larger proportion. I'll tell you what, that 58,000 mark is very, very important for the Nifty Bank. Yesterday, we went down to around 57,800 or thereabouts. So that's important because the 100 DMA as well comes in at that level. We've been talking about Brent crude prices cooling off. Remember, a few trading sessions ago, it went to around $70 a barrel and then it pulled back. So you have stocks like ONGC as well as Oil India. Both of them should come up for you on the screen. Both of them were beneficiaries of that move that we saw from around $63 per barrel to around $70 per barrel. Both those two have come in for profit taking today. From the Nifty pack, Eicher Motors is another stock that's opened up a little bit softish. I think the last I checked, Eicher Motors was down close to around 2%. What's opened up in the green? From the Nifty pack, you have Sun Pharma that's continuing yesterday's run, so that's well in the green. And BEL, that's the other stock I think from the Nifty. Sun Pharma actually has given up all the gains right now, but BEL is a stock that's bounced back up close to around 2%. The fine print indicated that maybe, in fact, the defense spend is as good as anticipated. So post bout to profit taking, BEL opens up in the green. I think HAL and BDL as well did see some kind of pullback. Bharat Dynamics yesterday ended down with a cut of close to around 10%. That's opened up more or less flattish in today's trading session. What else? HPCL. Well, that stock yesterday recovered from the day's low. I think from the broader markets, that one as well has popped up in trade. So that's sitting with a gain of another %. And the divestment target is going to be very, very important for this year. And they're projecting close to around 80,000 crores. So obviously, IDBI Bank is going to be a stock that's going to be in focus all through the year. That one's holding with a gain of close to around 1%. Anant Raj, the last time I checked, that was seeing some follow-through buying post yesterday's big move. So from the broader markets, that one is calling for attention, up close to around 4.5%, and RVNL as well from the railway pack. That stock is doing pretty well in today's trading session. So lots moving around from the broader markets, from the Nifty as well. But the good news is, as you can see, the Sensex has moved into the green. You know, guys, I'm getting that feeling that it's like two batsmen moving, to chase a tall target, batting second. And you have the RBI and LIC probably that are coming in there to play a good knock today. Let's see how that goes.
I don't want to say LIC, but I think you said it, Rachel, but we'll see. You got the start, which is not bad. But these things you can, markets have a mind of their own, and you can kind of sort of do things for a while, but the overarching, the bigger trend takes hold sooner rather than later. For now, it's not bad. I mean, 24,782, and we're down about 0.75%. The Sensex is absolutely flat as well. Well, S. Narain is Executive Director and CIO, ICICI Prudential AMC. He's one of the largest money managers in the country. Narain, good morning. Great to have you with us here. And I should say congratulations first up on that. I mean, I think investors are going to be happy. You're going to be around at the helm of things. So it was good to see that. Narain, what's your sense? The budget reaction, and what will the market do from here? Lots of opinion that we've gotten, pragmatic, etc. But this STT thing maybe is just kind of, for now at least, overshadowed everything.
I was involved in stockbroking from 94 to 2004. Somehow I've not seen retail investors make money in derivatives. But the way markets have reacted since yesterday is as though the retail investors have made a lot of money in the last 25 years in derivatives, which has never been the case. In fact, the regulator prepared a long document showing how much money was lost in derivative segment. But the market reaction since yesterday is only to do with STT, because everything else in the budget was fantastic. Because if you look at the fiscal deficit, it is in order. Overall macro is in order. And government is thinking, how can, one of the biggest challenges for India is it was not seen as a country which is connected to AI. So they did come up with this data center tax concession to propel investments in data centers. We've always been supportive to any tech trend in IT services, in cloud services. Everywhere we've been a supporter. So I think in AI also we have to be a supporter and create an AI services boom. So I think that step was a step in the right direction. But the market is looking at an area where only retail has lost in the last 25, 30 years. And if you increase taxes there and reduce volumes there, it's beneficial for retail. They have not touched STT on cash equities. So that is the challenge at this point of time. How to convince the market that actually this is a positive step for most retail investors, bad step for HFT traders and those kind of people. So how to convince that is one of the challenges, I guess, for the government.
This, from your fixed income team, the gross borrowing number, yields are higher, Narain. Any thoughts there?
Yeah. See, actually, they have budgeted for a very small number in small saving schemes. If you look at the way small saving scheme collections have been this year, it has been fantastic. So if you assume that small saving scheme collections will be very low and prepare a borrowing program, today I would say is an indicator of over worry, because at the end of the day, small saving scheme collections have been going up. And if you continue with that kind of trend, you're going to see a situation where the gross borrowing program, the net borrowing program is what matters, not gross borrowing program. And the net borrowing program is likely to be lower than what is budgeted, because the small savings scheme will take a much bigger share of the borrowing program. So while today's yield increase was something which my colleagues in fixed income had predicted, our view is that this is possibly not a score to worry, because the overall fiscal of the central government is very comfortable. It has been one of the best in recent years. And it's only the state government where we don't have complete comfort. But in central government, we have complete comfort on the way the fiscal management has been.
Got that. Narain, hi, this is Rima here. We'll get to the budget nitty-gritties in just a bit. But before that, wanted to get your view on the ICICI Mutual Fund's decision to resume subscription in the small cap fund. This is after suspending it for nearly 22 months. So take us through that decision. And do you think small caps will start outperforming the large caps, and all those worries about the froth? Has that settled?
See, we are always worried about euphoria, and we don't know how to react to euphoria because we have a comprehensive product range. So we felt that euphoria is completely off in small cap. There is no such euphoria in small cap. The euphoria had shifted to precious metals actually. And so we said that even if we open it, there is no risk of, euphoric money coming in or anything like that. From a market point of view, our view has been fairly static. We believe that most asset classes are costly at this point of time, and the only way to invest is asset allocation. Obviously, equity is a trifle more attractive than a year back because markets are down in small cap, and if you ask me, slowly the valuations are becoming slightly more attractive. So obviously you can have a slightly higher allocation to equity compared to a year back. But even today, markets are not cheap across the board. And we find it difficult to identify good thumping the table buy ideas in equity with big upsides at this point of time, even today, across market cap. But clearly the euphoria in small cap, we are far away from euphoria in small cap. If you look at the number of stocks which are touching new lows in small cap each day, it is so much higher than anything else. So we felt, as an investment institution responsible for public money, we thought the time for closing the scheme is over because there is no longer any euphoria.
But it's not a signal, Naren, right, that you are now gung-ho on the small cap space. And I mean, say if you get an inflow of 10,000 crores in one shot, will you deploy immediately? Because you're seeing those kind of I mean, it's a theoretical question. I'm exaggerating to just make that point, just to get that clarity.
We are not gung-ho. We are
no, in that space, in small caps.
We are gung-ho on areas like specialized investment funds, for example. We are gung-ho on asset allocation. But these are all more defensive ways of investing than pure equity at this point of time. And that is what we have been trying to do at this point of time, that where we are gung-ho, we try our best to collect money. But and that is the situation. For gung-ho, you need lower valuations. There's nothing wrong with the macro. There's nothing wrong with what the government could have done in the last 1 year, like lower GST, lower interest rates, etc. But the fact is valuations are high. And even today, many of the companies are able to easily raise money even if the valuations are high. So we're not yet in that gung-ho moment where we can say invest all your money in equity. That kind of situation we aren't in.
So that small cap signal is basically getting ready for whatever happens, right? I mean, that opportunity whenever it comes.
Exactly.
Okay.
Exactly. And there are investors, who wanted to invest more than the amount that we had specified. And we said that it was proving to be a bit difficult. And that was the reason why we said, let's open. There is no gung-ho moment.
Okay, hi Naren, good morning and good to see you. When 2 years ago, when you took that bold call that precious metals was the way to go, when there was euphoria playing out in small and mid caps, that was bang on. Current asset allocation, how does it change things? Given that small caps have gone through a big price correction and large caps have gone through a time-wise correction as well. So give us the strategy right now. And also with regard to metals, precious as well as industrial metals, how far away are we from that peak or euphoric stage?
Clearly we are in euphoric state. The only challenge is that how do you value precious metals? See, when you look at equity market, there's a value. You look at price to earnings, you look at price to book, you look at ROE, we look at market cap, etc. How do you value precious metals? But purely from a behavioral point of view, we are seeing euphoria in precious metals. Honestly, we don't know how to value precious metals, but we do know that it is the riskiest asset class at this point of time. So we tell people, if you want to put money in precious metals, do it only through the multi-asset route. Because whatever we have been seeing in the last few months is completely euphoric. The challenge is people want us to get the top exactly right. It is hard. It is impossible. I mean, it is impossible for us to get into a euphoric framework when that euphoric top will be exact price and then come. Our experience of 2007-8 was when something becomes euphoric, you decide to become cautious irrespective of how much more it will go. And that has been our framework. So over the recent past, we have been continuously telling people, don't invest standalone in precious metal ETFs or fund of funds. Focus only on multi-asset so that you're not investing big money in precious metals at this point of time. A framework that we have is that whenever any asset class gives you triple-digit return, that is more than 100% return, that in a year, you have to be careful in that asset class. And that asset class is silver at this point of time. So that's what we've been trying to do, but people want us to guess correctly. An asset class which can never be guessed correctly, because you see the daily moves in silver, you know it is impossible for someone at ICICI Prudential to guess daily movements in silver, which is a global commodity, and how it will move up morning, evening, night.
No, absolutely. Because, I mean, I remember, Naren, we spoke last time. This was in the new year. I mean, I think the first couple of days of the new year. And you said, well, I think that shift has some, you looked at ratios, etc., right? I mean, Nifty to gold, Nifty to... And that had moved too extreme. And you said, well, now it's time to kind of flip back to equities because it's just too extreme. And as you said, right, it's tough to call the top because then after that, I mean, prices ran up, gold and silver. And then, I mean, and then they've corrected, right? Very, very sharp corrections last Friday and today. I mean, we're seeing the prices correct today as well. But if you had to take a call, I mean, broadly, not exact or anything, have they topped out for now, especially silver? Silver is the more violent and volatile kind of...
That is what we think. That is what we think.
Yeah.
But can you get it right? That's a question. It's a global commodity. Yeah. Maybe Chinese can decide. I don't know who's going to decide. If you ask our view, yes. And we have been telling people don't invest in silver ETF or in silver fund of funds for the last few months. And people tell us you're bearish. What to do?
So this is
part of our job.
Yeah. If you look at long-term price charts of silver, there is they kind of it does things like what it has done recently. And then for years, it kind of goes sideways. Are we in for something like that? I mean, have you looked at that? Any thoughts, Naren?
We are not experts, but how do you, if you look at Nifty to silver or Nifty to gold ratio, clearly we won, particularly last week, it was clear that one should not invest in silver and gold. People should take out money from silver and gold and put it somewhere else.
Naren, one of the reasons that FIs have given a pass to India despite the expected earnings recovery is that even though in India, say FY27, we get about a 13% kind of earnings growth, you're still getting a 15 to 20% earnings growth expected, say, in emerging markets or even in the broader US markets. So those markets are still attractive. Now that even the budget has not given any concessions to FIs, what is the expected FI behavior to your mind this year?
So why did they invest in earlier years like 2024? So what happens is, we've seen in those years, they were not willing to invest in Brazil and China, which was very cheap at that point of time. And they were overweight India at that point of time. Our view is that, recent past performance does play a role in deciding where money goes. And if you look at India from a one-decade view, I think India represents one of the best structural stories. The challenge for us is particularly people who have been fund managers for long as the markets have not been cheap. If by chance the markets have been cheap, we would want to give a thumping the table buy on equity because everything else is in favor except valuations. And that is the challenge we've been facing. And that's why it's boring for us to tell every time, do asset allocation, do asset allocation. But that's what we have been forced to do only on account of valuations. But today valuations across the world is not cheap. And that is why I do agree in the very near term, maybe there are AI stocks which will deliver very good earnings growth, but neither are other markets cheap at this point of time. So I would say that to be maximum underweight today in India at this point of time means that at some point of time in the future, they will have to think of buying. So that is a positive in my opinion.
Naren, do you have a view? I mean, I remember speaking to you on the sidelines of the Global Leadership Summit late last year. You said the big risk for market is this AI thing bursting whenever it happens, right? Any thought, any updated view on that? Will we see a shakeout at some point? Are we there yet?
Yeah, clearly, when you compared AI and precious metals, I thought precious metals had become much more euphoric than AI. If you look at AI, at least many of the stocks had stopped going up in a parabolic move. So, between AI and precious metals, we had to, we always look for the most dangerous areas. So the most dangerous areas in the last 1 month turned out to be precious metal. It is not that AI is cheap. I think AI has still got to go through a correction, but AI is not at this point of time in bubble. It may be extreme valuation, but at least it is not a bubble. And I would say that there is a good room for a meaningful correction in global equity markets. But how much knowledge do I have when I make this statement is something I ask myself. But if I just do simple calculations like market cap to GDP, I think there is scope for a meaningful correction, but we are not experts. And therefore, we believe that if the global equity markets correct, our view is yes. And if they do, I think India should outperform at that point of time. But there is a risk of a global equity market correction in the next 2 years. When it will happen, again, we don't know. It will be nice to know if we could correctly time it, but we wouldn't know.
Okay, all right. Thank you very much for that. Really appreciate your time, and thank you for joining us with that perspective. That's S. Narain with that perspective. Well, Neelkanth Mishra is with us, Chief Economist, Axis Bank, and Head of Global Research at Axis Capital. Now, if there's one voice that people want to hear after a budget, any budget, at least the last decade and a half, is Neelkanth. Neelkanth, I can tell you, once the budget is over, everyone is scrambling to find details to your post-budget call and the note later. So tell us, Neelkanth, what's the verdict? There has only been 3 alphabets which have been talked about very much. I mean, Naren did not do it, but it is STT. Yeah, what are your headline thoughts, and then we'll dive in.
So the headline thoughts, the first is that as expected, completely predictable, and I think that's a good thing. I think having predictability allows businesses and investors to plan ahead. There are no shocks, there are no dramatic changes in tax rates. The spending quality continues to improve. There is no attempt at wasteful spending, and allowing more money to go into the hands of the private businesses and investors. The challenge that I see, I mean, I think the STT issue is more for controlling speculation, as the finance minister also mentioned in the press conference. But the challenge, I think, is on the financing side. So you've seen that the 10-year bond yields have now gone up to 6.76, and clearly the financing plan for the deficit and the fact that the government's overall conservative approach to forecasts, so taking a 10% nominal GDP growth, taking tax to GDP only marginally higher, I think they can do better on taxes. Perhaps on the financing side, they've gone excessively conservative. And that's something that is having the opposite effect of what the fiscal discipline and sticking to the fiscal consolidation path should have achieved. So there's clearly some work to be done there. I think 10-year yields should be, I think, closer to 6 and not 6.76 is my view, because the liquidity conditions are such that banks are having to borrow 12-month money at 7%. Yields have been going up, and now with the gross borrowing coming up higher than what markets had expected, has again started to push up. So that's something that I would say is perhaps the only niggle. Maybe you could have also expected a better plan for privatization and disinvestment. But again, I mean, some of those things can happen during the course of the year.
Neelkanth, are you saying the government has been very conservative with the revenue collection targets, and that is actually that's not the right way to look at it? So you're telling markets don't be worried because they've been too conservative and they'll collect more. Is that what you're saying?
Part of it is that, but I think the bigger issue has been on the financing of the deficit. So, for example, if you take small saving schemes, and I know we are getting a bit nerdy here.
No, because Naren just talked about exactly that, the small saving schemes. I mean, it's been very healthy, but what they've accounted for is very conservative. Yeah, go on, sorry, Neelkanth.
Yeah, exactly. So, sorry, I only caught the last bit of Naren's talk. So the first 9 months, there is a 32% increase in collections. But the full year number for FY26 is down 13%. So I think 4.2 lakh crores in FY25, falling to 3.7, something like that in FY26. Whereas in the first 9 months, you've seen a 32% increase. Now, a large part of the small savings inflow actually happened in the month of March. So perhaps they know more than what we do, though it seems unlikely given that there's been no dramatic change in the policy of other rates on small savings schemes. And at low base, they're expecting a 4% increase next year. Now, this is very good and conservative because, frankly, predicting some of these things is hard. But this means that you are expecting, 1 lakh crore, 1.2 lakh crores less on small saving schemes, and potentially even 1.5 lakh crores less than the small saving schemes than what you're likely to get. And this is possibly why your cash balances, meaning government cash balances, which can go out of the banking system and therefore bring down the quantum of deposits available for banks. So, the conservativeness on this front, look at government cash balances. They used to be 0.5 to 1 lakh crores for on average till the single nodal account transition happened about 2.5 years back. Now they are averaging 2.5, 3 lakh crores. Now, this is money that is effectively, not available for banks to lend with. And having this disruption for a while is understandable, but now it is starting to have a counterproductive effect that despite the fiscal discipline of the government, the 10-year yields are actually going up. I mean, that needs to be addressed. I think it's between the RBI and the government. But as I said, this is a technical operational problem. I think the hard miles on fiscal consolidation are now behind.
But you expect the yields to inch lower. It will be addressed from the current 6.76. You said ideally it should be 6%. And if it stays around the 6.5%, 6.6%, what are the broader implications? Will it hurt the growth? Will it impact the kind of earnings expectation the market has, investors have from the market?
Absolutely. So, see, look, the fact that the core inflation measures, ex gold and silver, plus, say if you take median inflation, those measures are at record lows. There is clearly evidence that there is significant slack in the economy. Now, the economic survey talks about 7% growth being the trend growth, which I think is the right measure, that we have been at that level for a while. And if you assume 7% growth and assume that the starting point is say FY18 or 19, we are 10% below where we would have been if COVID had not happened. And so therefore there's significant slack in the labor market, in the economy. Now there's significant output gap. There are only two ways to close an output gap. One is fiscal, the other is monetary. Now on the fiscal side, I think prudently the government is sticking to its roadmap, which means that interest rates and costs of borrowing should come down. So it will take much longer if we are not able to cause this transmission. It will take much longer to close that gap, and therefore there is definitely an impact. Part of the reason the banks sold off so much yesterday, I think, was while on budget day and there's so much of futures and options volatility that it's very hard to pinpoint reasons. But I think this could be a reasonable driver of that decline. That if your cost of financing, cost of funding is going to stay elevated, irrespective of whatever the RBI may be doing with the repo rate, it's a challenge.
All right, Neelkant, final question before we let you go. The big push for data centers, that could yield quite a few dollars and quite a lot of inflows. What's your take on that? How big an opportunity is it? That's one of the positives from this budget.
Look, the commitments from Microsoft, Amazon and Google, the three major data center providers, I think the others like Oracle haven't yet made announcements for India yet, together are already about $70-75 billion over the next 4 or 5 years. That's quite substantial. My understanding of the tax cuts, though, I mean, this is more my guess on the possible reasoning behind this change, is less to make India, host data centers for the rest of the world, which frankly is also not a bad idea. But, a lot of that competition is about the price of land, the price of electricity, basically energy costs, the price of water. A lot of those things go in. And remember, we are competing with space here. So there are people who are now arguing how the space may be more effective. The reason why perhaps this has been done is that suppose you have a global firm setting up operations in India. There is a data localization drive within India as well. And they can't just do it for India. So suppose that, that same setup needs to service some other country as well. in that case, the taxation should not be adverse. And I think they just clears up on that. And therefore, whatever investments may happen in India to meet India's demand, and the data center may not have been, the demand may not have been sufficient to set up everything here, and you want to do some bit of global servicing from here, I think that gets addressed. So this, I would say, is more an enabling factor than a big driver of investment by itself, because that competitiveness will come from cost of energy, cost of water, cost of land, and things like that.
Okay, all right, Neelkant, thanks a lot for joining in and giving us your take on the budget. We look forward to chatting up with you rather soon. Well, time to welcome next corporate then. We have Cholamandalam, which is the next management on the show. The loan growth disbursements came in healthy. The net interest margins expanded as well. We have Arul Selvan, the president and CFO of the company, who joins us on the show. Hi, sir. Good morning. Thanks a lot for joining in. Well, give us a couple of data points then, with regard to the disbursement growth. You were indicating that it should pick up in the second half of the year. So what is the outlook now for the year on the whole? And also, what does that mean in terms of AUM growth?
We stick to our original or the earlier, indications. You've seen that happen in Q3. Q3, you saw the disbursement grow by 16%. And just like how the AUM did not move much when the disbursements plateaued, same way, immediately it will not move much. And so AUM remains at the 20% growth levels, which we have indicated. It will remain so in Q4 also, while disbursement will pick up in Q4 further. So we see better disbursement numbers in Q4, but it will also not immediately reflect on the AUM. AUM will still grow at the 20 to 20 or 22%, which we had been indicating.
Okay, and the disbursement growth, sir, I missed that number.
The disbursement growth would be similar at around 15 to 16% levels in Q4 as against previous Q4. But overall disbursement growth should be in the range of around 10 to 15%.
Got it, sir. All right. Your NIMs that you've reported, actually, they have increased by close to 10 basis points. That's something that you were guiding for. It's got a bit of an improvement, I think, in the home loan part of your business as well. What's the outlook with regard to your NIMs from year on? And how do you expect your cost of borrowing to pan out in the coming quarters?
The cost of borrowing could improve further by around 5 or 10 basis points, and that should reflect back into the NIM. We will see the similar levels of NIM levels as we move into Q4, because the shorter end borrowings have sort of tightened, so there has been not that much savings out there, though we don't really do much of the short-term borrowings. So we don't see that impacting. However, we will be cautious about committing further on the NIMs. So we stick to our 5 to 10 basis points improvement in Q4 as compared to Q3.
Got that. Your vehicle finance segment, I was just seeing the internals grew at 17%, which is lower than the overall AUM growth. Can you explain that? Because CV markets seem to be doing very well. So, what is the expectation, particularly on the vehicle finance business?
Vehicle finance will grow better in Q4 from a disbursement perspective, but the reflection of the same on the AUM will still be little muted because it's a very large book. So one quarter disbursement may not shift the AUM growth that much significantly, or instantaneously. So you will see that growth more moving up progressively rather than having a visible impact immediately for a single quarter's move.
And for vehicle finance, what is the disbursement growth that you expect in Q4?
We expect around the same 16 to 20% growth in Q4 because last year Q4 would also be a better quarter. So we do not want to look at it from current quarter versus this next quarter.
Okay. And credit cost was at 1.7%. In Q4, do you expect it to decline?
Yes, it will decline in Q4, and the overall full year credit cost should be in the range of around 1.6%. This is what we have guided earlier also. We stick to that. We will see reduction in the unsecured book happening. You are already seeing that happening in the quarter-over-quarter numbers. So say this will further, benefit in Q4. And vehicle finance, always Q4 is a good quarter because that is when there is a lot of money with the borrowers because of the harvesting, etc. So that should also augur well for the loan loss numbers. So overall full year, in spite of the first 3 quarters being in the 1.8, 1.7 range, we still see a 10 basis points improvement when we close the full year.
Okay, final question before we let you go, sir. The ROA is currently at around 2.4%. Do you expect it to hold on to these levels? And what are the levers you have in store to see some kind of improvement in the coming fiscal?
So in the coming fiscal, we will see the full year's benefit on the cost of fund happening. The other thing is that the products which we are now growing are of a higher yield, like gold and even CSEL, and even the corrections which we did in SME, etc., should augur well in improving the bottom line, and so that should help us to improve the return on assets. And at a PBT level, I think we should be much closer to the 3.5% pre-tax ROTA levels, which we had always been working towards, and I think we should reach that in FY27.
All right. Sir, you're often compared to Sri Ram, and they've had a massive equity infusion post the partnership with MUFG. I mean, how has it changed the competitive dynamics? They've got a rating upgrade as well. And are you looking at any sort of, a similar partnership or an equity infusion?
No, we are not looking at partnership per se, but over a cycle as our, Tier 1 capital proportion, if it scales down below a threshold which we have set internally, we will certainly be open to taking fresh equity. But at this juncture, we are not looking at any partnership because there is a good amount of promoter interest and they continue to be, looking at Chola as one of the prime investment or their holdings. So we'll continue to be in that same position.
Okay, all right. Pleasure speaking to you, sir, as always. AUM growth of more than 20%. NIMs could improve by around 5 to 10 basis points from year on. And credit cost comes down to around 1.6%. Appreciate you joining in. Look forward to having a chat with you as the quarter does progress. Well, before we slip into a short break, there's news that, in fact, the Nifty is now at the high point of the day. We're up close to around 80 points. And there is further strength being seen on the Indian rupee, which is now pulled down to around 91.55 or thereabouts. Both those two doing pretty well this morning. Time to slip into a short break. On the other side, we have Rhythm Desai, Managing Director and Chief Equity Strategist, India at Morgan Stanley, who's waiting for us. Stay tuned.
Welcome back. Markets pushing higher now. 24,900 crossed on the Nifty. The Sensex has moved up by nearly 400 points. So after slipping 1,500 points yesterday, at least the markets are trying to recover. Asian Paints is your top Nifty gainer now, 3% up. We've seen a seminal fall in crude prices, so that is providing a relief. And Asian Paints has had a rough 2026. The numbers were disappointing with their volume growth, and plus crude prices were inching up. L&T is the other big mover, nearly a 3% gain on that. And then you've got Reliance Industries. That's really fighting for the bulls. Along with that, HDFC Bank, ICICI Bank are moving up 1%. Defense is also broadly higher. But let's invite the management of Dixon on the show now. Saurabh Gupta, Group CFO of Dixon Technologies, is here with us. Thank you very much for joining in. Saurabh, so just for the budget for your company, we've seen an increase in the overall EMS outlay for EMS to 40,000. But then mobile PLI, which started in calendar year 2026, had a 6-year clause, so it was ending this year. Has anything come on the budget with respect to mobile PLI? Tell us that first.
Yeah, hi, good morning. Thanks for having me. So as of now, I think so the government is very much deeply engaged with us, with the industry. Now, to say with absolute surety whether the mobile PLI will get renewed or not, it's very difficult. But clearly, we feel that the government wants to provide good support to the sector till the time the component ecosystem gets created. And clearly, the allocation towards the component scheme has been increased to 40,000 odd crores, which is clearly a pivot towards more and more component localization. So very difficult to say, Rima. Yeah, but in this budget, there was no such announcement on extension of PLI. So can't say for sure whether it will get extended or not.
But you were a big beneficiary of this mobile PLI over the last 6 years. So the fact that it's not happened in the budget is an overhang for now, because there's still no clarity if it'll come through. I mean, how does it impact your business if it doesn't happen?
So Rima, we have been investing in backward integration. So we are investing in the camera modules. We are investing in the the display panels, display modules. Some of them will go live by Q2 of this financial year. Camera modules, we already acquired this company, and we've already given a indication to all our investors that, of course, 26, 27 will be more of a stabilization year, but 27, 28 with this kind of backward integration that we are planning, we feel it will really create a lot of strength and moat in our business, and it will be really margin accretive for our business. So we should be able to overcome the PLI impact very soon, assuming the PLI doesn't get extended.
Oh, okay, all right. So we'll have to wait for clarity on that mobile PLI front, and that's something that the street is a little bit cautious on as well. But sort of let's focus on a couple of other key factors. What about the Vivo approval? That was scheduled to come in. That's got pushed back a little bit. Could you tell us timelines on that front?
Yeah, Vivo, we feel that the approval should come in very shortly, very soon. Now, very difficult to give an exact timeline to it. We are in very deep discussions with the government. We are deeply engaged with the government authorities, and we see no bottlenecks. It's only a question of timing, but we feel very confident that the Vivo approval should come in.
Okay, because does that put a risk to your volumes for the next year? How do you achieve that guidance? If you could help us out with some volume guidance for the next year.
Nigel, for me to give any volume guidance in mobiles is very difficult because the memory prices have been going up. And now it's a question of availability of the memory prices. Even the brands are not able to give us a complete visibility. It will take some more time. But clearly, we feel that the Vivo approval should come in. And also, we feel that even the other brands, there should be some growth. Our existing brands who we are manufacturing. And apart from mobile phones, of course, the other sectors, other verticals for us like IT hardware, telecom, refrigerators will have a very strong growth.
Okay. Saurabh, I wanted to ask you about memory prices. Morning.
Morning.
Absolutely crazy, right? I mean, look at what... I mean, if you are in one of these names on the other side, Micron and all these stocks have gone berserk. So there is like lack of availability now. I mean, it doesn't make sense, right, at these prices?
Yeah. So there's lack of availability. The capacities are limited. Capacity generally takes a couple of years to come by. More allocation is being done to the AI-based application because there the margins are much.
So can you give us a sense of where prices are, what you bought at, say, one year ago? I mean, just to compare, the dramatic rise.
So the prices have almost doubled, Prashant, and especially it impacts the low end and the medium end smartphones. Not so much in the high end smartphones because the price elasticity is not that much. The customers generally don't think much by buying a high end smartphone, but definitely it impacts the low end.
And how much is it as a percentage of, say, a low end smartphone?
It will be almost 12 to 15%. So if suppose it's a 6,000-7,000 rupees smartphone, and if the prices increase by say 1,200, 1,500 rupees, So definitely we feel that the demand will get impacted, and depending on how much the brands are willing to absorb and how much they're willing to pass. So clearly the last quarter 3, there was a 7% degrowth in the market. So this is something I think so one is a key monitorable for the next few months for us.
So if a phone was 6,000 rupees, this was about $900. I mean, the cost of memory.
Anywhere between 900 to 1,200 rupees. So
and that has become double now.
Yeah. So that is further increase. Yeah, that is and continues to increase. Yeah.
Continuous increase. It's a issue which I think companies across the board are facing on the electronic side. We'll leave it there for now. Saurabh, lots to talk more, and we'll invite you back. Thank you very much for joining us here this morning with that perspective. Well, I think we're going to talk about the bond deals and what's happening there. You heard from Naren and Neelkant, both basically talking about that gross borrowing number and the conservative revenue collection estimates, small savings schemes, etc. Lata, of course, has been talking to a range of market participants. Lata, tell us.
Well, first up, let's discuss the rupee. It's stronger against all expectations on a day when actually the dollar is stronger versus most other currencies. This is because dealers tell us that the Reserve Bank intervened rather, hugely in the NDF market, which opens before our market opens. The idea being, and that's usually Reserve Bank's logic, to ensure that there is no speculative attack on the currency because people have some narrative to sell. And, if actually FPIs come and, start buying dollars because they're selling equities, then usually RBI will withdraw. But at the moment, at least the way the stock markets are, it doesn't look like there is heavy FII buying of dollars. And therefore, the Reserve Bank may have guessed correctly. We'll have to wait and see. If actual selling of equities and buying of dollars by FPIs comes, usually the Reserve Bank withdraws. It doesn't stand in the way of fundamentals. But early days yet, at the moment, the Reserve Bank is holding up the rupee. On the bond markets, very clearly, it is as expected. I mean, the market was not prepared for a 17.2 lakh crore, gross borrowing for next year. The number of our own poll was 16.2 trillion, exactly 1 lakh crore less. And the average in the street would have been 16 to 16.5 trillion. And therefore, this is, getting adjusted to the fact that there will be a lot of demand. The dealer guess is that Reserve Bank is also intervening in this market. They often do, secondary market, purchases and sales. And at the moment, they must be purchasing in the secondary market. It is not at all unusual. The market is not all out selling off bonds. There is a niggling expectation that some buyback or some switch will be announced by the Reserve Bank. And in the very least, a further OMO could also be announced, but they are banking on some switches and buybacks to be announced in course of time. So it's not all hope lost, but clearly today traders are making it very clear that they don't like the borrowing program.
Yeah, no, absolutely, Lata, no doubt about it, right? And this is an issue which we will continue to discuss, debate. By the way, Hormuz is telling us that there are headlines, I think, coming on Bloomberg. South Korea has halted sell orders for program trading in Kospi. If you can just quickly look at a snapshot of Asian markets, Hong Kong and China and Korea. Korea, of course, was the top performing market in 2025, started 2026 in an absolute roll. And what's happening there? There are pullbacks, but remember, these are all markets which have done extremely well, especially on the tech side. And Korea, of course, was, the absolute king in terms of Asian markets. Can't call it an emerging market. Korea has done about 3.7, 3.8%. Taiwan has done about 2%. So it's actually a pretty poor global screen at this point in time.
Is this the trigger, Prashant? Is this the trigger for Indian markets? All those that were participating last year, suddenly they start giving up, and then India becomes a relatively better place to hide, or you don't think so?
I don't think so, Nigel. Look, first leg you will participate on the downside. And I think, as Naren said, all other factors are okay, but it's not as if valuations are like a screaming buy.
Yes.
So when you are using other markets because they're looking too expensive, and then you want to buy something, you'll buy something which is looking very attractive. It's possible that in some of the other markets which have got this AI trigger, etc., if prices correct sharply, it could work the opposite way. People look at that as an opportunity. Oh, we couldn't get in. Yeah. There's too much FOMO, and we're going to. Prices are now fallen. So yeah, the only thing is valuations here, which have corrected, which have become much more reasonable. But
You know, I was in fact reading a note earlier today that I think the S&P itself, S&P 500 is trading, I think, around 28 times, 27, 28 times. And historically, you have not made much returns from there as well.
Yeah.
So I think the risk of the global market coming off, that's another global factor at play. We have only been focusing on a domestic term. So
absolutely.
I think,
Nigel, Microsoft reported, Apple reported numbers last week. iPhone sales was super, right? Apple did not go up. I mean, these are all small signs, but it struggled.
Yeah.
And I think usually you would have seen in other previous quarters, etc., with the market doing what it is, the stock doing very well. I just want to quickly also highlight oil, which is down 4.5%. Let's just look at Brent oil prices. That is unambiguously positive for a large importer like India. And I think names like BPCL, IOC, HPCL, they're all doing well. Brent is down, 4.5%. And the news report is that President Trump is essentially signaling that he's open to talks with Iran. Remember that Armada, as he called it, described it, fleet of U.S. vessels, fighters, destroyers, etc., surrounding, I mean, essentially all in the Persian Gulf around Iran. That was the headline for the last 2 weeks, that at some point this is going to lead to escalation. But I think headlines now coming in that there's going to be talks and no, at least no, that's the interpretation, no fighting in that sense, and the supply, etc., will not be disrupted. So it's a big move coming through right now. And BP, let's just look at BP, HP, IOC. It should show up there first. And elsewhere later, it's flat. Okay, HP is up 3.5%. BP is not. And I think IOC is the other one.
For HPCL, BPCL, the other positive is also that the excise duty was not hiked in the budget.
Remember, but I think that is, I'm not sure. That
Can
the
still
excise,
come?
yeah, it's not happened now.
It's not happened in the budget.
It doesn't, but it doesn't happen in the budget, right? It comes out outside the budget. 16% growth in excise collections. It's got to come from somewhere. So that I'm not very sure, but I think this one, of course, is directly related to the oil price thing. We'll take a quick commercial break here. Manisha will be with us. It's all commodities, right? Silver, gold. There's another sell-off which is ensuing in global markets on the other side.
Fly Emirates, fly better.
Welcome back. 100 points gone in the Nifty in a matter of 15 minutes. The Nifty is now back at 24,800. But a segment that's been far more volatile is commodities. And over the last 48 hours, Manisha, the direction has only been southwards.
Oh, yes, volatile upside and volatile downside as well. So when you look at the gold, silver, copper, all of those metal prices, after that very sharp decline that we saw on Friday, you are looking at some follow-through selling coming in the Asian markets right now as well. I'll start with gold, and this was the biggest one-day decline on Friday that we saw since 1980. It was down by 17%. It's trading down by 5% right now as well. But I want to show you on what we've done really in sense of prices. We started January at 4330, and then gold saw an all-time highs at around 5600. Today we are trading at around $4,700 an ounce. So we still are positive in the year, but from the all-time highs is $1,000 an ounce of a decline that the gold prices have put out. Silver saw 36% of a decline on Friday. Biggest one-day decline ever is what that commodity gave you. So we started this year with $71 an ounce. We saw an all-time high of $121 and currently trading at around $80, $83 an ounce. Still higher on a year-on-year basis, but from its all-time highs, it has been a one big decline that silver prices have given you. Let me take you through copper as well, and it's 11% down from its all-time highs for this one as well. Started the year with 5.6. 6.5 was an all-time high, trading at 5.8 at this point in time. The profit-taking has come in from all sectors, from COMEX, from London, from Asia, from Indian markets, and the kind of froth that was building up in China also seems to be getting away in some sense. So the major reason for decline clearly comes in, one, because of profit-taking. The speculative trade, institutional retail trade was just getting very, very overheated. The second point has been about the dollar index. From a 4-year lows, well, that one has seen a jump up. And two reasons for that. One, it is about Kevin Warshaw's appointment as the next Fed chief. He's seen as hawkish but not very aggressive, is what perhaps has been supportive. The second thing has been about the Japanese PM statement, which says that they do not mind a weak Japanese yen because that supports countries' exports, has also supported the US dollar in turn. The third thing has been about the margin hikes that we've seen on CME. Huge, humongous margin hikes. Well, actually, if you wanted to trade gold and silver in India, you have to pay margins anywhere between 50 to 65% on the higher side. So weak hands, smaller retail, all of that is getting out of the market and can be seen in sense of prices as well. If you look at the metal prices on a week-on-week basis, everything is in the red there. So you have gold, which has declined by 6%. It is the PGM metals, which is silver, platinum, palladium, which has declined quite sharply. So 22, 25, 27% of a decline is what we are working with silver, platinum, and palladium. It's off to all-time highs coming in for many of the base metal prices also. So when you look at copper, nickel, aluminum, zinc, we are down anywhere between 2 to 8% for these as well. So copper and tin hit all-time highs. They're off those kind of highs by nearly 10 to 12%. We saw nickel prices trade at a 19-month highs. It has declined nearly 20% from those highs. And then you have aluminum and zinc, which hit 3-year highs. Well, they are trading off those prices as well, with the markets believing that the profit-taking is not done, and you could be looking at some declines continuing today.
All right. Thanks very much for that, Manisha. That's commodities, gold, silver, and, of course, everything else which is happening. I mean, suddenly a very, very macro-ish kind of a market, right, with everything which is going on. A frenzy and a bit of an unwind of the frenzy is what's happening. There's news at the bottom of the screen with regards to lupin, and this is with regards to tuberculosis and other microbacterial diseases. So there's a partnership which has been announced. Let's just take a quick look at the market, right? It's basically given up gains. The high today is 24,940, and we are about 60 points off that day's highest level at this point in time. So market breadth is flipped. If you look at an NSE advanced decline ratio, it's 2 down for every 1 stock which is higher. And guess what? It's once again, and we'll put this up, it's silver B, silver ETF, you know, it's basically gold and silver ETFs, which are down anything between, I think gold ETFs are down less, 4%, 3%. Silver ETFs, because of the international price decline that Manisha just spoke about, are down another 10, 11, 12% or so. Actually, the first 10 quotes with volumes is all this gold and silver business, which is selling off. I mentioned oil prices down sharply, and of course the IOC and HP going up. But the explorers, Oil India, is going the other way. Oil India is down 4% as we look at it. Time for a quick commercial break here. We'll come back in just a bit from now. Lata will be speaking with CNBC TV 18's Citizen MPC ahead of the monetary policy outcome. Stay tuned. That conversation coming up next.
The budget is done, and now it's all attention on the Reserve Bank of India's monetary policy on February 6th. Well, actually, the Reserve Bank is clouded with a lot of problems. There is the currency. There is the budget, which has given a larger borrowing program than expected. The inflation and growth numbers will change because of new series. And the world financial markets, at least, are in a tough place. As always, before the official MPC meets, CNBC TV 18 Citizens MPC meets to bring us all up to speed with what we should expect. Joining me now are our members, Soumyakanti Ghosh of SBI, Sajid Chinoy of JP Morgan, Samiran Chakrabarti of Citibank, Sonal Verma of Nomura, and the chairman of our committee, Dr. Pranab Sen, the former chief statistician. Gentlemen, and Sonal, thank you very much indeed for your time. Sajid, I'm starting with you. You know, the elephant in the room is rupee. Even if the RBI argues that we set the monetary policy only on domestic matters, it's not inflation, it's not growth, but rupee is the biggest concern. How will the MPC tackle this consistent fall in the currency?
Thank you, Lata. Good morning. So first and foremost, I think the rupee is a symptom, right? The underlying cause is we're unable to attract, adequate capital inflows, particularly FDI flows, to finance the current account deficit. So So the first best, of course, would be what do you do to attract more capital, more FDI flows? Portfolio flows are welcome, but tend to be more volatile. So the focus has to be on FDI flows. Now, absent that, if that were to take time, what is the best course to react? And, there's a trade-off here. If you don't let the rupee become the shock absorber, then you're putting a lot of pressure on foreign currency reserves to do the heavy lifting to prevent the rupee's adjustment, right? And if this was a temporary shock, it's perfectly understandable to use foreign exchange reserves and smooth it out. But we're seeing that volatility around the world has become a structural phenomenon, as the economic survey so eloquently pointed out. This is here to stay. We're just in the first year of a 4-year Trump administration, and we're going to see markets whiplash. So the question is, how much reserves do you want to use? And we've used a fair amount the last 2 years. And how much do you want to preserve? If you want to preserve reserves over the next 3 years, which I think is the prudent strategy, this is an environment to build buffers, fiscal buffers, monetary buffers, FX reserves, then the rupee has to become a shock absorber. Now, I'll take 2 quick things, Lata. Firstly, by letting the rupee become the shock absorber for the external sector, it frees up monetary policy, right, to focus on domestic growth inflation dynamics. So the monetary policy only has to react insofar as that the shock absorption capacity of the rupee translates into higher or lower inflation. In this case, it's a weakening rupee, so there'll be higher inflation. So you've got a separation of principles here. Yep. Rupee looks at the external sector, and monetary policy looks at the domestic sector. Yep. Very final point, I'll say, given the geopolitical strategic environment we're in, a weaker rupee will make our exports less uncompetitive versus ASEAN that have lower tariffs. It makes Chinese imports more expensive, gives our domestic substitutes a chance. So in this, and it's happening against a period of benign inflation. We can agree about that. We can debate the tactics of intervention. Tactics should not induce where weakness causes more weakness. But the larger strategy, I think, is the only one we can pursue.
I take your point. These are the theoretical points. But I'm not able to buy this, our exports become competitive because 90% of our exports are value addition to imports. And secondly, as you said, as you ended your conversation, you said that it can, speculatively increase, more outflows or at least make people afraid of coming. So, Samiran, do you think in this policy, aside from the MPC itself, we will hear something like, those NRI bonds, Resurgent India bonds? Is there a need now to head-on tackle the psyche?
So, Lata, just to take a different point of view than what Sajid mentioned, I think the key difference is that whether you treat rupee, as Sajid started off saying, as a symptom, or you take rupee as an endogenous variable in the whole construct. If you take rupee to be an endogenous variable, which in turn affects everything else through the expectations channel, then allowing for a large rupee depreciation actually could be harmful for capital inflows. Everybody will delay their capital inflows, thinking that we might actually lose money if we bring it in now. So that's where it's imperative for the RBI to put some guardrails on this process. It's debatable to what extent the rupee depreciation actually helps exports, whether there is a J-curve effect sort of thing also. These things are somewhat more debatable. I want more sort of clarity. Every sector would be different on this front. But clearly the expectation channel is something which today has become very, very important, especially because the traditional ways in which market used to think about the valuation of the rupee using that 40-country RER, those valuation metrics are not as useful as they used to be before. Because on those valuation metrics, rupee is undervalued for a sustained period of time now without any significant improvement in sight. So when does the market think that this is enough of depreciation and not anymore? So because that key metric is not being followed in a significant way, we can all debate which is the right metric of valuation, but at least some guidance needs to come on that front also, which is where I think a statement from RBI to start with that the rupee depreciation is beyond what the fundamentals suggest, I think would be very helpful. And then you can think of other measures. The only problem with those other measures is that they can bring back the memory of 2013, which is also something that you don't want to do to spook the markets at this point.
Fair point. Time permitting, I'll come back to it later on. I mean, whether we need actual steps to encourage flows. But, there is another problem that the MPC will face. Sonal, that question to you. We don't have a reliable CPI number. I mean, I don't mean it in derision. The CPI series is going to change. And therefore, how will the MPC tackle this? Your own report says that the new series could be a good 0.5 percentage point higher. So how will the MPC debate this?
Yeah, I think it's best for the MPC to wait for the new series to come out rather than prejudge what it is going to be. Now, based on the new weights that were released, where the weight of food is down by almost 9 percentage points and core is up nearly 10 percentage points in the new series versus the old series, the current regime where we have deep food deflation, it does lead to, spot CPI inflation rates that are almost 50 basis points higher than what the older series suggest. So there is uncertainty on where we currently are in terms of the inflation rate. The good news is that, under the new series, we will have a lower weight for some of the volatile food items, a higher weight for the services items. So it should be a series with less volatility and where we see lesser divergence between headline and core inflation. And I think for the, RBI and the MPC, the focus has to be on the momentum. And not just on the inflation rate, particularly as we transition from the old to the new series, because some of the transition will cause some technical adjustment. But if the momentum in the new series is broadly aligned to the momentum we've been seeing in the old series, then I think that should still lead to some optimism.
Okay, fair enough. So they can always look at the momentum, and we don't have to be worried that the end number will be higher than what the Reserve Bank forecast. It could be about 30 basis points higher is the consensus. Soumya, the other big problem that the Reserve Bank and the MPC will have to be tackled is zero transmission. Not because of their own problems, but because the end of the rate cycle and this huge borrowing program which the market was not prepared for. How do you expect the MPC and the RBI will tackle it?
Yeah, thank you, Lata. I think this transmission problem is also akin to what is the problem we are facing currently in the exchange market. I would like to delve into two parts. The first part I will address is on the government borrowing program. Yes, the numbers of the borrowing program which came yesterday are higher than market expectations. But the important thing to note is that the net borrowing numbers are almost similar to what the market was expecting. The gross borrowing has been significantly higher. And my sense is that if you look into the number last year also, the Reserve Bank did buybacks of around, the government did buybacks around 86,000 crore or so on. So if that is the same number, if that is the amount of buyback which we can see, which is announced outside the budget, so that could actually bring down the gross market borrowing. So I think this is one of the things which the market could actually understand over a point of time. So the yields actually could react to that. However, to the larger question in terms of the transmission, I think one of the big things is that the disconnect of the RBI liquidity management with the yield movement today in the markets. For example, I think the RBI has done OMO close to 6 trillion. That's a record OMO. And even then the yields actually have not bulged a little. It has actually moved up today for whatever reasons. My sense is that at some point of time, the central bank also needs to communicate to the market in no uncertain terms. Because as you know that the central bank had communicated earlier that yield curve is a public good. And there is also the communication to the market this time that yield management is not the function of the central bank. So therefore, again, it could actually make a self-fulfilling prophecy in the market that if yield management is not the function of the central bank. Note that the central bank is actually the PD. There is no public debt management office in India.
Yeah.
Borrowing cost of the center and the states has to be managed by the RBI, whatever are the consequences. This good. So from that perspective, I think to get over that self-fulfilling prophecy, to put the yields down, or to at least stabilize the yields, it would be very helpful for the central bank to make the OMO linked to the market microstructure in terms of the liquidity management.
Okay, so you mean some big OMO program can come. I mean, I wanted to debate more on whether we should expect the RBI to also speak about buybacks or something like that. I'll do that in a bit. We didn't discuss growth at all because the numbers looked so good. Dr. Sen, you've been there, done that, seen several cycles of growth. The survey tells us that real GDP growth for next year is going to be between 6.8 and 7.2. It's higher than the street at this point in time. And the nominal GDP is 10. So is this something the MPC doesn't have to worry about? Growth doesn't need a helping hand, would you say?
Lata, at this particular point in time, we are really in a state of flux. The Trump effect is really yet to hit us.
Yes.
And my take is that the coming year is going to be filled with uncertainty. We have absolutely no idea what's going to happen as is expected that we will start transitioning to a more rupee-based payment system. What the Indo-EU FTA will do. So there are a lot of moving parts that are there. Now, in all of this, whether we'll grow at 7% or not is not really the issue. The real issue is whether or not the sense of confidence in the Indian economy is restored. Because if you look at what's been happening to our investments, they've remained pretty much stagnant over the last few years, despite very healthy growth figures. So the question really is, can we up that? Can we make it possible for people to feel much more confident about what's going to be happening, given the situation that Trump is an imponderable in this whole scenario? We do not know what he's going to do tomorrow. It may work either way. And so the whole issue, I think, facing the RBI and the MPC is going to be that how do we position ourselves where we can move nimbly either direction?
Fair point,
because
sir.
we just don't know which way we're going to go.
Fair point, sir. There are further questions then on stance and on whether there will be rate cuts after this policy, February 6th policy. But I'll postpone that for the moment. Let me get your first vote in. The first question really is very simple. What will the MPC do on Feb 6th to the repo rate? Let me start with the lady. Sonal, what will they do?
Hold.
Hold, no change. Okay. Samiran?
Hold, no change.
Okay. Saumyo?
No change.
Okay. Sajid?
Hold, no change.
No change. Dr. Sen?
Hold.
Okay. So no change for now. But all my members are worried about several aspects, currency, growth, and the changing inflation numbers. All those questions to my guests after the break.
It's a resilient start on D Street after the STT hike in the budget yesterday triggers a sharp fall. The Nifty is volatile but mildly in the green right now. The broader markets outperform. It is the Nifty Bank which is low by about 0.25%.
And the Indian rupee strengthens, opens at around 91.75 versus the close of around 91.98 yesterday. Dealers point to an RBI intervention in the forex market.
Metal stocks, they rebound. Some relief after a sharp global sell-off in commodities over the weekend. Nalco, Hindzink and Hindustan Copper, all of them higher between 3 to 4%.
Intellect Design continues to slump after a weak showing in the third quarter on Friday. The stock is a top F&O loser, down another 7% today.
You're watching us here on Chartbusters. We come to you live from the CNBC TV 18 Motilal Oswal studio. I'm Mangalam Malu, with me Nigel D'Souza. This is the CNBC TV 18 budget headquarters. The market's doing okay. Resilient is what you would say. Volatile but resilient after what was a fairly sharp sell-off that we saw in yesterday's trading session. The Nifty holding closer to that 24,900 mark than 24,800.
Well, Mangalam, we had to call for you back into the studio because yesterday we were roaming around too much in the BSE and NSE, and I behave, you're not in very good behavior. Well, so that's why we got you back in the studio.
Got back in the studio, and to be very honest, it feels a little weird, both of us sitting on, that only tells you that, Nigel, maybe we've aged a little bit, have we?
No.
Not at all, not
Firing
at all.
all cylinders.
Firing on all cylinders. What we'll do is we'll basically wait for the markets to fire on a lot of cylinders as well. The budget, pragmatic for the medium and long term is what the verdict by and large has been. But let's talk about earnings because that's what drives the market as well. Rajesh Jain, the Chief Operating Officer of RR Kabel, joins in to discuss their third quarter performance. We'll be discussing the following talking points. Strong demand, whether that continues in cables and wires, the outlook on the FMEG business, growth and break-even, and high competitive intensity in wires with another corporate, Bajaj Electricals, announcing their entry in that foray as well. Thanks a lot for joining in, sir. And it's been a good performance, give or take everything else, given the sort of environment that we're in as well. So just a two-part question. One is on the increase in copper prices. Have all of them been passed on in the very near future? Can we expect some sort of margin pressure? Because from the second quarter, when you said that this could be a bit of a problem to now, there's been a big surge in the prices. So that's point number one. And secondly, on the FMEG business as well, you've been pushing down the break-even targets by multiple quarters. The last time you said by the end of FY26, the fourth quarter, it should break even. So break even in FMCG and the near-term margin outlook, if you could comment on that.
Good morning. Yes, we have seen a huge volatility in metal prices, and as previously also I said, we have a mechanism where we keep passing on these prices to our consumers in a lag manner. And as we have seen a very volatile, like in copper earlier, it was on very upward move. Now we have seen some downward move also in current quarter. So it's like continuous process. The only thing, the volatility or impact of volatility depends on the degree of how much it is moving upward or downward. But at the same time, if you see our results, we were able to pass on this impact of increase to our consumer in lag manner, and it has impacted very less. And going future also, we will keep this practice going on. If we talk about FMEG business, of course, yes, we have seen this was flat quarter, but our losses have reduced to a great extent. Like for this quarter, our EBIT losses in FMEG were around minus 5 crore, and by this quarter, which we promised earlier also if you remember in the beginning of the year, we said that by Q4 of FY26, we'll achieve like EBIT level green. And we are quite focused and confident to get those figures.
Good to hear, Mr. Jain. The other positive from the numbers was that you grew in line with the leader on the wires and cables business. So could you help us out with what was their volume growth for the past quarter? And for this year, earlier you had told us that the volume growth will be around 18% for the year on the whole. Stick to that?
Yes. So in this quarter, our volume growth was around 30%. So, and if I see overall for 9-month basis, again, it is around 17%, which is in line with our earlier projection of 18%. And we are there.
Okay. All right. Give us a little bit of a sense, sir, in terms of the inventory in the system. Could you tell us what is it currently? Is it higher than normal, or is it at par with what you've seen in the past?
No, it's on normal level only. Though it is increased by 4 days, which is marginal increase because of our sales in transit increased in export side. But otherwise, it's quite normal, and we are on at par with our previous quarters.
All right, and wires and cables margins stay at around 8.5% with consolidated margins around that 8% mark itself, right?
Yes.
All right.
So
go ahead.
So it's again, it is as per our projection where we guided that we will improve our margins by 100 basis points year on year in next 3 years. And till this quarters, we are online, and we are quite confident to achieve those targets.
What about the exports business? Because the last time you had also said that you're diverting exports away from the US because of the tariff uncertainty. Now that we've, signed an agreement with the EU, if you could give us a sense on how much of your product does go to the EU, will you see any benefit from there? And any sort of outlook that you can give on the export front here?
Yeah, so good thing that we are largest exporters of wires cable from country, and almost 30% of our revenue is coming from exports. And good part with RR Kabel that we have multiple country exports, where Europe is one of the biggest zone, from where almost 40% of our exports revenue comes from there. So of course this deal may further help us. At the same time, since our export market is diversified and we have exporting to more than 80 countries, so it will help us to balance our business in longer term also.
Okay, all right. Mr. Jain, I recall you had laid out a big adventurous capex plan as well. Could you tell us how much has already been spent and how much is pending?
So we have plan of around 1,200 crores in the next 3 years, that is up to FY28, and these are also on track where almost 400 crore will be spent in this year.
All right, and you had said that this could yield a revenue of almost 4,000 crores. By when does that hit? And even slightly longer term, FY28, we had given a target of over 2,000 crores in revenues coming in from FMEG rather, with 8 to 9% margins. Are you on track for both those?
So with the capex of 1,200 crore, it will earn top line of 4,500 crore, not 4,000 crore. And at the same time, yes, in FMEG, though this year our growth is flat, but it is if you see at industry level, still we have done better on the. So maybe 2,000 crore may not be achieved. It may have some shortfall, but on margin front, we have predicted almost 5 to 6% EBIT margins by FY28.
All right, 5 to 6% margins by FY28. This year will be flat, but you've broken even on the bottom line. You project better growth next year as well. Thanks a lot for joining in. Wish you good luck. We'll speak to you after the next quarter as well, and perhaps also getting a word from you on what competition is likely to do once we have firmer plans coming in from Bajaj Electricals as well. They've made an announcement as well. The last big announcement that came in after big corporates who've made their intention into entering the industry that you're in as well. Thank you so much for joining in. Good luck. With that, take another short break. On the other side, we have the management of IDFC First Bank joining in to discuss their third quarter numbers. Stay with us.
Welcome back. You're watching Chartbusters, and we have V. Vaidyanathan, the MD and CEO of IDFC First Bank, who's joining in to discuss the third quarter numbers. Mr. Vaidyanathan, thanks very much for being here. Sharp margin improvement on the back of that steep fall in cost of funds by 12 basis points. You, of course, undertook that deposit rate cut in the quarter. That's helped. So is that 5.85% NIM target pretty much locked in for the fourth quarter, or could you do even better than that?
Yeah, 5.8 is definitely locked in. Because it can only get better over what this quarter was, because we just recently cut savings rates, and in some buckets we cut it to 200 basis points on material buckets. So that should bring down our savings rates also, and naturally it should pass through the margin. So Q4 could definitely be better.
All right, could be better. Another positive from the numbers is your CASA ratio rising, and it's pretty much one of the highest that we've seen among the banking peers. At 51.6%, do you think you can sustain this, or would you say the quarter was an exception? And is the aspiration really to stay above the 50% mark?
Yes, I think the quarter was kind of exceptional because we were raising money through current account and savings accounts, and term deposit was we just planned it like that, and maybe it came a little more than what we even expected. But we cut savings account rates recently. So we expect this, this to calm down. But even maybe, anywhere in the zone of 45 to 50 will be quite comfortable. And we will definitely keep it in that zone, but maybe inch towards 50 or something. And that much you should expect in the next quarter, yes.
All right, 45 to 50% is the target you're comfortable with. You're also one of the few banks that actually has higher deposit growth than loan growth in the quarter, but the CD ratio, that said, it's quite high at 93% still. You told us you want to get to 80% kind of levels. Now, should we assume with the 20% loan growth that you're doing, a 25% plus deposit growth is something you could deliver to bring the CD ratio down? And how confident are you on this kind of a trajectory?
Clearly, I can see your concern there. So clearly, we feel like 20 to 23% we should be able to maintain. Credit deposit ratio is coming down. 93 by itself is not great. But see where it is coming down from. It's coming from 169% in 6-7 years. So it's like one-way drop downwards, which means every year, and 169 includes, even bond exposures of the bank. That is also credit in a way. So basically, otherwise it's 136. So it's come down like that one way. So we definitely feel that this number will continue to come down because our incremental credit deposit ratio is not more than 80%. So we are holding steady on the front, and we will bring it down. We are committed. We'll bring it to the 80s for sure. And that's a path. It's a glide path from a DFI bank to a regular retail bank, regular universal bank.
Well, apart from that, the other thing that's come down, and again a positive, is your credit cost, now at around 2% kind of a levels. But, in your MFI book, we've continued to see a decline. Currently, where are you seeing slippages in that book? What's the credit cost like? And are you confident enough to say that the MFI pain the industry has been seeing, that's squarely behind?
It's very straightforward. Definitely, this cycle has, we feel, has passed. And you can see our slippage numbers quarter on quarter. Our gross slippage has come down by 9%, and our net slippage has come down by 7%, or one of the or probably the other way around. But either way, it's coming down by 9 and 7%. And quarter on quarter, and microfinance, we feel the cycle is played out. We should expect lower slippages. We should expect credit cost of the bank to get even better in Q4. In not just in percentage terms, but also in absolute terms. So frankly, for our bank, it's been like 7 years, post-merger. We've not put one step wrong, except microfinance, but that is an industry issue. And we always maintain the other books are super clean, and it is clean. It is proving out through this cycle.
Okay, not one step wrong other than the MFI pain, which you hope will settle down. But finally, Mr. Vaidyanathan, the cost to income at 70% is still a bit higher than your aspirational 65%. How quickly do you get there?
On the cost to income ratio, it did get affected by the microfinance because the end of the day, like you rightly said, the book has come down by about 40% in the last 1 year, and that was a high yielding book. So it has been, a setback to our cost-to-income ratio. We were frankly by now planning to come down to the 70s, but still hovering around the 73 odd. But next year it should come down. I don't think we'll get to 65 because the microfinance is a shock that has happened to the P&L. But The good news is that the losses on our liability book is cost income ratio is coming down meaningfully. Credit card cost income ratio is coming down meaningfully. Asset cost income ratio is coming down. So once the microfinance impact passes through next year, then the year after that and onwards, it should come down.
All right, we'll leave it at that, Mr. Vaidyanathan. Thanks very much for joining in with that. That was IDFC First Bank's third quarter numbers. Nigel and Mangalam, it's back to you guys.
Well, thanks a lot, Ritu, for joining in and, in fact, taking us through that interesting interview. For the time being, though, we'll slip into a short break, come back. We'll continue to focus on markets and stocks that are moving around. Don't go anywhere.
You want to talk business? Meet me in the On-Board Lounge.
Welcome back. You're tuned in to Chartbusters. You're on CNBC TV 18. Well, it's a good time to shift focus and get a couple of ideas in our special segment. So let's hop across to Bharat, who's joining in, of moneycontrol.com, to tell us about a stock that he's tracking rather closely. Bharat, take it away.
Today's ideas will be Shringar House of Mangalsutra Limited. As per the Q3 business update, the jewelry demand continues to remain strong despite a steep increase in the gold prices. While the volumes have been under pressure, higher realizations owing to increased gold prices have led to the growth momentum for the jewelry companies. This is positive development for jewelry manufacturers like Shringar House of Mangalsutra Limited, and we expect the company to deliver strong growth. For the existing clients, the company is looking to increase the order frequency via launch of new designs and products. Additionally, the company is also looking to tap new clients in untapped geographies via intermediaries, which will drive the growth momentum. The company is also looking to enter new product categories in the long run, which would drive the growth momentum. The fundraise of 400 crore rupees via initial public offering in September 2025 will enable the company to scale up the business. Additionally, the company is expected to generate cash profits worth 150 crore rupees over the next 2 years, which would also be reinvested in the business to drive the growth. The company is looking to reduce the working capital cycle via increased sales to corporate clients. This would also be an important driver to enable the company to scale up the business. At the current market price, the stock is trading at a PE of 16 times FY28 earnings projections. Investors with a long-term view can add the stock.
All right, Bharat, thanks a lot for that. Meanwhile, it's a volatile market. When we started Chartbusters, the Nifty was closer to that 24,900 mark. Now it's slipped below that 24,800 mark as well. Led lower by the Nifty Bank, which is down by almost 0.75%. Mid-cap index lower by 1% as well. Volatility continues, and so does our coverage. Take a short break. On the other side, we have the team of Trading Hour taking you forward with all the markets.
Welcome. You're watching Trading Hour. I'm Ritu Singh. With me is my colleague Manglam. Hi, Manglam. It's good to be in the Mumbai studio. It's been a very volatile day of trade after that downfall we saw in the markets yesterday. Bit of a recovery, but still now we're at 62 points down on the Sensex, 60 points down on the Nifty, and the Bank Nifty is broken below the 58,000 mark as we speak. Now at 57,996, a market breadth firmly in favor of declines.
Market breadth firmly in favor of declines. In fact, what happened is that, 11 a.m., that's when the FII's start coming in, or the initial trades get settled in, and that's where we're actually seeing a fair amount of selling. So this morning it was volatile. Yes, we opened marginally in the red, and thereafter we saw an immediate recovery for the market as well. But then, as we speak, the Nifty is down about 60 points, below that 24,800 mark as well. The Sensex not doing particularly well. The mid-cap index, the market breadth out here tells you the story of the day. 2,151 stocks declining for about 681 stocks, which are advancing itself. The other thing that I'm looking at right now is, two packs in particular. One is the railway pack, the other one is the defense pack. So yesterday, we saw a sharp knock on all these stocks. And now if you look at some of these railway stocks, they are seeing another round of selling because maybe the street was expecting a little more coming in for some of these counters in the budget. Yes, there has been a 20% plus increase in defense capex, but is that enough given the valuations at which these stocks were trading despite the collection? Perhaps not. The defense industry is down about 1.5%. Individual stocks, something like a Bharat Dynamics or BEL, down a lot more than that. Bharat Dynamics is the one that should come up for you. Alongside that, we are also seeing a bigger gash on a few of these NBFCs, the likes of Shriram Finance, etc. That's the top Nifty loser right now. Down 4%. Is the gross borrowing number worrying the street, especially on the NBFC side or not, is something that we will monitor very, very closely. So yes, yesterday's verdict from the market standpoint for the budget was fairly clear that we have seen a decline. Today, the street was hoping for some sort of sensibility to pick in some rationality. And now, as we speak, the market has been, declining for a while right now. So, well, as we speak, the Nifty around that 24,750 mark. The one level that we have to track very, very closely is most definitely yesterday's low, which is just around that 24,500 mark, little below that, 572 or 472 thereabouts. So that's a level that we will be tracking, but we are seeing a fair amount of sell-off. Ritu.
Fair amount of sell-off indeed. Mangalam, thanks very much for running us through how the market's doing the day after the budget and the surprise with the STT and the borrowing number really bothering the markets. We have to take a short break though. We'll slip into that. And when we return, we'll get you more on the markets and continue our stock-specific budget coverage as well in just a bit.
Fly Emirates, fly better.
Welcome back. Brigade Enterprises is the first management on our radar today. The company's bookings have declined sequentially while realizations have grown during the quarter. The occupancy, however, declined as well. To discuss the numbers for the quarter gone by and the way forward, we are now joined by Pavitra Shankar, the MD of Brigade Enterprises. Pavitra, thanks very much for your time here. You know, bookings and volumes are both down, and that's contrary to the commentary we've been hearing from the likes of Puravankara as well as Prestige. You know, is there a sector-specific slowdown you're starting to see, or you think it's a more Brigade-specific issue?
Hi, good morning. Thanks for having me. The numbers that we're seeing this quarter is predominantly for Brigade due to some of our launches being pushed out into Q4. Apart from that, we don't see any major changes on ground. Over the last year or so, we've been seeing the demand shift more towards premium housing, where the absorption has been more of a stabilized manner instead of a very rapid absorption that we saw over the last few years as there was a pricing discovery going on. So we don't really see anything major in terms of on-ground effect other than the pricing increases over the last few years within our portfolio and overall in the industry in general that had gone up substantially, driving up ticket sizes as well. So we're seeing a stabilization of that demand across all our markets, Bangalore, Chennai, and to an extent Hyderabad, which is still able to absorb fairly high ticket sizes.
So does that mean this 15 to 20% sort of bookings growth guidance that you had given for the full financial year stays? And since you spoke about ticket prices, you had taken price hikes around 5 to 10% across your projects. Were they absorbed easily, or maybe there was some push here?
So yeah, for the ticket sizes that we're talking about and the price increases, they have been absorbed well. It's a mix of price hikes in the existing projects as well as new projects that get launched in the course of the quarter or in the course of the year. But our outlook has been that pricing when we launch the project is coming in at the right expectation for customers as well. So we're not trying to take it up substantially beyond that as well. So we're still able to meet our profitability requirements for each project. In terms of the end of year numbers, the dependency is still heavily there on launch. I think that has been part of the narrative for the last few years for us and industry. A lot of the numbers tend to be back-ended in the second half of the year. Some of the launches that we would have wanted to see in Q3 have slipped into Q4. But on ground, the demand is not a cause for concern. It is just about timing and getting the approvals on time and being able to get those numbers related to that.
So you're sticking to 15 to 20% kind of a target despite the 9-month decline that we've seen where bookings are down 15%, or do you think you may need to revise that guidance?
Again, the numbers that we hope to do every year are heavily dependent on launch. If I don't get the approvals for some of the launches that we're expecting to do in Q4, we may not be able to make that number. So again, as I said, it depends on those approvals coming through because we are seeing about 50-50 contribution in our projects, in our numbers from existing projects and new launches. That's what we've seen over the last 9 months. But a large part of our achievement for Q4 will come in from launches. So the guidance, so to speak, will depend on that. So
what's the launch that you've earmarked for the fourth quarter? Because I see, and our director will fire that as well on the graphics plate. 1.2 million square feet is the projected launch that you have, planned launches over the next 4 quarters. So what's the kind of launch pipeline that you have for the next couple of quarters where you have visibility at least?
We are hoping to do about 4 to 5 million in the next couple of quarters. And ideally, the bulk of that will come in Q4, barring which we will have a bit of a challenge in terms of doing sales, obviously, from new projects. But existing projects are all selling well, and we're still seeing good traction in terms of those.
Okay, you don't really have multi-geography exposure for Brigade, so to speak, to protect yourself from downturn, especially in what we've been seeing in the NCR region, etc. Is that something you want to focus on going ahead to diversify geographically a bit more?
So we are present in Bangalore, Chennai, and Hyderabad. Those are 3 major cities in South India. We are not we're currently not necessarily looking at the NCR market. And I think the three markets that I just mentioned are fairly well diversified. Yes, they're all in South India, but they're all very strong markets and have been doing well. And in the past 2 to 3 years, our ability to get good business development and sign up good projects in both of those and launch projects has shown that we are able to do that. And we so far have been focusing on South Indian markets.
All right, just a couple of questions before we let you go. Pavitra, one, the launch of 3 million square feet in office assets next year. What will the capex be here, and what do you eventually expect the annuity to be from the office sector for you going forward? That's one. And second is on your construction costs. They've increased from what, 1,800 crores to about 2,300 crores in the first 9 months of this year. Is this because launches got delayed and that's why revenues didn't show up, or is there something else that you could explain where the cost has increased but not shown in the revenue so far?
So on the construction cost, the cost has gone up because of the number of projects that we're doing, and that has increased substantially. On the revenue side, because we follow the Ind AS accounting method, the revenues will come in at the completion of the project. So that's where we see a bit of a time lag. There is no issue in terms of how much more we are spending in that sense, whether it is residential or commercial. Our costs are in line. In terms of our office portfolio, we have about 9 office projects with around 1,600 crores of estimated capex. We are hoping to get our current portfolio is about 1,500 crores in terms of leasing revenue, and we're hoping to grow that to maybe another 2,000 crores in the coming years ahead.
And that is when you plan the REIT or separation of that business or value unlocking out there?
Yeah, we'll definitely be examining that based on the top line.
So that happens in the next couple of years?
These projects have to get built out, leased up, and then we will take a call accordingly.
All right, take that point. Thank you so much for joining in and giving us an outlook to your business. The fourth quarter obviously depends on the launches, the sort of bookings growth that you've earlier guided for, whether you get those approvals in time or not. But over the next 4 quarters, 12 million square feet worth launches are planned, and 4 or 5 million, of course, realistically could happen in the next couple of quarters itself. Meanwhile, just looking at the market right now, the Nifty is down 90 points. So there is an accelerated shift on the way down, which has taken place. At any point in time in the last 20 minutes or so, one would have shorted, they would be making a fair amount of money. But let's shift focus to the bond link and let's figure out what's taking place in that part of the market as well. Is the street a little worried? The bond market action, Manisha Gupta joins in as always. Manisha.
Well, thank you so much for that. On Bond Street today, we are talking about the bond markets and the kind of impact that we've seen come in from the budget onto this one. So the last couple of days, really, we've seen the bond yields continue to gain up. The 10-year yield is currently trading at a 1-year highs as well. There was an expectation of higher borrowing program from the government, and that's exactly what you have seen. Higher capital expenditure and higher borrowing program. So when you look at FY27, the government will borrow a record rupees 17.2 lakh crores, which is 18% higher on a year-on-year basis. There have been concerns on debt supply and liquidity conditions in any case. There also has been a fear on demand-supply imbalance into the bond markets there. Also, when you look at the heavy issuance that we've seen from the center and the states and the weak demand therein, that has been impacting the bond and the yields therein. The government also is planning to raise a 1.3 trillion via treasury bills. That seems to be impacting markets right now. Also, when you look at the Indian rupee, we've seen a 2% decline in the month of January. There are adverse global backdrops as well, pushing the yields in the Indian markets higher. So while that is about spending and what's really happening in the international cues and macros therein, the budget also talks about steps to broaden the participation and improve long-term funding options when it comes to within the segment here. And that perhaps is going to be positive going forward. So to name a few, it's going to be a 100 crore incentive for a single municipal bond issuance exceeding rupees 1,000 crores therein. It will encourage larger and, of course, cities to raise funds through the bond markets therein. There also is introduction in the meanwhile of total return swaps on the corporate bonds. And then the finance minister, Nirmala Sitharaman, also spoke about market-making framework, especially for the corporate bonds. So some positives as well coming in from the bond markets from the budget therein.
Anisha, thanks very much for bringing us that. Though positives on the bond market development, Mangalam, not so good for the banks, where incrementally some of the credit has been shifting to the bond market. So perhaps an incremental negative there. And of course, the hit from the Treasury book because of yields rising. We'll take a short break, but up next, we'll get chatting with the management of Arvind on their third quarter numbers. So stay tuned.
Welcome back. The Nifty down 120 points now, on the verge of breaking that 24,700 mark as well. The Nifty Bank down almost 1%, with the mid-cap index lower by 670 points. Important corporate conversations lined up for you on the show, and now we have the management of Arvind Limited joining in, especially after the big announcement that came in from the budget yesterday, where the finance minister did say that they have been making plans for textile parks and increasing the skilling, etc. Integrated textile program outlay of close to around 1,500 crore rupees. Will this actually make a dent? What kind of impact will it have on the sector? Puneet Lalbhai, who's the vice chairman at Arvind, joins in. Thanks a lot for joining in. There is this National Fiber Scheme which has been announced alongside the announcement of mega textile parks, etc., the outlay of almost 1,500 crore rupees. Puneet, in the past, we have seen announcements like this come by. Do you think this one is any different from those and will make a difference to the sector, which is currently under a bit of uncertainty, especially given the sort of geopolitical, tariff-related uncertainty that we're facing right now?
I feel the government has been doing quite a bit around sort of creating good conditions for the industry. And this announcement is one more step in that direction. If you see the importance is to grow the ecosystem in India, especially around garment making. And I think these mega textile parks are definitely a step in the right direction. And that, coupled with the sort of FTAs that we have been able to close, the advantage of which will start to accrue sometime down in the future. I think it's definitely a step in the right direction, and I'm quite optimistic about all the efforts that the government has been making. And now it's up to the industry to take advantage and bat on the front foot.
But Puneet, could you put specific numbers in terms of how much of a benefit does this really bring? Because as Mangalam was saying, these have been announced in the past. We haven't seen it translate meaningfully into positives for players like you. And secondly, you said in the near future these FTAs will start to accrue, show benefits. What is that near future? Because the headwind currently for you is the over-dependence in the US market. How quickly do you think you could diversify, and what could the mix look like, say, 3-4 years down the line?
UK and Europe are very important markets for us right now. They comprise close to 8-9% of our overall turnover today. And going forward, we should be able to double our presence in these markets. So it's not an insignificant announcement for us, the FTAs. And the FTAs are under a ratification process, which takes time. I mean, in the case of other countries' FTAs also, it's taken time with these two geographies. So there's no reason to believe that the benefits won't accrue. And I think FTA is a very big deal because it's almost 10-12% in a net 6-7-8% business overall, right? So, the other announcements will pale in comparison to the benefit that one gets through FTAs. So we are very optimistic about the future. And historically, India has been an upstream textile player, playing mostly in yarn and fabric. And it's only now that we are seeing investments go into garments. And some of these major reforms were required and have been made. So I think the government's done its part, and I'm quite optimistic about the future.
All right. Can you put some numbers to the optimism then? If you look at the third quarter, your revenue is at around 1,800 crores. We did see some... your margins saw a bit of an impact, stable at around 11.5%, but not a big growth that we saw out there. What's your outlook for the next year?
So I would say this was a very good result in the context of all the trade uncertainty. We grew by 14%. Our EBITDA actually grew by 15% year on year. So overall, the if you look at the advanced materials business, that has shown very good traction. We grew at almost 30% quarter on quarter. Garments is up 22%. So overall, it's been a good quarter for us. And despite the headwinds, we see good traction in demand. So we should be able to continue this kind of trajectory going forward.
All right. If these tariffs, let's say we haven't heard more on the deal yet, if they persist through FY27 for a few more quarters, what kind of pressure do you think you could see, especially when it comes to the margin trajectory?
So I think we have currently achieved a balance to where, we've passed on discounts in lieu of additional volumes. We have done a lot of work on saving cost. And then there is the dollar that has worked in our favor, which is also linked somewhat to these uncertainties. So all in all, we should be able to continue this trajectory even if tariffs remain where they are. And then, of course, there is a very strong effort to diversify our dependence from the tariff-impacted markets, which is an effort that is slowly and surely yielding fruit. So all these things put together, we can be cautiously optimistic. But as you rightly say, in the face of these uncertainties and changes that continue to occur, one has to always factor that risk in. But so I would say it's a mood of cautious optimism going forward as well.
Got that. Take that point. Thank you so much for joining in. Wish you good luck, and we'll obviously monitor the changes that this budget brings about in the sector as we look at the free trade agreements that we signed as well. But the market's sharply off highs, and that's where the trends from the F&O space come in as well. You have the Nifty Bank, the mid-cap index, all of them at the lows of today's trading session. The advanced decline tells you a story of the day as well, with over 2,000 stocks in the red. The important part is that despite this decline, the India VIX is relatively stable, and the put-call ratio, which was at 0.59 yesterday, is now holding at around 0.74. So those two factors doing a lot better for the market than it was yesterday. Let's see whether there is support at these levels or not, because there are writers at the 24,700 put, and there are writers at the 24,800 put as well. If the market sustains at these levels, those writers will have to unwind their positions, and that would take the markets a lot lower than what it is right now. Though call writers are fairly active at 24,800, so that tells you that any level above 24,800 would see a fair amount of supply coming in. So the key Nifty levels to track then would be yesterday's low of 24,571 and today's high of 24,943. So this broad range of around 300 points is where the market is likely to move and stay choppy, but those are important levels to track as we speak. Take a short break, come back on the other side. We'll get chatting with the management of Motherson, but before that, we'll also discuss the market outlook. Gautam Duggar of Motilal Oswal joins in.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back. The market's under pressure, but we are discussing the after effects of the budget. The analysts, the experts, all of them have passed through all the fine print, and now we need to know whether there is any actionable idea that has come in from the budget or not. Gautam Duggar of Motilal Oswal Financial Services joins us now. Gautam, always a pleasure speaking with you. You've been tracking the Nifty earnings very closely. Each component, tweak them, speak about valuations, etc. Was there anything in the budget that caused you to, tweak those estimates and perhaps come up with any actionable ideas, or is it still more of the same?
Hi, Mangalam. Thanks for having me here. No, absolutely. We didn't need to do any change to our earnings estimates, and that's never been the case actually for the last 4 or 5 years. Typically, budget doesn't make big changes to sectoral earnings. Budget is more a top-down sort of a policy statement. We don't even expect budget to change our earnings materially, unless there are cases where the government had reduced the corporate tax rate 6-7 years back. That was when we needed to make big changes to our earnings. But otherwise, it's very peripheral. And given yesterday's budget, I don't think there is too much sector level changes as far as Nifty is concerned. Of course, there are several sectors which have seen some initiatives and announcements, but that's more bottoms up rather than it leading to any meaningful changes in our earnings estimates for the benchmark indices.
Okay. Gautam, you said the budget was a missed opportunity to perk up the markets. I mean, what was the biggest disappointment for you? And if that STT coming in, does that meaningfully change your view on, the outlook for exchanges, for brokers? Any revisions there?
So, look, I mean, there are two ways to look at it. We didn't have too much of expectations from the budget to begin with, which is what we had published in our preview, which we did 2-3 weeks back for budget. I mean, you can just assume that instead of August or September, if the government had done the GST cut in the budget, perhaps the budget headline would have been very different. STT raise did come across as a sore point. Not that it's going to have any meaningful change. Of course, the market reacted in a different fashion yesterday to some of those broking stocks. From what we understand, it's going to have some impact on the futures volume, but options volumes are not going to see any meaningful change out there. Some of the future volume may shift to cash or options. We'll have to see as we move forward. But the stocks, the way they've corrected, some of them have become quite attractive now. A couple of them are in our model portfolio. We're quite positive. We're very sanguine on the capital market themes in India, notwithstanding the near-term volatility that it will, entail, because the cyclical stocks and the sentiment in the capital market plays a huge role in the near-term stock price direction of some of these companies. But the story from a medium-term perspective remains extremely solid. Not just broking and exchanges, but even the other elements of the capital market ecosystem, which is the asset management companies, the wealth managers, the intermediaries, the depositories. So we have an overweight stance on that space in our model portfolio.
Right. There's one name to the game. It's called volatility. The Nifty is back in the green right now. The Sensex too is back in the green after testing levels of sub 24,700. The Nifty is now back above 24,800, and all in a matter of last few minutes. The Nifty Bank, which was down 700 points just moments ago, is now down just 380 points. So that's how volatile this market has been. And we were pointing out that despite the decline that we saw, the India VIX was fairly contained. So that told you that the downside perhaps may have been limited. So now the market's tested the lower end of the range. Let's see whether the upper end of the range gets tested or not as well. The rupee weakening from today's high of 91.4 thereabouts. It's weakened further to around 91.7. Gautam, markets are mainly moved by earnings, and we're in the middle of the third quarter earnings season. What have you made of the numbers so far? How do they track versus your expectations? And any meaningful upgrade or downgrade that has come by?
No, Mangam, look, for our coverage universe, out of 355 companies, about 189 companies have reported numbers. For those 189 companies, the numbers are bang in line. Earnings are up 14% versus expectation of 13%. And for the Nifty 31 companies which have reported so far, the earnings are up 7%, which is also in line with expectations. There are several sectors which have done well, auto, capital goods, the NBFC cohorts, metals, even retail for that matter, consumer staples at about 10-12% earnings growth is at a multi-quarter high number. So a lot of these things are getting ignored given the other extraneous considerations which the market is right now grappling with. I think once the budget is forgotten in 2-3 days, the focus will shift back towards corporate earnings and fundamentals, and which is where the picture is turning slightly brighter. In fact, the pace and intensity of the earnings downgrade has also come off, which is what we'd highlighted a month back in our note. Even this quarter, as we progress, we've seen only about 0.3, 0.4% kind of earnings cut. So the 15 to 17% earnings growth estimate that we have for FY27, and I'm sure skeptics will have arguments on that, and rightly so. But as of now, it is intact. We're still talking about a 16-17% earnings growth for Nifty in FY27, which essentially makes Nifty now below 20p at 24,700, the level that you mentioned a couple of moments back. So I think valuations as far as large caps are concerned are now in a territory which one may not call screamingly cheap, but it's quite reasonable now. It's trading at a long period average, which is 20.5 times. We are now at 19.6 to 19.8 times. So marginally below 20p. So yeah, I mean, earnings are turning slightly better, which is what the expectation was. That second half of FY26 will have better numbers given the low base and some of the positive impacts of the steps that the government and RBI have taken in the last 9 months, which is the GST cut, rate cut, interest, income tax cut, all of that. So that is manifesting in the numbers right now. And we are quite constructive on earnings for FY27 as we expect even the credit growth to start picking up a little bit from where we are right now.
All right, we'll watch for all of those cues as the market, the budget noise drowns in the next 2-3 days. Gautam, thanks very much. Always a pleasure to have you on the show. We have to take a short break, but up next, we're going to be joined by Anurag Gehlot of Motherson Sumi Wiring. Stay tuned for that.
You want to talk business? Meet me in the On-Board Lounge.
Motherson Sumi Wiring is the next management we have joining us on their third quarter numbers. The company's revenues have risen 25%, but margins have declined over the past year. Anurag Gehlot, the Chief Operating Officer of Motherson Sumi Wiring India, is with us. Anurag, Welcome. Thanks for your time here. You know, copper prices, have we been seeing elevated levels? The rupee, again, has weakened. How much further pressure should we expect in the fourth quarter numbers from you?
Hi, good morning. Thank you for taking us on CNBC. Yes, as you have seen that this is the highest ever quarterly revenues driven by the strong industry growth and increased content per car in the automotive industry. Having said that, we have grown 10.5% EBITDA year on year, though we are seeing a sequential margin pressure, and this is due to the rising commodity prices, and copper is one of the commodity in our cases. But we have the back-to-back arrangement, the pass-through arrangement with the customer, with a lag of a quarter in the major customer and on 6 months for the rest of the customer. So this is not something which is very much worried to us at this moment, because we have this customer contract in place where we have pass-through arrangement with them on the commodity as well as on the forex fluctuation.
So how much lower can margins go before they start stabilizing? You said it goes with a lag of a quarter, right? Between the second quarter and the third quarter, there's been a big spike in the copper prices. And not just that, even the rupee has depreciated, right? So how much is the headroom available right now?
See, as I explained you that we have grown, the margins with year on year by 10.5%. There is a sequential basis. There is a little pressure which we are seeing, but we are not worried because this is a arrangement with the customer back to back. But as a company, we believe in doing the ROCE. Our target is more than 40%, and happy to tell you in last 3 years. We are doing more than 40%. This year also in last 9 months, we are on track. And by the Q4 end also, you will see that the positive, more than 40%, subject to what customer is going to manufacture, what they have forecasted to us.
Okay, more than 14%. We also understand that the revenues did not account for the kind of copper prices rise that we've seen in the third quarter. So will we see that in your Q4 numbers?
See, as I explained that copper is, is a back-to-back arrangement with the customer. So, the 25% growth is consist of 2-3 things. One is obviously the impact of copper in that. But other than that, market has grown by 19% and we are growing by 25%. So one is the volume growth, and content is also growing into the business other than the copper price increase.
All right. And if you could give us a sense on the content per vehicle, any trend on that? How much was that about a couple of years ago, and how much is this now? How much is that likely to grow with your new products coming in? That's one. And secondly, your new greenfield units as well. They're ramping up. What's the capacity utilization there? And by when do they get to the ROCE that you have for the company level?
Okay, so first coming on to the second part of your question, on the greenfield plants, if you see that one of the plant, Kharkhoda, it is already ramping up the volume and reaching to 80% capacity utilization very soon in Q4. The plant in Gujarat, Mandal, there are two projects, two powertrain projects which are under launch at this moment, and they will be also ramping up the volume by Q4 and Q1. And the third plant in Pune, which is around at this moment, is coming to around 50% utilization. Other than greenfield, most of our balance plants are reaching to the 80% utilization because there is a surge of the demand from the customer. And as a company rule also, as soon as we are touching to 80% utilization, we started doing the expansion into this. But they are backed by the customer firm order. So you will see in the future also that how we are going to, doing the expansion into the coming times.
You're doing the expansion, but what about breaking even? When do the greenfield units break even?
See, if you see the greenfield projects at this greenfield plants at this moment, there is a improvement onto the greenfield plants as well. Obviously, all these plants, we have to see the volume also. The forecasted volume given by the customer is the key into this. Though some of the volumes has gone as per the forecasted, but some of them are not. But we are very much positive because these capacities are fungible. So in case the new businesses are coming to you, you can always put these new businesses into these capacity and can run the plants.
Right. And you did not answer on the content per vehicle. What does it stand at right now? Where was it earlier and where do you intend to take it?
At this moment in passenger vehicle also, you will see that most of the vehicles being sold, more than 60% are SUVs. And in these SUVs also, people are looking for the feature loaded models. So once the feature comes into the picture, a wiring harness get a little more with a higher content into that. So it all depends. If the customer is keep choosing the higher, higher specification of the cars, then obviously wiring harness sales and content will be growing accordingly.
Could you give us a sense of what the average duration for your contract revision is like? And when does that start to show in your numbers?
Sorry, can you repeat the question, please?
What is the average duration of your contract revisions and this repricing impact? When do you think it'll start to show in the numbers?
See, these customer contracts are to the full life for the model. And so we work accordingly to on these contracts. But as far as the margins are concerned, at this moment, yes, sequentially you have seen a little pressure. But as we have grown 10.5% year on year also, so the idea is that to keep improving the cost, the manufacturing cost. And for that also, we are doing an investment on the automation and digitization into the plants, where our focus is to improve the productivity and increase the process efficiencies so that, we can save the cost on the direct and indirect cost, and these margins can keep improving as the time goes by.
Right, electric vehicles, which were supposed to be the big game changer for the automotive industry, and a lot of players like yourselves also, wanted to be present in this via powertrains, etc. It's just about sub 6% of your revenue right now, and also that is the kind of proportion that it has in the overall market too. The street was expecting faster growth out there. Do you think there are reasons why that hasn't happened? And what is your own plan in terms of contribution coming in from EVs?
See, as you said that EV is approximately 6% of our this Q3 sales revenue, and this consists of passenger vehicle, commercial vehicle, buses, two-wheelers, and even three-wheelers as well. So MSWIL is already available, supplying to all the categories into the EV. And for EV, I can tell you that it is a more complex wire harnesses compared it to the low voltage. And we have to just see that in the greenfield also, if you've seen that one of the EV powertrain is getting a volume ramped up in Gujarat, and another one is launched as we speak right now. So EV penetration is there in the market. As a company, we are ready because we are already supplying to all the segments. So as soon as the volumes will come, we are a future ready organization, and we'll keep supplying as the customer need, whether irrespective of any powertrain.
And you don't have any target, aspirational target out here that maybe 10%, 15% or 20% should come in the next couple of years?
See, we have to listen with the, to the customer requirement. That is very important. So if customer is looking for any powertrain, irrespective of EV or, or ICE or hybrid, we make sure that whatever customer is looking for, we are ready for that. So there is no as such target for ourselves, driven by the OEMs. If customer is asking us to produce EV or to CNG or any powertrain, we are just ready ourselves for that, these 30 plants, which we are serving right now to these OEMs.
Anurag, just very quickly, the copper price hike, when will it be passed on? I think in the con call, you did indicate that the pass-through will be with a lag of a 3 to 6 month window. So when exactly will it be passed on?
See, there is a pass-through arrangement with a lag of a quarter with a major customer, and in some cases it's a 6 months also. So you're just seeing that it's a matter of, it's a temporary phase at this moment. So
now we're currently about a month into the third quarter. So have you passed it on from the second quarter?
Yeah, obviously, if you see from the second quarter, if you compare it or year also, there is not a very huge increase. But yes, in Q3, you can see there is a increase of around 15% on sequential, and I think around 20% plus odd on year also. So the mainly impact in the Q3, which should get settled by the Q4 and further in the Q1 of FY27.
All right, take that point. Thank you so much, Anurag, for joining in and giving us all your internal details, etc. What we'll do is we'll circle back after a quarter to find out whether you've actually managed to pass it on without that having any impact on your demand and your margins going forward as well. Thank you once again for joining in. With that, we'll take a short break, and on the other side, we'll get you an interesting update coming in on the PSUs. The market continues to hold in the green while volatile, holding above 24,850 for the frontline index. $24,870 and counting on the Nifty, but the government has set 80,000 crore as its divestment target for FY27. The economic survey too had made a recommendation with regards to the government bringing its stake in multiple PSUs below 51%, and the DIPAM secretary told CNBC TV 18 on all possibilities that are on the table. What does that mean for all those of you who've invested in PSU stocks, and which could be the ones which could be privatized? Well, Hormaz joins in with a detail and the PSU basket. How much value can the government potentially unlock? Hormaz.
Every time the budget is presented, one major section that has been awaited keenly by the market is the disinvestment target. Now, this year, the disinvestment target has been set at 80,000 crore for FY27. Now, before that, the previous years, there have been ambitious targets that have been set, but the targets have not been met. Now, yesterday, the DIPAM secretary told CNBC TV 18 that the eco survey mentioned this point, right? That there is a possibility of the government bringing its stake to below 51% in a lot of these PSUs. These are very exciting possibilities, and everything is on the table. Now, when you say something like this, there always is this question that what happens when everything on the table does fall into place. Now, on this analysis, we have analyzed 84 PSU stocks that are listed. This includes companies that have government stake of less than 75% as well, which are in compliance with minimum shareholding norms, and also includes PSUs which have other PSUs as their promoters and not directly the government. Now, when you take a look at the companies as well, there are 9 such companies, PSUs, that have the government holding more than 90% stake still. There are 10 companies between 75 to 90, and most of the others fall in the 26 to 75% range. But when you take a look at the total value, the minimum stake that the government wants to hold in these PSUs, 26%. In a hypothetical scenario, the total value of the stake in excess of 26% comes up to well over 27.5 lakh crore rupees. Now, that is the total government stake excess of 26% in a lot of these PSUs, and this is as of yesterday's closing. Now, which are these companies that we are talking about? Now, most of these companies, the more than 1 lakh crore value, is 5 of such names. There are 12 companies that have value between 50,000 crore to 1 lakh crore, 14 companies which are valued between 25,000 crore and 50,000 crore. I'm talking about the excess government stake above 26%, that is. Now, which are those companies if you drill that down? You take a look at LIC, of course, the government continues to hold well over 96% stake in the company here, and that excess 70% that they own is still valued at over 3.5 lakh crore rupees. Follow that up with India's largest lender, SBI. There's almost 3 lakh crore rupees to be unlocked there as well. The HAL is the other one, almost 1.5 lakh crore. Concor finds a mention here, that excess 54% stake comes up to around about 1.1 lakh crore. And of course, there is ONGC, which is of course more than 1 lakh crore rupees as well. I'd like to highlight one specific instance, which is IRFC. The stock has been listed for almost 4 years, but the government is yet to comply with minimum shareholding norms here. The stake still lies at 86.5%. The excess 60% that they own currently is valued at close to 90,000 crore rupees. But at the peak, when the stock was at 229 rupees, that stake was almost close to 2 lakh crore, and the stock is down almost 55% from those levels right now. But of course, the DIPAM secretary may have said that everything is on the table, all possibilities are on the table, but there are enough and more challenges. As you mentioned, that there are 9 such companies where the government holding is still more than 90%. Divesting such a large equity base is still going to be a challenge. Now, there are long completion timelines. IDBI Bank is a case in point. The disinvestment process began almost 5 years ago. It's still ongoing, and it may reach a completion by the end of this financial year. And the other major question is whether sensitive sectors such as the defense sector, the railway sector, should those be exposed to external shareholding? Of course, there are mutual funds and so on, but an external promoter or external control, should that be a question as well? So that is an important question to watch out for. But the government has said that everything lies on the table, and there is almost 27.5 lakh crore rupees that's still left to be unlocked.
Everything on the table, but Hormaz, disinvestment targets, I mean, the government has been missing them for a few years, and that 80,000 number this year as well looks like a bit of a challenge, so we'll have to see. Like you said, it's been 5 years in running on IDBI Bank. As we close, the market's in the green. Nifty up about 35 points. Sensex up another 230 points. The mid-caps, though, still under pressure. On that note, it's a goodbye from Mangalam and me. The next show will take all the action forward.
Stocks trade weak with mid-caps bearing the brunt, reflecting in a high declines to advances ratio. PSU banks, healthcare and IT are the big drags, with energy being a rare gainer. Revenue Secretary Arvind Srivastava tells CNBC TV 18 that the hike in STT was motivated by an intent to curb excessive speculations in the F&O segment. Market players, however, wish the mop-up was used to offer tax relief to long-term investors.
DIPAM Secretary Arunesh Chawla is confident of meeting the government's divestment target via a mix of asset and PSU land monetization along with traditional divestment. He says the government is also open to considering less than 51% stake in PSUs as suggested by the Economic Survey.
Automobile sales in January show sustained momentum following the GST rate cut, with most players reporting double-digit sales growth. From SUVs to tractors to CVs to two-wheelers, the pace is healthy all around.
Hello and welcome to Halftime Report on CNBC TV 18. I'm Ekta Batra. With me is Sonal as well as Vinny. Well, it's turning out to definitely be a very choppy session for the markets, and the broader markets are not faring any better in today's trading session. So we have the mid-cap index, which has recovered from the day's low, but still down around 0.8%. We have an advanced decline ratio, which is extremely dismal at this point in time. And the Nifty, which is just about flitting between red and green, undecided in terms of the direction that it wants to go. So the low point of the day was 24,679 for the Nifty, and the high point of the day was around 24,943, to give you a sense in terms of the kind of volatility and range that we've seen in today's trading session. But let's see more of the details in terms of stocks coming out through the day. So that's what we're going to be looking at in today's trading session as well. Vinny, Sonal, hi.
Hi, good afternoon. Absolutely, a lot that we'll watch out in terms of stocks, but a choppy trading session like you mentioned as well. And in terms of sectors today, we're seeing continued pressure coming for metals, pharma, media, not doing well in the trading session. What's managing to hold on to some bit of a gain today is the auto pack. We have those auto sales numbers obviously that are coming in as well. We'll watch out for that. But an interesting day of where we're going to be headed in the second half of the trading session, that will be key as well, Sonal. It will be. Markets continue to be on our radar. And that STT increase that came by on F&O is something that spooked the street as well, though the recovery is underway. So while we are talking about this F&O tax hike impacting the stock markets, there is another impact as well, and that is on arbitrage funds. Now, do remember, arbitrage funds are a type of hybrid funds. They do have exposure to F&O as well. And a lot of these funds have massive positions in the F&O space as well. And that's the reason this hike that has come by in securities transaction tax is something which could impact returns for investors, because fund managers book profits by leveraging the price difference between the current and the future markets, the cash and the futures market, that is. And that is the reason why these funds will be in focus. Now, do remember the yields on these funds usually is anywhere between 6 to 7%. However, if we talk about some calculations, because every fund will have a different exposure to the futures market, so depending on that, the impact on returns will be 0.3 to 0.5%. This is a short-term asset class where investors can park their money for a shorter period of time. And this was a category which a lot of investors were looking at from a short-term period because they have a better taxation structure. They are taxed as equity, while liquid funds are taxed as debt. So there was a differential of 1 to 2% in terms of returns as well post-tax. So now that differential comes down. But yes, still, arbitrage funds are better when it comes from a taxation perspective. But yes, the returns could be a little bit lower, and that is what is the takeaway from this STT hike that has come by.
Okay, all right. But we have a whole host of questions to ask our guests. We have Varun Lochab, who's the head institutional research at HDFC Securities, who's joining in now. Varun, hi, welcome to the show. Well, it's turning out to be a choppy session, but let's start with that discussion on STT. And what do you think is going to be the impact on companies such as, say, Angel One, Grow? Do you think it's going to have a significant impact in terms of volumes for them and your overall sense?
Yeah, hi, good afternoon. So yeah, that was clearly a dampener from a sentiment perspective, the STT rate hike, because I think most of the market participants were not expecting it. But at the same time, having analyzed the impact, we don't think the exchanges or, even the broking companies will have a significant negative impact. If you see in the past, when STT increases happened, frankly, that did not dampen the trading activity to that extent. I think it's the other factors, your outlook on the market and, the overall mood of the market, which impacts the trading volumes far more than, STT per se. So we don't see a very significant impact. And especially in case of BSE, like, which is a company under our coverage, they don't have much exposure on futures where, the increase has been sharper. So they won't be impacted much. And similarly, Angel One also, from our coverage perspective, we don't see a significant material impact because of this STT hike, on their trading volumes.
Okay, so your outlook overall for maybe all these capital market names continues to be positive going forward as well, short term or medium term?
Yeah, so we have been quite positive on this space. Both BSE and MCX have been our topics for quite some time. MCX, we continue to run as our topic across our model portfolio as well. And we are very comfortable holding some of these names from a medium-term perspective.
Varun, the other change that has come by is in the buyback taxation. And since the time from 2024, it was changed as being taxed like a dividend income. The companies were not going ahead and putting out so many buyback offers, right? Do you think now that trend could come back? And the higher tax rates that's come from promoters, what do you make of this? And IT space is one which sees the most amount of buybacks. How do you read this change?
I think overall it's a very welcome change, a very positive move, to kind of tax them on the lines of capital gains instead of and more so I think in with markets in a correction phase over last 12 to 18 months, hopefully more companies will be starting to do buybacks if the valuations start getting attractive and the froth is coming out. So from a timing perspective also we believe it's timed well because hopefully we'll see more buybacks in the next 12-18 months than what we saw during 2023 or 2024 sort of a time period. So a very good move and a very welcome and positive move for the companies.
Well, it seems as though the froth is definitely coming off for silver and gold at this point in time, Varun. I'm sure a lot of investors are probably asking about what they should do in terms of their holdings when it comes to precious metals separately, or maybe the ETFs where they have positions as well. What is your recommendation?
See, like we cover more on equities, but from a HSL perspective, our overall house, had turned a bit cautious on, gold and silver, especially towards the end of the year and early part of Jan, because the move was really, too fast. Even though we were expecting precious metals to do well at the start of the calendar year, first 20 days of, this calendar year itself was sort of return which we had not expected. So we had turned cautious, on these precious metals. And I think it's more like a speculative unwinding, which is probably leading it to sort of, overreaction even on the downside, just the way we overreacted on the upside. So I think from a medium or long-term perspective, one should not be changing their asset allocation significantly. We have been saying that 10 to 15% exposure to precious metals in your multi-cap portfolio, one should continue, and ideally one should have rebalanced at a very sharp increase, which we had seen, gold to Nifty or, silver to Nifty sort of ratios were really off chart. And I think that is correcting now.
Okay, Varun, thank you so much for joining us this afternoon, giving us a view on the markets as well as even in terms of gold and silver, 10 to 15%. Keep your asset allocation for the long term. But on that note, we're going to step into a very short break. Up next, we will connect with the management of Sun Pharma to decode their Q3 numbers. Stay tuned in for that conversation.
Welcome back. You're still tuned into Halftime Report on CNBC TV 18. Well, Sun Pharma reported what was a strong set of Q3 numbers, with their revenue, in fact, growing this quarter at around 13% and margins also expanding. I did catch up with the management of Sun Pharma and began by asking about the budget announcement of the 10,000 crore outlay when it comes to biologics. Listen in.
This is a welcome move by the Indian government. It's a step in the right direction, and I believe that it will give a big boost for the India's biological space. Funding of the R&D, better clinical trials and infrastructure, getting faster approvals are all going to be good from an overall perspective, and it will help us to stay competitive in the high-value therapies. We do expect more to come in. And with government and the pharma companies working together, this could be a very interesting space for us to be in.
Okay. All right. Well, before we get to the numbers, Ms. Jayashree, I wanted to basically quiz you on the big market speculation which has been doing the rounds for Sun Pharma, which is the potential $10 to $14 billion Organon acquisition. Your comments on whether you've thrown your hat in the ring when it comes to this acquisition?
Look, we have clarified our stand on this. We do not respond to market speculations.
Okay. But can you comment at least on whether or not a deal of this size fits your strategy as a company?
We do not respond to market speculations.
Okay. But in terms of M&A strategy, if you could just surprise us of what the company is thinking on M&A.
We continuously scan the market for opportunities. Our capital allocation priority remains the same, with our primary allocation which goes towards the innovative medicine business. We have looked at emerging markets, and we will look at it on an opportunistic basis as well. Our strategy hasn't changed.
But would the US be a priority market considering the push towards onshoring?
Yeah, US continues to be a priority market for us. We have a large presence there.
Okay. There are talks of you might be looking at Brazil as well. Would you like to comment on that?
Not really.
Okay, all right. Well, I tried my best there. But if you could now just, sort of narrow down on the FY26 guidance. You had guided for mid to high single digits plus $100 million in terms of specialty investment. Is this on track?
I think our results for the past 3 quarters have come out well. We would continue to focus on performing to our potential, and we believe that we will end the year towards the higher end of the guidance.
Okay. Anything that you can apprise us of when it comes to the innovative medicines portfolio, which came in at around $380 million this quarter? Estimates were $365 to $367 million. So you did better on that front. Should investors now model in maybe high single digit or low double digit growth when it comes to the specialty business or the innovative medicines business on a sustainable run rate?
I can tell you that our innovative medicines business has been growing pretty steadily, both in the US and across the other geographies where we have presence for innovative medicines. We will continue to focus on further growing these.
All right. The big question is semaglutide in Canada. Where do you stand for that?
Currently, our focus is on launching the product in India.
Okay, but you've applied for the approval in Canada, correct?
Yes, we have applied for the approvals in Canada, and as and when we get the approvals, we will be in a position to talk further on this.
But any timeline?
I do not have a timeline at this point in time.
All right. About India, it's expected to be a very competitive market. What are you expecting from semaglutide here?
As far as semaglutide is concerned, Sun, as you know, is a market leader when it comes to cardiometabolic segment.
Yeah.
We have approvals for both chronic weight management as well as type 2 diabetics. and we have approvals in all the 5 strengths. Both our new products, Novel Treat and Smart Trinity, will be dispensed in easy-to-use formats. And we are all pretty excited about launching the product on day 1.
All right. What about maybe launches in other emerging markets for semaglutide?
We do not have much to comment at this point in time.
All right. What's your outlook for the US business, considering that, Revlimid generic, the opportunity is now dwindled? We do have pricing pressure, which companies are also facing. What can we expect in terms of guidance for the US?
So US is interesting for us with both innovative medicines as well as generics. On the generics, we've been seeing a price erosion over the years, and that situation would continue to happen. We have our set of products which we will be marketing in the US. At the same time, as and when our facilities, the manufacturing facilities are coming out of the compliance regulatory requirement, we will be ready to launch new products for the US market.
Okay. And if you could just end by giving us a guidance in terms of what the status of the plants Halol, Baska as well as Mohali would be, and what are the timelines in terms of what the street could probably expect in terms of remediation?
So we are working on putting together the actions. Once we have the FDA come in and look at our facilities, we will be in a position to further comment.
Okay, all right. That's the one word coming in from Sun Pharma. But with that, we'll slip into a short break. When we come back, Vivek will take us through the stocks that are moving around in trade today. Stay tuned for that.
Fly Emirates, fly better.
Welcome back to Halftime Report on CNBC TV 18. As of now, the Nifty is at 24,896, almost near the day's highest point. We'll wait out for where it's going, up 70 points in the trading session as of now. But a lot of stocks that are moving around in the trading session. Why are they moving around? Let's go across to Vivek to give us that list. Good afternoon, Vivek.
Well, good afternoon. So much volatility in the markets, especially in the first 3 hours of the trading session on the day immediately after the budget. The first stock on our list today that's moving quite sharply higher is Reliance Industries, a sharp up move leading the index higher. Remember, it's a heavyweight, over 2% higher on good volumes today. Tata Motors passenger vehicle, very good set of numbers coming in as far as the monthly sales was concerned. That stock, the top gainer on the Nifty today. Paytm cooled off a little bit from the day's highest point, but this particular stock, opened sharply gap up. Again, higher UPI incentives is something that the street is looking at quite positively. Two names, from the real estate pack seen benefiting from increased data center tax relief. Both Anantraj as well as Lodha developers today higher by over 2.5% and 3% respectively. And the entire OMC pack, HPCL, BPCL, IOCL, clarification coming in that there is no excess excise duty is something that the street is taking quite positively. On the other hand, quite a few laggards as well. The entire metal pack continues to languish under pressure today. SAIL, Vedanta, JSPL, all of these stocks under pressure. The entire NBFC basket, hardening yields is something not seen very positively as far as NIMs are concerned. Most of the NBFC names like Shriram Fin, Chola Fin, LIC Housing Finance, all of them under significant pressure. Intellect Design Arena, one name from the broad end of the markets, continues to fall under after week Q3. This particular stock down over 7% on high volumes. And Glenmark Pharma, worries of a GST inspection on the stock is something that is leading to quite a bit of a sharp sell-off, over 4% lower for Glenmark today.
Okay, some interesting names there. Thank you so much for getting us the individual names which are buzzing around in trade, Vivek. And with that, it's time for another break. On the other side, Manisha Gupta will join with Sabyasachi Ray of Gem and Jewelry Export Promotion Council. This will be our What's Trending segment. Stay tuned for that conversation.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back. Well, it's a volatile day for the equity markets, but let's focus on our What's Trending segment today, and it has to be gold and silver prices. Gold and silver ETFs, they remain under pressure as bullion prices have extended their decline for a third consecutive session. Gold has seen its biggest single-day plunge in over a decade, while silver has also seen its sharpest fall on record. As a result, we have gold prices which have slipped below $4,550 and silver which is now trading below $74 at just about those prices. The sharp correction is weighing on precious metal ETFs, with investors now reassessing possible positions amid this heightened volatility. Well, let's listen in to S. Narain. He's the veteran investor and ICICI Prudential AMC's ED and CIO. He sounds caution on the precious metals rally and advises against investing in commodities. We'll also go to Manisha Gupta, our commodities editor, for more on our What's Trending segment. Let's start with S. Narain and what he had to say.
Over the recent past, we have been continuously telling people don't invest standalone in precious metal ETFs or fund of funds. Focus only on multi-asset so that you're not investing big money in precious metals at this point of time. A framework that we have is that whenever any asset class gives you triple-digit return, that is more than 100% return, that in a year, you have to be careful in that asset class. And that asset class is silver at this point of time. So that's what we've been trying to do, but people want us to guess correctly an asset class which can never be guessed correctly, because you see the daily moves in silver, you know it is impossible.
Well, yes, nobody could have said it better, by the way, because the kind of moves that we had started to see, the overheated froth in the market, clearly perhaps had to end this way. So I just want to take you through prices right now. That is gold international prices for you. Well, remember, the international all-time high has been 5,600. We are trading at 4,500. So that is $1,000 per ounce of a decline in a matter of 2 or 3 trading sessions there. Very, very sharp cuts coming in. Even on your screens right now, it is 7% down. Take a look at the silver prices, 12% of a decline. This comes in on the back of 37% decline that we saw on Friday. So the all-time high that you have seen for silver is $121 an ounce. In the morning when I was making all those demarcations, if you were still trading on the higher side, currently we are just about holding $70 an ounce. I mean, that's nearly 50% of a correction that we already have seen come in for the silver prices. And that's not just two of those commodities. If you look at platinum, palladium, in a matter of last 5 or 6 trading sessions, we have seen a decline of 25 to 28%. Copper has seen a decline of 11% from its all-time highs, and the list perhaps can go on because this is big profit-taking, a sell-off that we are seeing coming in case of commodities. Crude is down 5 to 6% at these levels right now, so we're looking at quite a bit of a sell-off coming in for commodities there. But what does this really mean for the overall sector going forward? To get that conversation in, we are now joined by Sabyasachi Ray. He's ED at GJPC. Sabya, thank you so much for joining in. And I know we've been talking to you about global cues and trade agreements and tariffs, but the volatility is something that we have to, address as well. The gains that we saw into the markets were disturbing, and we kept talking about on how it could impact the jewelry as a segment. But the kind of decline that we have seen also, how are you reading it as a council, as a segment?
Manisha, thank you. One of the things, Manisha, when we were conversing, I always used to tell that I do not want to be part of this conversation around the price of gold and silver. Because when there is no explanation into the growth is natural because you are the one who every day you are tracking it. When we originally started maybe last year, then we were all understanding that a lot of investments is coming to gold because of the gradual price of gold and silver. The way, its usage has expanded based on the price increase is normal. And it was going through a gradual improvement, let's say 20, 30%, 40%, whatever it was going through. That was a bit of a normal. But then in the recent times, what has happened, you are just showing in your screen only from January 1 to the record high. That is somewhere I think that it was beyond any type of explanation and any type of outlook what we can take. Because of that, we remain silent. And wherever it is going, as an industry, I can tell you that we are not that unhappy because we all understood, and it was also coming through your channel in newspapers also, that it was going to an unsustainable price for the buyers of jewelry. So that it should go to a sustainable price levels, that if it goes there, you are showing the levels of January 1 and etc., we should be very happy. However, the type of growth it has seen and the type of decline in the last 3 days only this type of decline is happening, it has its own pitfalls. Whoever has invested heavily, etc., they have their own loss making, etc. In India, at least, it may spell disaster on certain, maybe certain units or etc. That is a bit of concern. But generally, if the prices are as per the explainable levels, we're happy. And if it goes somewhere around January 1 level, that will be happy. But yes, of course, that's right. That time also a lot of people are telling the prices increasing before profit booking. And now it is going to the levels where it should be there. This much I can tell you at this point of time.
All right. Sabya, when I look at 2025, and this is as per the World Gold Council report, 2025 saw record investment in gold. Jewelry buying in 2025 has seen a bit of a decline. With this price correction, whether it's about the Indian markets, international exports as well, do you see once the prices stabilize at fair levels, we could be looking at business coming back?
See, the business is always there. Manisha, one of the things what we are it is only stalling of the buying. That's all. This all need to understand that there is no dearth of business or no dearth of the affinity of the consumers in terms of buying of jewelry. It is only the term of stalling, and only it is outpacing their income growth. That is the thing what is of a concern. So that will be a good thing, that if it again comes back to the levels where the consumers will find it attractive to buy in terms of buying of jewelry. In terms of investment, yes, investment will suffer a hit in the shorter run, because you always invest on this aspiration that it will go up. Now, people will always try to wait for the investors will try to wait when it will find the levels, when they will think that the floor level has reached, and then from here it is steady growth in future also based on the demand supply scenario, or demand based on the investment scenario, then of course people. So right at this moment, I do not think that anybody is investing, because everybody is trying to look at where is the floor, what is the floor level. That is one of the issues. And floor level, as you are showing, that in my opinion also, around the January 1 figures, around that should be the floor level, and beyond that can happen. But investments will go on. Gold, the way the type of returns, and it will be a very good commodity to invest upon. Gold and silver, both one.
Sabya, I also want to get your sense on the budget that came in yesterday. Did not talk about gold, silver at all.
No, it has talked about gold and silver. You have to see the fine print of the budget also. Don't go only by what the big ticket things, what the finance minister has told. But beyond that, you'll see that we are seeing a direction. If you see this is the first time what they have come up is that on the gold, doré and other, bullion commodities, they have now given a sunset clause of the duty waiver. This is a big thing. What we understand is that we are still checking and clarifying that the government of India is trying to go into a regime of a total ecosystem of gold. I'll tell you what is the ecosystem. You have a good refinery, you have a good exchange to price determination, etc. All these things. I think that the direction has been already shown. You have already created an exchange. The refining capacity in India has also grown. So why not? You have a market of around some 1,000 tons of demand market here itself for gold. Why not refine your own gold? Why not your gold finds price levels and etc. The way Dubai has done without being a big consumer of gold in that per se. So that way, I think the direction is given where the bullion import duties, there is a date which has been fixed. I can tell you exactly, it is 31/3/2027. The whatever concession duty concessions are there, they have given a sunset date. That means, and also you have seen that in recent time, IFSC has come with India Good Delivery Standards. One the standards, then you can always find your own price mechanism also you can make. So that is one question has been given already.
Okay, all right, Mr. Ray, Manisha, thank you so much for taking us through this important conversation. That's all we've been talking about, right? The volatility that we've been seeing in some of these precious metals prices. But with that, we'll slip into a short break. When we come back, we'll connect with the management of MedPlus Health Services to discuss their Q3 numbers. Stay tuned for that conversation.
Welcome back. Well, for the markets, the volatility continues at this point in time. In fact, we have the mid-cap index, which is back down around 1% with an advanced decline ratio, which is weak. We have the Nifty, which is just about holding by around 44 odd points. But let's talk about particular companies now. MedPlus is in focus. MedPlus Health reported what was a good set of Q3 numbers. The revenue and the margin did come in quite healthy, and we did have the company which was in focus because it added around 182 stores as well. We have Mr. Reddy, who's the MD and CEO of the company, joining in to discuss the quarter gone by. Mr. Reddy, thanks very much for taking the time out. Well, you know, what stood out was your same-store sales growth in your stores which have 12-month plus on them. It was double digits for the first time since Q4 of FY24. It was around 10+%. What led to that growth?
A couple of things. We had in the past alluded to a little bit of a constraint on the supply side. Supply side meaning our own ability to move stuff across to all our stores and all, because we had grown too fast. Our warehouses were not completely there. So a lot of that got eased up. It's still work in progress, but I think it'll get better as we go forward. And the second thing, you know, our own, you know, decision to, I wouldn't say step back, but, you know, take the foot off the pedal on the private label medicine side, meant that, you know, the growth came in with the full numbers. You know, if you had continued to grow the private label at the same level, the medicine side, what we normally sell at around 80 or 82 rupees basically comes down to around 40 or 45 after the discount. So that would have basically shown a slight decrease. That we have not done this time. So both those reasons, you know, slightly better logistics management, and also a decision to push forward on the brands and not necessarily continually push the private label, I think probably led to this.
Okay. Mr. Reddy, you have spoken about store expansion, which could add to the growth that Ekta just spoke about right now as well, right? Will you use your entire cash for that, or will you reward shareholders with that? You do have 600 crore rupees in terms of cash right now with you. Will you do it to expand it to 600 stores this fiscal, or will it go in some way to the shareholders as well? Even buyback taxes have become better now for shareholders.
Sure. No, I don't think we'll be giving out a dividend anytime soon. I think there's a lot more growth in the company, but the good news is that, you know, for the kind of growth which we are actually looking at right now, we really don't need to spend any of that cash at all. You know, even if you're going to put in 600 to 1,000 stores a year, it basically costs us less than 250 crores. So we're not going to be dipping into it. And that cash we're anyhow accumulating quarter on quarter, and also I don't think that's going to be a problem. But we want the money in the bank for a slightly faster growth as we go forward. We are looking at franchising as an option, and we are still, you know, trying to iron out some of the things out there in that model. Once that is done, then our growth will become way faster than where we are right now. And I believe, and for that reason, you know, I'd like to keep the money with us at least for a while.
Sure.
We also, by the way, we don't have any loans in the bank at all also. So for us, not only is there cash in the bank to take care of the growth, we could also borrow, but I know that there is a lot more potential for the rate of growth at which we are. We don't need the money, but our intention is to grow much faster at some point of time. So we'd rather keep the cash.
Okay, you rather keep the cash. You still see some growth there. Mr. Reddy, you know, you said that you're not focusing much on, you know, pushing too much private label now, and branded is also where you're focusing on. But private label, you managed to see a bit of an increase there, 22% that rose there. Contribution from pharma private label, that's a reduction, right? So overall now going forward, how is this mix going to be changing going forward?
So for us, whatever growth we can get on the general side, that's all added bonus, because normally people don't really look at least they were not looking at us to buy their toothpastes and shampoos and creams and all. Our private label allows us to push that because it is priced very, very attractively. So we are able to get, let's say, a larger share of the wallet of our customers by selling this stuff. So private label pharma on the other side, when we push it, you know, it's obviously there's sometimes a little bit of friction. We know it'll grow. It continues to grow out there and all. It's not going to stop anytime soon. But Compared to the past, where we are growing really, really rapidly because of a big push from our side, we have decided to slow down on that and only focus on the general goods. Here, there's absolutely no limit to what you can actually grow on the non-pharma side.
Okay. Mr. Reddy, are you on track to hit that 600 store guidance for FY26? Because you've done around 400 for 9 months.
Yeah, given that we did 182 stores this quarter, I think, we'll probably increase it a little bit and then get to that 600. I don't see any problem with that.
Okay. How are you doing on your diagnostic business front? Revenue was up around 19%. Margins seem to have been, better than what you reported the same time last year. Are you now confident about expanding the diagnostics business? Because that is something that you held off on for some time.
We'll probably require a pivot on that model out there because, for us, I was hoping to get a lot more memberships out there. Profitability was never in question. It was just that we wanted to get a number of around 250 to 300,000 as primary subscribers to our model. We have not achieved that. It doesn't look like we will get to that number that easily without the B2B aspect and all. So I'm going to hold off on that for a while. We're not going to be expanding in the current form, which is going and spending a lot of money on capex expanding would mean spending 100, 120 crores per city. And we would want to expand to 7 or 8 cities. That is not happening because in my mind, at least to us, the model has not been fully proven. It is profitable. That's the good news, but not to the point where we'll go and spend more money.
Okay.
We will pivot to a different kind of model on that, which is obviously has no capex.
Take that point, Mr. Reddy. Thank you so much for joining us and giving us those honest and clear answers on the strategy going forward. That's the word coming in from MetPlus. Good quarter. They do have sizable cash, but they'll use it for growth going forward and are confident on store addition guidance of 600 stores in FY26 as well. Slip into a short break. When we come back, we'll get you more on the markets and a lot of stock-specific action on the other side. Stay tuned for that.
Welcome back to Halftime Report on CNBC TV 18. As of now, the Nifty is where we started the show with, right, around the 24,900 level, just slightly below that. Oh, it's actually touched that 24,900 level. It's almost in the day's highest point, and 70 points uptick is what we're seeing for the Nifty. I do want to pull up the advance decline ratio and see where that is as well, because the broader end of the market was not doing too well. That was continuing to underperform. As of now, let's look at the advance decline ratio of where that is headed in the trading session as well. Mid cap is still down 0.8%. Small cap too is trading with cuts in the trading session as of now as well. Advance decline ratio still far apart. Declines is far advancing the far more than the advances that we're seeing coming in as well. But yes, that's the market setup for you all. IT continues to be under pressure. Banks down also 0.5% in the trading session. Auto is the only bit of a green that we were seeing on the screen. But with that, we're absolutely out of time on this edition of Halftime Report. Thank you so much for tuning in. Up next, your Business Lunch.
Stocks trade weak with the mid-caps bearing the brunt but now have recovered from the lows of the day, reflecting in higher declines to advances. But PSU banks, healthcare and IT remain the big drags. Energy is a rare gainer.
Revenue Secretary Arvind Srivastava tells CNBC TV 18 the hike in STT was motivated by an intent to curb excessive speculation in the F&O segment. Market players, however, wish The mop-up was used to offer tax relief to long-term investors.
DIPAM Secretary Arunish Chawla is confident of meeting the government's disinvestment target via a mix of asset and PSU land monetization along with traditional divestment. He says that the government is also open to considering less than 51% stake in PSUs as suggested by the Eco Survey.
Automobile sales in January show sustained momentum following the GST rate cut, with most players reporting double-digit sales growth. From SUVs to tractors to CVs to two-wheelers, the pace is healthy all around.
Good afternoon. You're with us here on Business Lunch. We are coming to you from the CNBC TV18 budget headquarters. I am Hormuz Fatakia. With me, Arundhati Ramanan. As always, Arundhati, good afternoon.
Good afternoon, Hormaz. Hi, guys. You know, the markets, the Nifty and the Sensex showing some resilience. You know, the Nifty near the high point of the day, 0.5% in the green. But, you know, the broader market feeling the heat.
Indeed, and it's been an extremely topsy-turvy session, right? At one point, we were down to almost 24,600 and 80 odd, which was the low point of the day. And from there on, we have seen a bit of a rebound of almost 200, 250 points from those levels. So it's been a smart recovery that you have seen on the index. And the recovery is more impressive, particularly so because yesterday, when the fall happened, we were bracing for the fact that the FIIs would be returning to the market, and that could potentially add more pressure to the indices. That has not been the case, at least as of now. We did see that dip, but that dip has been bought into. What has been extremely choppy, though, has been gold and silver. And you see the price action. Silver prices at the spot markets are still down 12%. Gold prices are still down 7% in the spot market. So extremely volatile on the commodities front. Brent is also down 4.5%, 5% as well. The Asian markets have sold off. The Dow futures are down almost 500. So the global markets are in a sea of red. But as of now, we are doing fairly okay for ourselves.
Fairly better than what the global markets are faring right now. But if we take a look at those sectors, right, Hormaz, we've got the oil and gas stocks, which are doing really well. HPCL, IOC, all of them gaining in trade, as you can see on your screens, between 1% and 3%. We've got those auto stocks also doing really well after those auto sales numbers that have been trickling in over the last 2 days. Tata Motors, M&M, and Ashok Leyland gaining in trade on. But on the downside, we've got those, you know, pharma names seeing deep cuts. We've got Glenmark Pharma, which is down about 3%. We've got Lupin, which is also down. We've got Cipla, all of them seeing cuts of over 2% in trade. The IT pack also in the red, feeling the heat. Emphasis, Infosys, and LTIMindtree, all of them seeing cuts of over 2%. In fact, even the metal pack not doing very well in trade today.
And that has been the case all through the last couple of sessions, right, for the metal names. But the one stock that's holding on is Reliance. That's keeping the market afloat. The highest point of the day now, 2.5% higher, is Reliance Industries, and that is the one that is the top contributor to that recovery that you have seen on the index, and then the subsequent up move as well. But the highlight of the last 2 days has been Finance Minister Nirmala Sitharaman's 9th consecutive budget, which is aimed at providing a thrust to manufacturing and offset the impact of the 50% US tariffs. Let's quickly take you through the top highlights. Now, the FM has proposed hiking securities transaction tax, or STT, on equity futures and options contracts. The defense allocation has been hiked by 21% to 5.9 lakh crore. The budget for defense modernization is up 24%. Overall, capex also saw a modest growth of 9%. And that is the kind of announcements that were made in the budget yesterday.
Absolutely. And as you pointed out, the F&O tax hike stumped D Street. In fact, the Sensex and the Nifty posted its biggest budget day decline in 6 years. Let's hear out what the Revenue Secretary Arvind Srivastava explained the rationale and for the STT hike. Take a look.
If you look at the volume of the F&O, if you compare it to the underlying securities market volume itself, or the size of the GDP for that matter, it is too large for it to be considered desirable. It looks to be fairly speculative, which is not a good way to take it forward. So in some way, this increase is essentially meant to address that kind of, possible risks that may be involved in this highly speculative side of the market. With no impact in the volume, if the volume remains the same, put together, it may fetch us around 15,000 crores or so.
And earlier, we spoke to a number of market veterans, Samir Arora, S. Naren, Neelkant Mishra, for some perspective on the budget. Here's what they had to say.
On Twitter, hundreds of times I have said that STT should be increased on futures and options, but always accompanied by a corresponding lowering of either capital gains tax or lowering of STT for cash or doing something. So that's why this one is that we are not accepting the fact that if you get, say, $5 billion through some FDI with doing hundreds of things, you can get it in 1 hour with the FPI guy if you understand the power of the market. I would think that because they were selling, in that context, at that time, we should not be doing things which are negative, because this means they will not change currently. Now, after 5 days, 10 days, 20 days, if there is a US deal or something which changes the sentiment for India relative to other markets, then it'd be different. But right now, how will that momentum stop?
The way markets have reacted since yesterday is as though the retail investors have made a lot of money in the last 25 years in derivatives, which has never been the case. In fact, the regulator prepared a long document showing how much money was lost in derivative segment. But the market reaction since yesterday is only to do with STT, because everything else in the budget was fantastic. This data center tax concession to propel investments in data centers. We have always been supportive to any tech trend in IT services, in cloud services. Everywhere we've been a supporter. So I think in AI also we have to be a supporter and create an AI services boom. So I think that step was a step in the right direction. From a behavioral point of view, we are seeing euphoria in precious metals. Honestly, we don't know how to value precious metals, but we do know that it is riskiest asset class at this point of time. So we tell people, if you want to put money in precious metals, do it only through the multi-asset route, because whatever we have been seeing in the last few months is completely euphoric. The challenge is people want us to get the top exactly right. It is hard. It is impossible. I mean, it is impossible for us to get into a euphoric framework when that euphoric top will be exact price and then come. Our experience of 2007-8 was when something becomes euphoric, you decide to become cautious irrespective of how much more it will go. And that has been our framework.
I think having predictability allows businesses and investors to plan ahead. There are no shocks, there are no dramatic changes in tax rates. The spending quality continues to improve. There is no attempt at wasteful spending, and allowing more money to go into the hands of the private businesses and investors. The challenge that I see, I mean, I think the STT issue is more for controlling speculation, as the finance minister also mentioned in the press conference. But the challenge, I think, is on the financing side.
And the reactions keep coming in on the government's STT hike. Nitin Kamath, the founder and CEO at Zerodha, in a post on X said, and I quote, that if the government's goal was to reduce speculative F&O activity, he was not sure that the STT hike would do anything, as 95% of trading was already in more speculative options, and argued that the STT hike would only push that share higher. He also recommended that if the aim was to reduce speculation, establishing who can trade options was the right way to go. He also expects the uncertainty on STT hikes to have a material impact on volumes, as transaction costs will make trading unviable.
Coming back to the currency, which has also seen some strength in today's session, the external flows of the country are holding up better than the headline moves are suggesting, according to DEA Secretary Anuradha Thakur, who flagged strong FDI inflows even as foreign portfolio investors continue to pull out in the near term. She also commented on the upsides of a weaker rupee. Listen in.
How much of intervention should be there to arrest the decline of any currency is a matter of great debate, as it has been in our country as well. And as we see the depreciation of the rupee, the capital flows which are behind this, the FDI has been behaving in a particular way and FPIs are behaving in a different way. The overall FDI flows are pretty strong and stable, I would say. If you see a netting off because of the ODIs, that's a different thing. The FPIs are pulling out for completely different reasons, including valuations, including interest rates, etc. So in the short term, we did not really think that the budget should be doing anything. So far, we've been watching it, and like it was explained 2 days earlier when the economic survey came out, it is in that zone, of course, right now. But so far, it's not
in the uncomfortable zone.
Yes, yes, because the moment it crosses 90, everyone talks about it. We start watching out. But so far, we are just looking at it as something which also has some positives for the country. So closely watching it.
Which enhances the export competitiveness.
Yeah, absolutely.
And the strategic disinvestment of IDBI Bank has moved to an advanced stage with technical and financial bids now invited, says DPAM Secretary Arunish Chawla. On reports around bringing down the government's stake in select PSEs to 26%, he said all possibilities were on the table.
The strategic disinvestment of IDBI Bank has reached stage 3, which essentially means that technical and financial bids have been invited. I will not be able to give transaction-specific details, but I would only say that be patient. Before the end of the current financial year, in March, you will hear more from us. The number is big, and this is a composite asset monetization target. This is miscellaneous capital receipts. It includes disinvestment receipts through various modes. It includes asset monetization of other types. It includes the new securitized innovative instruments.
Meanwhile, the government has set 80,000 crore rupees as its disinvestment target for FY27. The economic survey had made a recommendation with regards to the government bringing its stake below 51% in PSU stocks. DPAM Secretary told CNBC TV18 on Sunday that all possibilities were on the table. With a lowdown on the entire PSU basket and how much value can the government potentially unlock in case it does embark on such a drive, Hormaz is here with all of those details. Hormaz?
You know, I just heard the DPAM Secretary, right? He made a very interesting point, and this point was highlighted by us when we were at the Eco Survey as well, that it had mentioned that there's a possibility that the government should bring its stake below 51% in a lot of these PSU companies, because ultimately you need only 26% to have a control of the company. So, and all possibilities are on the table. Now, when a policymaker says all possibilities are on the table, you evaluate all the possibilities. So let's do that. And now, so we analyzed almost every listed PSU company in the country, which comes up to well over 80 companies. And in this analysis, we have also included companies where the government stake is less than 75% as well, and also companies where other PSUs are promoters of the company and not exactly the government. So it's the cross-promoting as well is part of this analysis. Now, if you take a look at the shareholding of the government in these PSU stocks, there are still 9 companies whose shareholding of the government is in excess of 90% as of the December quarter. There are 10 others whose shareholding is between 75 to 90, and the rest, the majority of them, fall between that 26 to 75% mark. Now, when you take a look at that excess stake, since the DPAM Secretary mentioned 26%, you take a look at the excess in excess of 26%, that entire sum of these 80 plus PSU companies comes up to over 27.5 lakh crore rupees. That is a big number that comes out for a potential value unlocking that could happen in the future. Now, you break that 27.5 lakh crore rupees down, you'd see that there are 5 companies whose stake is in excess of 1 lakh crore. There are 12 companies between 50,000 to 1 lakh crore. And of course, there are 14 others between 25 to 50,000 crore rupees. Now, you go down to specific companies. The biggest in them all is LIC, of course, because the government still owns more than 96% stake in the company. And that excess 70% is still worth 3.5 lakh crore rupees, despite the correction that the stock has seen from its all-time high levels. Next is SBI, of course, India's largest lender, trading close to record high levels, and that stock is also valued at almost 3 lakh crore rupees, that excess 29.5% stake that the government has. Then HAL, Congor finds a mention in this list, ONGC finds a mention in this list as well. And a specific example that I wanted to highlight was IRFC. And that's because the government here, 4 years of listing for the company, and it is yet to comply with the minimum shareholding norms, because the stake of the government is still at 86%. Now, that excess 60% that the government has is currently valued at close to 90,000 crore rupees. But there was a time when the stock was at its peak, almost 230 rupees. At that time, this excess stake was valued at close to 2 lakh crore rupees. Now, after that 55% correction that the stock has seen, the stake value has come down. That is one thing that you need to monitor, because most of these PSUs have already come down 30, 40, 50% from those record high levels. There are challenges as well. Of course, there are all possibilities on the table, but it's not easy, especially because there is a large equity base that needs to be divested, especially because in these 90% plus companies, with these small PSU banks that you're talking about, there could be consolidation as well of these PSU banks. So that remains a challenge. Now, there is a long gestation period for these disinvestments to take place. IDBI Bank is a case in point. It started off almost 4 or 5 odd years ago, still in process, might end before the end of the year. That is one thing that you need to keep an eye out on. And more importantly, the question being, do you expose sensitive sectors to foreign or, more importantly, non-government ownership, be it the defense or the railways sector? There are challenges aplenty. There is still an opportunity, but that opportunity right now is worth almost 27.5 lakh crore.
Absolutely, Harmaz. Thank you for taking us through those details. But on that note, it is time for us to slip into a short break. And coming up next, here's a quick sneak peek into the stocks that we will address on your stocks today. Don't forget to catch fundamentals and technical experts give their views on these at 2 p.m. today, only on CNBC TV 18. We're back with more news right after this.
Fly Emirates, fly better.
Welcome back. You're watching Business Lunch. Crude prices declined over 4%, heading for the steepest single session decline in more than 6 months after US President Donald Trump said over the weekend that Iran was seriously talking with Washington. His comments eased concerns about a potential escalation with an OPEC member following earlier fears of a possible military strike that had driven prices to multi-month highs.
And this comes after Iran's Supreme Leader Ayatollah Ali Khamenei warned that any attack on his country would spark a regional conflict as the US continues to build up its forces nearby. Khamenei said that the US wants to devour Iran and its vast oil and natural gas resources, adding that what happened during the recent anti-government protests was similar to a coup since a large number of government offices, banks and mosques were stormed. However, President Trump said that Iran was in serious talks with the US and he hopes to make a deal in a couple of days. Listen in.
Why wouldn't he say that? Of course he would say that, but we have the biggest, most powerful ships in the world over there, very close, a couple of days, and hopefully we'll make a deal. If we don't make a deal, then we'll find out whether or not he was right.
On that note, it is time for us to head into a short break, but we will get you more news and updates on the other side. Stay tuned.
Welcome back. The big highlight of the day, though, other than the sell-off in gold and silver, has been the sell-off in the Asian markets, particularly in South Korea, the Kospi is down over 5.5% at the close of the trading session. And remember, Kospi was the biggest gainer among the Asian indices in 2025, gains of close to 70% last year. And today, it's witnessing this fall because of its two biggest index heavyweights, SK Hynix and Samsung, both of which had gained almost 180 to 200% last year. And now they are down over 6%. The Korean won also weakened against the dollar, adding to the risk-off tone. And it is this AI trade, questions over this AI trade beginning to unwind, remarks from Jensen Huang, all of them is having a bearing on the global markets today.
Absolutely, and the India market faring slightly better than those global markets. But on that note, it is time for us to wrap up this edition of Business Lunch. More news and updates coming up on the other side.
Go.
Good afternoon. You're tuned into Mid Cap Radar. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, is Vivek Iyer. Well, a day after the budget, and we have seen some fall across the board, coming in across the asset classes as well. The Nifty did recover from the lows, but struggling to go above that 24,900 mark for now. The mid caps, though, are struggling, and the advanced decline ratio absolutely in favor of declines as we speak, Vivek.
Good afternoon, Sonal. You're absolutely right. Came in with weak cues, a very weak handover from yesterday's budget session. Commodities, like you mentioned, under significant pressure and a very volatile trading session. While the Nifty has managed to see a bit of a comeback, it's the mid-cap and the small-cap index that continue to sell quite significantly in the session today. But a lot lined up on the show, so let's start off with the top headlines. Stocks trade extremely volatile, with mid-caps bearing the brunt, reflecting in high declines to advances ratio. PSU banks, healthcare and IT are the big drags, with energy being a rare gainer.
Stocks like E2E Networks, Lodha Developers and Anantraj are rallying as Budget 2026 offers a tax holiday till 2047 for foreign cloud firms using Indian data centers, boosting long-term sector prospects.
Shares of IOCL, BPCL and HPCL trade higher in trade as no excise duty hike on petrol and diesel provides the relief for oil marketing companies.
NBFC stocks lower as higher market borrowing announced in the budget may keep bond yields at elevated levels, posing risks to net interest margin expansion. PNB Housing, Shriram Finance, LIC Housing trade with cuts.
Metal stocks continue to trade under pressure, mirroring the weakness in the global commodity market. SAIL, Jindal Stainless, Vedanta extend losses.
Okay, all right, those are the top headlines that we are tracking, and some of them we'll discuss in greater detail, but it's a power-packed show. A lot of weakness that we are seeing in the mid-cap index, so let's do one thing. Let's talk about a special segment, mid-cap movers, and we have Gaurav with us to take us through that. But before we do that, let's take a look at specific stocks, because there's been big cuts in the broader markets. For instance, Bharat Dynamics, that stock is down 8.5% as we speak. Sterlite Technologies is down 7%. You have Hoodco, the stock is down 7%. Welspun Specialty is the other one which is sitting with cuts. Grow, so because of that STT hike that has come by, a lot of these stocks, capital market stocks, are in focus. But we had conversations with a lot of these analysts who track the stock, and they have been of the opinion that maybe not so much of an impact immediately. Incrementally, maybe you could see some impact on their profits. But yes, it continues to be very volatile across sectors as well now.
That's right, absolutely. Especially when you look at BSE, it's seen a bit of a recovery from yesterday's very sharp sell-off. In fact, even a name like an MCX, Angel One, Nuvama Wealth, most of these names have actually seen a bit of a recovery. Well, before we hop across to Gaurav, one particular stock that we'd like to highlight is Powergrid. The company, after a while, has raised the capex as well as capitalization guidance for FY26. But Gaurav is ready. He's standing by the wall. He's taking us through all of the mid-caps that are moving around in the session today.
Well, if you look at the market, yesterday we saw broader market was under pressure, and today if you look at the Nifty mid-cap index, it is still under pressure. In fact, even if you look at Nifty, it has gained, but Nifty mid-cap index is under pressure. But even with that pressure, we are seeing some kind of gainers in that market. In the likes of D-Link, Latent View, Atul Auto and Lodha Developers, if you look at these stocks, they are not only gaining, but we are also seeing some volumes which are actually increasing in the stock. But on the losing side, we have a whole host of stocks. First, let's talk about some of the stocks which are not only losing, but they are seeing heavy volumes as well, in the likes of Onward Tech, Northern Arc, Intellect Design. Even if you look at Bharat Dynamic as we speak, Bharat Dynamic is also under immense pressure. Other than that, we are also seeing some we are seeing some pressure in the financial segment. Specifically, if you look at some of the names like Hoodco, 5-Star, Ujjivan Small Finance Bank, Jana Small Finance Bank, LIC Housing, all of these stocks are under pressure. And the two reasons, first is that yesterday we saw there was there was a number which was actually expected to go up in terms of the yields, and this is because of the bond yields which are likely to go up. It is something which is hurting the stocks right now, and they are seeing some pressure in the financials. Lastly, if you look at the stock which are reacting before its earning, we've got PB Fintech, City Union Bank, Tata Chemical, all of these stocks are currently under pressure, but let's not forget that these stocks will also come up with the numbers. So it is important to see how the numbers come, if there is any positive surprise in the numbers for these stocks. Lastly, let's also not forget, if you look at the 52-week gainers today, we do not have any 52-week gainers specifically in the mid-cap movers. But if you look at the 52-week losers, we have some stocks in the likes of Exide Industries, SBI Cards, which is again under pressure, IRCTC, NTPC Green. All of these stocks are currently have reached 52-week lows in the day today. So definitely let's watch out of these stocks and let's see if there is any mid-cap recovery sign in a day today.
Okay, take that point. Some mid-cap movers which are on our radar. Thank you, Gaurav, for joining us with that list. Let's now get some corporate conversation going. Rajesh Agrawal, MD Insecticides India, is joining us now to discuss the quarter gone by and, most importantly, the outlook going forward. Mr. Agrawal, thank you so much for joining in. This time around, revenue growth has been weak again. It has come in at 8% versus quarter one growth of 5%, quarter two growth of 2%. You had guided for a 10% growth for FY26 overall. Considering that it has been high single digits so far, do you think you will meet that 10% guidance or do you have a revised guidance for us?
This is a difficult year. We thought that there were some recovery signs, so that will be possible. But overall, it looks that getting the recovery during this year is going to be very, very difficult. So despite of our best efforts, we could grow our sales only by 8% in this quarter. And overall, if we see, it is just the 5% growth what we have achieved in the 9 months. So I believe that achieving the 10% target in this fiscal is going to be very, very difficult. And this year will close somewhere around 5-6% growth only.
Okay, so Mr. Agarwal, you're saying that at the end of FY26, you're toning down or moderating your top line guidance from 10% to around 5%. Now, when you're talking about the premium product segment, earlier you had given a guidance of 20%. So what will that grow at, given the fact that you moderated your guidance, and how will margins look at the end of the year?
Yes, correctly pointed out that these premium products have also taken a hit. The growth, overall growth for the premium products will also remain somewhere around 10%. And the margins might also not improve too much because we are into a cyclic business where 60% business or 65% business happens in H1 and it is only remaining 35 to 40% which happens in H2. Though we'll try to make a recovery in the last quarter, but meeting out all the expenses and doing the things are looking little difficult in the volatile market. So that does not mean that the outlook overall is going to change for this year, 26. Yes, this quarter 4 is not a very huge recovery quarter, but we'll try to maintain the top line and we are working on the bottom line that how we can sell the premium products better and make some gain into this.
Okay. Mr. Agrawal, when the entire sector was going through a lot of pressure, you were one of the companies that spoke about continuous growth. So I want to understand what is happening in this space right now. Are you facing pricing pressure? Is it demand pressure? Generally there is a lot of dumping happening from global markets. I want to understand what went wrong suddenly.
Overall, this year has not been a very good year for sales because demand pressure is very much there. And there had been seasonal impacts continuously during the cycle because in the beginning of the Kharif season, there were good rains and then there was a big drought spell. After that, there were big flood-like symptoms and even the Rabi season did not pick up. So overall, the industry this year is expected to decline by 2 to 3%. And in that scenario, we are going to grow by 5%. We have beaten the industry, but we are also beaten by our own targets. So that way, I'm not very happy. And particularly the margin side also has taken a hit, which is forcing us to rethink how we have to make up the thing, how we have to increase the ROC, how we have to reduce the expenses, how we have to see that where we are going wrong. So we are working out and I believe that from Q1 itself, we will find a change in our performance.
Okay, Mr. Agarwal, two-part question. End of the year, where will you end EBITDA margins at? I just missed that number. And secondly, off a low base, FY27, what is the kind of initial estimates you can give, especially given the fact that weather conditions are expected to be a lot more supportive?
H1 had seen the EBITDA margin going to 35-36%, difficult to maintain that. So there will be a little slide, but still the total EBITDA margin, what we are going to get is near double digit. That is something I can hope for the year as a whole.
Okay. Take that point, Mr. Agrawal. Thank you so much for joining in and being honest about the outlook going forward. So they will not be able to meet the guidance that they had given earlier of 10%. Now they have cut it down to 5 to 6%. There is some demand pressure and it is expected to continue for a bit. The stock has come off from the high of the day, but of course it was already trading in the red. We'll slip into a short break. On the other side, we'll decode the impact of STT hike in the F&O segment on arbitrage funds. We'll have Bhavesh Jain of Edelweiss MF who will join in to explain the impact.
Welcome back to Mid Cap Radar. Well, one particular stock that we alluded to very briefly at the start of the show was Power Grid. Power Grid, even as we speak, is holding its analyst meet post its Q3 results. A couple of important points from the presentation as well as the call that is going on. We spoke to a couple of analysts, so the management has gone ahead and raised both the capex as well as the capitalization guidance. This is something that is seen quite positively, especially when you're looking at a utility name. The capex that the company earlier had guided to was close to 28,000 crore. The company is hopeful of achieving a 32,000 crore capex for FY26. Capitalization earlier guidance was close to 20,000 crore. The company already has done close to 18,700 crore by the end of Jan. So in the next 2 months that are pending for FY26, they are expecting to go ahead and beat that guidance. On the back of that very positive commentary, Power Grid, after a while, don't remember the last time seeing a utility company higher by almost 5.5%, and positive commentary coming in on right-of-way issues, positive for the entire renewable energy universe as well.
Take that point and higher by 6% in a market like this. So that stock needs to be discussed. That's about Power Grid. But let's talk about some more budget amendments that came by this time around and get in Bhavesh Jain, co-head of Factor Investing of Edelweiss MF. Now remember, there's been a hike in security transaction tax on F&O trades. So while we have spoken about stock-specific issue and how it would impact some of the companies, let's understand how it would impact one category of funds, which is arbitrage funds. They do have trades in F&O because they try to make profit from the differential in pricing in the cash and the futures market. Bhavesh, thank you so much for joining in today. If you can explain to our viewers, if they're investing in arbitrage funds, what is the current yield that they are earning and how that return would be impacted once the STT hike kicks in?
Yeah. So hi, good afternoon. Thank you for this opportunity. So right now you will see for arbitrage fund, for whatever trades we do, almost out of the 100 rupees we have in AUM, 70 to 75% is in arbitrage position. Now this position gets rolled over every month. Earlier the cost of STT was around 2 basis point, and now that has gone to 5 basis point after yesterday's changes. Though it is effective from 1st of April, but just to give an hint, the cost will be up by 3 basis point, roughly 70% of our portfolio. So 2 basis point per month. So effectively the annualized impact will be around 24 basis point for rollovers. Plus we also do some fresh deployment, some churn which happens during the month. That will have an additional cost of around 6 to 7 basis point. So broadly the impact should be around 30 to 32 basis point. But it is like normally you will see whenever the cost of raw material increases, we pass on some of this cost. So similarly, the STT cost has increased for us. So we will also try to pass on some of this cost. When I say pass on this cost, we will increase our demand for rollover. So normally, if I'm rolling over my stock at say 50 basis point, now we'll ask a 51 or 52 basis point, so that at least a partial, you can say, impact of this STT hike is taken care of. But all said and done, as of now, on a steady state basis, we feel there will be an impact of almost 25 to 30 basis point on return of arbitrage fund. So normally, if you will compare return of arbitrage fund with liquid fund, say assuming both of them are giving you 7% return, earlier the benefit of you can say arbitrage fund over and liquid fund post tax was almost 120 basis point. Now 30 basis point out of that will go away, assuming we are not able to, you can say, improve our return to that extent. So now that gap between liquid fund and arbitrage fund on a post-tax basis will be 90 basis point. So still it is a better opportunity compared to a liquid fund on a post-tax basis. So we don't see a meaningful impact on the flows of the category. But yes, incremental returns are getting impacted, and we have to just, so at least for next 90 days, nothing is changing because we have already rolled over our position to February to March, and March to April rollover will also happen before 1st of April. So no impact till April of this year. But after that, once we start rollover from April to May, we will definitely see some impact of these changes on overall return of arbitrage fund. And this is not only limited to arbitrage fund, it will have some impact on balance advantage fund, some impact on equity saving fund, some impact on our SIF, which is Altiva hybrid long short fund. Though the impact will be much smaller in this fund, but yes, the cost will have some impact on all these hybrid products.
Right. Bhavesh, thank you for explaining that very clearly for us. Well, a couple of quick pointers. So you said that a certain portion of the increase you will be able to pass on. So a certain portion you may be able to absorb, and you've given us a reason, or you've given us a quantification of how much that could be. The other question is, a couple of traders that we spoke to actually mentioned that there could be an offset in terms of using options instead of derivatives. Now, for an arbitrage fund, does that option exit, or will you have to go ahead and continue working in the same way, in the derivatives or in the futures market?
Yep. So for arbitrage fund, so all the arbitrage fund under the mutual fund space, there is no alternative to trade single stock future. We cannot trade derivative options in arbitrage fund. So that's why that option is not available to arbitrage fund. But yes, for, as I said, some of other hybrid funds like Altiva hybrid long short fund or maybe balance advantage fund, we can use some options and try to you can say in a way reduce our impact. But anyways, over there, the impact was much, much smaller compared to what it is on arbitrage fund.
Take that point. So the short point is the impact could be anywhere between 0.3 to 0.5%, going by the exposure you have to futures position in a fund. But as you said, Bhavesh, it will not see a big impact. Still 90 days to go for this applicability to come by for arbitrage funds in particular. So we'll watch out for what kind of pass on some of these AMCs take when it comes to these hybrid funds. Thank you so much for joining today and explaining to us with example what this would mean for investors in hybrid funds. With that, we'll slip into a short break. When we come back, we'll get you more on the markets and stock-specific action on the other side. Stay tuned for that. Welcome back. There's a massive recovery which is underway. The markets are at the day's high. Nifty is above the 24,900 mark by a comfortable margin, actually. Even if we talk about the mid caps, they are down just 100 points as we speak. So there's been some buying from the lows of the day, and markets at the day's high as we speak. The stocks which are leading to this, we do have a lot of recovery coming in banking names and also metal names, select metal names, which are leading the recovery in the market from the lows of the day. So watch out for the Nifty Metals Index, Nifty Banking Index, because these two also are at the day's high. Look at that, the metals recovery. And this was one index which was seeing such sharp sell-off last week, especially on Friday.
That's right. The metal pack recovering, and like you mentioned, the banking pack. And within the banking pack, PSU banks have seen a very sharp recovery. But with that, it's all the time we have on this edition of Mid Cap Radar. Your stocks when we return.
Hello, good afternoon. You've tuned into Your Stocks, coming live from the CNBC TV 18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much, as always, for tuning in. And surely a good afternoon that's coming in for the markets, because look at the recovery that you've seen. As of now, the Nifty is trading almost near the day's highest point, about 24,900 mark. So that is something that we'll be keeping an eye on. Comfortably around the 24,900 mark is what the Nifty is trading at. More than 100-point upticks in today's trading session is what we're seeing for the Nifty. Broader end of the market, let's look at that. That was underperforming in the first half of the trading session. Now, that too has seen a recovery coming in from the day's lowest point. So mid cap is still trading with slight bit of a cut, but 0.2% of decline now for the mid cap. Small cap is trading with cuts of 0.6%. So yes, all in all, we've seen the recovery coming in the markets. Good recovery also coming in is what we're seeing in the Nifty metals. Look at Nifty metals. You know, it was seeing a sharp decline in the morning. Now it's trading on the positive side. That's the Nifty metal for y'all, trading with gains of 0.7%, almost near the day's highest point for the Nifty metals as well. Auto too has picked up pace in terms of a move that we're seeing today. So Nifty Auto was one of the sectors trading in the green, and that continues to be the case for Nifty Auto as of now. Bit more in terms of the advance that we've seen, or momentum in terms of the uptick that we've seen for the Nifty Auto as well. But yes, that's the move that we're seeing coming in for the markets this afternoon. A positive move as of now. Whether it sustains in the next 1.5 hours is something that we'll watch out for. But this is a show where we solve all your stock-related queries, and to do just that, we have our experts who will be joining in with us. We've got Gaurang Shah, Senior Vice President at Geojit Financial Services, as well as Ashish Kyal, a Chartered Market Technician, author at Wave Strategy Advisors, to answer all those stock-related queries. Gaurang as well as Ashish, good afternoon. Thank you so much for joining us on the show as always. And in terms of a volatile day for the market, as of now, at least trading near the day's highest point, Ashish, your views in terms of the market levels that we should keep an eye out on before we start with the queries. Ashish, I believe you're on mute.
No, I am right now speaking. Are you able to hear me out?
Yes, I can hear you.
Okay, fantastic. So good afternoon to you and Gaurangji and to all the viewers. Looking at the market right now, it is a volatile market, but I think it's going to be range bound. What happened yesterday was a very sharp movement of nearly 700-800 points from the highs and the lows. But I think it's going to be digesting that volatility, trying to find out the direction. On the upside, Nifty is going to have a hurdle of 25,150. On the downside, the support is going to be around 24,700. So I think if you're looking for an expiry trade for tomorrow, then you might have to create a short strangle far away strike prices. Trade the range. Do not try to bet on the direction right now. Market is struggling to find out that. It's not giving thumbs up to the budget as of now. It has recovered from the lows by 115 points positive from yesterday, but still it is way below what it was last Friday.
Absolutely, way below that, but we'll keep an eye out on those levels there. Thanks so much for that, Ashish. But on that note, let's get started with all the stock-related queries. The first query for today, with Chandrasekhar Iyer, who's writing to us from Bangalore. He's holding 1,000 shares of Kalyan Jewellers. This is at a price of 560 rupees per share. And the other stock that he is holding is 300 shares of Sterling and Wilson. This is at a price of 281 rupees per share. Wants to know if he should continue to hold or sell both these stocks. Gaurang, good afternoon. What's your view here?
Thank you. Good afternoon to you as well, Vinny, and to all the viewers of CNBC TV 18 and to my good friend Ashish Kyal. A small disclosure, Vinny, that all recommendations that I'll be sharing with you on your show are a part of our fundamental research team from a long-term point of view. Our company, Geojit, or myself, we do not have any kind of personal investments, no financial interest, no conflict of interest, but we give advice to our clients on similar lines. They might have their investment interest. So, while we remain optimistic on the entire gems and jewelry space, and of course the recent uptick and then a little bit of correction in the precious metals, both silver and gold, my sense and my advice would be to look at companies which has a diversified play in this particular sector. And if one company that we have positive coverage is Titan Company. You know, other than gems and jewelry, they've got wristwatches, they've got eye care, they've got personal care. They've also taken over companies in form of Carrot Lane for platinum jewelry. So Titan Company is a better, company to look at in this sector.
Okay, that's the view there. And Ashish, your view on Kalyan Jewellers, Sterling Wilson, what should the viewer do? Or would you also prefer Titan?
Yes, absolutely. I'll go with Titan as well, because Kalyan Jewellers started correcting from 520 levels, and this was somewhere around in January start itself, and we can clearly see with the sell-off across the board in the bullion market, the stock is going to be under pressure. So avoid buying Kalyan Jewellers. If you have positions, then possibly switch to Titan. That is Titan is much better there. And Sterling and Wilson Renewable Energy, I think it's quoting around 181 rupees approximately, but the stock has not shown any kind of positive momentum. It has been clearly making lower high, lower low with a downtrend. My suggestion, any pullback towards 188, 189, exit from here. I'm not optimistic about this stock.
Okay, not too optimistic about Sterling and Wilson as well, and Titan is a better bet. That's a word coming in, even on the fundamentals and the technical front. Let's move on to the next query for today, and that's a caller query. We have Mr. K.S. Rao, who is on the phone line from Andhra Pradesh, and his query is on Castrol. Mr. Rao, good afternoon, and what's your query, sir?
I hold that Castrol Limited at 120 rupees. For the last 2 years, what is the prospects? Should I hold or sell that?
Okay. Gaurang, what's your view for Castrol? Should they hold or should they just sell? They've been holding it for the last couple of years.
So, honestly, if you look at the entire automobile lubricant or industrial lubricant space, this used to be one of the star performers when it had a large market share and it had one of the most power brands called Magnatech, both for petrol and diesel engine. But then post that, in the last couple of years, there's been an increased level of competition in the automobile stroke industrial lubricant space. However, having said that, we used to have a positive coverage on Castrol, and if I am not mistaken, our approximate targets are somewhere close to about 225. And historically, I think Ashish might be able to help a little bit more. In the last 2-3 years, this stock has not done much. So if you get elevated levels, rethink your strategy in terms of your investment in Castrol.
Ashish, levels that they should keep an eye out on are reported at around 120.
180 is a very important support. The stock formed that low around 15th, 16th of December, managed to bounce back, again came close to it, bouncing back from there. Looks like a double bottom. That is the level one has to keep a watch on. So any close below 180, then possibly exit. Else we can expect a reversal back on the upside and stock can move back towards the 200 or 210 levels.
Okay, surely keeping an eye out on the levels over there. 180 is going to be the key. Mr. Rao, thank you so much for calling in. Hope that answers your query. Let's move on then to the next one for today. We have Venkatesh who's writing to us from Hyderabad, holding 50 shares of Mankind Pharma. This is at a price of 2,908 rupees per share. Currently, they're making a loss on this one. The stock is trading at 2,060. Wants to know the future outlook for Mankind Pharma. Gaurang, your view?
Mid-cap pharma stock, Vinny, and from the time it got listed, it has done phenomenally well. We have a positive coverage both on the buy and the hold side. Now, I'm given to understand that this gentleman has bought in at 2,900, if I'm not mistaken, and if I heard that right, Vinny. At current levels, if you have investable amount, then I think you should definitely gather courage and average a little bit over here, or maybe to the full extent to the whatever quantity of shares you have, and hold it from a long-term point of view. They've got some real strong brands in the market, and the repeat order market for this particular company's product is very, very high, Vinny. Hold and average would be the advice.
Okay, hold and average would be the advice here. Ashish, your view on the technical front as well. Start averaging here at these levels. Maybe we'll see a bit more of a fall. What's your view?
There is a very important price action support in the zone of around 2000, 2050. So averaging can be done at the current levels. On the downside, 1980 is where the stock has formed low in 2024. Then in 2025, again 1980, 1990 is the support zone. So it's inching near to that support zone. So my suggestion would be average here. Hold on, but the time horizon at least has to be at least for a year or more. And then we can expect the stock to move towards 2,300 and higher levels.
Okay, surely we'll be keeping an eye out on those levels over there. Let's move on to the next query. It's a caller query that we have this afternoon as well. Mr. Bhalchandra is on the phone line from Pune, and he's made an investment in LIC. Sir, could you go with your query? What is it that you want to know?
Okay, thank you. Thank you for giving me this opportunity to ask my query. I have 100 shares of LIC at 870 price. Shall I hold it for the long term? I am long term investor.
Okay. Okay, 870 is the price, is what he's bought it at. Currently, the stock is trading at 792. Gaurang, your view for LIC, what should they be doing? They're a long-term investor, so no problem in holding it going forward. But is average an option, or would you say just get out of LIC right now?
No, definitely hold would be the first advice, Vinny, over here. And just to give a little bit of more clarity on the entire life insurance space, I think this sector has not done much. Again, if you compare the past track record and certain sectors. But I think now with the kind of wisdom that a lot of individuals are awakening to on the bright side, a lot of individuals, and India happens to be one of the most untapped markets. So there is this theme, ensuring the uninsured, which is picking up at ground level. And not only are they taking term insurance, but they're taking large sum insured so that your premium outflow is also at a higher side. Long-term point of view, continue to hold on. If you want to average a little bit over here, you can definitely average it.
Okay. That's a view there on the fundamentals. On the technicals, what should one be doing, Ashish?
See, LIC, we can see has been breaking down the support, but I think the overall sector should start reversing back on the upside. It has a very important support near the zone of around 760 levels, and that should remain protected. On the upside, the stock needs to break about that 820, 825 levels. It has tried multiple times, but over short term, it's not managing to do that. Having said that, from a long-term perspective, my suggestion would be hold on. And if the stock manages to break that 825 mark, we can start expecting a positive reversal, which can take prices towards 860 and higher levels.
Okay, that's a view there on LIC, on the fundamentals and technicals. Hope that answers your doubts, sir. But on that note, we're going to step into a very short break. We'll come back with more of the stock-related queries on the other side. Stay tuned in.
Fly Emirates, fly better.
Welcome back to your stocks on CNBC TV 18. As of now, the Nifty is at 24,950 levels, 120, 130 odd point uptick for the Nifty 50. But let's keep it going with all your stock-related queries. Obviously, we still have with us Gaurang Shah as well as Ashish Kayal, who are here to answer those stock-related doubts. The next one that we have coming in this afternoon is on Kaynes Technology. We have Krishna Kumar, who's writing to us from Chennai. He's holding 1,000 shares of Kaynes Technology, and this is at a price of 3,900 rupees per share. Wants to know if he should continue to hold or average. Gaurang, what's your view coming in for Kaynes Technology?
Well, again, Vinny, we extremely positive about the sector, and of course, yesterday's announcement with respect to how the government wants to take the reforms forward was also quite a bit of an upbeat. The problem with Kaynes Technology, however, having said that, we don't cover Kaynes, but we like the sector. The problem is Kaynes Tech's what this in the time the management gave a little bit of subdued guidance in terms of earnings. The stock has started to correct it from maybe 4,500, 5,000 levels. We have positive coverage on PG Electroplast, which is relatively, peer competition, if you want to say. And we remain extremely positive about the growth prospect with respect to PG Electroplast. Kaynes Technology, since we don't have a coverage, I won't be able to give specifics.
Okay. PG Electroplast is something that you look at, a close peer that one could say coming in as well. Kaynes Technology, you don't have coverage on. The technicals though, Kaynes Technologies, what should the viewer be doing? They have 1,000 shares of this, Ashish.
See, my suggestion would be to exit from this stock. The stock started correcting from October last year from 7,600 levels. Now more than 50% down, and there is absolutely still no positive attempt on the upside. It has not even reached that 20 days average since that period of time, and that's a very concerning sign. So my suggestion would be it's better to be out, book out the losses from the stock, invest in something like a PG Electroplast that Gaurang said, or something like an HCL Tech, or other stocks from the banking name, something like an SBI. That holds much more potential to recover on the upside as the market stabilizes.
Okay, get out of the stock. That's the word coming in there on the fundamentals and technicals for Kaynes Technology. Let's move on then to the next query for today. We have Prakriti, who's writing to us from New Delhi. She's holding 1,000 shares of Raymond Realty. Price is 710 rupees per share, currently making a loss on this one. Wants to know the future prospects of Raymond Realty. Gaurang?
A recently hived off entity from its parent company, real estate related stock. My sense, Vinny, is that there are a lot of strong names which you can look at. On Raymond's Reality, we don't have really specific coverage, but if you really do want to look at real estate, and with a caveat, Vinny, that real estate, despite of having the kind of reforms that we've seen, it still remains a high beta. In good market, it will outperform. In a bad market, it will start contributing from the front on the lower side. Having said that, Godrej Properties is something that we are extremely positive. The stock has corrected Godrej Properties from the highs that we've seen. From here on, the risk-reward looks quite favorable in Godrej Properties.
Okay. Ashish, your view for this stock as well. What should they do with Raymond Realty? Prakriti is asking.
See, Raymond Realty, just about 2 days back, it showed some kind of a positive uptick from around 422 levels towards that 500, and now just retracing that. So my suggestion would be the stock has not done anything much. From the overall long-term trend perspective, the trend is still bearish. But since it has managed to show some supporting activity from lower levels, maintain a stop loss of around 420. If it manages to sustain above that, there is a possibility we might start seeing it moving towards 550 or 600 levels. But that can be from a short-term perspective. From a long-term bet, it's better to be out from this stock.
Okay, long-term better to be out of the stock. 420 is the level that you should keep an eye out on. Next query, we have Bhavan Kumar Patel, who's writing to us from Surat, holding 4,000 shares of sale. Price is 139 rupees per share. Wants to know if you should continue to hold, sell at current levels. Your view, Gaurang?
I think they are better choice, to be very honest. Sale used to be in our coverage, but our targets were in place. We've removed the coverage. So in the entire metal, ferrous, non-ferrous, we've seen a fantastic rally since a couple of weeks. And now there's a little bit of consolidation and correction. Tata Steel would be a preferred destination. On sale, currently we don't have coverage, but Tata Steel is a better company.
Okay, Tata Steel is a better company. Sale, not much coverage right now from Gaurang's view. But Ashish, your view for sale, what should the viewer do?
See, if you look at the entire metal space over past 2 days, a lot of things have changed. In just 3 days of time post the bullion sell-off, we saw the sell-off in copper, which is nearly again down by 8 to 10%, aluminum as well. So the commodity space has shown very sharp decline. And so is the commodity-related stocks as well, whether you talk about SAIL or Hindalco, those stocks are also. Having said that, if I look at SAIL, there is a very important support at 140 levels. So if it manages to sustain above 140, then hold on. If it breaks that level, then possibly get out of the stock.
Okay, keep an eye out on those levels over there. Next query for today, we have Preetham, who's writing to us from Mumbai, holding 200 shares of Eternal. Price is 281 rupees per share. Wants to know, should he continue to hold or sell? 281 is what he's bought it at, making some bit of a loss here, Gaurang.
Fear of competition in the entire food delivery stroke e-commerce space is something that is a short to medium term concern. Very long term, we've been positive on Eternal since the time IPO was there. And even at current levels, we have a standalone fundamental coverage on the positive side on Eternal. Our targets are somewhere close to about approximately 350. So hold on to it.
Hold on to it. And Ashish, on the technicals, what level should they keep an eye out on now?
See, hold on for Eternal also. The cost price is not very far away. 281 is the cost price and the stock is around 270, 271 right now. So my suggestion is hold on to the stock. It has corrected significantly from 360 highs, already retraced 61.8%. There is a possibility you might start seeing some base formation and then an upside recovery. So hold over here. The target can be around 310 levels and the support for the stock is at 250.
Okay, we'll keep an eye out on those levels over there for Eternal. Next query then is coming from Anand, who's writing to us from New Delhi. Holding how many shares of Page Industries is what they're holding. There's some shares of Page Industries. The price is 39,505 is what they bought it at. Now he's asking if you should add more or sell at the current levels. Gaurang, Page Industries?
Purely from an extended time horizon, that is long-term point of view. Point number one, Mini. This is not a counter which is heavily traded. Volumes are very, very thin on BSE and NSE if you go to see. We have a positive coverage on Page Industries. Continue to hold on to it since you got it at 39,000, if I heard that right, Vinny, and currently it's trading at somewhere close to about 32,700. If you have investable amount, you can definitely average and stay invested from a long term.
Okay. Ashish, just a quick word. What levels maybe they can look to average at?
See, average at current levels on the downside, 31,600 is the support that one should keep a watch on. And on the upside, the 20 days average comes to around 33,900. So that's the resistance. It has to break that.
Okay, we'll keep an eye on those levels over there. But that was the last query for today, gentlemen. So Gaurang as well as Ashish, thank you so much as always for joining us on the show and helping solve all those viewer-related stock queries. Thank you so much, viewers, for sending us your queries as well. Keep sending them to us as well on the email ID as well as the number that will be on the screens for you all as well. Thank you so much for tuning into your stocks this afternoon. Up next, you have Closing Bell to take you through the last hour of trading.
Welcome to India's #1 budget headquarters. Decoding key policies, delivering market-shaping insights, and unlocking the potential of India's growth blueprint. Beaming live from the CNBC TV 18 Motilal Oswal Budget Headquarters.
The Hang Seng is down almost 1.5% as we speak. The similar story playing out for the Taiwanese index as well. That too is trading with losses of a similar quantum.
With no impact in the volume, if the volume remains the same, put together it may fetch us around 15,000 crores or so.
I'm very confident that this panic reaction is possibly for the day, and you will see a lot of positivity in the days to come.
I think what was expected was some help on the equity taxation front, perhaps at the margin. But what was absolutely not expected was it going in the reverse direction, which is the STT hike.
And the government should look and the system should look at the market as an independent sector also. In addition to saying because it helps data centers, it will help the market.
The market's opening, what do we have? First rates coming through, 60 points lower on the Nifty, 24,750.
Markets have reacted since yesterday as though the retail investors have made a lot of money in the last 25 years in derivatives, which has never been the case.
There's clearly some work to be done there. I think 10-year yields should be, I think, closer to 6 and not 6.76 is my view.
I'll start with gold, and this was the biggest one-day decline on Friday that we saw since 1980. It was down by 17%. It's trading down by 5% right now as well.
You know, the Nifty is down about 60 points, below that 24,800 mark as well. The Sensex not doing particularly well. Mid-cap index, the market breadth out here tells you the story of the day.
Funding of the R&D, better clinical trials and infrastructure, getting faster approvals are all going to be good from an overall perspective, and it will help us to stay competitive in the high-value therapies.
While the Nifty has managed to see a bit of a comeback, it's the mid-cap and the small-cap index that continue to sell quite significantly in the session today.
Okay, well, I think I'll do a retake. Markets seeing a bounce and it's 100 points. Just see the kind of stocks which are moving up, right? Reliance Industries is up about 2.5%. Power Grid, Adani Ports, a fair bit of infra and old economy names out there. I must say, market breadth is yet to catch up. As the last I checked, about 2.5 is to 1 in favor of declines right now. This is Closing Bell. We're coming to you from the CNBC TV 18 Motilal Oswal studios. I'm Prashant, Nigel and Reema with me. Hi, afternoon.
Hi, afternoon. The mid-cap index is pretty flat. Softness is seen in many of the technology heavyweights, maybe tracking the cut that you saw on NASDAQ. So IT names are under pressure in terms of defense. For the second day in a row, many defense stocks are weak in trade. So Bharat Dynamics, Cochin Shipyard, Hindustan Aeronautics, weak in trade. And textiles too. Names like Gokuldas Export are sulking.
Well, that's right, Reema. You know, and if you look at the advanced decline ratio, yes, it's in favor of the number of stocks that are declining, but actually the lines have got a little closer to each other, which is heartening to see, because at one point of time, we had only around 450, around 500 stocks that are advancing. So that crisscross actually has taken place. And the mid-cap index, as we speak, that's moved into the green. So that's pretty good news. But there are otherwise big gainers. Vari Energy, Premier Energies, both of them flying away in trade. Even some of these, plays like the data center play, Anand Raj, that stock is flying away. That's doing pretty well. GMR Airports is up, and we've seen a big recovery in silver prices as well as in gold prices, and that's why you have a stock like Manappuram Finance that's recovered from the day's low, and Hindustan Zinc as well has regained its mojo. So pretty good stuff, guys. I mean, not such a bad outcome when you're preparing for a manic Monday.
And even these capital market plays have recovered, right? Angel, BSC and Nuvama Wealth all up 3-4%.
Absolutely. Let's just quickly run you through what's coming up here on the show right now. So, okay, I think we have Mitesh with us, so we can, I guess, directly go across to him. Mitesh, if I can come to you, what does one do right now?
Yeah. So, Prashant, I think, on the index, as I said, there could be a bounce back to about 25,000 levels. We are kind of attempting that. Let's see if we can close above that. Then, we'll look at further extension. But for the timing, I have a sell on Infosys. I think some kind of profit booking signals are emerging here. So keep a stop at 1644. Look for targets of 1580. And ONGC is a buy with a stop below 246.5 for targets of 264, sorry.
Okay, all right. Those are specific trades. Mitesh, thank you very much for that. And we'll come back to you for more. Well, we have one of the top equity strategists in the country join us now to take us through what he's and what he made of the budget which was announced yesterday. Rhythm Desai needs no introduction, Managing Director and Chief Equity Strategist India at Morgan Stanley. Rhythm, good afternoon. Great to have you with us here on the program. Thanks very much for joining us. I remember reading your pre-budget note, and one of the things you said in the pre-budget note is markets are not expecting, but they'd be happy with some kind of relief with regards to measures which may reverse the FPI outflows, right? I mean, you didn't say anything specifically, and I think this STT thing, which has been going on since yesterday, was a bit of a bolt out of the blue. It went in the other direction. I think that's kind of overshadowed the pragmatism and other things in the budget. Maybe unfair, but well, that's what it is. Your first take, Rhythm, how did you see the budget and what it means for the market on a durable basis, if at all?
So Prashant, thank you for having me, and my apologies, I could not make it in the morning. So I think let me just step back from your question. By the way, that what you read was on the front page, and inside I had explained what would reverse this. So we'll come to that in a moment. But ultimately, your viewers should understand the budget is a statement of the government's expected income and expected expenditure. And there are two ways of approaching this. You can make some aggressive assumptions and overestimate income, underestimate expenditure, and come up with a very rosy scenario, or you could do the opposite. Now, the government has chosen to do the opposite. It has estimated its income rather conservatively. You can see this line by line. It's expecting a 10% growth in corporate tax revenue, which I think is super conservative. It's actually budgeting for pretty aggressive growth in expenditure. And therefore, I would say that it has erred on the side of caution. And the likelihood is as the year progresses, it may find itself beating its estimates, which actually augurs well for all the markets, which is equity, bond, and currency. So that's the first comment. The second comment, which I made earlier today, today and in fact over the past few days, is that in my 35 years of doing markets, actually slightly more than that, I am sensing right now, and I'm relying this purely on memory, so take it with a pinch of salt. This is the biggest disconnect I'm seeing between the macro and the market. So the macro actually looks pretty good. I mean, look at the auto data that came out yesterday. It would suggest that we are in a recovery in growth. If you look at macro stability, things are actually quite benign. And in contrast, if you look at markets, whether it's the equity market, the bond market, or the currency market, they seem to be suggesting that India has some big problem on its hand. So this disconnect, I think, is certainly something to ponder over. And markets don't go wrong that often, but this time around, I'm quite convinced that the markets have underestimated what India is up to. So I think that's the second comment. And coming back to the overall comment on the budget, I think the budget actually addressed quite a few strategic issues, whether it's with respect to AI, whether it's with respect to services, or the focus on defense. I think it nailed quite a few issues, and in fact, even simplification of taxation. So in my view, this was a very good budget in both senses, in the sense that it doesn't overextend or overestimate things, and in the extent of the policy that it's delivering, which is a continuation of what we have seen over the past few months. Now to your question about FPIs. So clearly we are from the capital market, so we get very narrowly focused on what is the government doing about markets. And the last thing we want is them to do something that spooks the market. So unfortunately, the STT increase has spooked the market. And this is a little harder for people to understand, those who are not in the market. I mean, why would a 12,000-15,000 crore increase in a tax caused such big damage to market capitalization. And the reason is very simple. For those who are not in the market, is that the markets function on sentiment first and then fundamentals. And the sentiment was already weak going into the budget. In fact, if you look at India's relative performance in the 30 days in the run-up to the budget, this was the worst ever that India had. And it was going to be so hard to disappoint the market, but the budget managed to do so despite it being such an excellent budget with a little small change. So that's the nature of markets. Markets will go through this, and will probably when fundamentals assert themselves more strongly, this will be forgotten and over. But on your comment with respect to FPIs, I mean, it's something that I've been talking about for a while now. And actually, it came through in the budget. So our suggestion was that the definition of FPI should be liberalized, and that has happened. So persons residing outside India, PROIs, are now in a position to buy a lot more stock in India than they could do before. Now, the next thing, which I think was a very important line in the finance minister's speech, and I'm not sure whether that's got enough airtime, was with respect to the modification to FEMA on non-debt instruments. So you can say non-debt is not very different from equities. And I would be eagerly waiting for the RBI's announcement on this, because it's okay to allow foreign investors to buy. The process has still been onerous for them. And if FEMA delivers a simplified process, then I think we've opened up the Indian markets to a completely different capital pool, relative to history. Historically, this market has attracted largely emerging market pools and to some extent global pool, but not HNI and not other pools of capital, which is what this budget has done. So yeah, it's a material change, but it has to be seen together with the proposed modification to FEMA, which I think we'll learn in the course of the next few days.
Rhythm, just one more question from my side. I know you've interacted with a range of investors, right? Could you tell us, we've also had a bunch of conversations here, and most actually large money managers are kind of sort of sidestepping this STT issue as a sentiment negative. But sentiment, as you said, is important. Those outside the market perhaps don't understand it to the degree that we kind of sort of obsess over it. But what's the feedback? And I mean, my question really to you is, where does the market go from here? Are we in for more of the same? I mean, the start to 26 has been pretty tough. And the hope was that maybe this will change things a little bit around. What's your sense?
So see, Prashant, I come from a fundamental perspective. The relative multiple on India is now close to its lowest level ever. And it only got lower than this in October 2008 in the middle of the global financial crisis. So India has never been cheaper than this before. If I look at the fundamentals, they seem to be on the mend. And do not underestimate the amount of stimulus that government and the central bank have put into the economy over the past few months. We've had 125 basis points of rate cuts. We've had unprecedented liquidity infusion and more coming. We've had banking sector deregulation. We've had 2.5 trillion rupees of tax stimulus. And this wasn't a crisis. It was a plain vanilla slowdown. The policy response has been very large. So it's almost inevitable that India's growth turns this year. And therefore, I think for those who are, and that's what stock markets require. They require courage at times when we are dealing with very bad sentiment, to take a contrary view and to stand up and say, no, I'm buying this. I think 12 months out, the results will be quite good if nothing untoward happens in the world. So I think that's my primary position. With respect to sentiment, so there are two ways of looking at it. Sentiment is very critical. Let's not underestimate that. Not necessarily market sentiment alone, but sentiment overall. Because it determines how consumers behave, it determines how investors behave. That's how simplified the world is. When I get up in the morning and I feel good, I go and make a purchase. It may be of a car, it may be of a new wallet, it may be of anything. And if I'm not feeling good and if I'm depressed, even if I have the money in the bank, I decide not to do it. So it's important to handle sentiment. It is actually a leading indicator of the economy. So the risk from this STT increase is that it takes the market sentiment down a notch, and then ultimately the reflexivity of markets into the economy mean that it drags down the economy. And that is why I think there is a slight worry about this. But otherwise, I think the fundamentals are supremely good right now. And I dare say India actually enjoys the best fundamentals amongst large economies in the world.
But today, at least, markets seem to be settled. So day one after the budget, we aren't seeing that overhang of STT play out in the markets. Rhythm, afternoon, and thanks so much for joining in. Rima here. So data center sector has emerged as the big winner of this budget with tax holidays till 2047. Share your views on what has transpired, what's happened in the budget, and actionable investable ideas basis this.
So see, I think one of the reasons why investors were avoiding India, global investors were avoiding India, in fact, there were, I would say, three reasons. One is India's growth slowdown that started sometime in the last quarter of 2024. The second is India's extremely rich valuations relative to emerging markets in the world at the end of September 24. And the third is the lack of any immediate AI trade. Valuations have got fixed. I think growth is getting fixed, and we're going to get surprised to the upside. So the only thing remaining on the table was AI. Now there are 5 ingredients to AI. You need energy, they power the data centers, and then you need the supply chain, you need skills to convert that into some useful product, and you may or may not need an LLM, and that's an optionality. Now this budget actually goes around fixing 4 of these 5 things. So outside of the LLM, it has fixed the viability of data centers. I think India is probably one of the most attractive places on the planet now to set up data centers. This tax holiday has really sweetened it. So we've already seen tens of billions of dollars being announced, and I won't be surprised if these amounts go up materially in the next few months. The budget looks at the supply side issues quite intently, and we're talking about semiconductors, we're talking about rare earth. So all of these things go into the whole AI trade. It's certainly taken care of the energy side. There's a lot of incentives that have been rolled out, and I'm very bullish on the energy sector. So, and of course, skills. Do not underestimate the importance of the safe harbor for IT services. India is the place on the planet where you get skill at scale of very disciplined people at pretty low wages. It is unprecedented. It's an unprecedented advantage in a world that's trying to build AI-led solutions. So we have got the ingredients now, and I think as investors smell the roses, they'll wake up to the next big AI trade, which is India.
Okay.
So I think the budget has done a great favor, actually, to the market in that sense.
All right. Hi, Rhythm. Good afternoon and good to see you, Ben. I think in the morning you couldn't join us because there was a meeting with Minister Goel, if I'm not mistaken. I was looking at the gram and I think he uploaded some photos. I'm guessing that was earlier today. That said, you're impressed with the budget. You're optimistic that earnings pick up from here on as well. I think with regard to sentiment, that India-US trade deal is something that markets are looking forward to. How big a sentiment turner is that? Because there is some optimism that's been creeping back in the last few days, Rhythm.
Yeah, that's also an important thing to the sentiment. And I guess it's only a matter of time that the trade deal happens. I think a lot of work has happened in the background. I'm not privy to anything. I'm just guessing. But it's almost inevitable. And I'll tell you why I'm saying this. It's because of Pax Silica. So do not underestimate the importance of Pax Silica. And India is on the table in Pax Silica. So for those who had this view that India is no longer a strategic partner for the US because of the events of the past few months, need to revisit that view, because India is part of the most important thing that America is doing right now, which is Pax Silica. India joins the Pax Silica, I think, in the next 2-3 weeks, or maybe in March. And that, I think, is a game changer. So it reorganizes the whole supply chain around modern technology, and India is going to be part of it.
Okay, all right.
So I think that gives me optimism that the US trade deal should be somewhere around the corner.
Hopefully, I'm quite optimistic as well on that, Rhythm. Final question, Rhythm, before we let you go. As we know that India has underperformed as a market, and the US market has done very, very well. Valuation-wise, that market as well has gone to a bit of a premium in comparison to its averages. What's the likelihood that we see the global markets actually see a bit of a correction? And if whether or not that happens, do you believe India, irrespective, will outperform post the recent months of underperformance?
I think that's a very good question. I'm not the competent guy to answer what happens to the world, but I can make an observation to you, which is, I think, useful in assessing this.
Yeah.
If you look at the four major economic blocs in the world outside India, the US, the Eurozone, Japan, and China, each one of them is stimulating their economy as we speak. Three of them are doing it with both monetary and fiscal policy, and one of them is doing it with fiscal policy. Now, that hasn't happened since the global financial crisis. It's a synchronous stimulation, and there is no crisis that they are reacting to, but they're probably reacting to the reworking of global trade. And this is a pretty, you could say, reflationary environment that we're living in. So that's one point I'll make. Morgan Stanley as a house is quite constructive on equities as an asset class in the US included. So it doesn't look like that the global markets are in for any durable correction immediately. So I think that's the global backdrop. It is a worry for India if there is a recession around the world, but that's not our base case scenario.
Yeah, I mean, I could go on, right? Lots of questions, gold and silver. I'm not sure if you have a view, Rhythm. That's the other chatter. And oh boy, what a move we've had.
Let's get Rhythm's view on that.
Rhythm, you want to weigh in? Gold and silver?
No, see, I will say what I say about gold and silver is that unlike what people think, they're not assets. They are stores of value.
Yeah.
An asset, by definition, is something that yields an income, like property, like equities, like bonds, like fixed deposits. Bitcoin, gold, and silver don't yield. Well, silver, I'll keep that aside because it's an industrial commodity. But gold and Bitcoin don't yield any income. They are stores of value. And their fair price is what is basically dependent on the price that the next guy in the line is willing to pay. And that's a very hard thing to predict.
Yeah,
that's all.
It could be. That's absolutely right. But Central, there's a chase, right? And it's being led by central banks. Almost price agnostic buying, as we've seen both. Actually, gold. Not so much
Prashant,
yeah.
the RBI bought 70 odd tons in 2024.
Yeah.
Of gold. It bought 4 tons in 25.
Yeah.
So again, you got to question this thing about, central banks are buying. I think people need to go and check the data.
Yeah. No, but I mean, we have data which shows that Western central banks are buying, Rhythm. Maybe we have, and gold is, actually, Rhythm, the RBI dividend is superb this time because of gold and dollars. Those are assets on RBI's balance sheet, right?
Not because of gold, but because of dollars, because it's a function of the income they earn.
Yeah.
So gold doesn't earn any income, but yeah, that's true. Yeah, that's happening in the world, and people are looking for alternate stores of value away from paper currencies, and that's an ongoing thing. But I have no ability to tell you where gold is going next.
All right, Rhythm, we'll leave it there. Thank you very much for joining us. It's always a pleasure. And that headline stands out. This is the biggest disconnect between macros and markets. On a relative basis, India is cheap, never been cheaper. And 12 months out, investors who have patience, who stay in perhaps, will be happier compared to where we are right now. Most definitely. We'll take a quick commercial break here. Deepak Shah is going to be with us on the other side, and we'll ask him what he's been doing. I mean, Deepak, of course, is also someone who has been writing quite a bit about the budget, the nuances, and so interesting conversation lined up next.
Welcome back. You're tuned into Closing Bell here on CNBC TV 18. Just take a look at the markets. Wow, pretty good, huh? Nifty is up close to around 200 points. So we've made up half of yesterday's losses. So that's good news. The mid-cap index, that's the beautiful one in there. That's recovered more than 2% from the low point of the day. Currently up close to 0.3%. And the Nifty Bank, don't leave me out, it says, that one in fact has recovered as well from around its 100 DMA. We have some news that's flashing for you on the screen. UPL's numbers are out and they appear a tad bit better than what the street was working with, at least on the revenue front. We'll wait by for the operating profit as well. But for the time being, UPL reacting positively to those numbers. We'll get a quick analysis on that particular name. The EBITDA number should come up for you in just a bit. But we have Deepak Shenoy who joins us on the show. Hi Deepak, good afternoon and good to see you. Lot of debate with regard to this SGT. For that 15,000 crores of additional income, lakhs of crores of market capitalization eroded. How are you, what's your argument with regard to this? And it's clearly been a sentiment dampener, but you've got a couple of points on that. Please go ahead.
Yeah, no, quickly, Nigel, I think the SGB's change in taxation is primarily around paying that 12.5 or 20% capital gains tax. Now, if you sold it even now, even if the rules weren't changed, you will still pay that tax. So it doesn't make sense to sell it right now and try to game this system, because there's no point trying to sell it. If the price is actually below the market price of gold, you're going to pay that 12.5% tax, and that's fine. It's a fairly large increase in taxation. It's a large increase in price of gold from the time most people have bought this SGB. And you should just consider it now as a kind of a taxable asset. There's also an income associated with this.
Right. Deepak, actually, I want to ask you about the STT. That's the one. Yeah.
I heard that wrong. I'm sorry.
No worries.
Okay. STT is, so STT, stock futures are dominated by arbitrage funds at one level, probably FPIs at the other level. So it's not really as much a retail product. Index futures perhaps are. And what happens typically is that because ARB funds tend to short futures every month and roll it over, you will find that there is an impact on the returns of arbitrage funds going forward now. As a disclosure, we are also launching an arbitrage fund, but regardless of this change, it is probably still more tax efficient to park short-term monies as either an individual or even as a company in a short-term, like an arbitrage kind of a fund. If you have it's a slightly higher risk product in comparison with something that's like a pure liquid fund and so on. But the post-tax return is substantially more attractive. So I think even with this, which will hit you by maybe 0.4 to 0.5% lower in terms of returns, part of that will probably get adjusted by market changes when volumes change, and therefore demands for liquidity will also come in from from the ARB funds will probably demand slightly higher premiums as well. But at the same time, this may not affect your retail population quite that much. The option price STT increase is 0.125 to 0.15% or 0.015%. It is so tiny that, for the person that is actually speculating, doing this one lot, two lot option buying, it's ordinary, very, very tiny in terms of the differential for a 3,000 to 5,000 rupee premium that they typically pay per lot. The impact is going to be very, very marginal, of the order of, single digit rupees. So I would say, it doesn't affect the speculator that's going and punting on like one or two lots of Nifty options, buying it or something like that. But it does impact larger institutional players like ARB funds and FPIs a whole lot more. I don't think there's going to be major amount of changes in since the whole market is impacted and the tax advantage still remains. I don't see major either outflows from our funds or any changes in the FPI schedule, because FPIs buy futures first and then convert it into stock when they want to buy a stock, because the impact cost on the futures is far lesser in general than trying to buy a large volume of stock.
Got that. But particularly for ARB funds, arbitrage funds, what will be the impact? And will it dry up the market?
Yeah, I don't think so. I think it's, 0.03% per month is the increase, right? So there's no cess and all that on that. So you're effectively saying 0.36% per year is the differential. 0.36, and then you assume some market dislocations, maybe 0.4, max 0.5% impact on an ARB fund volumes, and perhaps even lesser because ARB funds have only about 70% of their positions in stocks and stock futures, right? So that impact maybe at 0.5%, I think is the highest you'll see. Probably be of the order of 0.3, 0.4% overall. But that's not meaningful because your yields in the market right now on ARB funds have been around between 6.5 to 7%. So that drop in return, if it actually happens next year, will be relatively small in comparison with the yields that you're getting, and the tax impact is not. So I don't see a major outflow meaningful over here. If STT was raised to like 15 basis points, 30 basis by 15 basis points, 30 basis points, something like that, then I think, yes, that would make a significant difference. But I don't see that happening. It's just 5 basis points right now, and it's only on the sell side. So you don't have to pay it in both directions. That's also an important thing to note. And remember, stock STT hasn't changed. Futures exercising into stock, that has also not changed. So therefore, I don't see a major impact on volumes or in arbitrage fund AUM in that sense.
Yeah, I mean, lots to talk about, right? Maybe we need a 30 minutes primer special with you, Deepak. Dinesh Kanavaru was here and he was saying, well, he was half joking. He said, well, great news for tax experts and consultants. There's some 90 changes he was telling us. Before the new tax code it comes into effect, some 90 changes. So, and I think we'll discover some more important ones as we kind of go along. But I think the big ones we already know in that sense, right? But this time it all comes through. Thank you very much, Deepak, for joining us. Good speaking with you, and more later. Appreciate your time here on CNBC TV 18. By the way, the tease up on the screen, FM's first post-budget interview today at 8 p.m. Network 18's MD and CEO Rahul Joshi in conversation with Nirmala Sitharaman, the finance minister of the country. That's a conversation you don't want to miss tonight at 8 o'clock. We take a break. We are back. The news at the bottom of the screen is what we want to address when we come back. Stay tuned. Well, news at the bottom of the screen. This is PE firm, and it's a very large PE firm. Advent International is likely to be infusing money into Aditya Birla Housing Finance, which is a subsidiary of Aditya Birla Capital. My colleague Rationale is here with what she's gathering from her sources. This is a CNBC TV 18 exclusive. Rationale, take it away.
What we've gathered from our sources is that PE firm Advent International is set to infuse around $300 million into Aditya Birla Housing Finance in exchange for a minority stake. Now, sources say that this will be a primary capital infusion aimed at strengthening the lender's balance sheet, improving capital adequacy, and supporting the next phase of loan book growth. Aditya Birla Housing Finance, as we know it, is a wholly owned subsidiary of Aditya Birla Capital, which has been scaling up its retail and secured lending businesses as housing demand remains steady across urban and semi-urban markets. Now, speaking of this deal, we understand that that Advent investment comes against the backdrop of multiple capital raises at the housing finance arm. In January 2025, the company raised about 830 crore rupees through the International Finance Corporation through non-convertible debentures, largely to expand affordable housing lending and priority segments. Separately, Aditya Birla Capital has infused about 249 crore rupees into the subsidiary to fund growth and improve leverage ratios. And now sources say that this equity capital would provide Aditya Birla Housing Finance with balance sheet flexibility, allowing it to grow without overstretching leverage at a time when funding costs remain elevated and asset quality vigilance is high. Both Advent International and Aditya Birla Capital have not responded to our queries. We will be keeping an eye out.
Okay, well, that is an important story that we are picking up at this point in time. And I think the board meeting for numbers is tomorrow. The board meeting for the third quarter results. We'll see if this is announced along with it or this is done separately. But so many transactions in the financial services space, one after the other, and this is the latest coming through. 100% subsidiary of Aditya Birla Capital. Stocks, by the way, come off quite sharply, Aditya Birla Capital. If you just look at, say, the last 1 month or so, I think we have seen a fairly sharp fall. I mean, I think 370 rupees was the high that we saw recently on the 6th of January. And it's at about 330 odd rupees or so, 331 as things stand right now. What percentage equity, how will that value Aditya Birla Housing Finance? I mean, I think those are the details which, of course, also will matter as we go forward. There's one more story which we are breaking at the bottom of the screen. This is PB Fintech, which is likely to announce a fundraise via a QIP. That is, again, a CNBC TV exclusive. It's source-based information, and it's likely to raise this money to fund an acquisition. PB Fintech, of course, is corrected again quite a bit from the highs of 2,000 rupees plus. But I mean, all of that, of course, was with regards to concerns around distribution, commission costs being under pressure and the regulatory lens on it. But this is, of course, the information we are picking up on PB Fintech. Our colleague Yash should be with us in a bit from now to take us through more details. Well, let's talk about, I think it's the right time to talk about the chatter, right? And what Nimesh is answering and picking up from the market, the feedback. Nimesh, 250 odd points on the index, 25,080. What are you picking up?
Well, Prashant, honestly not surprised with the kind of move we've seen in today's market. It looked very oversold the way yesterday the Nifty and the broader markets collapsed. The PCR had fallen below 0.6. And, everybody on the street was negative and they were expecting that FIs will be big sellers today. Surprisingly, that's not the case. FIs aren't large sellers. In fact, there is a small buying, what I understand. So it's quite mixed, is what I understand from a flow perspective from the larger FIs in today's market. There is a bit of small buying as well in select large cap names. The selling is largely into private bank names in today's market, some of the NBFCs, and to some extent a bit of profit booking in the defense names after the budget. So two stands out on the negative side is financials, especially the private banks and some of the defense names. Technically, I'm told there could be a counter trend rally, which is quite possible because it's so oversold from a technical point of view. So that's the other feedback. So clearly, a pullback from extremely oversold levels, but at least the fear of large FI selling doesn't seem to be in today's market.
Okay, all right, Nimesh, interesting times. I'm wondering by the end of today whether we'll see a small buy number from the FIs and maybe some short covering. That'll be really something. But what about individual stocks, Nimesh? What are you picking up?
So the first on my list is Shriram Finance. it's been under pressure today, and there is a reason for it. There is aggressive selling from larger FIs in Shriram Finance today. So expect high delivery volumes, but on the sell side, I said, generally within the financial names in NBFC, there is selling pressure, and Shriram Finance stands out in terms of one of the most bigger name where there is large selling today. So that's the first name. The second stock is Northern Arc. Even that is under pressure today, but I understand there could be a large block deal in Northern Arc very soon. So that's the reason why maybe a bit of overhang, and that's the reason why the stock is under pressure today. Lastly, couple of names where is delivery-based buying today: HDFC AMC as well as Hitachi. HDFC AMC stands out because there is so much of negative news flow towards the capital market names, but HDFC AMC stands out in terms of buy flows. And also Hitachi is buzzing in trade, small, but there is buying interest at these levels in Hitachi as well.
Well, no dearth of chatter, right, Nimish? Markets up, down, the chatter
and there is anyway there is going to be a large deal today evening as well, possibly. So watch out for that as well.
Yeah, absolutely. The PB Fintech news, of course, still flashing there, and we should be able to speak with Yash on this as he's breaking the story at this point in time. I think we can go across to Yash now. Yash, tell us, what are you picking up?
Well, quite an interesting transaction that we're looking at as far as PB Fintech is concerned. What we've been given to understand from our sources is that PB Fintech is likely to announce a large fundraise, and this fundraise could be via the mode of QIP. The funds which the company is looking to raise at this point of time are likely to be used towards the acquisition of an entity which we've been given to understand from our sources is on the international side, in an international geography, but is likely to be in the same business as what PB Fintech does in India, that is insurance products aggregation and insurance products selling. This is likely to happen over the next few days. Of course, the announcement expected soon, on the fundraise, and then eventually the purpose of the fundraise, which is likely to be the acquisition of another international insurance aggregator. PB Fintech itself has large amount of cash on its books. If it's still raising more cash via QIP, this is likely to be a large acquisition which the company is expected to make. We've written to PB Fintech on this particular development. The company, in fact, reports its numbers today evening itself. There could be some clarity which could come on that earnings call from PB Fintech today. But as of now, on this story, on this development, there is no response from the company as of yet. We are still waiting for a response from PB Fintech.
Thank you very much for that. Mitesh is now joining in. Mitesh, the rally is getting stronger now. Approaching 25,100. What's the trade?
As I said, about 25,000, I think there is a chance of a stronger pullback, and we could now see 25,350, 400 zones possibly. On the stock side, I have BTST on power grid. It's a very bullish candle happening over there. So take a BTST with a stop at 267 for targets of 275 thereabouts. And PG Electronics is also something which is reversing. So BTST with a stop at 554 half for targets of 570.
Okay, all right. Thanks a lot for that, Mitesh. By the way, the market's definitely taking note of both those two stories that are coming there. From Rationale first on AB Capital, the stock has spiked up, one of the outperformers in an otherwise dull 2025. And post Rationale story, actually, that stock has taken a bit of a leg up. I think we should get that one up for you on the screen, currently at the high point of the day. And the other one is the QIP on PB Fintech for an inorganic growth, despite sitting on a lot of cash. QIP normally comes in at a bit of a discount, so I guess that's the reason why that stock as well is correcting. Market taking note of both those two stories that were just broken on CNBC TV 18. But time to talk about stocks and get some ideas. Amrish Malika joins us on the show. Amrish, it's that sort of a day, right? Surprise, surprise. The mid-cap index now up close to around 1%. Beautiful move out there. The mid-cap index is calling for attention, and the advanced decline ratio is pretty much even Stevens. Good time to get in a pick from you. What's the stock on your radar, Amrish?
Yeah, Nigel. See, I've been talking about the budget. If you've seen in the last 10 years, the effect of the budget does not last beyond 1 or 2 days. In the last 10 years, only 2 years, 2016 and 2021, that we saw the budget effect lasting much longer than that. And this time we have seen just 1 day. Just yesterday, we saw that reaction this morning a bit, and now we are back to normal business. So my pick now would be Uno Minda, which is a global tier 1 manufacturer and supplier of automotive components and systems. Product portfolio is across 25 categories, mainly automotive switches, lighting, casting, seating, and acoustic. And in the new segment, they have EV-specific products, sensors, controllers, ADAS, and blow molding products. And catering mainly to two-wheelers and passenger car segment, but now they're also focusing on CVs, three-wheelers, as well as off-road vehicle segment. Mainly supplying to OEMs, but the replacement market also is growing quite fast. Globally, 75 manufacturing facilities, there are more than 37 R&D centers, and the new EU trade deal, this also should be positive for them. Q2 numbers were better than expected. EBITDA margin was about 11.5, strong, growth in aftermarket. Now, I believe the Q3 numbers, which should be coming on 5th of February, should also be in line. Also benefited from premiumization and increase in content per vehicle. So next 3 years, revenue CAGR is expected to be about 15%, EBITDA CAGR to be about 16%. Expected EPS for FY28 should be around 29 rupees, and my target price is 13.92.
That's Uno Minda for you. Amrish, stay with us. Coming back to you, look at the flashes at the bottom of the screen, right? Gold is up 7% from the lows. Silver is up 15% from the lows. So back at about 82. Why not go and bring in Manisha to tell us what's happening? I mean, you know, the commodity market, MCX will trade a lot longer after we are shut. But it'll be top of mind when we come back tomorrow with international prices, of course, also at play. Manisha, tell us what's happening.
Well, yes, it continues to be very, very volatile when you look at especially gold and silver prices therein. At some point in time, we are 15% down, then we are 6% up. There is buying on the lower levels and a sell-off in every uptick that you're looking at in many of these prices as well. Let me take you through some numbers then. And on 1st of January, the gold prices were trading at $43.30 an ounce. We saw a record high of 29th Jan at $5,600 an ounce. It's trading at $4,600 an ounce. So $1,000 has been shaved off in the matter of 2 days there. Same is the case with silver. We started this year with $71 an ounce, went on to make all-time high of $121 an ounce. It's trading at around 70 to 80 between that at this point in time. So a very sharp decline coming in for this one as well. If you look at the Indian markets, you can see the declines coming in much, much sharper. So 29th Jan is when we saw an all-time high in case of silver at 4,20,000 rupees. Today's low is 2,25,000 rupees. So we've seen prices actually go half in matter of just 2 trading sessions. Take a look at the gold prices. 29th Jan, the prices hit an all-time high of 1,80,000 rupees. We are trading at 1,37,000 rupees today. So very sharp declines. And when you put this in number, from the record highs which were seen on 29th of January, well, gold has come off by 24% and silver is down by 47%. That is the kind of decline that we are dealing with right now, with markets suggesting that there is some more profit taking that you could be looking at in gold and silver prices. But then again, most banks and brokerages have stayed their higher targets for the year end. Most believe that further highs in gold and silver are still awaited right now.
Manisha, thank you very much for that. So that's gold and silver, very volatile, lots of bounce coming through. Power grid. Sorry.
No, just take a look at the metal index. You know, the metal index has seen a big recovery from the lower stocks like Vedanta, Hindustan Zinc, Hindustan Copper. All of them actually have seen a big spike up. In fact, Vedanta, I think, is one of those stocks that has recovered considerably from the day's low. It's up only around 1% right now, but intraday chart will tell you the picture. And Hindustan Zinc now at the day's high, up close to around 7%, got slammed in last 2 trading sessions, pulling back some part of that. But Prashant was just telling us, we'll hop across to Vivek to tell us about Power Grid, one of the top volume gainers today. Vivek, what's going on there?
Well, you know, when was the last time you saw a utility like Power Grid, you know, move up so significantly? This was after the company held its Q3 FY26 analyst meet. The company, just before the analyst meet, uploaded a presentation, and against all expectations, the company actually has gone ahead and upgraded both the capex as well as capitalization guidance for FY26. The company has said that it is on track and they are poised to exceed annual guidance. In the analyst meet, they've given more granular details. Remember, the company's earlier capex guidance was 28,000 crore. The company's capex at the end of January stood at 29,200 crore, and they're expecting it to go closer to the 32,000 crore mark. Along with that, when you're talking about the earlier capitalization guidance, it is at 20,000 crore. At the end of January, it stood at close to 18,700 crore, but they're expecting it to go closer to the 22,000 crore mark. Very positive takeaway. Along with that, they also mentioned one word as far as the Chinese threat is concerned. They downplayed it significantly. They're saying only the existing transformer capacity could come on board, which has also led to a bit of a relief rally across most of the transformer names like Hitachi Energy, etc. So positive for Power Grid as well as quite a few other capital good names.
All right, Vivek, thank you very much for that. Well, what's the last time you saw an 8% move on Power Grid? I think you have to go back to a guidance increase in the past because it's happened before, and it's happened now. But 271, 272 on a Power Grid. Market's doing very well. 270, very, very nice bounce. So you're basically recovered about 3/4 of yesterday's losses with this bounce, and 25,100 is where we are at right now almost. Well, a lot of veterans, market veterans, we spoke with Samir Arora, we had S. Narain, we had Neelkant Mishra on the strategy, markets ahead. So this is perspective on the budget, but more importantly, markets now that the budget is behind. Listen in.
On Twitter, hundreds of times I have said that STT should be increased on futures and options, but always accompanied by a corresponding lowering of either capital gains tax or lowering of STT for cash or doing something. So that's why this one is that we are not accepting the fact that if you get, say, $5 billion through some FDI with doing hundreds of things, you can get it in 1 hour with the FPI guy if you understand the power of the market. I would think that because they were selling, in that context, at that time, we should not be doing things which are negative, because this means they will not change currently. Now, after 5 days, 10 days, 20 days, if there is a US deal or something which changes the sentiment for India relative to other markets, then it'd be different. But right now, how will that momentum stop?
The way markets have reacted since yesterday is as though the retail investors have made a lot of money in the last 25 years in derivatives, which has never been the case. In fact, the regulator prepared a long document showing how much money was lost in derivative segment. But the market reaction since yesterday is only to do with STT, because everything else in the budget was fantastic. This data center tax concession to propel investments in data centers. We've always been supportive to any tech trend in IT services, in cloud services. Everywhere we've been a supporter. So I think in AI also, we have to be a supporter and create an AI services boom. So I think that step was a step in the right direction.
Well, just about 4 minutes left before we wrap up trade. Just watch for UPL. Came out with numbers a while back. Looks like a good set of numbers. The company's top line went up by 12%. EBITDA increased by 13%. FY26 guidance has been maintained. And there is a healthy reduction in the company's overall leverage. And that stock has moved to the day's high, 5.5% up on that. Latent View is another stock reacting to their numbers, so 11% gain. While Misho, which has reported a big loss at the bottom line, nearly 500 crore, stock is under pressure. Amrish, you want to give us, Uno Minda is of course one stock that you like, but anything else that's got your attention post-budget? There are lot of data plays like Anantraj, Lodha developers moving up. What looks attractive to you?
See, I think most of the developers, I think, will start looking at data centers as an annuity business going ahead. So that's something to be watched out for. Because clearly this tax which is given is a huge advantage, which I think most of the developers will take advantage of, because most of them are sitting on land banks. And end of the day, data center requires land bank.
What about Angel One, Nuvama, BSE Limited? They got spooked yesterday. There was a violent correction in the stocks, but today they rebounded. Was the correction on account of STT overdone? What does your analysis say?
Yeah, I mean, because of STT, we saw that major reaction. But then, I mean, the sort of a tax on F&O, the increase in STT is more like the sin tax. I mean, do people stop smoking or, drink less liquor if the taxes are increased? I mean, that's the same thing with F&O. I mean, once you get used to it, whatever said and done, you'll come back. You'll still pay higher taxes. If you're not able to pay those higher taxes, you'll possibly go in for the unofficial market, which, I mean, I think all of us know that it exists. So they are not going to leave, trading. I think the finance minister thought of something else as an entry barrier. Maybe the NISM exams and refresher courses to continue to trade, than increasing, the STT, which is going to affect everyone. I mean, right up to the institutions. It's going to affect, every other large player.
Yeah, there's no distinction between gambling. I mean, you're using F&O for gambling or using it as a hedge or insuring your portfolio. So that distinction is not there.
Okay, all right. Amrish, very quickly, you want to tell us about the metal stock that you like?
Metals, I still like Tata Steel. I mean, I would like to stay away from those huge volatile stocks like Hindustan Zinc or Hindustan Copper at this point of time. I think that move is over. Tata Steel, I think, can still move to levels of about 250 to 260.
Okay, all right. Amrish, stay with us. We'll just wrap out things and come back to you. So it's a good-looking screen, and 265 odd points higher is what you have. 26,090. So it is counting down. In green across the board. Market breadth is still slightly negative, but it's a long list of volume-led gainers here. 2580, Nifty Bank 58,560, Sensex at about 81,620, and the mid-cap index up about 1.25% or so as well. So those are broad indices that we are looking at. Sectorally, capital markets, CPSE, and autos were the three areas where we saw action coming through. Wix, of course, cooling off after yesterday's spike that we had. Nigel has walked across to the big wall, wrapping up more single stocks and what really happened. Nigel, over to you.
Well, beautiful looking screen. Who would have thought the Nifty goes home with a gain of around 250 points? And just take a look at the Nifty Bank. That one as well, you know, from trading in the red, that's seen a big recovery. But the reason your portfolio is going to be feeling good is because both the mid-cap as well as small-cap indices, they did well. And the one that we're looking at the bottom of your screen, the advanced declined ratio, ending pretty much even, Stevens. I'll tell you what, at the start of the day, this advanced number was close to around 400 stocks. That's ending close to around 500 stocks. But plenty of movers from the markets, from the Nifty pack. You had Power Grid. That stock was booming away. Tata Motors, that stock as well was up close to around 4% in trade. And throw in there in Adani Ports as well as Tata Consumers. So there was no sectorial trend that played out. But from the Nifty pack itself, plenty of winners out there. However, there were some losers as well. And those losers actually have been outperformers. Shriram Finance comes up for you on the screen. Axis Bank is another one actually that should come. Let's get some losers as well up. I know it's more or less a green day, but we should get some of these losers up. And Max Health as well. That one did end in the red in trade. A few more losers from the broader markets. PB Fintech, you know, reacting to the news that Yash put out that they could be looking at some inorganic growth, probably a large size one as well. So that stock ended with a bit of a cut in trade. BDL, that's Bharat Dynamics, has tried to pull back, but that got sold into to, so that was lower in trade. And because crude oil prices did correct, you had ONGC as well as Oil India. Both of them were lower in trade, and they were lower in trade actually from the word go. Keynes, that's the other stock from the AMS pack that actually was underperforming today. Stock ended with a cut of around 4%. But let's go on with the list of winners then, and plenty of them today actually. You had Hindustan Zinc from trading in the red. That one goes home with solid gains. Silver recovered. Hindustan Zinc as well took a cue from there. So that's why Hindustan Zinc was up closer on 7%. Premier Energy as well as Wari Energies, both those two stocks, they've seen a sharp correction in the last few trading sessions. Today they said, let's be part of the party. Both of them up between 5 to around 6% in trade. UPL came out actually with a rather good set of numbers. So that stock was chugging along. In fact, it ended at the high point of the day. Keep in mind, this is one of the stocks actually that has underperformed over the last few years. But today it said it's time to participate. And BSE, one of the biggest casualties of yesterday, all that talk about STT, BSE says let's recover half of the losses that we saw yesterday. Stock, in fact, was up close to around 5%. Let's wrap it down then with some of those refiners. You had Chennai Petro as well as MRPL. Both those stocks did pretty well in trade. So net, it was a good trading session actually. Surprise, surprise, the Nifty goes home with solid gains in trade. And as I said earlier, this number actually was the biggest positive. The number of stocks advancing at around 1,400. Who would have thought your portfolios feeling good? Guys, not such a bad day.
Well, great day, and that screen is looking very good, Nigel.
It's all green.
You don't miss the down.
We could continue if you want.
Okay, we'll take a quick commercial break here. It's a wrap on closing bell from Nigel, Rima, me, everyone on the team. Thank you very much for staying with us. More comes up on the other side. Markets forward. Ambarish is with us. We'll pick up on that in just a bit.
Good.
and welcome to Markets Forward. This is the budget special. I'm Ritu Singh. Joining me today is my colleague Manglam Balu. And we have an exciting lineup of top market voices to analyze the budget verdict. But first up, let's dive right into the market action for the day after the budget. Manglam, what a volatile session. Started fully in the red. And a green screen is what we ended with. The sentiment seems to have turned.
The sentiment seems to have turned, particularly in the last hour of trade or so, because the first half was extremely volatile. We opened mildly in the green. Thereafter, there was a big gash towards that, 24,500 thereabouts, closer to yesterday's low. And thereafter, there was one move. The intraday chart of the Nifty actually tells you the story of the day, where we went up, we went down, we went up again, we went down again, and thereafter we ended higher and much higher than that 25,000 mark. There you have it. So that was basically the story of the day. Around that 11 o'clock mark is where we were closer to that 24,600 mark than we are to the 25,100 mark where we ended. We're still not out of the woods, not out of danger, still below the 200-day moving average on the frontline index. But the broader markets did well. We had more number of stocks advance towards the end of trade. And the Nifty Bank still is underperforming, just testing levels of below 58,000 and then closing above that 58,600 mark. But again, it's still 1/3% higher as against the frontline index, which is about 1% higher.
It is, and even specific names pulling up the Nifty, whether that was Reliance, L&T, ICICI Bank, HDFC Bank, all of them did their bit, to really turn things around in the last couple of hours of trade. But we also spoke with market veterans through the course of the day to understand the budget, its impact on the sentiments. Rhythm Desai, Samir Arora, S. Narain, and Neelkan Mishra weighed in on what worked and what did not. Take a look.
Now, the government has chosen to do the opposite. It has estimated its income rather conservatively. You can see this line by line. It's expecting a 10% growth in corporate tax revenue, which I think is super conservative. It's actually budgeting for pretty aggressive growth in expenditure. And therefore, I would say that it has erred on the side of caution. And the likelihood is, as the year progresses, it may find itself beating its estimates, which actually augurs well for all the markets, which is equity, bond, and currency. So that's the first comment. The second comment, which I made earlier today, today and in fact over the past few days, is that in my 35 years of doing markets, actually slightly more than that, I am sensing right now, and I'm relying this purely on memory, so take it with a pinch of salt. Is this the biggest disconnect I'm seeing between the macro and the market? So the macro actually looks pretty good. I mean, look at the auto data that came out yesterday. It would suggest that we are in a recovery in growth. If you look at macro stability, things are actually quite benign. And in contrast, if you look at markets, whether it's the equity market, the bond market, or the currency market, they seem to be suggesting that India has some big problem on its hand. So this disconnect, I think, is certainly something to ponder over. And markets don't go wrong that often, but this time around, I'm quite convinced that the markets have underestimated what India is up to. So I think that's the second comment. And coming back to the overall comment on the budget, I think the budget actually addressed quite a few strategic issues, whether it's with respect to AI, whether it's with respect to services, or the focus on defense. I think it nailed quite a few issues, and in fact, even simplification of taxation. So in my view, this was a very good budget. In both senses, in the sense that it doesn't overextend or overestimate things, and in the extent of the policy that it's delivering, which is a continuation of what we've seen over the past few months. Now to your question about FPIs. So clearly we are from the capital market, so we get very narrowly focused on what is the government doing about markets. And the last thing we want is them to do something that spooks the market. So unfortunately, the STT increase has spooked the market. And this is a little harder for people to understand, those who are not in the market. I mean, why would a 15,000 crore increase in a tax cause such big damage to market capitalization? And the reason is very simple. For those who are not in the market, is that the markets function on sentiment first, and then fundamentals. And the sentiment was already weak. going into the budget. In fact, if you look at India's relative performance in the 30 days in the run-up to the budget, this was the worst ever that India had. And it was going to be so hard to disappoint the market, but the budget managed to do so despite it being such an excellent budget with a little small change. So, that's the nature of markets. Markets will go through this and may probably, when fundamentals assert themselves more strongly, this will be forgotten and over. But on your comment with respect to FPIs, I mean, it's something that I've been talking about for a while now. And actually, it came through in the budget. So our suggestion was that the definition of FPIs should be liberalized, and that has happened. So persons residing outside India, PROIs, are now in a position to buy a lot more stock in India than they could do before. Now, the next thing, which I think was a very important line in the finance minister's speech, and I'm not sure whether that's got enough airtime, was with respect to the modification to FEMA on non-debt instruments. So you can say non-debt is not very different from equities. And I would be eagerly waiting for the RBI's announcement on this, because it's okay to allow foreign investors to buy. The process has still been onerous for them. And if FEMA delivers a simplified process, then I think we've opened up the Indian markets to a completely different capital pool, relative to history. Historically, this market has attracted largely emerging market pools and to some extent global pool, but not HNI and not other pools of capital, which is what this budget has done. So yeah, it's a material change, but it has to be seen together with the proposed modification to FEMA, which I think we'll learn in the course of the next few days.
But today, at least, markets seem to be settled. So day one after the budget, we aren't seeing that overhang of STT play out in the markets. Rhythm, afternoon, and thanks so much for joining in. Rima here. So data center sector has emerged as the big winner of this budget with tax holidays till 2047. Share your views on what has transpired, what's happened in the budget, and actionable investable ideas basis this.
I think India is probably one of the most attractive places on the planet now to set up data centers. This tax holiday has really sweetened it. So we've already seen tens of billions of dollars being announced, and I won't be surprised if these amounts go up materially in the next few months. The budget looks at the supply side issues quite intently, and we're talking about semiconductors, we're talking about rare earth. So all of these things go into the whole AI trade. It's certainly taken care of the energy side. There's a lot of incentives that have been rolled out, and I'm very bullish on the energy sector. So, and of course, skills. Do not underestimate the importance of the safe harbor for IT services.
The challenge that I see, I mean, I think the STT issue is more for controlling speculation, as the finance minister also mentioned in the press conference. But the challenge, I think, is on the financing side. So you've seen that the 10-year bond yields have now gone up to 6.76. And clearly the financing plan for the deficit and the fact that the government's overall conservative approach to forecasts, so taking a 10% nominal GDP growth, taking tax to GDP only marginally higher, I think they can do better on taxes. Perhaps on the financing side, they've gone excessively conservative. And that's something that is having the opposite effect of what the fiscal discipline and sticking to the fiscal consolidation path should have achieved. So there's clearly some work to be done there. I think 10-year yields should be, I think, closer to 6 and not 6.76 is my view, because the liquidity conditions are such that banks are having to borrow 12-month money at 7%. Yields have been going up, and now with the gross borrowing coming up higher than what markets had expected, has again started to push up. So that's something that I would say is perhaps the only niggle. Maybe you could have also expected a better plan for privatization and disinvestment. But again, I mean, some of those things can happen during the course of the year.
Neelkan, are you saying the government has been very conservative with the revenue collection targets, and that is actually not That's not the right way to look at it. So you're telling markets don't be worried because they've been too conservative and they'll collect more. Is that what you're saying?
Part of it is that, but I think the bigger issue has been on the financing of the deficit. So, for example, if you take small saving schemes, and I know we are getting a bit nerdy here.
No, because Naren just mentioned, Naren just talked about exactly that, the small saving schemes. I mean, it's been very healthy, but what they've accounted for is very conservative. Yeah, go on, sorry, Neelkan.
Yeah, exactly. So, sorry, I only caught the last bit of Naren's talk. So the first 9 months, there is a 32% increase in collections. But the full year number for FY26 is down 13%. So I think 4.2 lakh crores in FY25 falling to 3.73 or something like that in FY26. Whereas in the first 9 months, you've seen a 32% increase. Now, a large part of the small savings inflow actually happened in the month of March. So perhaps they know more than what we do, though it seems unlikely given that there's been no dramatic change in the policy of or the rates on small saving schemes. And on that low base, they're expecting a 4% increase next year. Now, this is very good and conservative because, frankly, predicting some of these things is hard. But this means that you are expecting, 1 lakh crore, 1.2 lakh crores less on small saving schemes, and potentially even 1.5 lakh crores less than the small saving schemes than what you're likely to get. And this is possibly why your cash balances, meaning government cash balances, which can go out of the banking system.
But you expect the yields to inch lower. It will be addressed from the current 6.76. You said ideally it should be 6%. And if it stays around the 6.5%, 6.6%, what are the broader implications? Will it hurt the growth? Will it impact the kind of earnings expectation the market has, investors have from the market?
Absolutely. So, see, look, the fact that the core inflation measures, ex gold and silver, plus, say if you take median inflation, those measures are at record lows. There is clearly evidence that there is significant slack in the economy. Now, the economic survey talks about 7% growth being the trend growth, which I think is the right measure, that we have been at that level for a while. And if you assume 7% growth and assume that the starting point is say FY18 or 19, we are 10% below where we would have been if COVID had not happened. And so therefore there's significant slack in the labor market, in the economy. Now there's significant output gap. There are only two ways to close an output gap. One is fiscal, the other is monetary. Now on the fiscal side, I think prudently the government is sticking to its roadmap, which means that interest rates and cost of borrowing should come down. So it will take much longer if we are not able to cause this transmission.
Well, S. Naren is Executive Director and CIO, ICICI Prudential AMC. He's one of the largest money managers in the country. Naren, good morning. Great to have you with us here. And I should say congratulations first up on that. I mean, I think investors are going to be happy. You're going to be around at the helm of things. So it was good to see that. Naren, what's your sense? The budget reaction, and what will the market do from here? Lots of opinion that we've gotten, pragmatic, etc. But this STT thing maybe is just kind of, for now at least, overshadowed everything.
I was involved in stockbroking from 94 to 2004. Somehow I've not seen retail investors make money in derivatives. But the way markets have reacted since yesterday is as though the retail investors have made a lot of money in the last 25 years in derivatives, which has never been the case. In fact, the regulator prepared a long document showing how much money was lost in derivative segment. But the market reaction since yesterday is only to do with STT, because everything else in the budget was fantastic. Because if you look at the fiscal deficit, it is in order. Overall macro is in order. And government is thinking, how can, one of the biggest challenges for India is it was not seen as a country which is connected to AI. So they did come up with this data center tax concession to propel investments in data centers. We've always been supportive to any tech trend in IT services, in cloud services. Everywhere we've been a supporter. So I think in AI also we have to be a supporter and create an AI services boom. So I think that step was a step in the right direction. But the market is looking at an area where only retail has lost in the last 25, 30 years. And if you increase taxes there and reduce volumes there, it's beneficial for retail. They have not touched STT on cash equities. So that is the challenge at this point of time. How to convince the market that actually this is a positive step for most retail investors, bad step for HFT traders and those kind of people. So how to convince that is one of the challenges, I guess, for the government.
It's one of the reasons that FIs have given a pass to India despite the expected earnings recovery is that even though in India, say FY27, we get about a 13% kind of earnings growth, you're still getting a 15 to 20% earnings growth expected, say, in emerging markets or even in the broader US markets. So those markets are still attractive. Now that even the budget has not given any concessions to FIs, what is the expected FI behavior to your mind this year?
So why did they invest in earlier years like 2024? So what happens is, we've seen in those years, they were not willing to invest in Brazil and China, which was very cheap at that point of time. And they were overweight India at that point of time. Our view is that, recent past performance does play a role in deciding where money goes. And if you look at India from a one-decade view, I think India represents one of the best structural stories. The challenge for us is particularly people who have been fund managers for long, as the markets have not been cheap. If by chance the markets have been cheap, we would want to give a thumping the table buy on equity because everything else is in favor except valuations. And that is the challenge we've been facing. And that's why it's boring for us to tell every time, do asset allocation. But that's what we have been forced to do only on account of valuations. But today, valuations across the world is not cheap. And that is why I do agree in the very near term, maybe there are AI stocks which will deliver very good earnings growth. But neither are other markets cheap at this point of time. So I would say that to be maximum underweight today in India at this point of time means that at some point of time in the future, they will have to think of buying. So that is a positive in my opinion.
The big risk for market is this AI thing bursting whenever it happens, right? Any thought, any updated view on that? Will we see a shakeout at some point? Are we there yet?
Yeah, clearly. When you compared AI and precious metals, I thought precious metals had become much more euphoric than AI. If you look at AI, at least many of the stocks had stopped going up in a parabolic move. So, between AI and precious metals, we had to, we always look for the most dangerous areas. So the most dangerous areas in the last 1 month turned out to be precious metal. It is not that AI is cheap. I think AI has still got to go through a correction, but AI is not at this point of time in bubble. It may be extreme valuation, but at least it is not a bubble. And I would say that there is a good room for a meaningful correction in global equity markets. But how much knowledge do I have when I make this statement is something I ask myself. But if I just do simple calculations like market cap to GDP, I think there is scope for a meaningful correction, but we are not experts. And therefore, we believe that if the global equity markets correct, our view is yes. And if they do, I think India should outperform at that point of time. But there is a risk of a global equity market correction in the next 2 years. When it will happen, again, we don't know. It will be nice to know if we could correctly time it, but we wouldn't know.
Samir Arora is with us, founder and fund manager at Helios Capital. Samir joined us yesterday morning as soon as the finance minister budget speech ended. Samir and I sort of posted that later last night, and really lots of comments, mostly thanking you to kind of sort of that you expressed what a lot of people are feeling. So any changes in the mood, thought process?
So let me
explain
for everybody's benefit.
Yeah.
So the point is, I think that the market participants and even the government feel that the market is just dependent on other sectors. So, when the, say, Mahindra and Mahindra CEO will come, he will talk about how the budget has helped the auto sector. But if in that budget, the help had gone to quick commerce sector, then the Mahindra and Mahindra CEO will say it's an okay budget, bad budget, whatever. The point is that we should look, and the government should look, and the system should look at the market as an independent sector also. In addition to saying because it helps data centers, it will help the market. Because the market has many other factors, for example, taxes, FII taxes, liquidity, and relative this market versus that market. And so when the market is bad, like say today the textile sector is bad because of US tariffs, then the government says we are going to help the these textile companies with whatever, either cheaper loans, this, that. Currently, in the last 1 year, the Indian market has done very badly. And look at it in dollar terms or more, look at it in euro terms, Swiss terms, because maybe X percent, 20, 30, whatever percent of the people might be coming from Europe and Switzerland, and they would have lost more than 20% on currency alone. So in that context, it should be at least accepted, recognized, maybe 5 lines should be said that, we are keeping a watch on this, and if it goes beyond a point, we will do. In that context, to put a charge, even if it is to squeeze liquidity of by the way, if you see me on Twitter, hundreds of times I have said that STT should be increased on futures and options, but always accompanied by a corresponding lowering of either capital gains tax or lowering of STT for cash or doing something. So that's why this one is that we are not accepting the fact that if you get, say, $5 billion through some FDI with doing hundreds of things, you can get it in 1 hour with the FPI guy if you understand the power of the market. The FPI guys or FII guys can put 5 billion in a month or in a week, and all they need is a little bit of recognition of their role and the fact that this money is easier to get. It funds Indian promoters. All it needs is fairness and a little bit of recognition of the role of stock market per se itself.
We played out the revenue secretary soundbite, right? And Shireen spoke with him.
Yeah.
That you just played it before we came to you. What he said is this is not to raise revenue. This is to.
I saw it.
Yeah,
I saw it.
This is to.
But the fact that now you got 15,000 crores, so please give it to the other side.
I am asking you whether this is actually even. Because it seems like it's kind of, they're taking a stance. So it's ideological in that sense, that we want to curb speculation.
I don't myself, know. By the way, I myself used to say it, that it is too much. I agree.
Okay.
But you see, you need it in a certain environment.
Yeah.
You can't have it in an environment where India is massively underperforming, and primarily because the stock market is doing badly relatively and all that, and FPIs are leading. You need a certain time for that. And also, this gives the impression that the market itself is not of importance. And I am saying that the market should be seen as a separate this thing, and I am the self-appointed representative of the market or of FPIs. But I'm saying the market can solve so many problems. The market is like an ad. It's an ad of the country. If the world sees that the market is down and the currency is down, without looking, they think that the budget is bad, which is what I keep recommending this book, The Halo Effect. The price also determines many things. And then, therefore, you will postpone things saying, no, that means nothing has changed. Everything changes. And why should we be? And it's some of it you may say, we are overvalued and all, which I don't believe too much. Some of it is because we have extra taxes, extra STT, etc., which in bad time comes out. In good times, nobody cares because it absorbs, the fact that the performance.
You don't mind paying a little bit more. Yeah, you don't
No
mind paying.
but you say it doesn't matter because overall. So what I'm saying is, it is for these times, and even now you don't have to do it. But please say it that, we are watching this closely and we are going to track it and, we are not letting it. Everything helps. But at that time to do an STT is like saying we don't care. And that is the negative part. Not so much that whether what is happening in EMS companies or what is happening in defense, obviously. And by the way, we still own all those. By the way, even yesterday, of course, before the budget started, we bought a lot for our FPI account. Some of these which actually did okay. But anyway, so the point is, nobody's walking away. So this idea, if you don't like it, go to another country. If you don't like it, how come the market went up in 24? That's not the point.
Hello and welcome to CNBC TV 18. I'm Archana Solanki and here are the headlines we're tracking this evening. The Wall Street recovers after the budget sell-off. Sensex and Nifty gain over 1% in late trade. Nifty ends above 25,000. Broader markets underperform. The Indian rupee strengthens 48 paise to 91.51 against the US dollar, posts its biggest intraday gain in 6 weeks. Sustained dollar selling by state-owned banks helped ease volatility and stabilize market sentiment. Global markets slide after the crash in gold and silver prices. Fears of an AI bubble also rattle investors. Asian markets see steep cuts. South Korea halts trade temporarily after a 5% fall. Bitcoin below $80,000 adds to the pain. European markets stage a recovery. Commerce Minister Piyush Goyal says there is good synergy about a trade deal with the United States, adds he is in regular touch with US Trade Representative Jameson Greer. Petroleum Minister Hardeep Puri confirms India will be buying oil from Venezuela. External Affairs Minister Jaishankar heads to Washington to attend a critical minerals convention. Southern states will get a higher share of tax revenues under the 16th Finance Commission devolution formula. Karnataka will be the biggest beneficiary. States in the Hindi belt will see a minor drop in their share of tax revenues. India's car makers hit the accelerator in January. Sales momentum holds post GST cuts, double-digit growth across the board. Maruti Suzuki posts record volumes. Tata Motors and M&M shine. Steady demand across EVs, SUVs and exports. All right, let's start with the day's market action. The Wall Street recovered after the budget sell-off. Nifty and Sensex gained over 1% to end at the day's high. Nifty closed above the 25,000 mark, led higher by Reliance. Broader markets underperformed the blue chips. Apart from the IT, all sectoral indices ended in the green. Let's talk about the Indian rupee that gained 48 paisa against the US dollar, posting its biggest intraday gain in 6 weeks. The RBI is reported to have supplied dollars in early trade, but dollar demand from funds was weak as per dealers. Lata Venkatesh is here with more. Lata, what sparked the rupee rally?
Well, first up, the way in which the rupee rallied itself was a bit reassuring, 0.5% on a day when actually the dollar was stronger. So that the amount of the recovery, 0.5% from 91.98 to 91.47 thereabouts, is a very, very big rally. The reasons, early morning, the expectation was that the rupee will do badly because stock markets had reacted negatively to the budget on Sunday. But, and therefore, in the NDF market, the offshore market opens before our market, onshore market opens. In the offshore market, the non-deliverable forwards, the Reserve Bank intervened heavily to ensure that when the rupee opens here, it doesn't open very badly, which is what happened. It opened gap up. But thereafter, what dealers tell us is that RBI didn't have to supply much dollars and do the heavy lifting. There was anyway not much demand from foreign funds asking for dollars. You know, they usually sell equities, buy dollars and repatriate it. That demand was very weak today. And the guess is that even in New York, you found the dollar, on Friday rising versus most commodities. Commodities were a bad word on Friday, as we know, most all precious commodities and even copper and aluminum and zinc all fell. The rupee was being shorted against commodities and commodity currencies. Because they were falling, the rupee actually got a relief, and that continued in the onshore market on Monday. The negativity surrounding the budget also clearly ebbed in the stock markets and seems to have ebbed in the rupee market too. And now most dealers were telling me that probably 92 rupees to the dollar is not going to be crossed anytime soon. They felt that reassured about the rupee. Just one word on the bond market, that market crashed. The very high borrowing number, higher than what the market expected. Market was prepared for about 16.5 lakh crore. The borrowing number announced in the budget was 17.2 lakh crore. And so nobody wanted to touch bonds. You saw a big sell-off and yields rose.
Right. Thank you, Lata ma'am, for that update. Shifting focus now, global stock markets recorded a broad sell-off on the back of concerns over artificial intelligence and volatility in precious metal prices. Asian stock markets stumbled, led by a sharp decline in South Korea's benchmark at 1 point. Kospi fell more than 5%, triggering a temporary halt in trading. European stocks also kicked off the week in negative territory. Gold and silver recovered some of their losses after a historic plunge on Friday amid a stronger dollar and profit-taking. Bitcoin hovered around the $77,000 mark after slipping below $80,000 for the first time since April 2025. On the Wall Street, investor focus has shifted to Nvidia as fears grow over AI funding and valuations. A report suggested the chipmaker may have stalled a proposed $100 billion investment in OpenAI. However, Nvidia CEO Jensen Huang dismissed the concerns, saying the company still plans to make a significant investment. On to a CNBC TV 18 exclusive now. Private equity firm Advent International may pump in $300 million into Aditya Birla Housing Finance. Rachna Dhanrajani joins us now with more. Rachna, what are your sources telling you?
That's right. We've gathered from our sources that private equity firm Advent International is set to infuse around $300 million into Aditya Birla Housing Finance in exchange for a minority stake. Now, sources say that this will be a primary capital infusion aimed at strengthening the lender's balance sheet, improving capital adequacy, and supporting the next phase of loan book growth. Aditya Birla Housing Finance is a wholly owned subsidiary of Aditya Birla Capital, which has been scaling up its retail and secured lending businesses as housing demand remains steady across urban and semi-urban markets. Now, speaking of this deal, we understand that the Advent investment comes against the backdrop of multiple capital raises at the housing finance arm. In January 2025, which is exactly a year ago, the company raised about 830 crore rupees from the International Finance Corporation through non-convertible debentures, largely to expand affordable housing lending and priority segments. Separately, Aditya Birla Capital, the parent company, also infused about 249 crore rupees into the subsidiary to fund growth and improve leverage ratios. And now sources say that this equity capital from Advent International would provide Aditya Birla Housing Finance with balance sheet flexibility, allowing it to grow without overstretching leverage at a time when funding costs remain elevated and asset quality vigilance is high. Both Advent International and Aditya Birla Capital have not responded to our queries that were sent via email, but we will keep an eye out for this.
All right. Thank you, Rachna, for that update. From one deal story to another, PB Fintech is all set to raise funds for an acquisition. Yash Jain is here with more. Yash, what's brewing?
Well, that's an important update that we're expecting as far as PB Fintech is concerned. A very interesting acquisition plan brewing. At PB Fintech, what we've been given to understand is that the company is likely to raise a sizable amount of funds via a QIP issue. As far as the fundraising itself is concerned, the company is expected to use that towards a large acquisition. And according to our sources, that acquisition is expected to be in the space of insurance aggregation and insurance sale itself, just what PB Fintech currently does in the country. This acquisition, according to our sources, is expected to be in the overseas market. But important to note that the company already has strong amount of cash lying on its books. Despite that, if a fundraising is being planned, then one would assume that the size of the acquisition will be quite large, and that is what reflected on the stock price today itself. We've written to PB Fintech on this particular development, but we are yet to receive a response from the company.
All right. Thank you, Yash, for that update. The union budget continues to be our top focus. We have, over the course of the last 24 hours, decoded the key announcements with the budget architects, economists, and industry. We've also had the time to glean more minutely through the documents. Here are the top 5 highlights. The government has significantly revised its FY26 capex budget, while last year's budget allocated 15.4 lakh crore towards capital expenditure. It has been brought down by close to 9% as per revised estimates. The much-touted PM internship scheme failed to take off. 95% of the budget allocated for the scheme was unspent. Similarly, close to 40% of the money allocated towards rural housing and roads were not spent by the government. 75% of the money allocated towards rural drinking water mission was unused as per budget documents. That's not all. The government allocated over 95,000 crores to the newly legislated VBG Ramji scheme, which replaced Manrega, the flagship rural employment guarantee scheme. However, 30,000 crore rupees has been budgeted for Manrega in the FY27 budget. Expenditure Secretary has called the allocation a committed liability. Rules on the sovereign gold bonds have also been tightened. The exemption from capital gains tax on such bonds will only be available where they were purchased by the individual at the time of original issue from RBI and were continuously held until redemption on maturity. Manisha Gupta joins us now to explain what the announcement on sovereign gold bond means.
Well, yes, the budget 2026 did bring a change around for the sovereign gold bond holders. The budget document says that there is an exemption from capital gains taxes if the sovereign gold bond is subscribed at the time of original issue and is held till maturity for redemption. Now, the original issue has to be bought from RBI designated banks, post offices, even RBI Retail Direct for that matter, Stock Holding Corporation of India, and you could have bought it from brokerages and apps as well. But this is at the time of when the tranches are available as an original issue. Now, if the sovereign gold bond has been bought in the secondary market, then the gains that you have made out of that is going to be treated to the capital gains. The long-term capital gains stand at around 12.5%, and in addition to that, there are applicable surcharges and cess as well, which you will have to pay. Now, what does secondary market mean? This means that SGBs that have been bought or sold in the secondary market, such as BSE, NSE, and via brokerages as well, but in the secondary market, where you have bought it on the exchanges and not during the tranche. If you have bought it during the tranche and you're holding it till maturity, you're not redeeming it beforehand, then you do not have to pay the taxes. But every dealing that has been done in the secondary market is now liable for taxes.
All right. Thank you, Manisha, for that update. The Expenditure Secretary has clarified that 95,000 crore rupees that was allocated for the Viksit Bharat Guarantee for Rozgar Ajivika Mission scheme has been provided as mandated by the law. Speaking with Shireen Bhan, the Secretary added the earlier Mahatma Gandhi Rural Employment Guarantee scheme was plagued with inefficiency and is winding down now.
We have provided exactly the amount which was estimated when the bill was being drafted. The Parliament was considering the bill and the act has come into force. 95,000 crores, exact full amount has been provided. And the ongoing or the earlier scheme, which also had some committed liabilities.
So
there were some
30,000 crores is on
for
account
that
of the
purpose.
existing
Otherwise, that one is really a winding down stage, and it was just the inefficiencies in the fund flow and the implementation, and we expect it to be winded down now.
All right, and you can catch the exclusive interview with the Finance Minister Nirmala Sitharaman at 8 p.m. right here on CNBC TV 18. This will be Finance Minister's first interview after the budget. Right, welcome back. Let's revisit the day's market action. The last street recovered after the budget sell-off. Nifty and Sensex gained over 1% to end at the day's high. Prashant Nair joins us now with the day's market action. Prashant.
Well, if you'd asked people and conducted a straw poll whether the market is going to end in the green tomorrow, and you'd polled, say, 50 market participants, I think all 50 would have said no, unlikely. And actually, that did actually happen. Well, the market is usually follows the most unusual path, and I think that is what we saw today. So mix of, the T+1, the budget, and the next day usually sometimes are different. The shock of the STT, I mean, not that suddenly markets are finding it palatable, but the point is that they're looking and willing, at least for now, to look beyond it. What also, of course, it was a different kind of session in the first half and second half. In the first half, there was also another very, very sharp correction in commodity prices once again. In the second half, the commodity prices also started to reverse a little bit. Extremely oversold names. If you just look at what did well in the Nifty, it was heavyweights basically through and through. Reliance, of course, pulling its weight with a 2.5% rally, and the single largest contributor to what you saw on the index. On the way down, of course, it's been a big drag as well. I'll just look at sectorally things. Capital market came back 3% or so. CPSE index was up about 2.5%. And you also had the auto index, which was up about 2.25% or so. Wix cooled off. I mean, usually volatility cools off on the day of the budget. Today, we had to wait one more day. But I don't think one can really blame what really took place. I'll just run through stocks before I go any further. Power Grid was up about 8%. The top gainer, Tata Motors Passenger Vehicle, Adani Ports with 5 and 4% respectively. On the downside, Shriram Finance, Axis Bank and Max Health were the top losers. More down than up, but very little separating gainers and losers. The entire silver and gold ETF pack, financial instruments, all sold off very, very hard. And actually, that is what dominated more than anything else. On the upside, if you look at the broader market, metal stocks, right? Hindustan Zinc was up 8%. Capital market, I spoke about the index. BSE was up 5%. Power Grid raised its guidance about 8% higher. Latent View was up 11%. Sharda Cropchem was a big mover. HPCL, oil prices saw a sharp drop, 5% higher. There was MRPL, which was up 10%. Vari, UPL reported numbers, ended about 6% higher. And of course, there were two CNBC TV 18 exclusive stories as well. There's AB Capital, where the subsidiary is raising money, and PB Fintech, which we reported that it is going to go in for a fundraise. So, eventful day after the budget on Sunday. Back to you.
Right, thank you, Prashant, for that. Shifting focus now, the increase in taxes on futures and options trade in the budget caught markets off guard. Union Revenue Secretary Arvind Srivastava said the hike in securities transaction tax was motivated by an intent to curb excessive speculation in the F&O segment. However, market players wish the mop-up was used to offer tax relief to long-term investors.
If you look at the volume of the F&O, if you compare it to the underlying securities market volume itself, or the size of the GDP for that matter, it is too large for it to be considered desirable. It looks to be fairly speculative, which is not a good way to take it forward. So in some way, this increase is essentially meant to address that kind of, possible risks that may be involved in this highly speculative side of the market. With no impact in the volume, if the volume remains the same, put together, it may fetch us around 15,000 crores or so.
Unfortunately, the STT increase has spooked the market. And this is a little harder for people to understand, those who are not in the market. I mean, why would a 15,000 crore increase in a tax cause such big damage to market capitalization? And the reason is very simple. For those who are not in the market, is that the markets function on sentiment first and then fundamentals.
STT should be increased on futures and options, but always accompanied by a corresponding lowering of either capital gains tax or lowering of STT for cash or doing something. I would think that because they were selling in that context at that time, we should not be doing things which are negative, because this means they will not change currently.
the way markets have reacted since yesterday is as though the retail investors have made a lot of money in the last 25 years in derivatives, which has never been the case. In fact, the regulator prepared a long document showing how much money was lost in derivative segment. But the market reaction since yesterday is only to do with STT, because everything else in the budget was fantastic.
Now, Commerce Minister Piyush Goyal has said that he is in regular touch with US Trade Representative Jamieson Greer on the trade talks. Speaking with Parikshit Luthra, Goyal added that there is good synergy about trade deal and reiterated that India does not do trade deals on deadlines.
Just a word on what Jamieson Greer had to say. Just last year, he had said that India has given the best possible deal ever. Now, in his latest remarks, he said that India needs to do more when it comes to
I can assure you
Russian
we are
oil
in
purchases.
regular touch. My good friend Jameson and I, we've known each other since Trump won. And I have absolutely no doubt that between him and me, or between both our teams, the synergy is very good, the understanding is very positive, and we'll be able to finalize very quickly.
So would it be a matter of a few weeks or months?
That we will have to wait and see. You know, we never do any trade deal with deadlines. You know.
Oil Minister Hardeep Singh Puri clarified that India has been buying crude oil from Venezuela for a while. Speaking with Abhimanyu Sharma, Puri added that India imports crude oil from 40 countries, reiterating that India is not relying only on one country to import oil. This statement comes after President Trump said that India will begin importing crude oil from Venezuela now.
We've been buying from Venezuela for a long time. In fact, I have people from ONGC stationed there. We know that Venezuela has massive reserves, but because of underinvestment, they're only producing 1 million barrels a day. Much of it was being bought with one source. So I think when that statement is made, said India will be now buying oil from there. We were buying earlier. I mean, one private sector person was buying, and my state sector OMCs were also buying. So that's good news. But we are buying from all over the place, the Western Hemisphere.
And with that, it's a wrap on this special news broadcast. News and updates continue right here on CNBC TV 18.
You've heard the budget. Now, understand its impact. Hear it directly from the architect of the budget. Finance Minister Nirmala Sitharaman's first interview post-budget with Editor-in-Chief Rahul Joshi. News 18 Network exclusive. Tonight at 8, the FM interview across the News 18 Network.
Good evening, ladies and gentlemen, and a very warm welcome to CNBC TV 18 Budget Verdict 2026, brought to you by IDFC First Bank. The Union Budget presented yesterday lays out the government's roadmap for the year ahead, with a focus on sustaining growth, managing fiscal balances, strengthening exports, funding India's ambitions, and enhancing India's global competitiveness. But as always, the real story lies beyond the announcements, in how these proposals translate into action, impact businesses, influence markets, and shape India's economic journey. That's exactly what we aim to do this evening: move beyond the fine print, cut through the noise, and decode what Budget 2026 truly means for India's economy, markets, businesses, and citizens. Before we begin, a sincere thanks to our presenting partner, IDFC First Bank, our associate partners, Dhruva Advisors, Aspiro, and Funds India, and our hospitality partner, the Leela Palace, New Delhi, for supporting this important and timely conversation. Without further ado, let's have a look at the key budget highlights. Can we have the AV, please?
Navigating global headwinds, India's Reform Express is surging ahead with bold infrastructure and manufacturing bets. In her 9th consecutive budget speech, Finance Minister Nirmala Sitharaman targeted fiscal deficit at 4.3%, while ramping capital expenditure to 12.2 lakh crore rupees.
Our government has undertaken comprehensive reforms towards creating employment, boosting productivity, and accelerating growth. The Reform Express is well on its way and will maintain its momentum to help us fulfill our kartavya.
From Mumbai, Pune to Hyderabad, Bengaluru, the FM signaled a connectivity revolution through 7 rail corridors. She also announced rare earth corridors and chemical parks to boost India's strategic minerals and chemical self-reliance. Anchoring the strategy are 6 priority engines: scaling manufacturing, rejuvenating legacy industrial sectors, creating champion MSMEs with fresh incentives, a massive infrastructure push, long-term energy security and stability, and city economic regions. Sectoral measures targeted higher farmer incomes via high-value crops, 5 regional medical hubs with 1.5 lakh caregivers trained to boost medical tourism, and custom duty cuts on 17 medicines. The budget also included announcements to bolster India's IT services sector, offering incentives and policy support aimed at attracting fresh global investment.
I propose to provide tax holiday till 2047 to any foreign company that provides cloud services to customers globally by using data center services from India.
The Union Budget charts a bold path for Viksit Bharat, unlocking Yuva Shakti and strategic self-reliance to drive investment, exports, and inclusive growth.
भारत के 140 करोड़ नागरिक फास्टेस्ट ग्रोइंग इकोनॉमी बनकर ही संतुष्ट नहीं है। हम जल्द से जल्द दुनिया की तीसरी सबसे बड़ी अर्थव्यवस्था बनना चाहते हैं। ये बजट 2047 के विकसित भारत की हमारी ऊंची उड़ान का मजबूत आधार है।
Well, that were the highlights of the Budget 2026, and we will get to that discussion very soon. But to formally open this evening and share his perspective on the budget and the broader economic landscape, it gives me great pleasure to invite Mr. V. Vaidyanathan, Managing Director and CEO, IDFC Bank, for the opening note.
Okay, good evening, ladies and gentlemen, good evening, friends.
First of all, wonderful event put together by all of you, and this video said it all. I think it's a brilliant video, put it all together. So I'll keep it very quick for the interest of time. The key thing which is really stands out about India and about the budget for 11 straight years, a continued focus on infrastructure is really a big deal. And this year, like 12.2 lakh crores, 2.9 lakh crores on roads and infrastructure, following on 2.5 lakh crores last year, 2.9 lakh crores on railways, 7 high-speed rail freight corridors, investment in ports, airports, infrastructure. This is quite sensational. I was doing a back-of-envelope calculation before coming here that, frankly, for this 11 lakh crores, you could have chosen to give, say, 2,000 rupees to every adult woman in India for 12 months at a stretch, and then you could have spent off 11 lakh crores, and then you could have made maybe 500 million people happy temporarily. But frankly, that wouldn't have bring down the cost of goods. That won't make India more competitive. And in this architecture of putting roads, highway, you bring down cost of goods. Bring down cost of goods, products become competitive, inflation comes down, coupled with GST, you actually make, and process reforms make things faster, less fuel consumption on the roads, more green, and make products more competitive we can export to the world. And that makes India fundamentally more competitive, a larger economy, more tax collection, and finally improve a lot of the people in a more sustainable way than freebies. And to stay away from freebies for 11 years in a row, I think is really, really something. And of course, there are many other things about services, infrastructure, tourism, health, SMEs, and many other things, and data center and all that stuff. In fact, I really believe that the consistency is the key, and for staying on the path of reform, infrastructure, and making India fundamentally more competitive is the core of the budget making for the last 7 years, for which we must really thank the government, the policy makers, many of whom are with us today, the finance minister, the prime minister, and putting this marker of Viksit Bharat for 2047 actually energizes and makes people to work towards a goal in a way which is consistent and in a way that is more sure than making people temporarily happy and then losing the plot. So thanks very much. And today we really look forward to hearing many of the secretaries. And we really, really want to hear your insights. I must read out to you 3 or 4, 5 or 6 headlines I read from the newspapers this morning that says it all. And I think, it says, one here says stability trumps spectacle. It does. The next one says FM Sitaraman takes a shot at the future. The third one says keep calm and carry on. The fourth one says a long game budget. And this is the best one of all. It says, Mr. Modi in this avatar of probably Tom Cruise, I think, because it says Mission 2047. And, if you've seen Mission Impossible, you know that this is not impossible. This will probably happen with a kind of consistent approach. So thank you very much, ladies and gentlemen. It's our pleasure at IDFC First Bank to be part of this. And once again, thanks.
Thank you so much, Mr. Vaidyanathan, for that insightful opening to the important dialogue. Moving on to our first session for today, and we begin with exports, a key engine in India's growth, especially at a time when global trade is being reshaped by geopolitical shifts, supply chain realignments, and slowing demand in key markets. Budget 2026 has reiterated the government's intent to strengthen India's export competitiveness and deepen integration with global value chains. And to share how the government plans to accelerate India's export story, I am pleased to invite Rajesh Agarwal, Secretary, Ministry of Commerce and Industry. Ladies and gentlemen, a huge round of applause for him. And I would also like to invite and welcome on stage Parikshit Luthra and Shireen Bhan to drive the conversation.
Well, good evening, ladies and gentlemen. It's wonderful to be back here on the CNBC TV 18 Budget Verdict platform. And many thanks to the Commerce Secretary, Mr. Rajesh Agarwal, for a very fitting start to Budget Verdict 2026. So if I can start by asking you, the context that the Finance Minister laid out the budget, she did highlight the fact that India is faced with a very difficult geopolitical climate. We're also faced with geo-economic confrontation, geo-economic fragmentation, which makes the mix even more complex. And within that context, the government has decided to focus on enhancing competitiveness and thereby enhancing India's export competitiveness specifically. I want to understand from you the groundwork that the budget has laid out for 2026 and beyond. What now is the immediate export aspiration that can be achievable?
Thank you, Shireen. I hope I am audible clearly.
Loud and clear, sir.
Very well, sir.
To
Thank
President Trump as well.
Yeah, thank you. So, Shireen, you see, for trade, I know it is this is a year of global turmoil, 2025. But still, if you see India has been one economy which has withstood and showed resilience. Our economic growth has been in the vicinity of 7%, and the projections are also that will be around 7% or so. Our exports have held good. Our exports have rather grown in this financial year for the first 9 months, and we are hopeful that we'll grow in the last quarter also and keep the trajectory northwards. And as Department of Commerce, as government, we have been creating a much wider ground, a much more fertile ground to see that we can take our export trajectory more northwards, can make a sustained growth in our exports as years come by. And in that quest, if you look at in last 1 year, we have concluded 4 free trade agreements with 30 countries, which might together, earlier we had 14 trade agreements with 26 countries. Now we have 4 trade agreements with 30 countries. And once these are operationalized, we are talking of 56 economies with which we'll have preferential market access, which constitutes around 55 to 60% of the global trade. So that's the kind of canvas we are opening for our industry to actually take advantage of and grow our export market and see that our exports are diversified and they can keep on growing. The budget completely goes on to provide the right structural and the systemic stability to it. If you look at budget, touches the right areas which can actually drive exports in the long run. It touches on manufacturing.
Yeah.
A good competitive manufacturing is a sine qua non for growing exports. It touches services in a big way. India is a services giant, and it keeps a target of 10% services by 2047. So if that is where we are going to move on, and India has been driving, we are 4.4% of the services export globally, that will keep on growing further. So that also will add to, and all these 56 countries that I talked to you about, they constitute 5 trillion of services market out of the total global basket of 8 trillion. So we are 60% of the globe we are covering where there is more policy predictability, more clarity, so that our services can grow much faster. If you look at all the custom thing also, if you look at trust-based framework that it has been talked of, all the EODB that has been talked of, it will go on to make our products more competitive. And if our products become more competitive, I think it's much better for our exporters, and it's much easier with these FTAs and market opening up. I think our exports are well poised to grow. This year we are looking as to cross $850 billion. But going forward, once these FTAs are operationalized, I hope we'll catch on faster.
What is that number that you're working with? As soon as these FTAs are operationalized, UK hopefully will be done within this calendar year, and the EU mega trade deal should be operationalized in early 27, is what we're given to understand. If both these go through, I'm not even coming to the US yet, if both these go through, what could that export number look like, for instance, in FY27, FY28?
See, putting a definite number is a very difficult task, but I can tell you at the rate at which we are growing, definitely there will be much sharper and much increase in the growth rate that you will see once these FTAs are operationalized, because we are talking for much bigger market. EU itself is a 10 trillion market, goods and services combined, and if that opens up, this is around 30% of the global trade. I think it can actually grow much faster. Right. So numbers I'll not hazard a guess and keep on giving fodder to the media on that, but I feel it will grow very well.
Mr. Agarwal, when it comes to labor-intensive exports, we've been seeing in the April to November period exports of shrimp, fisheries, leather, footwear, textile, apparel coming under some amount of strain. And you've tried to help these sectors by reducing costs of raw materials that are being imported. Would you be able to quantify for us the kind of drop in exports for these sectors that may be on the anvil, and how you've tried to protect these sectors from the losses that they're incurring?
Thank you, Parikshit. I think labor-intensive sectors have been under challenge because of the global turmoil and the high tariffs that we face in one of our biggest market. But what I can tell you, in spite of that, I think the industry has shown enough resilience. The textile exports till December, overall at a global level, I think it has only grown, it has not gone down. Marine, we are growing in double digits in spite of these challenges because we are diversifying. We are growing in Europe, we are growing in Vietnam. On leather also, we are holding good as of now. So in sum total, in spite of this, all the challenges that we face, I think Indian industry, because of its own resilience, because of its adaptability, they have been able to hold good. And with these now new FTAs coming into being, as Serene pointed out, if UK gets operationalized early, I think this will open up new windows where they can diversify more, deepen their exports in those markets, and maybe make good their losses that they are facing in other geographies.
Right. Just to also ask you about the theme of resilience. You've tried to bring in a lot of resilience with the budget, making sure that there is ease of doing business as well. When it comes to the trade deal with European Union, for that matter, how do you think this deal, along with EFTA, along with UK, is going to open up opportunities for services exports? Yesterday's budget was a lot about services. And how do you think the budget push, along with the FTA push, will help the services sector?
First thing, if you look at the EU, 27 economies, UK, and the 4 economies of EFTA, all these 32 economies are a service-driven economy. UK has 70% of the GDP of UK come from services. So they're all services-driven economy. If you look at all these 3 free trade agreements, you will see the policy commitments under services in all these three agreements are very high. In EU, we get one of the best ever commitments in 144 subsectors, which means a long-term policy predictability for all our service exporter in 144 sectors. In UK also, we get something around that. In EFTA also, we have got one of their best offers. So what we see in all these economies, which are large service consumers, we are seeing a long-term policy predictability. We have got commitments around mobility also in all these agreements. That will also help our service providers to move in the right direction. And now with the impetus that we get in the budget, like the impetus for the GCC, the safe harbor rates, thresholds going up, aligning it with the best practices across the world. What will happen, the GCC ecosystem, which was as it is growing very fast in India, now a lot of GCCs from even European and these companies from this region will also find it easier to open GCCs in India because they have got more policy predictability in India, and we have got mode 1 commitments in all these agreements. So they can sit here and export services there. So the FTA actually align with the policy shift or the support that we are getting under the budget.
You know, your predecessor, BVR Subramaniam, called it the services budget here on CNBC TV 18, Mr. Agarwal. I know there's many people, including Mr. Kanabar, waiting to ask you a question, but let me ask you, sir, you laid out for us what's the latest as far as the UK FTA is concerned, the EU FTA is concerned. Let me ask you the big question that everybody in this room and in the country wants to know. What is the latest on the US trade deals? The last conversation that you and I had, you said that there were 2 frameworks that were being looked at. One was the trade deal in itself, and the other was a framework to address the reciprocal tariffs. India's been hit with 50% tariffs. The other framework, in your words, was to deal with the reciprocal tariffs. What's the progress on both those 2 frameworks?
As I told you last time, Shireen, I think we remain engaged, very positively engaged, and it's progressing very well. The 2 frameworks are still in place. The larger framework is going to take time because US is a big economy, and a larger, deep, wider FTA will always going to take time. But the one which can be done in the short run is the one which is an early harvest, can address the reciprocal tariff bit, is also getting shape. When it will happen, how fast it will happen, these are the questions. I think I'll not put a date to it, but we are hopeful that we should get it sooner than later. let's see what happens next.
Sir, I'm just going to push you a little bit on this. When you say we're waiting for it to take shape, or it is shape in progress and work in progress, can you explain to us what are the cornerstones, what are the pillars that both sides are working on, at least as far as this reciprocal tariff framework is concerned?
Largely, see, reciprocal tariffs are in the good space. If you look at these tariffs are in the good space. So one of the key discussions in this is how we are able to align our tariffs on both sides to see that we work towards a more balanced trade between the two nations. So that is going to be the core of whatever we achieve in the first. Aligned with that, when you, as you mentioned, tariff itself is not the driver of trade. The entire ecosystem, the policy certainty or the non-tariff issues also needs to be addressed. I think we are trying to discuss on both sides to see that when the deal gets finalized, both sides are better off than where they are standing
How much
today.
convergence is there today, Mr. Agarwal, on the framework to deal with the reciprocal tariffs? Would you say we're 90% done, we're 80% done, we're 50% done? How much convergence is there on both sides?
I think you heard my minister a few days back where he said most of the sticky issues are now out of the... So that's where I will leave it, that most of the sticky issues are more or less resolved. So we are progressing fast. Let's see what happens next.
One quick question before I hand it back to Parikshit, and then I'll get the audience to come in as well, is a comment that's coming from President Trump. On board Air Force One, President Trump said that a concept of a deal has been arrived at with India to buy Venezuelan crude. Now, for context and for the benefit of our viewers, India was a buyer of Venezuelan crude till the US actually sanctioned Venezuelan crude. So I want to understand from you, sir, what is the concept of a deal that President Trump claims that we have arrived at on Venezuelan crude?
See, one, I'll not like to comment on Honorable President Trump's comments because that will not be fair on my part. Two, from India's perspective, we are an energy importer. We import a lot of energy, and our position always has been that we want to have a very resilient, diversified supply chain for energy products. So we'll always want to diversify, we look for more opportunities, and in that quest, what happens is something for the energy department to decide.
You know, Mr. Agarwal, the other question I think a lot of exporters would want to know, you've sealed a number of FTAs. Some of them will take effect this year, will be ratified this year. How many more deals is the government of India likely to seal or sign this year? You're in negotiations with Israel, with Canada, with Mercosur. What's the status?
Yeah, we are in midst of multiple other negotiations also, but with EU closed, and I think one of the major part of the globe, 27 economies gets closed. So we are now 56 countries which will be having preferential market access. In addition, we are looking at markets we provide which are complementary in nature, like Israel, where goods and services basket is more complementary in nature. We are also looking at GCC. We are also looking at Chile. We are also trying to look at EAU also. There's also a negotiations going in progress with them. So we are hopeful some of these deals will definitely find finalization this year. We are also looking at, now you have heard something that the Canada also wants to have resume the negotiations and restart negotiations in that direction. We are considering that also, or are engaged with our counterparts on the other side. So we hope with this 6-7 new negotiations going on, some of them will cross the finish line this year. I'll not again put a number of which one, because I'll not put one against another, but we are positively engaged on all these negotiations, and wherever we can find fast convergence, a win-win solutions and a mutually beneficial deal coming into shape, we'll try to finalize it and move ahead.
You know, one question that I'd like to ask you is about the sentiment. We'll not go into the nitty-gritties of the trade deal with the US again, sir, but what is the impact that it has had on market sentiment? We've seen net FDI coming down, slowing down. There has been a flight of FIIs as well. What can be done, and what would be your priority in terms of having a durable, sustained pipeline of FDI in the country? Would there be certain priority areas which you would be looking to liberalize this year, or maybe push harder?
One, I think on FDI, if you look at in multiple other sectors, we have liberalized FDI. Insurance also, it has gone up to 100%. Secondly, in our FTAs also that we are signing, like the one we are finalized with EU also, if you look at, there are multiple services sector where we have taken investment commitments, we have given policy certainty on investments so that they can come and invest in mode 3. Yeah. And that's how the GCCs will shape up. Right. So I think we are doing a bit as part of FTA also, wherever we can take commitments to give a policy certainty. On a MFN basis also, India, I think, majority of sectors on automatic rate today, and it's a very consistent policy that we are seeing over years. There hardly been any backtracking of limits that we have seen in India. So I think there is a signaling to the world that India is providing a policy certainty in the long run. So there is already a signal open. Many of these things globally are happening at the same point in time. I will not like to make one as the causative factors for the other. They might be all happening in the same time zone or time arena, but they may not be connected also at point in time. Without getting into those details, I will not like to comment and get into, because I don't know where actually one is affecting the other.
Fair point. Dinesh Kanabar, sir, go ahead with your question.
First of all, sir, compliments on the FTA, and of course we are waiting for the elephant in the room to sort of be addressed. I think a couple of very important things which I saw in the budget which are very, very positive. One is the tax holiday on data center, and the reason I mentioned this is that over the last few years, the government has walked away from tax holidays. And I think it's important for the government to realize that the sectors where we see a lot of investment coming in, we need to promote and give holidays. So the tax holiday on data center does give a degree of certainty, which is very welcome. I think the even more welcome thing, which I don't think has been spoken about a lot, is the safe harbor on services, which will promote a huge amount of global capability centers coming to India. One suggestion there is that there has been an overall cap on who can avail, so your turnover needs to be less than 2,000 crores. I don't think that is necessary really. Just opening that up will be very, very positive. You mentioned that we are looking at manufacture in India, we're looking at that creating a base for export. And I was a little bit disappointed, if I may say so, that there was nothing much for R&D and manufacture in India. I think those are the two areas which we need to look at, because we are looking at H-1B visas, whatever is happening out there, probably an inward flight of the talent coming to India. If we are able to provide that platform for R&D, promote semiconductor, etc., that's one thing. And the last comment, Parikshit asked you about a question on FTA. Where are we on press note 3 and how do we address that? Thank you.
Mr. Kanabar, you've taken all my questions. Go ahead, Mr. Agarwal, you can start by answering.
Thank you. One on the GCCs and the safe harbor rate, I think it's a very strong forward movement from 300 crores to 2,000 crores and the safe harbor rate, which are more aligned to international norms. And if you look at the fine print, I think the budget also provides us for a fast tracking mechanism beyond 2,000 crores. So there is a provision wherein there will be a fast track mechanism where the tax authorities and the GCC can finalize. So I think that will provide a lot of comfort to the GCCs to grow. Data centers, as you rightly said, I think it's a very forward-looking policy. The tax certainty bit will enable a complete data center ecosystem in this India to get fast-tracked, and a lot of exports through that data services will also take place from India, adding to my export kitty. So that is also a plus from our perspective in a big way. The third question, the third aspect that you talked about, R&D, I think some of these new agreements that we are doing, there's an technology and R&D collaboration also we are talking of. R&D is something that you can't have any binding commitments from the country, but this is somewhere we are talking of tech cooperation, R&D cooperation with the country. We talked of agri-tech cooperation when we did New Zealand. We talk of technological and high-tech cooperation when we did EU. So we are looking at the right synergies and trying to bring that in forward also. In budget also, I think when we talk of university campuses which can provide education services, I think R&D gets built into it. When we talk of GCCs, GCCs are also now providing R&D services online. So I think there is a lot of R&D which is coming horizontally in many of these things that we are doing, and it will definitely add to the press note 3. I think it is handled by my colleague. It is something which has been discussion in media a lot, as like you, I've also been reading in media a lot. So I hope, let's see what is the decision.
But Mr. Agarwal, what should we realistically now expect in terms of re-engagement with China? Many steps have already been taken, a resumption of visas, travel, and so on and so forth. In terms of trade, in terms of economic re-engagement with China, what should we now realistically expect? Chinese companies being allowed back into tendering processes and so on and so forth. Again, a lot of speculation around that. What is the government's thinking? Whether or not a decision has been taken is a separate matter. What's the government's thinking?
I think it's Chinese company, as it is with PN3 also, they don't come under automatic route, but through a screening committee they can come, the investments can come, and that must have been happening in some cases and there. I think with these positive movements in the bilateral relationships, some of these issues are being discussed in media. I'm sure in the government also deep consultations are going on. If the movements, because these positive movements with our neighbor, once these are getting, they have to be quid pro quo, it has to be from both sides. I think our people in MEA and DPIT must be collaborating to see what are the next steps that we can do on PN3 also. So let's wait for any final decision, final call by the government.
Fair enough.
Till then, I think we can all keep discussing and keep on building the right pressure or expectation in the ecosystem. Thank you.
You know, when it comes to reducing dependencies, and that's connected with the China question, the budget went a long way in terms of reducing our dependencies on rare earth, on critical capital goods, critical components as well, and their raw materials. Would you say that this is a theme that India is going to double down on, focus on more aggressively, map out our dependencies, look at areas where we're dependent on China or other nations for that matter, and invest more in localization?
I think...
and could you list out 4 top priority sectors for us?
I think COVID itself, when we had COVID across, I think COVID has brought in this new debate of resilient supply chains, plugging the vulnerabilities and trying to see that our sourcings are more diversified. All countries across the world are not talking about it, and they are trying to do their bit to do it. But this is something which is easier said than done. It takes time. I think in India, we have come up with very concrete steps. The budget provides for concrete steps while talking of critical minerals corridors and things like that, to see that we are able, because critical minerals are an important element in our decarbonization effort also. So if you want to move on a trajectory of decarbonization, we need to work on it. So I think the budget touches the right pain points to see that we are able to work in that direction. And this is something I think each country is trying to do. When US does the mineral partnership or Pax Silica, I think this is also moving in the direction trying to see that how we can reduce vulnerability in the critical mineral supply chain.
Right.
So that I think has been the theme around the globe. Everybody is talking about it. And for India, which has got 1.4 billion population, one of the fastest growing major economy with a very clear aspiration to go to Viksit Bharat 2047, it becomes more so important that we are able to plug our vulnerability sooner than later.
We've got a lot of questions, sir. Go ahead.
Mr. Secretary, the government has done a very good job on FDI, not just now, but over the years, this government. And that gives me the encouragement to ask you a slightly provocative question. What in your view are the red lines for this government in terms of opening up FDI? What sectors fall within those red lines? And do you think India has evolved enough that we look at some sort of relaxation on foreign direct investment in multi-brand retail? In some formats, perhaps, do you think we as a society and as an economy now have the resilience to be able to absorb this? You've opened up insurance, you've opened up virtually every sector in the economy. But modern retail, multi-brand retail, still remains close to foreign investment for the most part. How do you look at that?
I can tell you, Mr. Agarwal, that he and I have had this conversation and this debate for a large part of the last 15 years. So multi-brand retail, we've opened up defense, insurance, pretty much everything. Is that still off the cards?
See, I'm not a subject owner on this, so I'll not be able to give a clear government perspective on this because I am not handling that subject. So I'll not be able to say so. But my sense is, as an economy, we are maturing fast. And if you look at multiple sectors that we are deepening our FDI limits and opening up, that goes on to say that story. Multi-brand retail, the sensitivity is not on the multi-band retail per se, because it is because our economy is poised and is structured in a particular way. The structure of our economy is quite different than the structure of many other economies.
Yeah.
So we have to look at, it's not only about the economic growth, because many countries at the same economic growth level can have a different prescriptions or different, because of the structure of our economy. And we are a very huge economy, huge population, and huge amount of population dependent on different kind of vocations and different kind of. So we need to look at, if we take these decisions, what is the different pathway in which our economies will grow. And that's why I think this is best, the subject owner will go, but these decisions are something where they think when government feels this is matured enough, it will be taken.
Okay, it will be taken. We've got the budget architects walking into the budget verdict. The DPAM Secretary, Arunish Chawla. Welcome, sir. Thanks very much for joining us. We will come to you in just a second. But let me also bring in Ajay Roti and Anita Rastogi of PwC. Can you raise your hand so that I can come across to you there? You go, Anita. I can see you there. Go ahead.
Thank you so much. So, sir, I think this budget has been really good as far as the requirement of the current need of the country is concerned. But regarding cross-border transactions, we just wanted some more, in-depth analysis by the government to ensure that the businesses don't really get into small little litigations, considering the transfer pricing and customs are two very different areas and they have two different objectives. So is there, and also the economic survey has recommended that, there should be a convergence over there and there should be coordination. So is there any thought in the mind of the government in this area as well? Thank you.
Thank you, Anita.
I think we have been moving positively in that direction, and even the GCC thing that we are talking of again is trying to address that issue precisely. So it is being moved in that direction slowly, but these things take time. It doesn't happen, these reforms don't happen in a day.
Okay, we have questions here. Go ahead.
Sir, good evening. This is Ajay Roti. Again, this is linked to the, what Mr. Kanabar called as the elephant in the room, and where Shireen pushed you on the dates for US trade deal. Given how it's been going with other countries, sir, will we be actually seeing a full-fledged FTA equivalent, or is it a framework? Will we actually have a deal, or is it more of, because even what we've seen is that the so-called deals are also don't last too long. So what is it that we can expect in the short term? Is there an overall agreement on, like you mentioned, only reversal of the reciprocal tariff and thereafter working towards a longer deal? Will we have a full-fledged FTA like the EU, UK, etc., or are we looking at just an agreement in principle on certain things in the immediate future?
As I told earlier also, there are two parts of the deal that we are looking at. One is the larger part, but this will depend on the appetite on the both sides, because it takes two to tango. The appetite has to be on both sides. So then only it will happen, because in any deal, the commitments are going to be from the both the sides, both the partner countries. As far as the reciprocal tariff bit is concerned, if you have looked at the number of deals that has been announced, I think only one or two deals, the details and the deal has been finalized per se. Majority of deals have been announced, but they have not been completely rolled out yet. So we don't know what is the legal framework in which each one of these deals will be falling. So for us also, that is one of the points that we are trying to figure out when we are doing that. Because there is a wide array of choices that both partners have while fixing the interim deal, while it will address reciprocal tariffs and tariffs on both sides, but the legal frameworks can vary depending on what kind of commitments and how both sides want to give to each other.
Mr. Agarwal, you said it takes two to tango, sir. So are we on the same dance floor even, or we're not even on the same dance floor today, sir?
Therein I'll only say you have been hearing Honorable President Trump. He says that we are very near and he's going to do one.
We are very near and we're going to do this. Sandeep Jhunjhunwala of Nangya Global, if we could stand up so that I can see where you are and get a microphone across to you. Go ahead.
Hi, sir. Good evening. Regarding the FTA, while we know that the US is in the pipeline and EU is something which is already sealed, and you spoke about some of the other larger FTAs being in the pipeline, just wanted to understand if you could give us a little more visibility on what are those other significant ones, and what does the Indian economy and the Indian consumers stand to gain on account of those FTAs as and when they come?
I think He answered that already. Parikshit, over to you.
Yeah. So, Shireen, I had a question for Mr. Agarwal, and this is based on the budget, sir. And this is an item that you had been working on how to make it easier for manufacturers within special economic zones to sell within the domestic tariff area. And the budget has announced that they will be given concessional duties. Could you give us a sense on when this scheme will be implemented? What will be the concessional duty that will be offered? What are the sectors that are likely to benefit?
I'll touch on two aspects. One, why. SEZs is an old scheme that has been going on, but what has happened over the years, the landscape of trade has changed. Over the last 15, 20 years, we have done multiple FTAs. So many other countries and many other SEZs across the world now have duty-free access to our market in many other sectors. So SEZ may be functioning in Vietnam, may have a duty-free access in some sectors in India. Our SEZs don't have that. So we are trying to look at how we are able to provide that access to them also. But at the same time, we need to see that the interest of the domestic industry also doesn't. So we are trying to find a fine balance between protecting the interest of domestic industry, but at the same time trying to give them a pathway. And that's why this announcement. Two, now that this announcement will definitely spur a lot of confidence in our SEZ units, because the ideal capacity that has been lying there can be used very well to substitute some of our import supply chains in the domestic market. Two, when they get scale, they become more competitive. The production becomes more competitive, and competitive production means more exports. So I think it will also enable our more exports also, more value add in the SEZs, and also lead it here. Three, when do we do it? I think it has been announced in the budget. We will try to do as fast as possible, because both commerce and revenue will need to sit together and try to figure out what are going to be the duty rates and how we are able to roll it out. I think it shouldn't take much time, but I think as early as possible in the next financial year, we should roll it out.
Right.
In the next financial year, sorry, Parikshit, just one quick clarification there, sir, because the finance minister said that this is going to be a one-time window. So how long for which this period of relief is going to be provided for? This window is going to be open for how long, sir?
I think my sense is that window, because I think this is something we are looking at for the existing units in the SEZ, and that's why probably it's a one-time measure that has been announced, because the current units which are there are facing this challenge. They have ideal capacity, and this is not being leveraged for substitute the imported supply chains in the domestic market. So we are trying to provide that facility to them. The details around this scheme, I think both ministries will sit together and finalize, and that's why the broad intent of the government has been conveyed as a part of the budget statement, but details will be worked out between the two ministries, and we'll roll it out to the satisfaction of our SEZs. Thank you.
So a lot of exporters have been coming to you with pain points over the last few months. Are there more targeted schemes for certain sectors, maybe like the leather sector, which are on the anvil, which you're thinking of in order to support the labor-intensive exports? And also on the timeline for implementation of the export promotion mission, if you can give us a sense.
One, I think on the schemes for sectors, I think largely these are the different stakeholder ministries which come up with various supporting schemes for the sector. Like for textile, a lot of Samarth 2.0 has been announced. Other initiatives have been announced for textile in the budget itself. So they will all be rolled out by the administrative ministry, and this is agnostic to export or domestic market. It is for growing that sector in the economy. It will definitely have a positive for the exports also. We normally don't do sector-specific schemes or incentives for exports per se. So that is something not been our practice in the UOC. Under the export promotion mission, we have already rolled it out. We have around 11 components that we have planned as a part of the export promotion mission. 3 of those guidelines are in public domain and on which actual work has started, and industry is actually going to take benefit of them in these 2 months. Already some of them, sanction orders and all, are being issued. 6 more guidelines are going to be announced in next 10 days. So 3 plus 6, we'll have 9 guidelines which will be completed, announced for industry to actually take benefit of it. there are 2 more guidelines which will be left, and we'll try to finish them off also in the month of February, so that there is a complete framework under the export promotion mission which is available to the exporters, and they can try to take their due benefit. Largely, if you look at, this is more attuned to MSMEs, and if they are able to take benefit under this, I think many of their pain points will remain addressed, and they will be able to plug into export supply chain in a much bigger way.
Let me ask you a question as far as the macros are concerned, Mr. Agarwal. You know, the current account deficit at this point in time, the government has said that you're comfortable with the situation, even though we have seen a significant decline and a depreciation in the rupee. I just wanted to get your thoughts on that, the currency depreciation as well as the macros, how you're looking at that. And, you know, there was a lot of chatter around the fact that the government may try and put in a duty to curb the import of gold and silver. We didn't see any duty imposition, but does the import bill on account of gold and silver concern you?
Definitely, two of the biggest elephant in the import bill are energy and gold and silver. But however, this year I think we are doing good on our import front also. The import growth this year as compared to last financial year has been slightly subdued, not very subdued, but slightly subdued. Our trade deficit still will go up a bit, but it will not go up substantially. My sense is overall trade deficit will go up by $15 to $20 billion by the end of the year. But that, I think, with the overall trade growing on both sides, import and exports total growing by $80 billion this year as compared to FY26. I think this is FY25. I think this is something that we can live with.
And the rupee, sir, that's helping exporters for sure at this point in time. Does it? How much of the tariff hit is it helping provide a buffer for?
I think the rupee depreciation does help exports, but then you also need to remember, I need to export more to get you the same dollar numbers.
Yes.
So every time when I say that we are doing better in exports, this is in dollar terms.
Yeah.
And if I'm doing 2% there, then I am actually doing 7-8% to do that. So that is also to our strength of our industry, who has been able to take advantage of this and actually ramp up the exports.
Right. Gokul?
Congratulations, sir, on the EU FTA. It is a landmark deal. One of the things it will be good to hear is this controversy around CBAM continuing to apply to the Indian exports. And secondly, in the budget, there's a provision for 20,000 crores spent on some form around carbon capture. Is that connected to enabling the export from some of the sectors which are impacted by CBAM?
Thanks. One, I think on CBAM, there has been a lot of discussion with the EU also. We need to understand CBAM is a horizontal regulation. This is a regulation which they have brought in, which is equally applicable to the domestic industry also in the EU and also for the imports. This is one regulation on which there is no derogation that they have been able to give to any country thus far. But what we have been able to secure as part of FTA is 2 kinds of commitment. One, in case there is any flexibility that they are able to extend to anybody in the world under CBAM, India gets it automatically. So we'll never be worse off than anybody else as far as the CBAM regulation is concerned. 2, we have also been able to get a technical dialogue set up as part of FTA, wherein we'll get clear insight into how the CBAM is calculated, how the CBAM levy is being worked out, so that our industry is able to understand it clearly and align its supply chains accordingly. 2, we have been able to push them to see that the local verifiers in India are also accredited, so that our industry is able to verify that. 3, we have also ensured that in case tomorrow we come up with a carbon trading mechanism in India, the impact of the same is also linked to CBAM, so that there is no double payment of levy by the Indian industry in the supply chains going to Europe. So I think this will help us to deal with this better, and that in that perspective we have done this. And 3, I think decarbonization is a common endeavor of EU and India. And in that quest, we have also tried to work, we are working on a common pool of funds wherein EU can bring in money to help us decarbonize in India, especially in the hard-to-abate sectors. So that is also where they can bring in both technology and finance, technical assistance to support us. That is part of their joint statement also.
Yeah.
And once you get the fine print of FTA, you'll find a mention of that also in the FTA.
We've also got Christian Arora from Grant Thornton. He's got a question for you, Mr. Agarwal. Go ahead.
Good evening, sir. I just wanted to, get your thoughts on the speculation which was around announcements or revival of PLIs. And we, in the economic survey also it was mentioned about, the success of PLI, but also looking at reviving them in some form or the other. But there were some announcements specifically for certain sectors. But beyond that, the thrust sectors and the strategic sectors, is there any thought that PLI schemes would also be part of some of the thought process which will come in, as we can see?
See, I look at PLI or any other such scheme in a very broader perspective. If you look at historically also, governments have been supporting, giving sectoral support for domestic industry to grow and get to some size. So production-linked incentive is the incentive when the incentives are linked to production. Similarly, their incentives can be linked to employment. You have got employment-linked incentive. You can have incentives linked to some other outcomes also. The idea is, can we cover up for the handicap that our industry faces vis-a-vis its global peers, so that it can do that initial journey with the support of the government, and once it is matured enough, it can then run on its own. So that is something which every government does, and the government needs to do it, and this is something which will happen in India also in some form or other.
Well, we've also got the Expenditure Secretary joining us. Sir, many thanks for joining us here. But Mr. Agarwal, before we close with you, sir, manufacturing, as you pointed out, a lot for services in the budget. But on manufacturing, sir, we're still at that 17% share of GDP, sir, despite the many measures that the government has put in place. Do you now feel confident that on the back of the additional steps taken, that we will finally get anywhere closer to that 20%? The aspirational number has been 25% for very, very long, but moving beyond this 15, 17% to even 20%, sir, by when?
I think the budget provides a right boost to the manufacturing sector. If you look at, they have been talking of 200 legacy industrial clusters which will be rejuvenated. That will provide a boost to manufacturing. They have talked of support to 7 key sectors like electronics, semiconductors, marine, textiles and others. That will also lead to larger manufacturing in this. So there is a trajectory which is looking northwards. This budget, the focus on some of these sectors and reviving those industrial cluster will only add to it. So definitely I think we are moving northwards as far as the manufacturing also concerned, but our GDP is also moving northward. So I think there is some catching up that needs to be done. But till we are both moving northwards, I don't think there's a cause of worry.
Are you being able to catch up with any sleep, considering the fact that you're probably on the phone or on Zoom calls or Microsoft Teams meetings with the US, sir?
It happens the job in the Commerce Ministry is to deal with entire globe at multiple points in time. And that's why we have got a strong team which looks into various aspects and various time zones to deal with them. Our working hours are a bit different, but at the same time, I think they are more satisfying with these FTAs coming to fore. I think any kind of work is satisfying and is good to look up to now.
So how many all-nighters did you pull in the last lap leading up to the EU FTA?
I think EU-FTA last 3 weeks were tough because both sides had a deadline to meet and there were things we needed to close. So there was hard work and teams needed to work. But because we are only 4 hours apart, I think we could manage it much better.
Well, Mr. Agarwal, we hope that, as you said, it takes 2 to tango, that we actually see that tango result in something soon. But many thanks for joining us, answering so patiently the many questions that our participants here have put to you, and for explaining to us the thinking, the rationale and the priorities of the Ministry of Commerce. Many thanks indeed. Ladies and gentlemen, a big round of applause for the Commerce Secretary joining us here on the CNBC TV 18 Budget Verdict. We will take a break.
Thank you.
The conversations continue. The newsmakers, the headliners will join us. We'll be joined by the DPAM Secretary and the Expenditure Secretary after this very short break. Stay tuned. You're with the Budget Verdict.
You've heard the budget. Now, understand its impact. Hear it directly from the architect of the budget. Finance Minister Nirmala Sitharaman's first interview post-budget with Editor-in-Chief Rahul Joshi. News 18 Network exclusive. Tonight at 8, the FM interview across the News 18 Network.
Welcome back. You're watching the CNBC TV 18 Budget Verdict, and we're coming to you live with the budget architects. Joining us now is the Expenditure Secretary, Mr. Bulam, as well as the DPAM Secretary, Aruneesh Chawla. Gentlemen, appreciate you joining us here on the CNBC TV 18 Budget Verdict, the very first time that industry will get a chance to interact with the budget architects right after the presentation of Finance Minister Nirmala Sitharaman's 9th budget. Expenditure Secretary, we've now had time to go over the fine print of the budget, and let me talk to you about what the numbers are showing up. The effective capex, if I take a look at B versus RE, B 15.4 lakh crore rupees, RE 14.03 lakh crore rupees, across a whole bunch of schemes, whether it's the rural drinking water mission, where the B was 67,000 crores, the RE 17,000 crores, a big drop there. Gram Sadak Yojana, 19,000 crore rupees, BE, RE of 11,000 crore rupees. If I take a look at rural housing, 54,000 crores in BE, RE of about 32,000 crores, 500. Urban housing, 19,794 crores, RE of about 7,500 crores, so on and so forth. Can you explain to us why there's been such a sharp drop between the budget estimates and the revised estimates, sir?
What happens is around October, we start an exercise where we interact with each of the departments and ministries, where the secretaries of those departments, their financial advisors, they come, and in the Department of Expenditure, we look at the pace of expenditure, the trend of expenditure, and whatever comes out in the revised estimates are really an outcome of that discussion, so that unnecessary idling of funds for projects or schemes not required does not happen. Now, you took a few specific ones. So, for example, if we are to pick up the Department of Drinking Water Supply, yes, we did have 67,000 crore rupees in the BE 25-26, and we brought it down to around 17,000 in the RE. The drinking water is really the one where the Jal Jeevan mission is being implemented, and during the course of the year, what was found was that there is a need for sort of resurvey, re-examining, streamlining the procedures. So it went through that kind of an exercise. But if you look at the BE 26-27, you will find that now that we have the certainty that the scheme is ready for full-fledged implementation, the 67,000 crore is brought back in the BE 26-27. So So it's moving on, yeah.
So if I could just double down on that, are you suggesting then that there were inefficiencies in the manner in which the scheme was being executed, there were perhaps leakages, etc., which led to an overall examination or re-examination of the scheme? Have those issues now been addressed, which is why you feel comfortable to bring the number back to 67,000 crores versus the RE of 17,000 crores?
Yeah, it's all streamlined, and we are set to sort of have a full-fledged this thing in the new financial year. Yeah.
Okay, but there is still, sir, quite an overall gap between the budget estimate and the revised estimate on the expenditure front. You gave us an example of one scheme, but there seems to be expenditure compression across a whole range of schemes.
What happens is some of the items where the scheme is brand new. So, for example, again, let's pick up in the Department of Science and Technology, the Research, Development and Innovation scheme. It's a huge scheme. We can talk about it more. But for the first year where we thought the 20,000 crore outlay which could be utilized, but then it's such an innovative kind of structure that the second level fund managers are just coming on board. So again, we had to scale it down to the level where the allocated funds can be utilized. But again, in the B26-27, if you see, as approved by the cabinet, as announced in the cabinet in the budget speech last year, it's coming back to 20,000 crores. So these are adjustments which happen over the year to see that required funds are provided where they are utilized, and scale down where the immediate requirements are not there. Yeah.
So then that brings me to a larger question, sir, and I asked you this question when we met yesterday on the execution ability and the execution capacity of the state to be able to spend money. And, the industry's ask, as I pointed out, was that a much larger capex number would have perhaps spurred the economy even more. And your response was that at this point in time, the state's capacity is to do 12.2 lakh crores or thereabouts, and that's the number that you've put down for public capex. Is that what we should understand, even when you talk about the RDIF, for instance, that you could put larger numbers there, but the execution capacity, the state capacity to be able to deliver on those numbers is perhaps constrained at this point in time?
Let me put it this way. What the budget speech also put right in the beginning, the fiscal prudence and the macroeconomic stability, the numbers which have been mentioned, enables us to provide resources where required. And the 12.2 lakh crore rupees which you mentioned for the capex is again a fairly big jump, but the government is in a position to provide. And with all the esteemed audience that is here today, it's really a collaboration. So where, for example, on national highways, when we say 10,000 kilometers have been constructed in each of the last few years, it's with everyone working together. It's not a government official who goes and constructs. When we say 3,000 kilometers of railway lines have been laid, it's again not a railway official who has gone and done. It's with some private company, some industry, some people who have all worked together. When we say 1,000 kilometers of metro rail network now available in our country, it's again government agencies, private contractors, everyone working together. So we put the money where the need is there and where the implementation capacity is there. That's how we do it, yeah.
Okay, so yes, the implementation capacity is crucial to the manner in which budgetary allocations have been provided for. But Mr. Chawla, let me address the other elephant in the room. Why did the government lose its disinvestment mojo, and what has enabled you to find it back, or hopefully find it back? You put a larger disinvestment number of 80,000 crores. But, what was the reason why we saw you go slow on disinvestment? I'm not even getting into privatization. And why do you now feel that you want to be seen as reviving that agenda?
Government has not lost the disinvestment mojo, nor is it off the track. If you see how the disinvestment policy evolved, the Department of Disinvestment was set up somewhere towards the end of 1990s. And in the first 5 years was the learning phase where we initiated the disinvestment experiment. And somewhere around after 2004, for the 10 years, there was a hiatus, there was a window when disinvestment was put on the back burner. In fact, there was a talk about doing away the department itself. But in the next 10 to 12 years, which is the term of the present government, the disinvestment was reinvented as a composite strategy. That is why we are not called Department of Disinvestment anymore. We are called Deepam.
Yes.
And that means we light the lamp in the lives of ordinary investors. To do that, we follow a composite strategy. And that composite strategy is guided by what is called the Atmanirbhar Bharat policy for the public CPSEs, which was announced by the government in 21-22. Under this policy, we have arranged the public enterprise domain into 3 verticals. The strategic domain, which is essentially for delivery of public goods, and for ensuring the continuity of our supply chains, like natural resources, core infrastructure, defense, financial infrastructure, and so on.
Right.
Then there is a category called the exempt category, which is not-for-profit functions, which are the social functions, support to vulnerable groups, support to farmers, essentially the market failures that government needs to take care of. What is left is, in a way, non-strategic, but in a way, it is an invitation for the private sector.
Yeah.
And this includes a large number of enterprises which were erstwhile engaged in manufacturing. And in this non-strategic area, we take up both strategic disinvestment and closure as a composite strategy. Because in a macro framework, whether you disinvest or whether you close, it creates greater space for the private sector. It allows them to operate and acquire a greater share of the market and energize the economy. So it is part of that strategy. We've taken both of them together. Almost 25 enterprises have either been strategically disinvested or closed in the last 10 years, which is the highest ever done in the past. And going forward, we continue to revive this momentum. We have learned from certain iterations do not succeed, certain others succeed.
Okay.
The idea is to learn, reinvent the strategy, and move forward. And that is why you see a large number of 80,000. It does not scare us. It is done with our consent, and it reflects our confidence in our ability to achieve it. And if you ask me how this will be done,
yes,
we will use both traditional disinvestment methods. We will use a variety of market sales. And in addition to land monetization traditional, we have now invented and perfected new modes of asset monetization. And if I may mention, one of them is public InvIT. We got the SEBI approval in December.
Yeah.
And we hope to launch the first public InvIT before the end of the financial year. InvITs, as you know, are capital market equivalents of risk capital, which help us monetize the present value of user fee and redeploy it to create assets.
Right.
Honorable Finance Minister also announced in the budget yesterday that we will launch REITs for CPSEs to monetize their surplus land. This will help us securitize the future rental revenues and redeploy them in redeveloping these surplus lands without putting any burden either on the budget exchequer or on the CPSE, and be able to create greater use and put these idle assets to productive use, and also invite private sector participation.
So, plenty that you've laid out for us there in terms of what the DPAM strategy is going to be. How many lights are you going to light, lamps are you going to light this year, Mr. Chawla?
Excellent question. Let me give you numbers. 12 years ago, the number of demat accounts in our country was 4 crores. Today, it is almost touching 21 to 22 crores. So how many times is that? 5 to 6 times. And if you see the dividends, the fair dividends which CPSEs distribute, the CPSEs achieved record profits of 3 lakh crores last year, and they distributed record dividends of 1.4 lakh crores. And our analysis, if I may use a technical term, provides evidence that the CPSEs have first and second order stochastically dominated the Nifty 50 companies as far as dividend distribution is concerned. And with just 15% market cap, the CPSEs distributed 25% of the dividends distributed on the entire stock market last year. You can count the number and millions of lamps that we have lit.
Millions of lamps that you've already lit. And there's hands going up, so I'll get questions. But just to follow up on that, the REIT that the finance minister spoke about in the budget, what are we talking about in terms of the land bank monetization? What is going to be the size that will be part of this REIT? And any timelines by when we can actually see this REIT being operationalized?
Okay. This is going to be a new experiment. We've tried traditional methods of land monetization, which are difficult and time-consuming. This is going to be a securitized mode, where the title can remain with the CPSE. The land title does not have to change.
Okay.
But still, you can securitize the present value of its future revenues and use that to redevelop the same through a developer model.
So will it be individual CPSEs that will do these REITs?
Absolutely. We will identify specific assets, specific areas, surplus areas. And we already have done some homework. We'll sit together with the CPSEs. We will identify the developers. We will create technical consultants and a securitized framework where institutions and even people can invest and we can redevelop.
How many CPSEs are on that list, on that short list that you said you've identified, the homework that you've done?
Let it evolve. It may not be right to give out the names right away.
Okay, but before I go back to the Expenditure Secretary, the appetite for privatization, do you still have the appetite and the mojo to do privatization, or IDBI Bank, one and done?
Not at all. Already, 2 privatizations have reached stage 3, which is the stage for bidding, that is the technical and financial bids. Everyone remembers Air India, but many people forget that after Air India, Neelachal Ispat Nigam in Odisha was successfully privatized with the Tata Group, and it is now running, and it's a going concern with its mojo back. And very recently, just in the closing year, we closed the deal for Ferroscrap Nigam Limited with a Japanese firm, Konioko. That deal has just closed just a few months ago in the last year.
Right.
And the enterprise is running successfully and it is looking up. More will come, but it will not be fair for me to give the transaction-specific details.
Okay, fair enough. Expenditure Secretary, let's also give our viewers an understanding of what the 16th Finance Commission has put out by way of its recommendations, because that's another important document with important recommendations. I think everybody's only understood the big headline number, which is the 41% devolution to states that remains at 41%. But some of the other changes that the 16th Finance Commission has brought about over the 15th Finance Commission's recommendations, and what that will mean for both the centre as well as the state, if you can explain some of those big highlights.
So the Finance Commission is something that decides on the sharing of taxes between the central government and the state governments, and it's a constitutional provision. So they are constituted, expert bodies are co-opted into that. So the Finance Commission, the 16th Finance Commission recommendations have been accepted and approved by the cabinet along with the budget document. So it goes together, and it went together this time. And the 41% which has been mentioned is that 41% of the divisible pool of taxes will be shared to the state governments. And this is same as what was done by the previous, the 15th Finance, and somewhat similar to the 14th, but it's a big jump up if we go back beyond the 10 years, because it was 32% earlier.
Yes.
So there's a huge sharing of resources now with the state governments, and even at that time with the 14th Finance Commission, the central government had approved it, and we continue to accept that, and this time the 41% of our divisible pool of taxes will go to the state governments for them to utilize in whatever manner that they deem fit within their system. So that is one part of it. The other big thing which the 16th Finance Commission has done is really to boost the support to the what we call the 73rd and 74th Amendment related local bodies, that is the urban local bodies, the rural local bodies.
Yeah.
So the 16th Finance Commission has recommended that monies worth rupees 7.9 lakh crore will go to these local bodies from the central government. And to understand the magnitude of the recommendation, it's almost a doubling of what the previous Finance Commission had recommended. So really, in some ways, it's a huge jump. It's a huge outflow from the central government. But we also see it as a sort of, what to say, a whole of government or maybe even a whole of country kind of development at the cutting edge. You know, it's ultimately whether it's in the big cities or in the rural areas when the local bodies are really activated, our municipal bodies, our municipal corporations, our panchayati bodies are activated and fully up to the mark that our daily lives will be affected. So again, central government has accepted. So these are the two very big recommendations that the 16th Finance Commission has made.
And those are important, as you point out, and specifically the ones that you talked about to strengthen urban bodies. I think that is an important recommendation as well. Mr. Kanabar, go ahead, sir.
A quick question, sir, on privatization. This whole proposal to say that even if the government shareholding goes down from 51 to 26%, you'd continue to regard an enterprise as being a government enterprise and continue to sort of exercise. What's the plan out there, and is that really also giving impetus to this 80,000 crore amount budgeted?
Good question. If you read the economic survey carefully, it talks about alternatives. 1/3 of listed CPSEs are already below 60%, and that much public wealth has been shared with the shareholders, minority shareholders. Going further, we have various options, various alternatives. Economic survey, as you know, is an ideation document. The economists are free to ideate. The policymakers have to be more cautious.
But you just finished telling us that you've got your mojo back, or your mojo never left.
Absolutely. Our mojo is back, and back with caution. So the alternatives
it's cautious mojo.
The jokes apart, the alternatives are being considered. One alternative is that you change the definition of a government company. The second alternative is to enter a strategic partnership mode, where you bring in a strategic partner, come down en route to a final privatization. Another alternative could be a joint venture mode, again with both private partner or public partner. A fourth alternative could be a mechanism where other government entities help you dilute. It does not remain a government company. It acquires the flexibility and the freedom to operate, and still being in a strategic area, the public control, a looser control, both directly and indirectly, is maintained to achieve the public goods. And yet, through all these modes, we can share greater wealth with the minority stakeholders, and also give more freedom to enterprises to operate and compete with the private sector in the open market. All these options are on the table. The pros and cons will be considered. One option may be suitable in a particular scenario. Another one may be more appropriate in another one. And that's how we take the best step forward.
But what would be most feasible, Mr. Chawla? You know, bureaucracy is also ensuring that you do the art of what is possible. So what do you think would be most feasible? Because, you know, I'm looking at it from a point of view, a strategic investor, etc. Would they not prefer a clean-cut privatization? I mean, you want to get out of something, get out of it, and let it go to the person who's coming in. Don't you believe that that would perhaps be the most feasible way forward?
Not just bureaucracy, the private sector and the market is also about the art of what is being possible. So what we do is to maintain a set of options. When we do transactions on the market, we don't go with one transaction. We always have a repertoire of 3 or 4. See the market conditions, see the assets, underlying fundamentals, and seize the opportunity. In the same way, we have various options. Sometimes, say, a public enterprise has a heterogeneous set of functions or operations. The private sector is now getting more and more specialized. So if instead of trying to privatize a heterogeneous set of operations, we can follow a cost center approach or try to privatize a vertical which is more easily privatizable, then the chances of success increases. And that is why we are talking about a multi-pronged approach and flexibility so that we move forward in the right direction in which the government and the Honorable Prime Minister wants us to move.
Okay. Mr. Vaidyanathan, you had a question, sir.
No, but just curious what happens like underneath, in making of the budget. There are so many conflicting priorities. You have, GDP growth, you need fiscal consolidation, you need investments of like massive scale, like 12 lakh crores in infrastructure, you need process reforms, that is one push. On the other side, social sector, SMEs, just so many priorities. And in the end, you're delivering a budget that is so consistent, that is, over the years. And of course, we can see that. So just curious, what we see is a final shiny output that we saw, which is so consistent with what all of you are speaking. Underneath, under the hood, how do you deal with conflicts that are happening here? There must be, and one or two instances on how you solve them will be curious, because for a government to deal with conflicts, quite amazing.
Well,
I'll request my friend to take that question.
Because he probably has to deal with most of the pulls and pressures, given the fact that he's looking after expenditure and there's competing priorities that you have to balance. But that's an important question as well, sir. And, it would be nice to understand how you've been able to balance the needs and priorities as well as the competing interests that land on your table. What happens in the quarantine period? Under the hood, Mr. Vaidyanathan tells me.
Yeah, so, for a massive exercise like this, which, as rightly said, has so many competing requirements and competing priorities, I think the starting point, very important, is the clarity of what are the top priorities. And the first top priority that was very clear, which comes out very clear also in the very beginning part of the budget speech, is the fiscal prudence, the macroeconomic stability, that the inflation is at a moderate level, so that aspect, the priority of it was very clear right from the beginning. So that sets one kind of a framework. And the next is really what we discussed a little bit, the focus on the capex. That again was something which was very clear from the beginning. The creation of infrastructure. We are at a stage where as a country we really need to create infrastructure more and more. So these were some of the guiding principles which were there right from the beginning. And within that, again, if we see there are sectors which require support, segments of society which require support. For example, the farmers have to be assisted, the youth have to be provided various opportunities. So those then add on. So in some ways, the clarity of these two big points really then helps in unifying the massive exercise that goes on for several months. So that's how it is. Yeah.
He's trying to get cues for how he's going to operate in his boardroom, sir.
No, really, this is great. But the additional thing is that how do you stay clear of populist things like, given money to people, you could have waived off farm loans, could have done all the kind of stuff. And it wouldn't have been great. We all understand that. If you had given away 2,000 rupees to every woman in the country, you could have spent off 10 lakh crores and made maybe 200, 500 million people happier. Wouldn't do any good. We all understand that from economy point of view. But how do you resist that? For 10 years straight, we've been observing you stayed the course of investing in capital and create growth through that route, and not not fall for these short-term incentives or short-term priorities.
So let me add to that. The focus or the attention on measuring the output and the outcomes. I think that is another pillar which really strengthens the budget making process. Some of the unconditional kind of transfers and all are, at the end of the day, not very easy to measure. So again, the focus, which probably for all of you in private sector may be something very natural, but something which now government has really taken upon itself. So in fact, we publish an output and outcome monitoring framework, and we try and see that we move on. And to that, let me add, I think, what does not come out in a stated sentence, but what is very clear, since you mentioned, say, a decade of sort of continuity, is the trust in the private sector. So why I say this? For example, one of the prominent items this time is let me try to illustrate, the Semiconductor Mission 2.0.
Yes.
Now, that is ahead of us, but if we just step back, Semiconductor 1.0, a huge outlay, something like 76,000 crore rupees,
yes,
is basically something where government is saying to the industry, to the private sector, please come forward, make the projects, identify the locations, and the state governments have also been, I must say, extremely proactive and supportive. They've provided the land, they've even topped up the financing support and everything, and really a private sector-led initiative where something extremely critical as a country is coming up.
Yeah.
Rare earth was mentioned again this time in the budget. Rare earth corridors are being set up, and it's a recognition that in fact, we have the third largest deposit of rare earths in the world. Our beach sand and all these are rich in rare earth. It's just that we have not got our act together. Now, again, if you step back, last year, the rare earth processing mission with about 7,000 crore rupees was approved. Again, something where it's not a PSU or a governmental department which will do it, but really private entities who will work on it, private project proponents who will come forward and will get the support, and along with the government agencies, along with the IREL and the others, will really get onto the rare earth processing. So, and various others. Even the RDI, which we just mentioned briefly, the research, development, and innovation, is really a private, an initiative where private sector is being put in the forefront, because the second level fund managers, when they get into project selection, which innovation project, which scientific invention to fund, it's really a firewall from the government. They have their free hand. The fund manager has a free hand. So really it's another pillar in our budget making, that the private sector, the dynamism of private sector is something which is really being relied upon to lead the economic growth, to development, the infrastructure creation and everything. Yeah.
Well, yes, a quick glimpse there from the Expenditure Secretary on what goes into the budget-making exercise. I'm sure he hasn't given us exactly the flavor of what happens when they go into quarantine. But before I get more questions, Mr. Chawla, my question to you, many public sector companies are still not meeting the minimum float requirements. Now, what can we expect on that front? Also, is there a pipeline of IPOs from the CPSEs that you're working towards? Is there a short list of candidates that you're readying for IPOs, sir?
Thanks for asking that. We have evolved a waterfall mechanism, which essentially means stage 1, stage 2, stage 3, stage 4. Stage 1, we identify a CPSE which meets listing criteria. Once that CPSE is taken up for stage 1, which means we launch an IPO and we try to bring the government equity down from 100 to 90. Once it has successfully crossed that level, we are confident a sufficiently thick market has been created, or a sufficiently stable market, reliable market has been created. The next step, which is stage 2, is to bring the government equity down to 75, which is the minimum public shareholding level. Like in any market, in any process of creative destruction, everyone will not succeed. Our experience is that almost 80% of CPSEs succeed to reach this milestone, but about 10 to 20% also fail to live up to the market expectations, which is when they go up into closure. After a CPSE has reached 75, successfully survived in the market, we have 2 more stages. One is 60 to 75. This is the stage of dividend disinvestment trade-off, and also a stage where the CPSEs start mobilizing capital on the markets through various options and routes that is available. We always encourage them to do that. And you saw the BCCL, the Bharat Coking Coal listing recently.
Yeah.
It was the highest, most responsive. It broke all records. 94 lakh investors and stakeholders participated in that IPO. And going forward, this company, which needs to modernize mining operations, invest deeply in the capex, will now have the market, the capital market, to raise those resources and invest in those operations. We are going to follow the same strategy for many other natural resource companies and their subsidiaries. Once we have reached below 60%, we are cautious, because that is the zone that is near the edge of the cliff,
right,
where for capital management, for capital restructuring, the CPSE needs that cushion. And so this is how it works. We are going to pick up a few more CPSEs for bringing them down from stage 1 to 2, from 2 to 3 in the coming year. And that is why you will see a few more OFSs or market operations or qualified institutional placements within this financial year, and also many more in the coming financial year.
Okay, so many more OFSs in the future, but also within this financial year, i.e. by March 31st this year, 2026, we are going to see more OFSs and perhaps also QIPs. But you know, sir, I'm trying to think, was it 2 budgets ago? I think it was 2 budgets ago that the finance minister had said insurance companies will also be up for IPOs. What's the plan on that front? LIC is of course done, but any others?
See, the General Insurance Corporation has been successfully listed, and it has also successfully crossed stage 1 of the waterfall mechanism. It's there, it's doing well. It's also undergoing, it's reviving its refinance operations, and also branching out into other countries in the region. The LIC IPO was also a great success. It is already, the first IPO is done. Don't ask me when the next one will come. But when the timing is right, we are ready. But when the timing is right, market is right, and we think it is the right step forward, we will take it.
Okay, Ajay.
Good evening, sir. Sir, as I saw it, the 80,000 appeared aspirational, but you've clearly explained you almost have a deal-by-deal working for that. 2 related questions there, sir. One, in the last year, we saw a few banks where you moved the stage 1 to get into the public float. Given a couple of deals which have happened on foreign banks, can we see some of that stage 1 moving directly into strategic now, given the interest? And second question, sir, is what's the plan on Vodafone? I saw that come into the books this year. Is there a plan, or is it too early and it was only to give them an AGR relief and then, the plan will come subsequently? Because that's a big number again.
2 smartly worded, sensitive questions. The first one, let's do the big one first, okay? Honorable Finance Minister announced yesterday the setting up of high-level committee on banking. So that is a step in the right direction. We'll come to it down the road. On the second one, we hold minority stakes in Vodafone Idea Limited, and we do not participate in the management. And that is going to be our strategy, and I would not like to speak any further on that.
Okay, so nothing more to be said on Vodafone at this point in time. But gentlemen, there is one question. Let me go across to gentleman here before we take a quick break. Go ahead, sir.
Hi, Anshul here from representing Aspero. I just, so since you guys have mentioned that there is a sustained push on public capex, we're also seeing government borrowings growing, although net borrowings have grown marginally. But what is government's plan to ensure that, there's no long-term impact on the interest rates and also crowding out of private investments?
See, we monitor the public the capex of public enterprises on monthly basis. And the target this year was very decent and good, about say public enterprises and public bodies to invest about 6 to 7 lakh crores in capex this year. It is on track, and as per our last information, almost 70% of the target was met by December. And we endeavor to provide a graduated, consistent support to the economy through this mechanism. And we have built in the capex performance of public entities and CPSCs into their MOU framework, which determines the corporate performance, also determines the pay and the perks of the corporate leadership. And that works. That helps.
Okay. Expenditure Secretary, I'll give you the final say, sir. So, before you leave us, how confident do you feel about the state of the economy as well as the growth estimates that the budget has held out?
We are extremely confident, and in fact, the GDP numbers, the growth numbers are all put at a very realistic level. So it's not at all shooting beyond what is likely to happen. So we are very confident on that. And before I close, on the budget as a whole, it's almost as if every sentence has meaning. So why I say is, for example, some of our esteemed listeners may be in the export business. So that one sentence about customs integrated system, for example,
yes.
Government is now equally sensitive on the number of forms that have to be filled up by an exporter. So while the ICE Gate 2 has come up on one side, the back end of it, the customs integrated system, for example, is something we look forward to very much as something which will improve the things. Then again, the other one sentence about the governmental agencies who have to sign off before an export has to go out or a import has to come in, the food safety, the animal quarantine, plant quarantine, it's a disjointed kind of thing, So now, single, unified, IT-based platform where any exporter, any importer can, in that one platform, in a monitorable way kind of thing, bring in all the things, So, and the third, for example, again, another small sentence, the Bharat Vistar initiative, which is really to use the power of IT on the agri side, agriculture, agri stack, which is really an entire farmers database, the soil health database, the crop production database, and link it to the ICAR database of knowledge. So again, it's just one sentence, but the way in which farmers all across the country, in the hinterland, everywhere, will be able to access the best knowledge, and also then utilize the most suitable fertilizers of the appropriate quantity and of the crop type which is required. So these are all very promising. So besides the big ticket items which have been mentioned, really all parts of the budget are something which really gives us much optimism.
Well, speaking of all parts of the budget, sir, the budget also talked about mountain trails in Himachal and Uttarakhand. Which trails are the two of you going to be hiking off to now that you presented Budget 2026? Expenditure Secretary, I'll start with you.
We'll try to go for both.
Well, good luck with that, gentlemen. Many, many thanks for joining us here and for giving us a very clear understanding and a path forward on how you present the execution of the promises made in Budget 2026. Ladies and gentlemen, big round of applause to the Expenditure Secretary and the DPAM Secretary. Many thanks for joining us. We are going to take a break here on CNBC TV 18. Our conversations will continue. We'll be joined shortly by the Chief Economic Advisor, Ananta Nageshwaran, the DFS Secretary, Mr. Ragaraju. We'll also have the Defense Secretary joining us, Mr. Rajeshwar Singh. All of that and more coming up for you on the Budget Verdict. Stay tuned. We're back in a minute.
Hello and welcome to CNBC TV 18. I'm Rationale. Here are the headlines we're tracking this evening. The Wall Street recoups some of its losses after the budget sell-off. Sensex and Nifty gain over 1% in the late trade. Nifty ends above 25,000. Broader markets underperform. The Indian rupee strengthens 48 paise to 91.51 against the US dollar, posts its biggest intraday gain in 6 weeks. Sustained dollar selling by state-owned banks helped ease volatility and stabilize market sentiment. Global markets slide after the crash in gold and silver prices. Fears of an AI bubble also rattle investors. Asian markets see steep cuts. South Korea halts trade temporarily after a 5% fall. Bitcoin below $80,000 adds to the pain. European markets stage a recovery. Commerce Minister Piyush Goyal says there is good synergy about a trade deal with the United States, adds he is in regular touch with US Trade Representative Jamieson Greer. Petroleum Minister Hardeep Puri confirms India will be buying oil from Venezuela. External Affairs Minister Jai Shankar heads to Washington to attend a critical minerals convention. Southern states will get a higher share of tax revenue under the 16th Finance Commission's devolution formula. Karnataka will be the biggest beneficiary. States in the Hindi belt will see a minor drop in their share of tax revenues. India's car makers hit the accelerator in January. Sales momentum holds post GST cuts. Double-digit growth across the board. Maruti Suzuki posts record volume. Tata Motors and M&M's shine. Steady demand across EVs, SUVs and exports. All right, let's start with the day's market action. The Wall Street recovered some of its losses after the budget sell-off. Nifty and Sensex gained over 1% to end at the day's high. Nifty closed above the 25,000 mark, led higher by Reliance. Broader markets underperformed the blue chips. Apart from IT, all sectoral indices ended in the green. The Indian rupee gained 48 paise against the US dollar, posting its biggest intraday gain in 6 weeks. The RBI is reported to have supplied dollars in early trade, but dollar demand from funds was weak as per dealers. Lata Venkatesh is here with more. Lata, what sparked the rupee rally?
Well, first up, the way in which the rupee rallied itself was a bit reassuring. 0.5% on a day when actually the dollar was stronger. So that the amount of the recovery, 0.5% from 91.98 to 91.47 thereabouts, is a very, very big rally. The reasons, early morning, the expectation was that the rupee will do badly because stock markets had reacted negatively to the budget on Sunday. But, and therefore, in the NDF market, the offshore market opens before our market, onshore market opens. In the offshore market, the non-deliverable forwards, the Reserve Bank intervened heavily to ensure that when the rupee opens here, it doesn't open very badly, which is what happened. It opened gap up. But thereafter, what dealers tell us is that RBI didn't have to supply much dollars and do the heavy lifting. There was anyway not much demand from foreign funds asking for dollars. You know, they usually sell equities, buy dollars and repatriate it. That demand was very weak today. And the guess is that even in New York, you found the dollar, on Friday rising versus most commodities. Commodities were a bad word on Friday, as we know, most all precious commodities and even copper and aluminum and zinc all fell. The rupee was being shorted against commodities and commodity currencies. Because they were falling, the rupee actually got a relief, and that continued in the onshore market on Monday. The negativity surrounding the budget also clearly ebbed in the stock markets and seems to have ebbed in the rupee market too. And now most dealers were telling me that probably 92 rupees to the dollar is not going to be crossed anytime soon. They felt that reassured about the rupee. Just one word on the bond market, that market crashed. The very high borrowing number, higher than what the market expected. Market was prepared for about 16.5 lakh crore. The borrowing number announced in the budget was 17.2 lakh crore. And so nobody wanted to touch bonds. You saw a big sell-off and yields rose.
Right. Thank you, Lata, for that. The big exclusive this evening, a day after Finance Minister Nirmala Sitharaman presented her 9th budget, corporate captains quizzed India's top policymakers on the key announcements. Commerce Secretary Rajesh Agrawal told CNBC TV 18 that the budget would go a long way in giving a fillip to exports. When quizzed about the India-USA deal, Agrawal said that the most sticky issues have been resolved, while reminding that it takes two to tango.
We remain engaged, very positively engaged, and it's progressing very well. The two frameworks are still in place. The larger framework is going to take time because US is a big economy, and a larger, deep, wider FTA will always going to take time. But the one which can be done in the short run is the one which is an early harvest, can address the reciprocal tariff bit, is also getting shape. When it will happen, how fast it will happen, these are the questions. I think I'll not put a date to it, but we are hopeful that we should get it sooner than later. Let's see what happens next.
Sir, I'm just going to push you a little bit on this. When you say we're waiting for it to take shape, or it is shape in progress and work in progress, can you explain to us what are the cornerstones, what are the pillars that both sides are working on, at least as far as this reciprocal tariff framework is concerned?
Largely, see, reciprocal tariffs are in the good space. If you look at these tariffs are in the good space. So one of the key discussions in this is how we are able to align our tariffs on both sides to see that we work towards a more balanced trade between the two nations. So that is going to be the core of whatever we achieve in the first. Aligned with that, when you, as you mentioned, tariff itself is not the driver of trade. The entire ecosystem, the policy certainty or the non-tariff issues also needs to be addressed. I think we are trying to discuss on both sides to see that when the deal gets finalized, both sides are better off than where they are standing.
How much
today.
convergence is there today, Mr. Agarwal, on the framework to deal with the reciprocal tariffs? Would you say we're 90% done, we're 80% done, we're 50% done? How much convergence is there on both sides?
I think you heard my minister a few days back where he said, most of the sticky issues are now out of the... So that's where I will leave it, that most of the sticky issues are more or less resolved. So we are progressing fast. Let's see what happens.
Will we have a full-fledged FTA like the EU, UK, etc., or are we looking at just an agreement in principle on certain things in the immediate future?
As I told earlier also, there are two parts of the deal that we are looking at. One is the larger part, but this will depend on the appetite on the both sides, because it takes two to tango. The appetite has to be on both sides. So then only it will happen, because in any deal, the commitments are going to be from both the sides, both the partner countries. As far as the reciprocal tariff bit is concerned, if you have looked at the number of deals that has been announced, I think only one or two deals, the details and the deal has been finalized per se. Majority of deals have been announced, but they have not been completely rolled out yet. So we don't know what is the legal framework in which each one of these deals will be falling. So for us also, that is one of the points that we are trying to figure out when we are doing that. Because there is a wide array of choices that both partners have while fixing the interim deal, while it will address reciprocal tariffs and tariffs on both sides, but the legal frameworks can vary depending on what kind of commitments and how both sides want to give to each other.
Mr. Agarwal, you said it takes two to tango, sir. So are we on the same dance floor even, or we're not even on the same dance floor today, sir?
Therein, I'll only say you have been hearing Honorable President Trump. He says that we are very near and is going to do one.
Now, DIPAM Secretary Arunesh Chawla has said that strategic disinvestment will continue beyond IDBI Bank. Speaking with Shireen Bhan at the budget verdict, Chawla added that two privatizations have already reached stage 3.
Do you still have the appetite and the mojo to do privatization, or IDBI Bank one and done?
Not at all. Already, two privatizations have reached stage 3, which is the stage for bidding, that is the technical and financial bids. Everyone remembers Air India, but many people forget that after Air India, Nilachal Ispat Nigam in Odisha was successfully privatized with the Tata Group, and it is now running, and it's a going concern with its mojo back.
Oil Minister Hardeep Singh Puri clarified that India has been buying crude oil from Venezuela for a while. Speaking with Abhimanyu Sharma, Puri added that India imports crude from 40 countries, reiterating that India is not relying only on one country to import oil. The statement comes after President Trump said that India will begin importing crude oil from Venezuela now.
We've been buying from Venezuela for a long time. In fact, I have people from ONGC stationed there. We know that Venezuela has massive reserves, but because of underinvestment, they're only producing 1 million barrels a day. Much of it was being bought with one source. So I think when that statement is made, said India will be now buying oil from there. We were buying earlier. I mean, one private sector person was buying, and my state sector OMCs were also buying. So that's good news. But we are buying from all over the place, the Western Hemisphere.
Onto a CNBC TV18 exclusive, private equity firm Advent International may pump in $300 million into Aditya Birla Housing Finance. Rachna Dhanrajani joins us now with more. Rachna, what are your sources telling you?
That's right. We've gathered from our sources that private equity firm Advent International is set to infuse around $300 million into Aditya Birla Housing Finance in exchange for a minority stake. Now, sources say that this will be a primary capital infusion aimed at strengthening the lender's balance sheet, improving capital adequacy, and supporting the next phase of loan book growth. Aditya Birla Housing Finance is a wholly owned subsidiary of Aditya Birla Capital, which has been scaling up its retail and secured lending businesses as housing demand remains steady across urban and semi-urban markets. Now, speaking of this deal, we understand that the Advent investment comes against the backdrop of multiple capital raises at the housing finance arm. In January 2025, which is exactly a year ago, the company raised about 830 crore rupees from the International Finance Corporation through non-convertible debentures, largely to expand affordable housing lending and priority segments. Separately, Aditya Birla Capital, the parent company, also infused about 249 crore rupees into the subsidiary to fund growth and improve leverage ratios. And now sources say that this equity capital from Advent International would provide Aditya Birla Housing Finance with balance sheet flexibility, allowing it to grow without overstretching leverage at a time when funding costs remain elevated and asset quality vigilance is high. Both Advent International and Aditya Birla Capital have not responded to our queries that were sent via email, but we will keep an eye out for this.
All right, thank you, Rachna, for that. On that note, it's time for a short break. Our exclusive interaction with the budget architects continues on the other side. Stay tuned. Welcome back. The government has managed to crimp its expenditure in FY26, but cutting the outlay for several schemes. The Rural Drinking Water Mission had an outlay of 67,000 crore rupees for this financial year, but only 17,000 crore rupees was spent. This essentially means 75% of the funds allocated for Rural Drinking Water Mission have not been spent. Now take a look at the PM Awas Yojana for rural India. Nearly 55,000 crore rupees was allocated for this scheme, but only 32,500 crore rupees was spent, leaving 41,000 of the funds unutilized. Now to the rural road scheme known as Gram Sadak Yojana. 19,000 crore rupees were allocated, but only 11,000 crore rupees was spent, which leaves 42% of the budgeted amount unutilized. The PM internship scheme was launched with much fanfare in the last budget, but 95% of the budget was left unspent. Nearly 11,000 crore rupees was allocated, but only 526 crore rupees was spent. Shireen Bhan quizzed the expenditure secretary on why so many schemes had unutilized funds in this financial year.
What happens is around October we start an exercise where we interact with each of the departments and ministries, where the secretaries of those departments, their financial advisors, they come, and in the Department of Expenditure we look at the pace of expenditure, the trend of expenditure, and whatever comes out in the revised estimates are really an outcome of that discussion, so that unnecessary idling of funds for projects or schemes not required does not happen. So for example, if we are to pick up the Department of Drinking Water Supply, yes, we did have 67,000 crore rupees in the BE 25-26, and we brought it down to around 17,000 in the RE. During the course of the year, what was found was that there is a need for sort of resurvey, re-examining, streamlining the procedures. So it went through that kind of an exercise. But if you look at the BE 26-27, you will find that now that we have the certainty that the scheme is ready for full-fledged implementation, the 67,000 crore is brought back in the BE 26-27.
The increase in taxes on futures and options trade in the budget caught markets off guard. Now, Union Revenue Secretary Arvind Srivastava said the hike in securities transaction tax was motivated by an intent to curb excessive speculation in the F&O segment. However, market players wish the mop-up was used to offer tax relief to long-term investors.
If you look at the volume of the F&O, if you compare it to the underlying securities market volume itself, or the size of the GDP for that matter, it is too large for it to be considered desirable. It looks to be fairly speculative, which is not a good way to take it forward. So in some way, this increase is essentially meant to address that kind of, possible risks that may be involved in this highly speculative side of the market. With no impact in the volume, if the volume remains the same, put together it may fetch us around 15,000 crores or so.
Unfortunately, the STT increase has spooked the market. And this is a little harder for people to understand, those who are not in the market. I mean, why would a 15,000 crore increase in a tax cause such big damage to market capitalization? And the reason is very simple. For those who are not in the market, is that the markets function on sentiment first and then fundamental.
STT should be increased on futures and options, but always accompanied by a corresponding lowering of either capital gains tax or lowering of STT for cash or doing something. I would think that because they were selling in that context at that time, we should not be doing things which are negative, because this means they will not change currently.
The way markets have reacted since yesterday is as though the retail investors have made a lot of money in the last 25 years in derivatives, which has never been the case. In fact, the regulator prepared a long document showing how much money was lost in derivative segment. But the market reaction since yesterday is only to do with STT, because everything else in the budget was fantastic.
And with that, it's a wrap on this special broadcast. On the other side, we'll have the budget architects with us.
Welcome back. back. You're watching the CNBC TV 18 Budget Verdict live. Welcome back to all of our audiences on television, the viewers tuning into us on YouTube, and of course our audience here who's gathered in the capital to listen to the budget architects, to our policy makers on the strategic rationale for the decisions and the priorities identified in Budget 2026. With great pleasure, let's welcome the Chief Economic Advisor, Anantha Nageshwaran, here to the Budget Verdict. Mr. Nageshwaran, many thanks for joining us here on CNBC TV 18. And here's a fun fact for those of you who've been following the CEA and his economic surveys. He's presented two. This was his third one. And there's been a lot of convergence between what the survey has prescribed and what the budget has taken forward. So as I told him yesterday, he delivered a hat trick. So Mr. Nageshwaran, four. So let's start with that. As you put the economic survey together, and in your own words, this was longer than usual, 730 pages at that. How did you identify the areas that you believed would need to be prioritized by the government, and then they found their way into the budget? Take me through the process of putting together the economic survey, the rationale behind identifying the sectors that you chose to prioritize.
Thank you, Sharon. Happy to be here, and thanks for having me. The selection of topics actually is sort of a year-long process. From the time the survey finishes the year before, whatever keeps happening, and we kind of store it in some sort of a repository. We keep accumulating both the empirical developments, data, and everything. But the choice of topic for prioritization, as far as this particular survey is concerned, I am referring in particular to chapter 16, because the rest of the many of the other chapters kind of choose themselves. They are part of the routine. What requires deliberate decision making are two things. One is what are the special essays we focus on, and the other one is global development. So this time global developments played a very big role in the choice of chapter 16 to be added, and that too in two parts. And urbanization, I think, from the way we see traffic flows and quality of life, pollution, etc., we decided to take it up. And AI, I think, because we wrote about it last year, and much has happened since then, we felt it is important to keep track of it and keep updating the country with these developments, both macro as well as on the computing side, etc. So that is how the topics end up getting chosen.
You said that, of course, the global mix was a significant aspect of what the survey has dealt with, and how India must prepare itself for future challenges as well as possible shocks. But let me address an issue that is now starting to sort of get a lot of attention, and I think in a way you also highlighted that in your survey. Rhythm Desai on CNBC TV 18 earlier today said in the last 30 years of tracking the markets, he's never seen this kind of dissonance between the macros and the markets. The macros are stable as they are, and the markets underperforming. You've also, in a different way, asked for an examination of the investment reluctance that is at this point in time visible when we talk about FPI flows or we talk about FDI flows. How would you address this dissonance that we're seeing between very stable and strong macros and weak markets at this point in time?
So there are no clear-cut formula, a mechanism to address this, because at some point, because there have been occasions not just with reference to India, but with other markets as well, when they have decoupled briefly for specific, it could be specific stimuli that markets are focused on, which is not coming, or because of global developments, or a combination of the two. But over time, they do sort of fall in line together. So right now, I think the concerns leading up to the economic survey and the budget that the markets were looking at were possibly, valuation concerns, and mainly because of the FII net outflows, which in turn was based on the fact that the tariff matter uncertainty with the United States was lingering, apart from concerns about the fact that India didn't have a specific or few AI plays in the stock market, and then whether the tariff would have any impact long term on China plus one. and also the concerns with respect to H-1B and other noises coming from United States on even the services sector. So these were the question marks that people had, and also I think we had specific sector, specific concerns on IT sector, etc. in India. So there are multiple factors. I am confident that over time this divergence between the two will close, with the markets kind of recognizing that the India story hasn't been derailed because of these developments. That is how I see the divergence closing.
Speaking of global developments, Mr. Nageshwaran, and I want to understand from you if, how you're seeing this business about a new Fed chief in place and the possibility of now the Fed's balance sheet shrinking or being cut. We've already seen a significant amount of volatility in the commodities market on account of that. What do you foresee as a result of some of these developments as and when they do take shape? Because we still haven't seen the change or the changeover, and there's a question mark even on the changeover itself. But the likelihood of a taper tantrum, is that a significantly high possibility at this point in time?
A very fast set of questions, Shireen, but the range of questions, the number of questions we have is so wide that any answer I attempt to give will be very speculative in nature. Because we know from his previous writings, etc., that Mr. Vash had a different view on quantitative easing, ultra-low interest rates, etc. But he and all of us are facing a very different environment and a very different relationship between the executive and the central bank, etc. So I think it will be premature to speculate on what stance would Mr. Vash adopt, etc., and what kind of implications would it have on the dollar. Right now, I think the markets have reacted to his appointment based on what they recall from his writings post 2008 in 2011-12 period. But we simply have to wait it out. There is no point in, because there are multiple pathways to speculate on.
No, absolutely a fair point that you make there. But how do you read into the implications of this new world order or this new world disorder, depending on how you see it? What could the implications be in the near term?
So the problem is not that there is a new world order. What we know for sure is that the old way of looking at the world or functioning has been disrupted, and a new one is yet to emerge. That is why the entire set of confusion and uncertainties, because we are in this interregnum between two world orders. My suspicion is that this will continue for quite some time. So that is, in other words, while we often say that change is the only constant or the only certainty is uncertainty, I think that is what will be with us, not just for 2026, but for a few years before we are able to settle on a new order, whatever that might be. But I think we have to accept the fact that the so-called interregnum will not be as short-lived as we would like it to be.
If it's not going to be as short-lived as it's likely to be, and I think the budget in a way sets out the framework of the choices that India will need to make, some of the choices that you spoke about in the economic survey as well, the sectors that we will need to fortify, so to speak. In your assessment, how ready are we today to face some of those challenges?
So there is no yes or no answer to that. We are getting ready in many ways, and to some extent the budget pushes that agenda or progress in getting ready to face this world forward in quite a few ways. Whether it is in the rare earth corridor matter, whether it is in trying to achieve certain self-sufficiency in key areas, including medicines, chemicals, and then giving exemptions for capital goods involved in the nuclear power generation, etc. If you think about it that way, these are all in line with what we wrote about in chapter 16 of the economic survey, where we said you have to look at the scope for indigenization or self-sufficiency in a 2x2 matrix between feasibility and desirability or necessity. That is exactly the kind of approach that the budget has taken. So it is not a question of saying country A is ready and country B is not ready, but I think it is a process. And I think what the budget signals unmistakably is that we are well cognizant of the need to undertake this process and the journey, given the state of potential disruptions to supply chain, either due to logistics difficulties or as conscious choices made by nations, etc. That therefore this budget is a sort of a advanced preparation exercise for that.
You know, and just to take that forward, I'm trying to understand if there has also been a shift, a nuanced shift in the way that the government is trying to address the issue of how the private sector is going to deal with some of this. I think the government, and you've been pretty vocal about it as well, has done the heavy lifting when it comes to public capex. The government has put corporate tax breaks on the table. It's put PLI incentives on the table, and plenty more. But the ask is from the industry is more R&D subs, for instance, which the government has stayed away from. Is there now an increasing understanding or an acknowledgement within government that incentives per se or incentives by themselves cannot get industry to invest more in setting up fresh capacity and so on and so forth? That is to be done by demand. And so by giving more incentives, you may not necessarily get private capex moving.
Don't think this is articulated in that fashion quite as you put it. But nonetheless, you are right broadly that the reduction in the corporate taxes in 2019, along with the choice given to them to shift to a lower rate with fewer exemptions, and the fact that we have already implemented the suggestions with respect to the Anusandhan National Research Fund and the Research and Development Innovation Fund, spanning the TRL level entirely from 1 to 9. So there have been a lot of action on the part of the government in putting the money where its mouth is, so to speak. And if you look at the corporate sector's profitability recovery post-COVID from the lows of the second decade has been very impressive. So it is not for lack of resources. And the more important thing, again, taking the cue from what you said, ultimately corporates invest on the basis of demand, and therefore the direct tax relief last year, a substantial one, and the indirect tax relief later in the year, they are attempts on the part of the government to ensure that policy is doing whatever it can to create that demand certainty. So to an extent, I understand that the private sector is concerned about the global uncertainties, supply chain disruptions, competition coming from another country which is suffering from very weak domestic demand, and therefore substituting that with external demand by exporting. And therefore, how profitable will my investment be if I create domestic capacities, etc., is a valid question. However, what I see from bottom-up data is that in 24-25 financial year, the corporate sector's investment performance wasn't particularly bad. I think 23-24 was a disappointing year. I think my analysis based on bottom-up data will be borne out when we see the full year disaggregated data coming from MOSPI later in February. So there are some legitimate concerns and questions that the corporate sector has, but we have to appreciate the fact that we are living in a country with a 60+% private consumption ratio as a percentage of GDP. And the more we postpone these investments, the questions become bigger and more pressing rather than going away, especially since I said these question marks will be with us for a few years. They're not going to dissipate. I think the corporate sector has to say that sometimes the answers to these questions will be found when we actually confront them, not by ducking them.
Not by ducking them. Do you believe that they're still on the fence? Do you get enough evidence to suggest that they're stepping out of the fence?
No, it is not purely with respect to the investment I'm talking about, because that, as I said, 24-25 data was actually pretty decent from what I can see. When I talk about confronting the question, is about taking the steps to establishing long-term competitiveness of India, and other countries which have gotten to where they are did not do so in a few years. It was a marathon exercise. We have been ducking it for quite some time, relying on protection and a vast domestic market. Ultimately, you can't shield yourself from external competition for too long. And I think, in a way, I welcome the recent global developments because they are making us confront these issues. We now have to focus on productivity and the private sector commitment to R&D, quality and innovation, and be able to compete in the world. Otherwise, we will be forever lamenting about about a weak currency, high cost of capital, etc. And that is what the economic survey focuses on. If you read the chapter on fiscal matters and external sector, if you want to achieve a meaningful reduction in cost of capital, if you want strong and stable currency, the answers lie in manufacturing excellence, manufacturing competitiveness, and achieving external sector surplus. Without that, we are not going to get these two aspirations that we have.
No, and that's exactly right, and that's where I want to take the conversation on manufacturing specifically. While the budget did address many of the sectors that we need to, let me also welcome the Defense Secretary, Mr. Singh. Thank you very much for joining us here. We will get to you. The defense sector got a very big allocation in the budget, but we'll get to you with all of those questions in just a second. But let's address the manufacturing question, sir. Still at about 17% of GDP, the aspirational number of 25%, I mean, it's been over 2 decades that we've been talking about that. Again, what is timing the sort of big shift or the big push that we expected to happen on the manufacturing side? And do you believe that we're now getting closer to being able to at least get to that 20%?
No, I think, first of all, that being a ratio, it's important to understand that doesn't mean the numerator is not growing.
Sure.
Right?
Fair enough.
Let's be very clear.
Fair enough, yeah.
If the ratio stays constant, and we know that it is growing in line with the nominal GDP, which is about double digits growth. So I think we are growing the manufacturing, but if you look at including whatever we have done on defense capex, or for that matter with announcing the seven high-speed corridors, or announcing a second electronic component manufacturing mission. So you name it, and also biopharma and chemicals in all of this. And more importantly, one of the things we need to do to make manufacturing profitable is to reduce input cost, which is what the exemption from basic custom duty in several areas attempts to do. And then I will also like to bring in something which has been happening outside the budget, which is that the new power sector amendment bill is talking about ending cross-subsidization by the industry of corporate and farming sector power subsidies. So that is another important input cost. So if we are able to end the cross-subsidization by the industry of power consumption by households on the farming sector, that will also mean lower cost of capital, contributing to manufacturing competitiveness. So I think what has happened in this since the time we pronounced our aspiration to have a 25% share of GDP coming from manufacturing is the collapse in the real estate sector in China and the massive emphasis on external sector-led growth, which obviously has cast a huge shadow not just on India, but in fact more than on India. It has cast a shadow on several other Southeast Asian countries, etc., on their manufacturing sector. So considering how they are coping or struggling with it, I think we are doing far better in relative terms. That is something which we need to acknowledge.
Okay, let's also address the wage issue, CA, and that is something that, of course, you've been publicly speaking about as well. You believe that the private sector, corporate India, needs to do much better when it comes to wage growth, especially given the fact that they have had significant periods of strong profit growth. Now, how do you see that, and how important and significant is that going to be in this quest for nation building that you've talked about in your survey as well?
So, frankly, in some sense, the Labour Code notification will, I believe, move the needle forward on this matter, on restoring a sort of fair share of wages, so that ultimately that is also a very important contribution to consumption growth and demand visibility for the corporate sector itself. It's about choosing the relevant horizon for optimizing one's profits. That's what I put it that way. So it's not inconsistent with the industry's own goals and preferences itself. But I believe that the Labour Code will definitely make a difference to that agenda. And I think, of course, the attitude to work itself is undergoing a change in the household sector itself, with a lot of people preferring flexible hours and flexible arrangements, entrepreneurship. Ultimately, it's about making sure that the economy, whether through entrepreneurship or through employment, provides enough livelihood returns for households. Whether it comes in the form of wages or entrepreneurial returns is a matter of choice.
Speaking of entrepreneurial, sir, you talk about the fact that industry needs to get more competitive and the state needs to get entrepreneurial. Where do you believe the state has made the most significant gains in adopting a more entrepreneurial mindset, and where do you believe it still needs more work to be done?
We can be here for 2 more days discussing this, okay? So I think, by the way, quite a few people misunderstood the phrase entrepreneurial state. It isn't the case that I want the state to get into commercial sector.
No, absolutely, absolutely.
Yeah. So it was more about a particular mindset.
Yeah.
And I think some of the reform measures that have happened over the last 6 to 8 months in particular, I think the state is moving towards an entrepreneurial mindset, particularly with respect to the deregulation agenda in Indian states, which we have covered extensively in part 2 of the chapter 16. I think that is a very concrete manifestation of what we wrote about in terms of entrepreneurial mindset. And we also given an example from the software sector in the 80s, how bureaucrats at that time, actually one particular quote that I really liked from Mr. Seshagiri Rao, the electronic secretary at that time, he said, "We broke as many rules as we created them," or even more. That is coming from a bureaucrat. In order to create the software industry to rise, they ended up having to break many of their own rules to be able to do this. And that is the kind of mindset that is required. But to be fair to the bureaucracy also, you need a corresponding shift in the mindset of so-called auditing and compliance agencies to see some of these things in an ex post manner, more as a normal, legitimate judgment calls taken by the bureaucracy, and not assume malafide in some of the calls if they happen to not materialize in the right way. So that's also required. Both have to complement each other. If those things don't change, then one can't blame the bureaucracy for remaining cautious.
Fair point. As you said, we could be here for 2 days and have this discussion and the debate. But, you mentioned the software industry, sir, and the fact that the government in many ways allowed this industry to bloom and blossom, and today it is one of our largest exporters. Do you believe what the government and the budget has done this time around with this 20-plus year tax-free period for AI data centers is almost akin to the STPI scheme?
That is one example, definitely. Even the semiconductor mission 1 and 2 are examples of that. And I would include the high-speed train corridors on the east-west freight corridors. All of them are as examples of long-term thinking. So it isn't only in the AI data center case that I would consider this as an example of government emulating what we did on the software sector. There are multiple examples in the budget which are in alignment with that kind of mindset we saw back in the 80s.
You talked about AI, sir, and it was mentioned in your budget, in your survey last year, and of course it found its place in the survey this year as well. The threat of disrupting the labor market, the threat of job losses and so on and so forth, you believe that at this point in time, that threat in the Indian context is exaggerated?
I think whether in the Indian context or in the global context, it is still early days. We are still unfolding. I mean, the labor market impact of AI is still unfolding. That is why the budget actually identifies 4 areas where skilling can happen independent of AI, and which gives our youth an opportunity other than AI-related skills, whether it is allied health sector, care economy, the tourist guides, the orange economy. All these are all about creating employment opportunities in areas where human skills will be needed. So I think we have to approach this in 2 ways. One is to create a workforce that can work with the AI, and to create parallel opportunities in areas where AI will not be making a dent or will not pose a threat to labor force. That is how we are approaching this. But still, I would say, whether it is in the case of India or the world, it is still very early days to gauge whether it is going to be labor complementing or labor displacing. We are still in early days.
In early days. CA, let me end by asking you then whether you are concerned, and how concerned you would be, if at all, about the wealth migration that we're seeing. High net worth individuals leaving India or taking residency out of India. And we've seen that number go up quite significantly in the last few years. Does that worry you?
On balance, no. I think first of all, we have to put these numbers in perspective because the size of the economy also has been growing. In many matters, we look at these things for example, manufacturing, we look at it as a ratio. So here also we should look at the ratio of this wealth going out in comparison to the wealth that is being created in the country. And some of it comes back in the form of investments also. And second, we need to see this from the perspective of what's happening to wealth migration from other countries as well. And I think over time, if we are able to continue to deliver the kind of growth rates we have delivered post-COVID, I don't see this phenomena as being enduring, but more fleeting.
Okay, more fleeting. Finally, a quick check on the growth pulse, 6.8 to 7.2. That's the estimate that you've held out. Many that we've been speaking to in the market believe that the government has in fact been conservative as far as its tax estimates are concerned. And I know that you believe that you could perhaps also do better on the tax front and the growth front as well, perhaps?
Yeah. So on the growth front, I think if there is a resolution, speedier resolution on the tariff situation, I would say then the growth estimate will have a more upside risk than downside risk. As far as the tax estimates are concerned, only because of the indirect taxes, GST, because compensation cess has gone away, the overall buoyancy ratio appears to be on the lower side. But if you look at the direct tax buoyancy rate, it's 1.1 or 1.14 times, which is in line with long-term average. So we are realistic, neither extremely conservative nor overly optimistic.
Okay, well balanced, like the budget. Chief Economic Advisor Anantha Nageshwaran, many thanks for joining us here on the CNBC TV 18 Budget Verdict, for highlighting for us why this budget will make a dent as far as India's aspiration to move up the value chain across many sectors. We will take a break, ladies and gentlemen, but don't go anywhere. We've got the Defense Secretary in conversation with my colleague Parikshit Luthra coming up. Remember, 21% higher allocation for the defense sector. It has been the sector in focus for Budget 2026. That coming up for you after this very short break.
All right, welcome to our Budget Verdict 2026. It's time now for the conversation that all of you have been waiting for. The defense capex, how Budget 2026 paves the way for Atmanirbharta and solid self-reliance in the defense sector, with an eye on more local defense manufacturing and greater exports. And who better to talk about it all than the Secretary of Defense, Mr. R.K. Singh. Sir, thank you so much for being with us. So, yes, the defense capex has got an all-time high allocation, a 21% increase overall, 24% specifically for defense modernization. Could you give our audience a sense as to what will be the sectors or focus areas when it comes to utilizing this capex?
Well, Parikshit, first of all, thank you for having me here. This is the third time running that I'm coming to this program. The first time was when I was in DPIIT. The last two, of course, as a Defense Secretary. You are right. I mean, we've asked for a increase in our capex budget in particular by about 20%, and the Finance Ministry, because of the better utilization that we were able to show over the last 2 years, because of the fact that we did record number of contract signings in the last 2 years, we were able to prevail upon them, also in the context of the prevailing geopolitical flux that you see around us, including in our neighborhood. They were good enough to concede to our request, and they've given us a 21% increase in our overall capex budget and a 24% increase in the modernization budget. Now, where that will go is a matter of detailing. We have to work with the services, but there's a lot of stuff that is already in the pipeline in terms of committed liabilities, the things we signed up in the last few years, like the Rafael Marine, the Predator drones. All of those will start coming over the next 2 to 3 years, and various milestone payments will be made. But there will be some fairly large, big-ticket items in areas like drones and counter-drones, in terms of ensuring that our depleting fighter fleet strength is adequately replenished. All of it with the intention that we leverage our buying power to ensure that the bulk of what we procure also gets made in India.
Right. Sir, there was a major allocation. In fact, the largest allocation, around 64,000 crores, was for defense aircraft and aero engines. Could you give us a sense what's in the pipeline?
Well, I mean, it's not a secret that we are working out modalities for doing a co-development of a jet engine with an international engine house. That process is on. Since it'll go to the highest levels in government, I can't give you a sort of timeline of when it will happen, but it's going to happen. We also have significant proposals for increasing the strength of our underwater fleet for our the submarine fleet for the Navy, as well as medium-role fighter aircraft for the Indian Air Force. The timelines, the milestones, etc., I'm not going to tell you because that is really preempting the decisions that are to be taken at higher levels than mine. But yes, all of those are happening. And of course, we are also going through with some emergency procurements that we started last year, but for which the payments will become due this year. So with that combination of procurements, we expect to ensure that this enhanced budgetary outlay is fully utilized during the course of the next financial year.
Right. When you speak about aero engines, are we talking about the deal with Safran?
That's right, yes.
And by when do you expect this to be announced? And
I told you that I can't give you timelines, but I can tell you that we are moving the proposal, and hopefully it'll, get clear. But I can't preempt the decision at the highest levels in government.
All right. There has been a lot of reportage on how the Defense Procurement Board has cleared the deal for 114 Rafale fighter jets. This was a proposal from the Indian Air Force. Could you give us a sense where this is right now?
So I'll give you a theoretical answer that the process involves the DPB, then the DAC, and then if it is above 3,000 crores, it goes to the highest level in government, which is the cabinet. So the first step has been done, as you correctly mentioned. The next two steps will take place over the next few months. But again, I'm not going to give you specific timelines. That's not going to be the headline for you because, again, I don't want to preempt the decision-making of levels in government that are higher than, me alone.
Right. And of course, everyone in the audience possibly knows that Secretary of Defense also had chaired a committee which prepared a report on how to plug the gaps in the preparedness of the Air Force. I'd also like to ask you, sir, that when it comes to fifth generation fighter jets and AMCA, let me begin by asking about the AMCA program. There have bids which have come in from different bidders, including an HAL-led consortium. Could you give us a sense of how that program is moving and when we could possibly have some clarity?
Yes, sure. But before that, let me talk about the committee and the gaps as far as the Air Force are concerned. I think there were 3-4 major gaps. One was, of course, the overall strength and the numbers, even of the 4.5 generation fighter aircraft, given the delays with the LCA. Other one was the absence of adequate numbers of refuelers and AWACS aircraft. Now, for all of these three, the procurement cycle is well underway. For the refuelers, we are down to the last stage of negotiating costs. For the AWACS, again, the similar thing. We are well underway in terms of finalizing those procurements. And finally, MRFA, we just spoke about. Regarding the other issue that you mentioned about the AMCA, we were pleasantly surprised by the very robust private sector response to that tender. I think 7 consortia of very credible private sector companies bid for it. We've done the initial, the pre-qualification. I think there are 3 remaining. And that will go to the Raksha Mantri soon. And thereafter, you can expect the RFP to be issued to all 3 of these companies for giving their cost bids for production of 5 prototypes of this AMCA aircraft. So I would say that we should get this finalized in about 3 months' time, hopefully.
And then the contract would be awarded.
That's right, yes. Then it will go to the L1 bidder among those 3.
And it's a 10-year roadmap for the first prototypes?
No, the first prototypes is only about 3 to 5 years, about 3 to 4 years. But the production, of course, will take about 10 years, yes.
Right. I think the audience would love to know that what were the lessons from Operation Sindoor which you have tried to bring into the union budget from the point of view of defense capex?
I think it brought home to us in sort of slightly closer terms as compared to sort of, say, watching the war in Ukraine, that what are the sort of evolving nature of warfare, the requirement for more of standoff precision weapons, of air power, of the use of drones and counter-drone systems. And as a result, we've obviously had to combine some immediate buys through our emergency procurement, which we ask the services to do immediately. And thereafter, in the course of the next few months, you will see a lot of fast-track buys of other areas where capability enhancement was required.
Right. Also to ask you about emergency procurements, you have mentioned that some of this allocation will go towards emergency procurements, but what can the private sector, the public sector, and the defense industry expect? What will be the focus of your emergency procurements in terms of arms, ammunition in the coming months?
So, Parikshit, actually the private sector already knows, because those contracts have already been signed. The 15% of our last year's budget, which was earmarked for emergency procurement, we had given the services a 6-month period to sign the contracts. Those contracts have all been signed already. So I would imagine the players who got those orders are already in the know and are working hard on getting these. Both the OEMs and the component manufacturers must be already at it in terms, because the timeline is very strict there, that within 1 year the delivery has to take place. So, that is not really an issue. The private sector is fully aware, and the contracts are already signed the last of them were signed by January 15th, about 15, 20 days back.
Okay. Now, when it comes to the total defense expenditure as a percentage of GDP, now this budget, this defense budget takes it to about 2%. We've been hearing experts across the spectrum who say that it's possibly time for India to have a defense spending to the tune of 2.5% to 3%. What is your aspiration? You've made recommendations to the Finance Commission. Ideally, where should we be and by when do you want to reach?
So for the current year, I requested for a 20% increase in the capex budget, which of course we have got. In fact, we've got a bit more. Before the Finance Commission, if my memory is right, I think I asked for a CAGR of about 19%, so that over a 5-year period, we end up with close to 2.5% of the GDP. That was my aspiration. The government will take a call on that. But let me remind you that because we are growing at about nominal terms at about 10% in our GDP every year, we have a bit of fiscal headroom to ensure that at least 10% growth rate we can certainly give to the defense forces. I'm aspiring for a bit more, closer to, as I said, about 15 to 20%, primarily to ensure that this declining share of defense expenditure in our GDP, which has been reversed by this budget, gets further sort of enhanced over time to about 2.5%, as you mentioned.
Right. So that should happen in the next 2 to 3 years, sir?
5 years. 5 years is what I was mentioning.
All right. I would like to ask you about certain big picture items in terms of total defense production for FY26, total exports. What are certain targets or estimates you have in mind currently?
I think 26, 27, we are looking at taking our exports from about 25,000 crores to at least 30,000 crores. And for the entire value of domestic production to about 2,25,000 crores from around 1,52,000 crores in the current financial year. So yeah, and that is broadly the fairly large jumps in both is what we envisage, and I wouldn't be surprised if we overshoot these figures.
Right. You've outlined certain priorities in terms of getting unmanned aerial vehicles, combat drones as well, and those were some of the lessons from Operation Sindoor. Apart from aircraft, apart from aero engines, what's going to be the big modernization theme, and how are you going to drive the indigenization story? Are we going to see more positive indigenization lists?
Well, one way we drive it is by simply fixing a normative figure that 75% of our capex will be spent in Indian rupees, which is within the country. We've achieved that last year. In fact, I think we achieved close to 87% domestic expenditure. The current year, we'll hopefully be able to overachieve that again. In terms of where the money will go, I mean, the Honorable Prime Minister announced a major new mission, which is basically a combination of air defense and offense, called the Sudarshan Chakra mission. So you can expect to start seeing some of those contours of that mission in the future. That will be fairly expensive. Other countries are trying something similar, the Israelis, the Americans. So we'll be working on that, making that mission into reality by building some of the building blocks that are already available and then adding various other additional layers on top of that. So that combined with, we have fairly large procurement programs for combat UAVs. The RFP is already out, and we've had a very robust response again from some 24 odd firms, which is quite remarkable. I'm sure all of them are not that serious, but hopefully at least 7, 8 of them are really serious players. So yeah, then we have these Predator drones that are going to come in the next 2 years or so. So yeah, all of that will, will ensure that we spend the money that has been allocated for us. We signed contracts of 2,10,000 crores 2,09,000 crores last year, which was a record, an all-time record. And this year, in the current financial year, up to December, we've already done about 2,10,000 crores. So we'll certainly go beyond 2.5 lakh crores. So yeah, I mean, things are moving, and we want to make the defense industry hum in this country.
Right. We're negotiating a trade deal with the United States, but at the same time, other aspects of the relationship, such as renewing the trade deal, that has happened and that has remained on track. But how have the trade volatilities with the United States impacted our defense choices vis-a-vis our traditional partners, such as Russia for that matter? And how has that really changed our Atmanirbharta strategy?
So the trade vicissitudes are a kind of a validation of Honorable Prime Minister's vision of Atmanirbharta, that we should secure our supply chains much better, and which is why I mentioned that 75% figure and all the rest of it. But if you're saying that whether the trade talks have had adverse spillover effect on our defense relationship with the US? I would say no. On the contrary, we've continued to have a very stable, very strong relationship with them in terms of exercises, in terms of signing this new 10-year defense cooperation framework, and even some of those procurement elements which you will get to know in due course of time, where we are continuing to sort of engage with them, and you will see some of those contracts getting signed as well. So it's not I don't think there's any major blowback as far as the defense partnership with US is concerned in terms of a spillover from the trade talks that are ongoing.
Right. About the DAP review, this has been on for some time. Could you give us a sense when the defense acquisition procedure, the revised procedure, will be put out and effective?
So I want to emphasize that even within the existing DAP, we've been sort of trying to ensure that, I mentioned the record contracts that we signed, that we move faster and get things done more quickly, irrespective of the procedure. But there are some elements of that old DAP handbook which require revision, particularly given the lessons learned in terms of low cost, the need to sort of ensure that the technology cycle, which is very short, doesn't create a situation where your procurement cycle is done in such a way that the product is sort of obsolescent by the time you buy it. So that process, the DAP review, is in its final stages. We intend to put it out in the public domain in about a week's time. And thereafter, this is the final round of public consultations. After that, we'll finalize it, hopefully before the end of this financial year.
Defense Secretary, in terms of the big reform push, 2025 was a year of reforms. How would you describe priorities in 2026? And what would be your expectation from the industry as to what the country needs right now? We call it the year of reforms, but the reform agenda is not changed. As I mentioned, the DAP review will take place, and that will be a fairly, major, game-changing kind of a reform. Ultimately, your procurement, because government is a single buyer, ultimately it is the government which can set the tone for the industry. And the intent is to ensure that the public and the private sector are actually given a level playing field. Both can sort of work on merits, that DRDO's technologies are leveraged equally by the private sector through the development production partnerships that have now started seeing results in terms of large-size contracts being awarded. So this entire combination of reforms is intended to make sure that we end up with a technologically advanced and diversified industrial base in this country, a hybrid production pipeline of both public and private sector. Two quick questions and wrapping, sir. Mazgaon Dock Limited and Thyssen Group were identified to build 6 advanced submarines as part of the P-75I program. When is that likely to possibly see the light?
So you keep trying to sort of get timelines out of me, which I can't give you because I can't preempt decision-making at levels above mine, but we are working on the cost negotiations right now. So after that, in due course, it will happen.
Right. And my final question to you would be, we have seen tensions with Pakistan in 2025, and Operation Sindoor continues to be a lesson for India in terms of preparing itself for future warfare. How do you see our preparedness on both our borders, be it Pakistan, be it China? How are we preparing ourselves for the future?
Well, the way to prepare is to create enough deterrent capacity, hopefully asymmetry against a much smaller neighbor whose GDP is 1/10 of yours, and sufficient deterrent capacity against adversary whose GDP is about 4 times yours. So both those, that requires, as I mentioned earlier, enough capex to support a large, growing, diverse, agile defense industrial base comprising a robust public and a robust private sector, and that is what we are really...
Secretary of Defense, thank you so much for joining us here at our budget verdict, giving us a clear indication of where you want to take the defense industry and India's priorities as well. Thank you.
Thank you.
Welcome back to the CNBC TV 18 budget verdict. We are now at our finale. We've been bringing you the budget architects, the policymakers who are shaping India's economic policy to explain to us what the road ahead looks like. And to cap things off, we have with us the Financial Services Secretary, Mr. Nagaraju, and the Secretary of MeitY, Mr. S. Krishnan. Gentlemen, thank you very much for joining us. May I request you to please take the hot seat, so to speak, before we get started. Ladies and gentlemen, a big round of applause for Mr. Nagaraju and Mr. Krishnan. Joining us here live at the CNBC TV 18 budget verdict. Thank you very much to our audience on TV, to our audience on YouTube, and to our participants here who are joining us live for the budget verdict. Without further ado, Mr. Krishnan, let me start by asking you, sir, lots for you to do, courtesy the union budget. Let's get started with Semicon 2.0. Semicon 176,000 crore rupees, that was the budgetary allocation. Of course, an allocation has not been provided for in the budget just yet. Lay out for us what Semicon 1 has been able to achieve in terms of milestones, but more importantly, what should we expect now for Semicon 2?
I think Semicon 1 has laid the foundations of a semiconductor manufacturing industry in India very firmly. We have 10 units which are already approved and possibly 2 or 3 more before we completely close the scheme. The first of those schemes, first of those projects should commence full commercial production in a matter of weeks or months. And before, in a few months' time, we should have about 4 of those projects which would be fully grounded and in production. And the remaining would come in the next year or so. So I think that represents a huge and significant step forward. We would have a fab, a full-fledged CMOS fab of our own, a silicon fab, and in addition, a compound semiconductor fab also of our own, and 8 other units who are packaging units in a range of technologies, some of them more advanced, some of them more conventional and legacy. It gives us a whole range of technologies to work with. So I think it's a very, very sound base which has been laid. In addition, we have also laid the base for 24 units which we have approved for under the DLI scheme, under the Development Linked Incentive Scheme, where semiconductor design is the main thing. And 14 out of those 24 have also received funding from VC funds and others to go forward. So I think there's been significant forward movement there. And the modernization of the semiconductor laboratory in Mohali, which was another component of the scheme, will also get underway shortly. So all this means that we have successfully completed the first phase, putting us...
utilized all of the money? And utilized all of the money?
Committed all of the money. Committed all of the money. Utilization will take time because the build-out will take longer. So we've committed practically the entire amount allocated for this purpose. So we move on to Semicon 2, which again, the focus on getting in more fabs and packaging units will be there, but there will be an added emphasis on advanced packaging. That is one part. But more than that, I think what we would be focusing on is bringing in the entire ecosystem, that is manufacture and the equipment manufacturers, manufacture of equipment in India for semiconductors, both for units in India and to export elsewhere in the world. The materials, gases, chemicals, all of those which are used in semiconductor manufacture, all of that, plus a substantially revamped and enhanced version of the development-linked incentive scheme so that we are able to develop semiconductors in a number of crucial areas which are important for India as a country. And we are able to have our own products in the semiconductor space which would truly enhance capability of the country and insulate you against, from a sovereign perspective, give us that necessary strategic autonomy that we need.
So if Semicon 1 was 76,000 crores, what will Semicon 2 be?
You will know.
How much of an escalation are you hoping for or asking for, sir?
what we ask for is immaterial. Decision making in government.
What you get is
what we get is what is material, and that is a process, and we will get that done. Yeah.
Okay, you'll get that done. I'll come back to you in a second, but let me get the Financial Services Secretary, Mr. Nagaraju, into the conversation as well. Mr. Nagaraju, I know you will say that the terms of reference of the committee that the Finance Minister has announced have not been formulated just yet. But broadly, sir, if you can take us through the 2 or 3 key priorities that the government must address by way of this committee when we talk about re-architecturing India's financial sector.
Thank you. The proposed committee is Committee for Viksit Bharat, Banking Committee for Viksit Bharat. Let me give you some numbers. I might have mentioned, the bank rate to non-financial sector is about 56% to the GDP. We are one of the lowest in the world. And we can actually, many countries are above 150%. Now, that's one. The second challenge is we have between 300 to 350 million people who are not credit linked. They are financial inclusion we have achieved by opening the bank account, but credit inclusion we have not. They are credit deprived.
Okay.
2. Now, there are few issues are around. One is, of course, the regulatory requirements of capital. Can we do something about how the capital, how much capital can have ratios, reserve, and how do we hold that capital, and then how do we look at the banking scenario? We have the scheduled commercial banks and small finance banks, and we have cooperative banks, of course, rural banks. All kinds of banks we have. So what kind of banks we require going forward 2047? I think many of us know, not a single Indian bank is, I think, in the list of top 40 banks. I think so a country, we are likely to take over, to become 3rd largest economy in the world in a short period of time. We don't have a
bank in the top 10.
Bank in the top 10. Top 10, leave the top 10, top 20.
Yeah.
So that is one. How do we do it? So we wanted this expert committee to look at what kind of regulatory policy ecosystem we need to build so that the adequate bank credit flows to the country, which can help India become developed by 2047.
Okay. So, that's an important aspect that you brought up there. And let me understand from you, when you talk about regulatory ratios, so do you believe that the current system, the current requirements, the current buffers may perhaps be onerous, that requires a review? Do you believe there needs to be more flexibility? What's the thinking there on what needs to be done as far as the regulatory ratios are concerned?
Yeah, these ratios were fixed a long time ago. And the things have changed now. They were aftermath of this, the financial crisis. Now, there are better ways of deploying capital.
Okay.
And there are better ways of asking the capital to be held in different instruments. Now, all these things are possibilities which the committee could actually look at.
Okay, so that's an important one, because this was not something that we got from the Finance Minister. You've given us a little bit more color there on what the committee will do. Outside of that, the big question that everyone's asking, and I know I've been trying to push you on that, is it also going to look at consolidation of public sector banks in the attempt to make 1 large or 2 large public sector banks that could then be in the top 20?
No, see, we have not yet finalized the terms of reference, as you have
I already said that at the start, sir.
Previously referred. Possibly it could include anything. This is the banking. We are talking about the banking for Viksit Bharat 2047. The banking includes everything. I don't think anything is off the table.
Okay.
The committee, when they form and the TU are finalized, they can actually take on anything they want to recommend. And in any case,
would you like them to take this up?
By the time we don't know. See, in any case, the government has the ultimate decision-making power to accept or not. But they can consider anything relating to the banking.
Okay, I'll come back with more questions on banking, the future and the present in a second. But Mr. Krishnan, let me come back to you, and let me also get my colleague Ashmit, who's tracking the sector that Mr. Krishnan looks at very closely. But Mr. Krishnan, you know, the other significant announcements that came in from the budget was this, which nobody believes, this 20-plus year tax holiday as far as the AI data centers are concerned. And people don't believe the fact, because it's too good to be true, that, you know, you're actually being given a 20-year tax holiday in that sense. If you can explain to us how quickly you believe that this is going to actually translate into action on the ground, and whether this could perhaps be, and I was asking the CA this as well, because he brought up the STPI example as an example of the entrepreneurial mindset of the state, whether this is such an example of being able to create an industry like we did with the software export industry 3 decades ago in India.
See, I think as far as the data center initiative is concerned, you have to look at it in 2 ways. There are 2 or 3 paras there. It's not just one paragraph. The idea we work on always is that we don't export taxes, right? I mean, that is a basic economic premise that we work on. So for data centers which are intended for storing data for customers overseas, sending it back, and with no connection within India, and it's a complete transaction which is related to that. It's an export-oriented business, literally, and that is the reason why it does not suffer taxation. So that is the simple logic there. And so I don't think we should worry too much about the duration of how long that is.
No, nobody's worried, sir. They're in fact very happy that you've given a 20-year period. No one's worried at all. They're celebrating.
I don't think. I mean,
in fact,
I think it is a treatment in tune with economic principles that you don't export taxes. Now, whatever business that they would do within the country would have to be done through a resident entity. Correct. So that the idea is that that would be transactions which happen within the country, services provided within the country, and which, for a level playing field, everyone has to have the same level of taxation for that. So I think that is the clarity that is really needed in this particular case, that we are following a principle, and it's also in tune with what the Revenue Department and the CBDT normally follow, which is that we don't like to exempt, or we don't like to create a class of people who claim that they don't want to be permanent entities in India and completely escape taxation. So the idea is that entities will be permanent establishments here in India, right, but will not suffer tax, because the principle is that tax is not to be exported. That is the philosophy behind this.
Fair enough. Ashmit?
Thanks for that, Shireen. Mr. Krishnan, firstly, thank you so much for joining us. Shireen was pointing out Semicon 2.0. She made a reference to the tax holiday for data centers. We heard in the budget about the IT safe harbor protection that has been granted. We also heard about AI going forward. The budget has been kind to you. In lighter vein, did you go back home last night thinking maybe you should have asked for more?
I only felt that it should have been called a technology budget. I think in terms of how it could have been branded, I think there's a lot intended for technology there. And the ministry and the various sectors related to the ministry also put together articulated all their requirements, which many of them were satisfied. So it's not a question of could I have asked for more. There were 1 or 2 things which were left out, which we will go back with. But I think, it's on the whole, the sector and the industry is extremely happy, and they have conveyed their feedback to us as well in terms of what the budget has managed to do. It's not only in terms of allocations. There's, of course, the announcement of the second phase of the India Semiconductor Mission. There is an enhancement of allocation for the electronic component manufacturing scheme, all of which are significant and important to support manufacturing. In addition, all what has been announced in terms of simplification of tax structures and simplification of procedures both for IT, for data centers, and for electronic manufacture. I think all of them are extremely significant in terms of encouraging the digital economy in India and in terms of taking us literally on a technology path, because ultimately, if you want to be a developed nation and if you want to grow fast, a Viksit Bharat by 2047, you have to ride the technology wave. And I think that's what the budget has signaled.
I think that's the one aspect I had missed out, flagging the ECMS increase that we've seen from 22,000 to 40,000 crore rupees. But while we're on the subject of electronics, Mr. Krishnan, I would just want to ask you, just help us decode some of the numbers that we saw. There was, while there have been increase in allocations for the likes of ECMS, the PLI component has seen a downward projection in terms of what the outlay needs to be. Can you help us read those numbers? Does that mean that there will be no perhaps mobile PLI 2.0, or will it be there in a very different form and structure?
I think it does not mean that there will be no more, PLI 2.0 for large-scale electronic manufacture, which is the formal name for the mobile PLI, what is commonly known as mobile PLI. What it means is that we are winding down the first phase, and the allocations next year are primarily intended to pay the bills for the last quarter of the current year. Because up to the third quarter, we would meet within current year's budgetary allocations, and it's only effectively for just about one quarter for most of the big companies, and for the smaller companies, maybe the year's requirement. So that is what we anticipate would be the money we need next year, and that has been fully provided for. The PLI 2.0 scheme is still being, the consultations with the industry are still on, and we will finalize the scheme. And as and when it is finalized, there will be a provision in the budget. I'm fairly confident of that. That was our experience with ECMS. That was our experience with the AI program, with all of them. So I don't think I would worry very much about, whether the provisions are there or not there. We will get them when we are ready to spend the money.
You'll get them when you're ready to spend the money. But Mr. Nagaraju, let's talk about the money, sir. And let's talk about also the future of banking in India in the context of technology. What we have seen is the big move on digital transactions, UPI touching record numbers practically every month, the advancement of many fintechs. Now, as you look at this committee, do you believe that there is also the need for regulators and for this committee to look at the next phase of Indian banking, which could involve licenses to digital banks as well?
Yeah, one thing is you are right to note that increasingly the Indian banks have become much more digital. The journeys, most of the journeys for large number of creditations are through the digital thing. We are UPI, we do almost 50% of the total transactions of the world happens in India. Now, coming to the digital bank, in some of the services of the banks are completely digital now also. Let me put on this. Let's say, suppose you want a retail loan. IDFC will actually sanction you within few minutes. That's how Vaidyanathan has been confirming to me. And similarly, the SBI has confirmed to me that the MSME loans, they actually sanction within 10 minutes. And all my banks, in fact,
They're giving Swiggy and Zomato a run for their money.
But my only caution to them was they ensure that your software engines ensures that underwriting principles they follow, and no compromise on the quality, and ensure the loans are sanctioned.
Ensure that the loans are sanctioned, but you didn't answer my question about digital banks.
No, I'm saying, see, in a different situation, the difference between the completely digital and the traditional banks is actually this is a blurring. Okay, banks increasingly becoming digital. Now I should not praise twice IDFC in a night, but look at the IDFC thing. They have been most of the services they provide online. In fact, digital. Even though they have a large number of branches, but they are digital. Similarly, now some of these small finance banks also digital. And then even the behemoth like SBI.
SBI, yeah.
No, nobody needs to go to the bank branch now. 2.0 provides every service. Yeah. Every service. Now, I think going forward, I think that maybe is only is a semantic difference only.
Okay, a semantic difference only. Mr. Nagaraju, 2025, all of your private sector banks, many of the private sector banks saw many deals happen, including IDFC Bank here with a lot of FDI coming in. Are the public sector banks feeling left out?
No, these deals happen, IDFC happened, fine. But the remaining two are actually led by the public sector.
Yes, in a way.
See, so you can't say these two deals, the biggest deals, happened in the public sector.
Yeah.
So
but to Mr. Krishnan's point about wanting more, have you put forward the recommendation that at least for public sector banks, the FDI limit should now be enhanced?
See, one of the ways of enhancing credit infusion to the society is having the adequate capital with the banks. The one way of public sector banks is whether the government puts in equity, enhances, or the existing equities is diverted. Now, of course, the domestic as well as the foreign. Now, currently we have 20% FDI, FII allowed, and there are discussions on to enhance this. As and when we enhance it, I think
to 49%.
Yeah, whatever is the percentage, and the CNBC will be the first to know.
We will be the first to find out. That I'm sure of. That I'm absolutely sure of. But under active consideration. Okay, Mr. Krishnan, I want to come back to you now, sir. And I think one of the big success stories as far as India's manufacturing sector in the recent years has really been what's happened as far as the mobile manufacturing scheme is concerned. And I want to understand from you, on the back of the lessons learned from that experience, what should we now do to ensure we can replicate and scale that success?
I think, you see, mobile manufacturing has been a true success story, and there are certainly lessons which we have learned from that in terms of first achieving scale, making sure that we achieve scale, and actually locating within India the most labor-intensive part of that process to begin with, which means that it actually generates the kind of jobs, and that makes it truly appealing as well. So those two factors, I think, are very important. The next stage is to deepen the entire value addition within that sector. Also recognize and be strategic that not everything you're going to localize. You're going to localize those elements which are crucial to retaining a grip on the industry in the days to come and making sure you build that ecosystem, while recognizing that these are global value chains and certain things, some things you will not necessarily manufacture in the country and you will rely on global supply chains. What you will need to build resilience is a diversified supply chain to make sure that you have it from multiple sources. These are all, I think, important lessons, whether we are talking about IT hardware in the future, whether you're talking about other forms of electronic manufacture for various other goods, because practically everything that we consume today has some element of electronics in it. For all of those, I think these would be important lessons. The same could also be true eventually in other sectors of the economy, if you're talking about, auto components, if you're talking about a whole host of other manufactured products. But I think the critical point is that you have to achieve scale. Because without scale, it's very difficult to localize supply chains and also to sort of actually grow to an extent. And to also have the kind of impact in terms of the employment impact that electronic manufacturers managed to create so far.
I just want to labor on that point, Mr. Krishnan, as far as electronics and especially smartphone manufacturing is concerned. When this scheme was first envisioned, there was talk of how we would want global champions as well as national champions. Now we've realized scale as well. We're exporting, we're largest manufacturers of third largest, please correct me if I'm wrong, third largest manufacturer of smartphones. What I want to ask you is that, having traveled the distance that we have, what is the missing ingredient for having a national champion? We don't have national companies, Indian companies that are competing with the Apples and the Samsungs of the world.
I think one of the, number one, we are the second largest manufacturer of mobile.
I stand corrected.
So let me sort of correct the record there. But I think one of the critical things which we need is a national champion, is a national brand more than anything else. I think one of the key aims of MeitY is that we need more product companies, and we need more product companies not just in electronics itself or mobile phones, but also in software and a range of other products that we create. I think that is something which we certainly need, because that's where the